Okay, welcome back. We've got, 16 minutes to go for the market open and about 2 minutes to go for the pre-open session. Mitesh Thakkar and Shrikant Chauhan are with us with what they'd have you do in terms of specific trades and specific, ideas. Gentlemen, good morning. Great to have both of you here. Strong close, not quite at 24,900, which is what the Nifty got to at one point, kind of fizzled out, but 150 points is not bad at all. Mitesh, what's the trade this morning?
Yeah. Good morning. I think we've been maintaining that the market is still broadly consolidating. In the last 2 days, what has happened is that we've kind of bounced back from the lower end of the range, which is closer to about 24,500. And now somewhere heading towards the middle of the range between 24,500 and 25,050. So still no additional bias. But yes, the hourly indicators, the chart setup has started to improve, which means that good chance that we'll head towards that upper end, which is 24,950, 25,050 zone. And that is where I would want to at least take profits and see if we get a breakout. Then we'll trade the breakout on the upside. So that's the way we are positioned on the Nifty.
Okay, got that. Shrikant, morning to you as well. Morning to Mitesh. Shrikant, what's your approach? Any index trades, Nifty, Bank Nifty?
Good morning, Survi. Good morning, Prashant and everyone. For Nifty, we saw some activity and some recovery yesterday, but the pattern has not yet changed. It is still in the range. It has not crossed the level of 24,900. It has not broken the level of 24,500. But the strategy should be to look for taking some contra bets of going long in case if we see the market is dropping to 24,600 levels. There we can keep a stop loss of 24,500. I am of the view that the way VIX volatility index is falling from the highs, we should look for taking some contra bets of going long. Again, we can keep a target of 24,900. And for Bank Nifty, it is quite interesting. It has spent nearly 30 days below the level of 56,100. I mean to say after hitting the highs, all-time high of 56,100, it has spent nearly 30 days. So on the dismissal of that, we can expect a short covering sort of trend in the market. But till then, it is in the range. But above 56,100 and today, as it's a day of credit policy, we should be very, active in terms of taking trade in the Bank Nifty.
Okay, got it. Hi, gentlemen. Good morning. Shrikant, you go first. Tell us what's the stock on your radar.
See, there are a number of stocks from the metal basket. They are doing well. Hindustan Zinc, also if we consider Hindustan Copper or GMDC, they have crossed their important levels in yesterday's trading session. Specifically, GMDC has crossed its important level at 380 and it closed about the same. From here, the stock can move towards 430.35. And we have seen, we are witnessing good amount of activity in mid cap and small cap companies. So GMDC looks good at current levels around 385, 386 with a target of 420, 430 on the high side. We can keep a stop loss at 375 for the same. And the other stock which we like is from the pharmaceutical basket, and that one is Lupin around 1995. Here we can keep a target of 2,100 and stop loss should be somewhere close to 1950.
Okay, got it. All right, got those stocks. Mitesh, what about you?
Morning, Nigel. I have mix of buy and sell more on the buy side. Persistent System is a buy with a stop at 55.70 for targets of 57.50. Godrej Properties managed to get past this 2300 mark, which it was struggling for the last few days, and there's a mild pivot at 2320. So buy about 2320, keep a stop below 2290. Look for targets in the range of 2380 to about 2400. Britannia is a buy with a stop below 5550 for targets of 5700. And Biocon is the only call on the sell side, which I would recommend selling with a stop at about 336 for targets of 318.
Got it. All right. Thanks a lot for that, gentlemen. We'll come back to you all for your 9-10 call. Siddharth Khemka is still with us. Sid, what about Bharti Hexacom? You know, that stock, I think in the last 3 or 4 months, it's up 35% if I remember correctly. You think it's run its course?
Yeah, hi. So basically, if you look at Bharti, we were definitely very positive. Numbers have come out pretty strong, but definitely at the current valuations, we see it's run up its course. Just today morning, we have downgraded the stock to neutral as the risk reward is no longer looking attractive. While Bharti Hexacom continues to provide a pure play exposure to the parent Bharti's fast-growing wireless as well as home business. With a better ROC, lower capital misallocation concerns, and hence we looked at it from a premium valuation perspective. However, the 40% premium to its parent, we believe that is steep and the risk reward is no longer attractive. Core business continues to do well, but at these valuations, we'll definitely have a neutral rating and wait for any correction to look at it positively again.
Okay, all right. Thanks a lot, Sid, for joining in. So you believe that it's run its course post the big run that we've had in the last few trading sessions. Thanks a lot, Sid. Wishing you a good Friday ahead. Let's focus on pharma stocks. They have been outperforming, reacting to various news triggers. Let's discuss the sector outlook with Vishal Malchanda, the research analyst at Systematics Group, who joins in. Hi, Vishal. Good morning. Good to see you in. It's been a while since we spoke. I wanted to ask you about Wockhardt. You know, we had the management yesterday on the channel, and they were sounding very, very optimistic in terms of revenue growth, in terms of margins improving as well. Did you have a look at the release that they gave out, and any view on the stock?
So Nigel, I don't cover Wockhardt, but broadly, like I keep tracking their kind of the core asset that they have, which is WCK5222, their NCE asset. I think that's one of the most potent antibiotics we have seen in the history. So I think from my perspective, I think the antibiotic market so far hasn't given us very large opportunities. If I look at the last 10 years, I think the largest opportunity that has shaped up in the US would be $200 million, and globally about $750 million is the peak sales that we have seen. So I think we'll have to wait and see how this pans out. But looking at precedents, like how other antibiotics which have been launched in the last 10 years, I would, the US is actually not a large market, but I think the ex-US is a large market where commercial excellence would be required, and probably Wockhardt will need to choose the right partner.
Okay, all right. Vishal, let's talk about another stock then. Dr. Reddy's, you know, spate of news is what we have seen in this week itself, and that's why the stock has been buzzing. What's your view on the news that we've seen? How material could be in terms of a positive, and your official rating on the stock?
So I have a hold on Reddy's as of now, considering, so I think the sector itself has a lot of uncertainties. Reddy's probably has been doing a lot in terms of putting in a lot of licensing relationships with companies to kind of ensure that they continue to grow even with one of their large opportunities kind of. So I think, so basically Revlimid coming off next year, they are putting in pieces together to replace what they lose from Revlimid. But I think while they're putting in pieces together, we are not sure how long these efforts will kind of take in terms of reflecting in the numbers. So one of the large opportunities we have for Dr. Reddy's is semaglutide launch in Canada next year. Again, it's a large market. They are one of the 4 or 5 filers, one of the 4 filers in Canada who are targeting to launch semaglutide there. We might see more coming through before the patent expiry. So there are a lot of uncertainties in terms of whether the innovator will give market share to the generic players or not. So we'll have to wait and see. The opportunity, the market size is large, but execution is where things can go wrong.
How large is the market size of that?
I think right now it's about $1 billion in Canada, but that can expand because once prices come down in terms of volume, the opportunities can expand, say 20-30% or even higher.
Okay, all right. Let's talk about another frontline name, which is Divi's Laboratories. A lot of interest on the stock, but you're not too comfortable on the valuation front. If yes, could you tell us what valuations is it trading at, and at what level would you be comfortable?
So I think I have a target valuation multiple of 40 times on FY27, while on my numbers, it's trading around 65 times, 60 times FY27. So I think if I look at the price earning to growth ratio, it should be around 2.5 times of what growth we expect. While if I look at global peers like Lonza, Wuxi, which kind of have the same growth rates. So their PEG ratios are around, Lonza would be around 1.3x and Wuxi is at less than 1x. in terms of the valuation. So that is where I think the disconnect is. While having said that, Divi's probably does a higher return on equity versus these guys.
Okay, all right. So you're not too comfortable with regard to Divi's valuations. That's why you have a sell as of now. Hold rating on Dr. Reddy's. And Wockhardt you're not covering. Let's get to your top picks. I believe Sun Pharma features in there. So give us a rationale out there. Your top pick from the pharma pack first. Let's get the couple of picks out of the way with the rationale.
So my broader rationale for the sector is we need to kind of not be into names that have large US generics exposure. So there might be a US exposure, but less of US generics exposure is what I prefer. And if I look at Sun Pharma, their US generics exposure is about 15% of the overall sales, while the peers are around say 40 to 50%. So I think US generics is where I think there will be struggle in terms of growth. So probably US generics will pull down the growth rate for most companies over the next 3 to 4 years. So Sun not being positioned there, and I think the rest of the 85% of the business of Sun can grow high single digit to mid-teens. So probably Sun can deliver higher growth in the sector versus the peer names.
So from the frontline name, Sun Pharma, and I think you are positive on Alchem, on Ajanta, I think so. If you could tell us.
Cipla and Ajanta are the other names I prefer. So again, Cipla, I think there is visibility on a pipeline as far as the US is concerned. Their US exposure is also not that large like others. They are around 30% exposed to the US. So a relatively lower exposure, maybe higher than Sun, but still lower than Zydus, Lupin or Reddy's. So that's one positive, and I think the domestic franchise is relatively much stronger than other companies in the large cap space.
Okay.
So I think those two things are the ones that I like for Cipla.
Okay. All right, Vishal, we'll leave it on that note for this morning. Thank you very much for joining in and giving us some perspective on these pharma stocks. Let's look at the market now that the pre-open has settled. It's very quiet, 2 points lower on the Nifty. That's all we're getting. In the mid-cap market action, a couple of stocks look interesting. By the way, Imagica World has been seeing consistent buying through this week. Stocks up about 8-9% this week. Again, in the pre-open, it's starting almost, I think, 3% higher. There is Cochin Shipyard. There is ZF Commercial, where the block has happened, which is in focus. And of course, Ashoka Buildcon in the pre-open is up 4.5%, and that's because of this large order. Almost 1,400 crores is the value of the order that they have won in Maharashtra. So that stock seems to be, getting ready for a positive start. Couple of interesting broker notes as well, which would be in focus today, and the spotlight is going to be on Bajaj Auto and Tata Motors on the back of these, brokerage notes. We have Sudarshan joining in with what the brokers are saying. Sud.
So first one is Tata Motors. JP Morgan has downgraded the stock to neutral and target is rupees 740. It's saying that company is facing a new set of headwinds. First one is tariff risks and aging portfolio in JLR. And second, muted industry growth for FY26 and market share challenges in both passenger vehicles and commercial vehicles that Tata Motors is facing. JP Morgan believes that FY26 is going to be a tough year for Tata Motors and may turn net debt again. But in FY27-28, there might be some improvement, and also balance sheet is expected to improve. But all the eyes would be on upcoming analyst meet that both Tata Motors and JLR will have. Tata Motors analyst meet is on June 9 and JLR analyst meet is scheduled on June 16. Coming to Bajaj Auto, CLSA maintains outperform call and target is 10,149. It has given few reasons why it's positive on Bajaj Auto. First, company is aiming to gain market share in 125cc plus segment. Second, upcoming launch of Chetak will help gain market share electric two-wheelers. And third, about the exports, companies maintaining that it's going to grow in the range of 15 to 20% on the back of rising traction in Latin America and recovery that's seeing in Nigeria. And fourth is companies eyeing a turnaround in KTM by 2026. So on the back of these reasons, CLSA is positive.
All right, since autos came up, so thanks very much for that. I was just thinking, guys, if this spat in US is going to continue.
Good news for Mahindra and Tata Motors.
Yeah, for India, what is the big sticking point? It's Tesla and Mr. Musk.
Yeah.
There is, by the way, auto and telecom. Right? So actually, here in India, you know, it's up in the air in terms of how it goes. Maybe they make up and it all goes away in the next 12 hours. But it doesn't look like it. So it's not, you know, it's not exactly negative. That's the point. And actually for the broader market as well, the fact is a weaker White House allows others more breathing space, and that's the point. Well, you know, we'll talk more about this as we go along, but stocks now as we hit market open. Bajaj Finserv is in focus. Vivek with details. Vivek, tell us why.
Well, that's right. You know, like we indicated an hour ago, we told you about how it was likely that the expected block deal could happen in the block deal window, you know, given the fact that the demand there was quite robust along expected lines in the pre-open block deal window. The large trade has been executed. Almost 1.8% of the total equity worth over 5,500 crore exchange hands. From the term sheet we managed to access last evening, it's two promoter entities, Bajaj Holdings and Jamnalal Sons, who are the sellers. But given the fact that it's happened in the block deal window, you could see a green opening as far as Bajaj Finserv is concerned. Now, key to watch going forward, number one, what is it, you know, that the fund utilization will be for? Most likely, you know, an educated guess will be the fact that they need to pay out their partner, and that this could be the first tranche towards that particular, you know, money that needs to be paid out. Secondly, the block deal or the term sheet indicates that there is now a 60-day lockup on further sale of shares from the promoter entity. So that will be another key trigger going forward.
All right, we've got market open coming up in just a bit. Vivek, thank you very much for that. So what do we have in terms of first rates? We'll look at the indices as always, and we'll go and look at individual names, Nifty and broader markets, etc. as well. So let's just start the session. It's almost unchanged, 2 points. So it's as calm as they come. And Nifty mid cap is up about 1/3%. I think the small cap index will. I mean, the broader markets, and this is a Friday. Every Friday for the last 3 Fridays, we've had a situation where the broader indices, the large cap indices, have not really done very much. But broader markets have continued to move higher, 0.75%, 1.5%, in that range, 3 weeks now. What do we have? First rates, so 24,754 on the Nifty. The Nifty Bank is absolutely flat, 55,730. Sensex is flat, nothing on it. The small cap index is up about 0.25%, 18,485. And the mid cap index, I think, will also come up. There is some gain there, about 0.15% or so is what we have. Nifty heat map maybe gives us a quick sense of what's up and down, although it should be, you know, with a 10-point change, don't expect fireworks. It is more up than down at this stage. And I think one of the names which two names we highlighted with our research team, Bajaj Finserv with Vivek, and just before market open on one end, and some of the stuff in the red as well. Surabhi.
No, it seems like people have already left for the weekend. There's absolutely no movement. It's 20 points lower now on the Nifty. By the way, beyond the Nifty, Cochin Shipyard is interesting, 5.5% up once again. So watch out for some of these defense shipyard companies. Bajaj Finserv on the large cap screen after the block trade, so 1.3% up on this one. Dr. Reddy's, the stock that we were just discussing with the pharma analyst, 1% higher. Coal India, IndusInd Bank, Eternal has had a fantastic week. Eternal's put on about 8% so far this week. That's just 4 days. Let's see what it does today. JSW Steel is seeing a very little buying, but this is, I mean, we're talking 2-3 rupees on the stock, so this really doesn't count. ITC, BEL, it's flat, it's not moving, it's completely, undecided. On the lower side, Tata Steel is falling 1.5%. There's Shriram Finance, ICICI Bank on the lower side. Let's actually check the Bank Nifty. Bank Nifty is down 0.2%, approaching the RBI policy with caution. SBI is lower. There's, Bajaj Finserv we discussed, even Bajaj Finance is lower, Shriram Finance lower. So generally speaking, Jio Finance is also down. Financials, pretty cautious this morning. Nigel.
Well, that's right. Let's focus on a few stocks, though, based on news that are moving in. Tejas Networks, the stock got bombed out post its numbers. Now they've got 123 crores. This is the first tranche of the PLI incentive from DOT for the past quarter. So that stock, after seeing a sharp correction, they won an order as well of around 2,000 crores in the last 1 month. That's popping up a little bit. Ashoka Bilcon, that's the other name that's up and about. They won 1,390 crore LOI for traffic systems in 5 circles of Maharashtra. Street likes it. That stock is up. We have Praj Industries. They're collaborating with a company in Paraguay for a project, a biorefinery project. So So that stock, in fact, is up close to around 2% or thereabouts. The ones with large trades, actually, they have bounced big time. You know, your Bajaj Finserv, there were some shorts in the system. The stock is marginally up. It's up close to around 0.5% or thereabouts. But there were some shorts in the system and there was some call writing as well that's taken place. So I'll be interested to see what happens to the stock from here on. ZF Commercial, that promoter was likely to sell 3% via the large trade. That's got done. Stock zooming away as we speak. So good move out there. BSE Limited on its way to be a 3,000 rupees stock, one of the big movers in the last 1 month or so. It had a bit of a dip and that dip got bought into, flying away. Harsha Engineers, that's the other stock that's up close to 6%. It's coming as one of the top traded volume gainers as well. So that stock, in fact, is calling for attention. Now up close to around 6%. Big move is what we're seeing on that particular name. So the headline index, waiting by for the RBI governor. Just added there actually Hindustan Zinc. That one's up close to 2%. On Monday, we had told you that in fact, zinc prices are going to be strong. And if those technicals are in place, there's only one listed player that you can play it via. That's Hindustan Zinc. It's not a one for a faint-hearted, but that stock in fact is doing well. And Vedanta owns Hindustan Zinc. So maybe some kind of positive rub-off on that particular name as well. Prashant.
No, absolutely. Silver as well, right?
Yeah,
Najib?
silver.
Yeah, silver is the one which
highest
is,
level in the last 12 years.
Yeah, it's maybe more to go with gold doing so well. So we'll see. But as Nigel said, only one player to really play that particular theme in the listed space at least. What else? 1,700 stocks are higher. It's still early to look at the market breadth, but 1,600 stocks are up and 500 stocks are lower. Guess which is the number one volume-led gainer right now on the NSE? It's Cochin Shipyard, once again. It's not a ship, it's a rocket. 2,500 on Cochin Shipyard, 3 million shares traded, and it's just gone berserk. Of course, it's an all-time high. It's a new all-time high every day. And this week, by the way, stocks up 27% to be precise. So Cochin is going and going. Garden Reach is starting. I mean, some of these, typically price action, there is one leader and then the other two follow slowly and then quickly. So we'll see. I mean, Garden Reach is up 1.25%. It's got very large volumes, and Mazgaon Dock is up about 1.25% as well. So there's Cochin, Garden Reach, and Mazgaon, three names which are doing very well. Yeah, I mean, other stuff, there's not very much. Maybe just, let me just sort this. Tejas Network, I think we already mentioned. Premier Explosives is up 5.5%. And I think it's slowly but surely coming back to its previous highs, which was made in, June last year. The high was about 908. Stocks at about 650 right now, but it's done very well from the lows. From 350 to 650 in 10, 15 days. That's Premier Explosives. So volumes are still picking up, so I guess we'll give it some time. RK Forgings is up about 2% or so. There was, of course, that inventory mismatch issue, the promoter coming in and putting in money. So 618 is coming out with volumes, that's why I'm mentioning it. So yeah, I mean, 3:1, almost 3:1 in favor of advances is what we have at this point. On the downside, I can spot CG Power, which is down about 2.25%. Bank of Baroda is down about 2%. I'm not sure if there's any news flow here, but these are some of the biggest volume-led losers at this stage. But nothing large, nothing 5-10% kind of down at this point. And there is a grand sum total of 1 point change on the Nifty. 24,750 is where we're at. Dheeraj Agarwal is with us, Managing Director at Ambit Investment Managers. Dheeraj, good to have you with us here. Thank you very much. Since the market is not doing very much here, I think it gives us the opportunity maybe to indulge in some, outside the market box conversation. So let's start. How do you? I mean, of course, I'm sure you've been following what's happened in the last 12 hours. This bromance between Trump and Musk coming to an abrupt, sharp halt. But from a policy, and I'm sure there are implications, right? I mean, because it's not a typical White House. They're trying to do a lot of things which have not been done for the last 30, 40, 50 years.
That's right.
So, in that sense, how do you assess? I mean, will this lead to a weaker administration? Does it, in a way, does it strengthen the hands of trading partners it's trying to put pressure on? And specifically for India, if you have any thoughts.
So the one clear thing which comes out of what is happening internationally, especially in the US at this point of time, is the uncertainty quotient has risen, right? So as you rightly said, it's almost impossible to predict what will happen tomorrow, what will happen next week, what will happen the month after that. Because you can't even price in or you can't even build your business strategy basis an announcement which came last Friday, because it could change the next Friday, right? So it's pointless. I mean, all of us go back to Excel sheets and say, okay, gainers, losers, this is how businesses will have to rejig. This is what we will have to do to readjust to the, let's say, for example, new tariff rules. But then the tariff rules changes in a week or 2 weeks time. So you can't really budget for it. So unfortunately, the one casualty which happens whenever uncertainty rises is capital spending. Most people tend to hold back saying, since we don't know what the next year or two will hold for us, since we don't know what kind of policy regime to work with, let us just postpone capital spending for a while. And that has its own feed-through effect in the economies in terms of slowdown. So and also the risk premiums come off because people want to become a little bit more risk averse. Now that's at the broad level, I think what the global picture should look like over the next year or two. Having said that, our markets look very different at this point of time. There's a full-on risk on at this point. The riskiest part of the market and the highest beta and highest momentum part of the market is actually doing significantly better as compared to the so-called safe and high quality part of the market, at least in the last 1 month. And as you pointed out on the show a little while ago, quite a few stocks are up 40, 50, 70, 80% in just 4 to 8 weeks time. I think that has got to do a little bit with where there is increased optimism with respect to earnings growth coming through, if not immediately, at least from a 3 to 5 year horizon. That is point one. And point two is our markets, and I've been saying this for a while, and I think I mentioned this on your channel once or twice. Retail has become the price setter and institutions have become the price takers. And that's a segment retail money wants to play in. And that's what is being driven. So last point on the macro front, this is definitely an opportunity for India. Because another thing which is clear is that everybody is looking at alternate supply chains, China plus one, etc., etc. And this time we have to seize it. I mean, that's the biggest point I want to make. This time we will have to capture the opportunity with both our hands, because we missed it in 2008-9 when a similar opportunity presented itself. So I'm hoping this time we will actually be able to capitalize on the opportunity.
Yeah, well, let's see. There's a lot going on. And we need to see if we can just keep walking our path, whether it's manufacturing, whether it's Make in India, or self-reliance in areas like chemicals and defense, so on and so forth. Good to have you on, Dheeraj. I was just, while you were speaking, I was also counting the number of trading days the market has been testing traders' patience.
Right.
It's 15 to 16 trading sessions where we have been doing nothing. We're in a 500-point band, 24,450 on the downside, 25,100 thereabouts on the upside. Typically these long periods of consolidation, I mean, they are followed by a big move, either on the upside or the downside. I know maybe an unfair question, but what do you think? Higher chances of an upside breakout whenever this ends, or a downside one?
I think the range trading with a slight upward bias can continue for many months. And I'm actually sensing a huge similarity in the market right now as compared to what happened between Jan to May 2024. Backdrop is very similar. November, December 23, markets went up about 12 or 13%. Jan to May 24, if you actually plot the Nifty chart, it's literally like this. So point to point, in those 5 months, Nifty was up just 3.5%. But you would see, if you actually look at the internals, you would see 4% up, 3% down, 5% up, 4.5% down, innumerable number of times, broadly trading the same range. But within that, the kind of stocks which are doing well, those kind of names actually went up 40, 50 to 80% in that 5 month time horizon. And I see something similar happening. So I'm not very hopeful that the market will break out of this range. I mean, it could break out a little bit and go another 200-300 points higher, but that's okay. I mean, I don't see a huge move on either side at the Nifty level in the next few months.
Okay, all right. Hi, Dheeraj. The big cue that we're looking at for today is going to be the RBI governor. 25 basis points appears it's baked in. And maybe that good GDP number that we got, could be one of the excuses they give that not going with 50 basis points. We'll have to see how that goes. But in a rate cooling off cycle, what is the top theme that you'll play? NBFC as well, they'll have some part of their borrowing mix that comes in from banks, so they'll benefit in a cooling interest rate scenario. Could have the real estate pack as well, or maybe some of these, companies that have larger debt in their books. How would you play this rate cutting cycle?
So, real estate is an obvious one, and real estate demand has been looking pretty strong in the last few quarters, last few months as well. All the data coming out is quite strong. NBFCs do benefit, but remember, most of the NBFCs are trading at valuations from where I don't know if there are large upsides left anymore. So, that's another large conundrum in the market at this point of time. If you pick any sector or stock which is actually doing well, where there's high degree of margin of safety or high degree of predictability of earnings, there is a discomfort on the valuations. And if you go down a couple of layers where you can find some ideas, there is a discomfort on fundamentals. So one of my friends and colleagues, not colleagues, one of my friends, and a very senior fund manager once told me recently in a conversation that I've never seen a market which is so priced to perfection. That is very difficult to find a decent quality asset which is offering you that mispriced opportunity of making some easy returns, and which is what you're seeing reflected in the Nifty, right? It's just not able to break the range because there isn't enough for it going at the mega cap, large cap, high quality stocks level for it to break the range.
Dheeraj, the issue then is, this kind of a market for the average retail investors, when the DIY retail investors, it also starts getting frustrating, right? Because it gets harder and harder to find the stocks that will do the 20-30% in a trading market, in a ranging market rather. What do you think of, the current stories that have run, still continue to run in parts? For instance, defense. That whole valuation argument can probably be tossed out of the window, but then again, it's that situation that people find themselves in. What do I buy? Because where valuations are maybe comforting, like FMCG, stocks are not moving. And then the ones that are moving, like a Cochin or the whole defense pack, the numbers perhaps don't make sense at some level. But what's your thought?
See, it's a difficult call from 2 points of view. It's very difficult to justify fundamentally why this stock should continue to go up from here. But why is it a difficult call to say that don't buy or sell them here is because it can go higher, right? And that's a very weird kind of a conundrum. And I can explain that only by drawing parallels from the history. So, and my favorite example for that is September, October 99. One of my most revered fund manager, Prashant Jain, HDFC Mutual Fund, September, October 99, he brought his IT holdings down to zero. Now, Wipro was trading at probably 125, 150 times PE multiple at that point of time, or 100 times PE multiple at that point of time, I don't remember. But between September 99 and March 2000, that's just 6 months. 6 months, Wipro went up 4.5 to 5 times. And it's just illogical, but it went up 5 times. For somebody who's playing it, somebody who was smart enough actually to exit close to the top, there was a lot of money to be made. But could you fundamentally explain it? Could you fundamentally explain even a good quality company like Wipro trading at 600 times PE multiple? I don't think so. So these things can happen in the market, and hence it's very difficult call to say the current momentum names can't go up 20, 30, 40, 50% more. But in a number of areas, I would just warn that if you're riding the tiger, be ready to jump off at the first sign of trouble. Otherwise, the pain after that could be really bad.
Okay.
A clear, unforgetful riding the tiger quote, you guys.
Oh, we can, Mr. Ramalinga Raju, who can ever forget? Reading that press release out.
Very briefly, is buying defense stocks here akin to riding the tiger? Quickly?
I think they are expensive. I don't think they're in a bubble yet.
Okay.
Maybe not yet, but could it become at some point of time, looking at the positive momentum? Perhaps.
This is good. Ride the tiger carefully. That's the key takeaway. We got it. Thank you for that, Dheeraj.
Okay.
Okay, all right, Dheeraj, thanks a lot for that. By the way, at the bottom of your screen, there's another large trade that's taking place, Azad Engineering. Just keep an eye out on that stock. It's down close to 8-9%. I think 2-3% equity changed hands. We'll try to get you a further insight in terms of who could be the potential names, but the stock clearly has moved to the low point of the day. That said, let's focus on Kaynes Technology, and to help us out with their vision ahead, they've got a big plan in terms of scaling up business. We have with us Mr. Jairam Sampath, the whole-time director of the company. Hi, Mr. Sampath. Good morning. Thanks a lot for joining in. And I've gone through the numbers. Brilliant outlook is what you'll have given. But first, let's address the year and now. The promoter entity earlier this week went ahead and sold a percent in the company. Could you tell us why was that done, particularly in the backdrop that you all have taken an enabling resolution to do a QIP? So does the promoter entity intend to sell more stake in the company?
No, there are two different parts of the, let's say, dimensions to this activity. One, promoter wants to actually create something called a Kaynes Center in Mysore. We've been wanting to do it for last several decades to add reputation to our company and then give it a slightly higher kind of brand image. And we cannot actually lose money from within the company for that. So promoter does not mind, diluting and then doing this. So he's going to create a Kaynes Center, which will be like a part educational, part scientific exploration center in Mysore. And so that's his intent. He's been thinking about it for last several years. So we thought we'll start it now because 3-4 years time frame it will happen. The QIP is to fund our...
Just a minute, Mr. Sampath. First, let's get this out of the way. Yeah. So it's a noble thought that he has, to create that center. And he's raised close to 600 crores. Is that money enough, or will he have to sell more to, for creation of this? Is he done?
No, I think he's done for at least some time now. This particular thing will last. This project will last for about maybe 5 years time frame.
Okay.
And hopefully, we'll get there what he wanted to do, a large Kaynes Center. And see, for him, the entire life is the company.
Yes.
Whether he does it personally or whether he does it within the company, it's all the same.
Taken that on board, sir. So for the remainder of this year, can we assume that he doesn't come to sell more stake?
Oh, no, not at all. Not this year. Some more time now. Yeah.
More than a year. He will not be selling stake.
Several years.
Got that. So that's put to rest. Now you had an enabling resolution of a QIP. And the street was hot on this. Could you tell us where does that stand? Will you be raising the money, in the coming month?
Yes.
And quantum will be 1,600 crores?
Yes, 1,600 crores, and we'll be raising the funds shortly. See, if you remember, we had talked about $1 billion sales by FY28, and that seems to be visible now. So then the question that came to us is what happens thereafter? We've been talking about a 50% CAGR. So by FY30, so the first billion came in 40 years. But the second billion will come in 2 years time frame. So we want to make sure that FY30, $2 billion happens with some little bit of, let's say, margin to spare. So that's why we said we'll take some steps here. They're essentially in 3 areas. One is geography expansion. These are all, let's say, inorganic expansions. The second is in the area of getting some design capabilities, ODM, to shore up our margins further. And third is to get deeper into technology, because I think going forward is going to be a global arena. So we need to be technologically savvy. So these are the 3 things, small, big, babies. Maybe about 800 crores into geography expansion, 400 for the other 2 design and, deepening the technology footprint.
So the inorganic opportunity is around 800 crores. Is that correct?
Yes.
Okay, all right. And we'll be hearing about the acquisition then in the next couple of quarters, right? If you're going to be raising money this month.
Yes, you will. We had already acquired one company in Canada. And so...
okay, Mr. Jairam, I just sorry, apologies to interrupt there. That's the RBI governor walking in. Those are shots which are coming in, from the Reserve Bank of India. policy going to get underway in just a bit. And we'll start our policy programming in just a bit as well. Jaram, go on. Sorry, please, I interrupted you. Finish that point.
Yeah. So the point is that we had already acquired two companies, one small company, $6 to $8 million turnover. That was Digicom. And then later on, recently we acquired a company called August Electronics in Canada. That's about $45 million US dollar or 57 million Canadian dollar. And we are quite enthusiastic that these kinds of acquisitions will definitely add the quantum of, let's say, beachhead for sales, which we badly need if we have to cross $2 billion sales in FY30. And so that's very important for us to make sure that you make the beginning now so that 5 years time frame, we can grow these businesses to $200, $300 billion businesses in the US. As you know, US is the largest market for our kind of electronics.
Yeah.
So in order to partake some portion of that market, I think we got to be there.
You know, I'm glad, Mr. Sampath, I'm glad you touched on that point because really wanted to understand this. I mean, your overall exposure across your businesses, you know, whether it's semicon, whether it's PCBs, whether it's, you know, all the segments you operate in, total exposure to the US. But before I get to that, since you're talking about another acquisition, last time we had spoken in May, you had given a guidance of about roughly 60% growth for the current year. Did that bake in the acquisition, or was that just 60% organic top-line growth? And it could be more than that if you do this acquisition this year.
Yeah, no. So it's very, the math is simple. So this year, based on India geography business, we will do about 4,350 crores. And another 175 crores comes by consolidating the acquisition that we have already done. So we plan to consolidate at least 6 months. Maybe if you're lucky, we can do 8 months too. So 175 is the crores is the quantum of business that will consolidate from our Canadian entity. 4350, I think 4350 itself grows at a big number, no, compared to last year's number. So total is 4525, I think, and hopefully we'll exceed that. And we have also guided for a slightly increased, expanded EBITDA number. It's about 15.6% or so. So I think it's fair to say that next 2-3 years time frame, we are in an expansion in terms of profitability.
Sure. So I take that point. You're saying that from the number you'd given us in May, which was 4525 crores, maybe the top line ends up being even better than that. Got that point. Okay, now very quickly, just a few questions to understand your exposure to the US and whether there is any risk given everything that's going on. Just tell us, sir, you know, what percentage of your revenue is coming from exports? And within that, how dominant is the US as a geography?
Yeah, so this year, FY26, if you see, broadly about 15 to 20% will come from, let's say, exports. And I think most of the incremental businesses will come from US geography. And I think our exposure to US geography is used to be very minimal in the beginning. We used to have one client in the US called Amitech, and then we had some clients in UK and Europe. Now we have other bigger clients. And so it is going to increase, but nothing.
From what to what, sir? From say 1%, 2% of revenue over the next 2-3 years, where do you see that US number moving? Would be 5% of your revenue, 6-7? Just some idea as you scale up.
No. Consolidated way, I think by FY27, we should do, including semiconductor and PC boards, etc. Yeah. Export per se will be touching about 25% plus. Now, out of it, some will be Europe and bulk of it will be US.
Bulk of it will be US. Okay, yeah. So which brings me to the central question then, sir. The market would want to know if there are any inherent risks building in. Because doing business with the US, I mean, things change at the drop of a hat, at least, you know, in the present dispensation.
Yes.
So can you tell us, I mean, how firm are your plans? Will the clients continue to come in? Because for instance, I think some of on the semicon side, some of the tie-ups that you have had are with US entities.
US companies, yeah.
Yeah.
So fundamentally, most of the demand centers are not in the US, though the entities that we export to, like aerospace, avionics, etc., they go to the US, but then they come back into places like India, because India is one of the largest buyer of aircrafts. So from that perspective, I guess the risk from the demand perspective is not there. And this is a necessary component of, let's say, supply chain routing. So if it didn't export to US, you cannot really make the US or Europe, you cannot make really our electronics as part of product which comes back in India too. India is not yet fully self-sufficient in terms of, let's say, aircrafts and things like that, right? So from that perspective, I think risk is not there in terms of the demand side risk.
Okay.
Execution always will be, let's say, will be affected by all these pronouncements. But actually speaking, relatively speaking, post this new administration in the US, we are probably having a better time than before because there's a net differential in terms of tariffs and, let's say, perception. Real tariffs, I don't know whether when they will implement, but perception-wise, India is seen as a better country.
Okay, all right. Mr. Sampath, final question before we let you go. Ola is one of your clients, right? Could you tell us what kind of revenues do they contribute to you? Point number one. Point number two, if you could tell us, the smart meters, what was the revenue in 25? What will it be in 26? Just these two queries and then we'll wrap up on this interview.
Absolutely. So last year we did about 500 crores of smart meters. This year we'll do about 1,000 crores.
Okay. And Ola?
Ola will not grow, I guess. I mean, I can't really talk about a company's growth plans, but I think...
No. What is their what part of your revenues come from there?
It's not a huge number. I can't really give you specifics, but it's not a huge number. It's going to probably, if at all anything, come down in terms of our composition for this year because they are redoing their strategy. So as and when they come back, I think we will then see it at that point in time.
Okay, all right, Mr. Sampath, out of time, not out of questions, but thanks a lot for joining in and give us some clarity on business. Important to note, the promoter entity will not sell more stake in the company, and we look forward to the QIP as well. Appreciate you joining in and speaking to us here on CNBC-TV18. On that note, though, we'll wrap up on Bazaar, but our policy coverage starts on the other side of the short break. We connect with a whole host of experts to address the much-awaited policy, and RBI Governor as well will be addressing the press at around 10 a.m. Stay with us.
Hello and welcome to our special coverage of the Reserve Bank of India's monetary policy, coming to you straight from the precincts of the RBI Mint Street, as we call it. Well, it could be an also-ran 25 basis rate cut policy, or it could be a policy of fireworks. We will know shortly in about 10-15 minutes. Joining me is Ritu Singh, my colleague from the Mumbai studios, and a bunch of guests. Ritu, over to you. Good morning. You did the poll, so tell us what the market's ready with.
Good morning, Lata. You know, the fireworks, if any, aren't likely to come from the rates, but it is the other policy measures that the street will really watch out for. 25 basis points rate cut, that's pretty much factored in. Anything above that, you know, there's a few outliers like Soumya from State Bank of India that are expecting a 50 basis point cut. Now, that is going to come as a big surprise if it does come at all. But of course, what the market will watch out for apart from this cut is the macro factors. Now, the GDP forecast for the current fiscal is at 6.5%. If there is a downward revision there, or any risks cited from growth, that will give market cues about how RBI may look at rates going ahead. And importantly, the CPI forecast at 4% for the fiscal, the street actually has a number which is at least 50 basis points lower than that. So if they reduce that and that opens up room for further rate cuts, that's something we'll watch out for. The majority of our respondents are expecting a 10 to 20 basis points downward revision at the very least. Where will the terminal rates really grow? You know, the consensus is about 5.5 to 5.75%, and the rate cutting cycle is largely expected to end by December, although some are even betting on the end of rate cuts by August itself. Not much is expected on liquidity because, you know, RBI has already done a lot, and it's really the mandate of RBI more than the MPC, so we're not likely to hear much other than the fact that RBI will say we will keep adequate liquidity to direct to the real sectors of the economy. On non-policy measures, you know, anything on gold loans, given the government's recent comments, anything on the liquidity framework, including NBFCs, you know, some of it talking about in the external benchmark link rate, those are the things that we really look out for.
Oh, yes. Gold loan companies, of course, will have their ears pricked, their antenna up. Yeah, I mean, what about this foreign bank shareholding thing? Maybe he could electrify the atmosphere with something on that. But that, I guess, will be the press conference. Let me straight away introduce our guests. We have Nilesh Shah of Kotak, Parul Mittal of Standard Chartered, Indra Nilpan, the chief economist from Yes Bank, and Sakshi Gupta, the economist from HDFC Bank. Ladies and gentlemen, it's an even house. Thank you very much for your time. Nilesh, let me start with you. What's the market expecting? What can be the outside surprise?
So whatever Ritu has summarized, that's the perfect summary. It just shows how predictable this monetary policy has become from a market point of view. Everything is under control, growth above estimate, inflation well within control, banking system fairly balanced on liquidity. So RBI will probably go as per the market expectation, 25 basis point rate cut, growth estimate probably keeping same at 6.5%. And inflation, while the actual number or the street number might be lower, they may just go ahead with 4% number to keep some buffer.
Okay. But a 50 bips cut could mean that you will sell off banks. I mean, there could be a trading sell on banks.
Undoubtedly, 50 basis point is going to have a material impact on banks' NIM margin. So there will be some sell-off if there is a 50 basis point rate cut in banking sector.
Okay, Parul Mittal, of course, would be the master at knowing what the bond market is thinking. Parul, what's the market prepared for? What will be the outside surprise? How may yields move if there is ultra dovishness or not so much?
Hi, Lata. So this time, market is pricing in exactly 25 basis points of rate cut for this MPC. And this we can see how the OIS curve is priced in. If we look at the bond curve, it's the shorter end of the curve is trading below the SDF rate itself. So 1-year T-bill is trading at 5.6%. So that tells us that apart from the rate cut expectations, there is a positive overhang from the liquidity surplus in the interbank market. So market has nothing to complain about over the last couple of months. Liquidity and the inflation coming down has really boosted markets' comfort on policy rate cuts. This is a very special policy where the fear is, what if RBI gives a bigger and bolder rate cut? And if that happens, I think market is not currently prepared for it. We can see material moves if that small probability of a larger rate cut materializes. And our governor has surprised the markets on the stronger action from RBI in the past. If we look at their policy on dollar rupee, on liquidity itself, the surplus which has been given is bigger than market participants anticipated. So very interesting policy, very finely priced in, exactly 25 basis points of rate cut expected, and a fear of a larger rate cut from RBI.
Yeah, you know, there can be an argument made that the RBI wants the repo rate at 5.75, although the repo is today at 6. The call rate is at 5.75. So why not give a 50 bips cut and do reverse repo to keep the call rate at the repo rate? In that case, an argument for a 50 bips can be made, and continuous reverse repo to keep the call rate aligned to the repo rate. That argument can definitely be made. We will have to see what he would do about that. Indranil Pan, besides the 25 basis, what else would you watch?
I think for me, the very critical thing is, first of all, the base case is 25 basis points. I think the commentary for the future is very important for me. Now, the reason I say so is that there is no sort of grave fear on the growth. Yes, if I accept the potential growth rate for the economy at about, say, 6.5 to 7%, we are more or less there. And there is no grave fear that growth is sinking, which necessarily means that I don't expect a shock treatment from the Reserve Bank of India, even though inflation has surprised to the lower side. The critical thing I would be looking for also is how much they reduce their inflation expectations number. Now, the broad, as you street expectation is about, say, a 10 to 20 basis points, which doesn't make a material difference to me. But for instance, the RBI sort of is bringing down the inflation forecast by about 50 basis points. That clearly is a signal for the forward or the forward guidance that the depth of the monetary policy easing can be significantly more. Now, the other reason why I don't expect a 50 is that we are reading news prints that early rains may have damaged crops in the southern India. And there has been an uptick in prices of vegetables, especially tomato, which will probably be filtering into the market over the next 2 to 3 weeks. So that's also the reason, and given the various uncertainties from the global markets where inflation seems to have stalled and global rates being on the higher side, I would not sort of want the RBI to provide a 50 basis point shock.
All right, 50 basis points, a shock if it comes. Sakshi, are you at all pricing in any surprise apart from the 25 cut that is expected? And on the macro front, what sort of revisions, if any, are you expecting?
Right. Good morning. So, I broadly agree with what's been already said. I think 25 basis point rate cut is also my expectations. I don't think the RBI would want to rock the boat and deliver a 50 basis point cut. On inflation and growth, I think it is too early for them to kind of change or tinker with the forecast that we saw in April. And, given that food prices can be extremely notorious, in the months of, July and August, I think that they'll kind of keep that cushion. And for now, I would expect them to keep their inflation as well as growth forecast unchanged. I think it is too early for them to kind of revise down their inflation forecast. I think, one of the things that I would kind of watch out for is the tone of the monetary policy and their assessment of how domestic growth is doing, not just in terms of, any sort of impact from global headwinds, but how is the domestic recovery panning out, over the last couple of months. So their comfort around that, because I think that will give us some perspective on, what comes next. So are we looking at a further 25 basis point cut or a deeper rate cut cycle? So in terms of forward guidance, I think their commentary on growth will be very important.
Yep, I completely agree. We would watch out for 6.5 is where RBI stands. 6.3 to 6.8 is what the chief economic advisor has been saying for some time now. RBI is at the midpoint. Anything lower can mean that there is more dovishness. But Nilesh, what about outside the policy? What would you like to hear on gold loans? What would you like to hear on this, foreign bank shareholding that suddenly become very newsy? Even if he doesn't say anything in that statement, you can be rest assured that we are all going to ask him. So if he says, for instance, yes, we are reviewing, we don't mind a larger foreign bank shareholding, who gains? Will the chota private sector banks, old private sector banks become active, become interesting for you?
So undoubtedly, when a strong promoter steps into a banking system, investors will be positively looking towards it. Second, as this smaller guy gets bigger promoter, better promoter, their ability to compete with larger players also increases. And hence the entire banking system will have to be reevaluated. On the gold loan, whenever stock market goes up, we see beneficial impact in real estate sector. Far bigger wealth creation has happened on the gold. But unlike stock where there's no emotional attachment to sell, on gold for whatever reason, there's emotional attachment. I think if we can liberalize gold loan and ensure that this wealth effect translates through credit into other parts of economy, it will be better. Obviously, the gold loan, if done properly, is one of the most secured way of lending, and hence it can be pushed to create growth in economy. One more thing, Lata, we will be looking forward in this policy if there is a hint. RBI is running a fairly large short forward dollar position. What will be the game plan over there? How will it get unwind? The reserves are comfortable. So how will that get unwind will be something we will be looking forward to in this policy.
Parul, very quickly, could there be any possibility of widening the corridor, reverting back to pre-pandemic levels of that 50 basis point gap between repo and STF? Or you think this corridor is still serving its purpose?
So yes, there is a bit of discussion around whether RBI would want faster transmission and therefore widen the corridor so that the excess liquidity leads the banks to either lend at their SDF window 50 basis points lower than the repo rate, and that can then propel their propensity to extend credit and bring down the lending rates in the system. I think there are two choices in front of RBI. One, to either give a larger repo rate cut or to move the SDF window lower by another 25 basis points. I think given how RBI has been very focused on keeping the volatility in the overnight markets lower, I would personally give a higher probability to a deeper rate cut rather than widening of the corridor. I think RBI would continue to focus on keeping a control on the overnight rates closer and in the narrower corridor that has been their policy focus over the last few years.
Okay, so that's something that RBI is unlikely to do, at least in this policy. Quickly, Indranil Pan, non-policy measures, you think the liquidity framework, which has been under discussion with some of the bankers of late, is that something that RBI could discuss in this policy?
I would guess no, because as Parul also rightly mentioned, that they are not going to widen the corridor. So the liquidity measures are under discussion, and I think unless the sort of first document is released for public discussion, I'm not sure whether the RBI governor will let out anything on the liquidity framework immediately in this policy.
Okay. Sakshi, what is your sense? Any other non-policy measures that you would watch out for?
Right. I mean, Ritu, at this stage, on the liquidity side, I also agree. I don't think that, we will hear too much around the, new liquidity framework. Also, in terms of, liquidity measures, the RBI has been already, very active on that front. System liquidity is now close to, a surplus of 2.9 lakh crores. I think they will talk about.
And namaskar. The 55th meeting of the Monetary Policy Committee was held in the backdrop of an early and promising start of the monsoon season. This is of vital significance for the Indian economy. In contrast, the global backdrop remains fragile and highly fluid. The uncertainty around the global economic outlook has somewhat ebbed since the MPC met in April, in the wake of temporary tariff relief and the optimism around trade negotiations. However, it is still high to weaken sentiments and lower global growth prospects. Accordingly, global growth as well as trade projections have been revised downwards by multilateral agencies. Moreover, the last mile of disinflation is turning out to be a little more protracted. As growth-inflation trade-offs is becoming more challenging, monetary authorities are charting out a more cautious and carefully calibrated policy trajectory. Looking beyond the near term, growing economic and financial fragmentation is reshaping the global economy. Besides complex interconnections with the financial system, elevated debt levels, and growing influence of frontier technologies like AI are raising financial stability concerns. Amidst heightened volatility in capital flows and exchange rates, coupled with constrained policy space, central banks of emerging market economies have a tougher task to stabilize their economies against global spillovers. In this global milieu, the Indian economy presents a picture of strength, stability, and opportunity. First, strength comes from the strong balance sheets of the 5 major sectors: corporates, banks, households, government, and the external sector. Second, there is stability on all 3 fronts: price, financial, and political, providing policy and economic certainty in this dynamically evolving global economic order. Third, the Indian economy offers immense opportunities to investors, both domestic and foreign, through 3 Ds: demography. We have a high proportion of the working age population which is growing. It is becoming more literate, it's becoming more educated, more skilled, urbanized. Then there is the third D, the second D, the digitalization. We have very advanced and sophisticated public digital infrastructure. And domestic demand is the third D, which we are talking about over here, which is very important given the trends of deglobalization. This 5x3x3 matrix of fundamentals provides the necessary core strength to cushion the Indian economy against global spillovers and propel it to grow at a faster pace. We are already growing at a very fast pace. 6.5% is the highest, not only last year amongst major economies, but even in the last decade. Of course, we aspire to grow at a higher rate, and we are making all efforts in our vision of a Viksit Bharat by 2047. I now come to the Monetary Policy Committee decisions. The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%. I repeat, the reduction recommended by the MPC is for 50 basis points to 5.5%. This is with immediate effect. Consequently, the standing deposit facility rate, which is the STF rate, shall stand adjusted to 5.25%. And the marginal standing facility MSF rate and the bank rate shall stand adjusted to 5.75%. I shall now briefly set out the rationale for these decisions. Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target. Latest numbers are 3.2%, with signs of a broad-based moderation. The near-term and the medium-term outlook now gives us confidence of not only a durable alignment of headline inflation with the target of 4%. You are aware we had earlier projected for this year an average inflation of 4%. as excluded in the last meeting, but also the belief that during the year it is now likely to undershoot the target at the margin. While food inflation outlook remains soft, core inflation is also expected to remain benign with easing of international commodity prices in line with the anticipated global growth slowdown. The inflation outlook, therefore, for the year is now being revised downwards from our earlier forecast of 4% to 3.7%. Growth, on the other hand, remains lower than our aspirations amidst challenging global environment and heightened uncertainty. Thus, the MPC felt that it is imperative to continue to stimulate domestic private consumption and investment through the policy levers to step up the growth momentum. This changed growth inflation dynamics calls for not only continuing with the policy easing, but also the MPC felt front-loading the rate cuts to support growth. Accordingly, the MPC voted to reduce the repo rate by 50 basis points to 5.5%, as already mentioned. After having reduced the policy repo rate by 100 basis points in quick succession since February 2025, the Monetary Policy Committee also felt that under the present circumstances, monetary policy is now left with very limited space to support growth. Hence, the MPC also decided to change the stance from accommodative to neutral. From here onwards, the MPC will be carefully assessing the incoming data and the evolving outlook to chart out the future course of monetary policy in order to strike the right growth-inflation balance. The fast-changing global economic situation too necessitates continuous monitoring and assessment of the evolving macroeconomic outlook. I will now come to the assessment of growth and inflation. First, growth. The provisional estimates released by the National Statistical Office placed India's real growth in 24-25 last year at 6.5%. During 25-26 so far, domestic economic activity has exhibited resilience. Agriculture sector remains strong with a very good harvest in both the Kharif as well as Rabi cropping seasons. The supply of major food crops is comfortable. The reservoir levels remain healthy. The highest procurement of wheat in the last 4 years provides a comforting stock position. Industrial activity is gaining gradually, even though the pace of recovery is a little uneven. Services sector is expected to maintain momentum. PMI services stood strong, as you are aware, at 58.8 in May 2025, indicating a very robust expansion in activity. On the demand side, private consumption, which is the mainstay of aggregate demand, about 56% of the total GDP, remains healthy with a gradual rise in discretionary spending. Rural demand remains steady while urban demand is improving. Investment activity is reviving as reflected by high-frequency indicators that we track. Merchandise exports recorded a strong growth in April 2025. Of course, this could be because of some front loading, but this is after a lackluster performance in the recent past. Non-oil, non-gold imports posted a double-digit growth, reflecting buoyant domestic demand conditions. Services exports continue on a very strong growth trajectory. Both the last month's figures have been quite robust. Going forward, the outlook for agriculture sector and rural demand is expected to receive further impetus by the expected above normal southwest monsoon rainfall. On the other hand, sustained buoyancy in services activity should nurture revival in urban consumption. The healthy balance sheets of banks and corporates, governments the government's continued thrust on capex, elevated capacity utilization, improving business optimism, and easing of financial conditions should help further revive investment activity. Trade policy uncertainty, however, continues to weigh on merchandise exports prospects. The conclusion of the free trade agreement with the United Kingdom and the fast progress that is being made in our negotiations with other countries, on the other hand, should provide a fillip to trade. Spillovers emanating from protracted geopolitical tensions and global trade and weather-related uncertainties pose downside risks to growth. Taking all these factors into consideration, real GDP growth rate for this year 25-26 is projected at 6.5%. We continue with our earlier forecast with Q1 at 6.5, Q2 at 6.7, Q3 at 6.6, and Q4 at 6.3%. The risks are evenly balanced. I will now move to inflation. CPI headline inflation continued its declining trajectory in both March and April. The headline inflation moderated to a nearly 6-year low, in fact 69 months to be precise, to 3.2% in April 2025. This was led mainly by food inflation, which recorded the 6th consecutive monthly decline. Fuel group, which had been earlier witnessing deflationary conditions, there was a reversal of the deflationary conditions, and it has recorded positive inflation prints in the last 2 months of March and April. This is partly because of the hike in LPG prices. Core inflation remained largely steady and contained during March and April, and this is despite the increase in gold prices, which exerted an upward pressure. The outlook for inflation provides towards benign prices across major constituents. The record wheat production and higher production of key pulses in the Rabi crop season should ensure adequate supply of key food items. Going forward, the likely above normal monsoon, along with its early onset, augurs well for Kharif crop prospects. Reflecting this, inflation expectations are showing a moderating trend, and this is more so for the rural households. Most projections point towards continued moderation in prices of key commodities. This includes crude oil, which is of critical significance to us. Notwithstanding these favorable prognoses, we need to remain watchful of weather-related uncertainties and the still evolving tariff-related concerns with their attendant impact on global commodity prices. Taking all these factors into consideration and assuming a normal monsoon, CPI inflation for the financial year 25-26 is now projected at 3.7%, as I mentioned earlier. This is a downward revision from our earlier forecast of 4%. We are projecting inflation for Q1 at 2.9%, Q2 at 3.4%, Q3 at 3.9%, and Q4 at 4.4%. The risks are evenly balanced. I'll now come to the external sector. With a moderation in trade deficit in Q4 24-25, alongside strong services exports and remittance receipts, the current account deficit for last year 24-25 is expected to remain low. We are yet to get the final figures. Furthermore, despite rising geopolitical uncertainties and trade tensions, India's merchandise trade remained robust in April 2025. As imports grew faster than exports, trade deficit, however, widened during the month, which is the month of April. Going forward, net services and remittance receipts are likely to remain in surplus, counterbalancing the rise in trade deficit. The current account deficit for this year, 25-26, is therefore expected to remain well within the sustainable levels. On the financing side, in 24-25, foreign portfolio investment to India dropped sharply to $1.7 billion US, as foreign portfolio investors booked profits in equities. Net foreign direct investment, FDI, too moderated. I would like to take a moment over here because there has been large and widespread commentary on this moderation of net FDI. Now, we look at net FDI primarily because of our concern regarding foreign exchange reserves, where the net becomes important. It's not only the net the inflows, but also the outflows, which actually lead to either an accretion or a depletion in the foreign exchange reserves. However, when it comes to investment, then it is the gross FDI which is actually important, and gross FDI last year actually increased quite sharply. 14% is a very robust growth that we had, $81 billion US. And so India continues, therefore, to be an attractive investment destination, despite there being a moderation, as we are seeing, in net inflows, which is primarily because of rise in repatriation, which is again a very good sign of a maturing market, where foreign investors can enter and exit smoothly, and at the same time higher gross FDI, which is again a sign of our large industrial and other companies going out and investing. So on the whole, gross FDI is high, which indicates that India continues to be a good and attractive investment destination. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the previous year, as on May 30, 2025, India's foreign exchange reserves stood at $691.5 billion US. These are sufficient to fund more than 11 months of goods imports and about 96% of external debt outstanding. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. We remain confident of meeting our external financing requirements. Now I come to liquidity and financial market conditions. You are all aware that the RBI over the last few months, in fact since January, we have injected a lot of durable liquidity through various means, through OMOs, through the CRR rate cut, through the buy-sell swaps, OMOs, etc. A total of 9.5 lakh crore rupees of durable liquidity has been injected into the banking system since January. As a result thereof, after remaining in deficit since mid-December, liquidity conditions have transitioned to a surplus at the end of March. And this is also evident from the tepid response to the daily VRR auctions, which got a bid coverage ratio of only 0.26 in the recent past, and also from the high STF balances. They are averaging about 2 lakh crore rupees in the last 2 months, that is April and May. Similarly, reflecting the improvement in liquidity conditions, the weighted average call rate, which is the operating target for the monetary policy, this traded at the lower end of the LAF corridor since the last policy. The comfortable liquidity surplus in the banking system has further reinforced transmission of policy repo rate cuts to the short-term rates. However, we are yet to see a perceptible transmission, although there are incipient signs of transmission to the credit market segment, but it is still not perceptible, although we are aware and we need to keep in mind that it does happen with some lag. The Reserve Bank remains committed, as we mentioned earlier, to provide sufficient liquidity to the banking system. To further provide durable liquidity, it has now been decided to reduce the cash reserve ratio, the CRR, by 100 basis points. I repeat, we have decided to reduce the cash reserve ratio by 100 basis points from 4% to 3% of net demand and time liabilities. This will be done in a staggered manner during the course of the year in 4 equal tranches of 25 basis points each, coming into effect from the fortnights beginning September 6, October 4, November 1, and November 29 of this year, which is 2025. The cut in CRR would release primary liquidity of about 2.5 lakh crore rupees to the banking system by the end of November 2025. Besides providing durable liquidity, I would like to emphasize over here and highlight that it will also reduce the cost of funding of the banks, thereby helping and accelerating the monetary policy transmission to the credit market. I would like to reiterate that we will continue to monitor the evolving liquidity and financial market conditions and proactively take further measures as may be necessary for liquidity and for monetary policy transmission. I will now come to financial stability. The system-level financial parameters of the scheduled commercial banks continue to be robust. The asset quality parameters, liquidity buffers, and profitability parameters have shown further improvement. The credit deposit ratio for the banking system at the end of December 2024 was at 81.84%. This is broadly similar to what it was a year ago. Similarly, the system-level parameters of NBFCs are sound with comfortable capital position and improved GNPA ratios. The stress witnessed earlier in retail segments like unsecured personal loans and credit card receivables portfolio has abated, while the stress in microfinance segment is still persisting. Banks and NBFCs active in these segments, however, are already recalibrating their business models, strengthening their credit underwriting practices, and stepping up their collection and recovery efforts to avoid any excessive buildup of risks on this front in future. I now come to the end of my statement. On both inflation and growth fronts, the Indian economy is progressing well, and it is broadly on expected lines. And this is despite, the huge uncertainty that the global uncertainty that we have. Strong macroeconomic fundamentals and benign inflation outlook provide space to monetary policy to support growth while remaining consistent with the goal of price stability. As global environment remains uncertain, it has become even more important to focus on domestic growth amidst sustained price stability. Accordingly, today's monetary policy actions should be seen as a step towards propelling growth to a higher aspirational trajectory. Here I would also like to highlight that there is no tussle between price stability and growth in the medium and long term. Price stability preserves purchasing power. It imparts certainty to households as well as to businesses in their savings and investment decisions, and it ensures congenial interest rate and financial conditions, all of which foster consumption, investment, and overall activity and therefore growth. Moreover, this is crucial for equitable growth and shared prosperity because its absence is disproportionately burdensome on the poor. I must also add over here that while price stability is a necessary condition, it is of course not sufficient to ensure growth. A supportive policy environment is vital. And this is even more important during periods of high uncertainties such as the current times that we are witnessing. At the Reserve Bank, therefore, while price stability remains the focus of monetary policy, we are not oblivious to putting in place complementary monetary as well as credit policies and regulations that support growth and prosperity. Thank you, Namaskar, and Jai Hind.
Oh my God, this is a very startling policy. It means both a CRR cut and a repo cut of 50 basis points. So this is definitely an extremely pro-growth policy. And the last sentence that while we understand that inflation is our prime goal, we will not be oblivious to the importance to support growth during uncertain times. Clearly that statement is also extremely dovish. We perhaps are not seeing too much of a movement in yields simply because the rate cutting cycle seems to have ended for now. The policy has gone on to neutral, so we can't take further rate cuts for granted. That may be a bit of a negative, but I would think that it is positive. Banks, it's positive immediate fall in lending rates, and therefore, I mean, I would expect that the market is going to celebrate this in a decent fashion. Let me immediately get to our guests. We've got Sakshi, Upasana, and others with us, Rajiv Anand as well. Rajiv, first to you. Actually, what is the net impact if you've got a CRR cut, which liberates, you know, a 2.5 lakh crore on which you guys can earn anything from 6 to 7% by lending it? What is the impact on margins this year?
I think clearly, you know, like you rightly said, this is all about, you know, front-loading liquidity and rates to be able to get to a new trajectory of growth. And I think clearly in that context, the CRR cut is a huge positive. Our estimates and very early estimates, it would mean about 4 to 5 basis points positivity on NIMs at this point in time. One must also understand that you know, there is a cut, and so therefore margins as far as assets will reprice faster than deposits. But the CRR cut itself, if you look at it in isolation, would be about 4 to 5 basis points.
Yeah, immediately 4 to 5 basis points. But with the money multiplier going ahead, I think the benefit will be a little more. Of course, the 50 basis takes away from the margins, so you can't forego immediately. Let me come to the economists. Upasana, what have you made of this statement? Are you saying, will you now say that 5.5 it is and done?
Lata, the kind of surprises that we've got in this policy today, 50 here and 100 basis on the CRR cut, the stance has been shifted to neutral, and I think we should keep cognizant of that. We should, of course, you know, I think now what the governor has suggested is much of the rate action will be data dependent. There is a whole lot of uncertainty, global related, which he has referred to in his statement. And that will be the determining factor. If it has a spillover on growth, I think his last statement did refer to that while price stability is necessary, but not a sufficient condition for growth. So I guess he is open to action, but it also suggests, today's outcome suggests that the next two policies probably, at least to say the least, 2 to 3 policies suggest that on the repo rate front, only if we see a significant downside to his estimates of growth, we could expect some change, otherwise a pause in the near term.
So no action on definitely in August and October, you would say?
Yes, absolutely.
Okay, Sakshi, you agree?
Yeah, Lata, I mean, this policy was a big surprise. I think they've used the lower inflation and the space that they're getting from lower inflation to front load their rate cut. So, we had a terminal rate in this cycle of 5.5. And if we continue to see improvement in growth, I think that, at least for 2025 calendar year, we might not get any further rate cuts from the RBI.
Oh, okay. No further rate cuts this year. So your terminal rate is 5.5 now?
That's the terminal rate that we were working with. If growth comes in, broadly in line with what they are forecasting of 6.5, and we don't see a further, significant headwind from the global side, then I think that this could be very well the end of the rate cut cycle from the RBI.
Okay. Rajiv Anand, how quick will be the transmission of rates now that you all have slightly cheaper cost of funds overall because you can lend more of your money, 1 percentage point more of your deposits? How does the how does the transmission work?
Oh, I think as all of you know that on the asset side, a very large portion of the retail and SME portfolios are external benchmark linked, typically repo rate, and so those will reprice anything from starting from tomorrow to within the quarter. However, it is what will take a little more time, obviously, is retail deposits. Typical maturity of retail deposits is 1 year, so you will see that book reprice over a period of 1 year. Obviously, there could be banks will perhaps once again look at cutting rates on the savings rate. You saw in the previous rate cut, banks were able to cut rates on savings accounts. That could perhaps happen again. So to answer your question, a very large portion of the asset side will reprice quickly. The retail deposits will reprice over the next 6 to 9 months, and you could see a cut in savings account rates very quickly.
Oh, that's big. That's important. Mr. Lakshmanan from Federal Bank is also with us. Mr. Lakshmanan, what is your sense in terms of the yields? I don't think there has been much of a movement in yields, but in the Reserve Bank, the connectivity is not very good. So I'm not quite sure of how the yields have moved. Would you say that you are expecting the fall in yields now to stop? I mean, yields going below 6 is now out of the question.
Yeah, so I think, of course, all of us have been caught in a bit of a surprise on the 550. If you saw the yield movement immediately after the announcement, it came down to closer to 610. It's back higher right now. In other words, I would say markets are pricing in a 550 terminal. And if you look at the OIS rates, if you look into the behavior of the 10-year after the announcement, it's pretty much talking about bulk of the rate cuts having been done. If, of course, the growth surprises further to the lower side compared to what the governor has spoken, then perhaps we would expect the market to readjust. But for now, I think a bit of a bottom seems to already be formed on the rate side, both on the GSEC as well as on the OIS at this point in time.
Okay. Well, Ritu, I believe you have more data now that the RBI has put out. How is the voting percentage? Have all of them supported 50 bips? Can you enlighten us a little more?
No, Lata, it is not a unanimous decision. Actually, 5 out of the MPC members, 5 voted for the 50 basis point outside surprising rate cut. Saugata Bhattacharya, though, he only voted for a 25 basis point rate cut. And the RBI has not really said much on how the voting went as far as the change of stance is concerned. If you remember in the last policy as well, the MPC did not vote on the change of stance to accommodate it. Perhaps this time around, it was something to that effect because, the voting pattern on the stance change has not been specified. But the rate cut, not unanimous. Saugata Bhattacharya actually voted for a 25 basis point reduction only.
Okay. No, I would agree with you. Actually, now I think it is set in stone. As long as Mr. Malhotra is in charge, the stance will not be put to vote. And actually, the Monetary Policy Act framework and the changes in the Act do not require the stance to be voted on. It is only the repo rate which is in the purview of the MPC. And it was just the generosity of Shaktikanta Das that he put the stance also to vote. but it's not called for by the Act. And Urjit Patel also did not put it to vote. So he's actually status quo ante on that. Mr. Lakshmanan, again, I wanted to also ask you about transmission. What is your best guess? Do you think you agree with what Rajiv said about transmission?
Yes, so the key to look at is with the 550 coming back, you're looking at a 525 as the SDF right now, which essentially means that the liquidity corridor clearly in the surplus liquidity environment that has been promised by RBI through the CRR as well, straight away comes in over there. And thus, to that extent, the transmission will need to get the savings rate, as Rajiv was talking about, coming in the same direction. So yes, so it clearly the effort, which is unsaid as a part of the policy announcement, is the focus on transmission and trying and front-loading the transmission on the earliest. It's been the prerogative, I think, and that's what has been emphasized in this decision.
Okay. Upasana, if I remember right, you all had a more benign view of the terminal repo rate. Do you change that? That is one question. And the other question is, now clearly the cost of funds, the cost of loans is going to fall rather fast for the borrower. So any changes, will you ameliorate your growth forecast a bit?
Lata, two things. Yes, we were at 5 to 5.25 on the terminal repo rate, and bulk of it was seen in FY26. So we were expecting to exit with this lower terminal rate in this year itself. The way I guess the uncertainties are, our GDP numbers are still at 6.2%, lower than what RBI expects, and risks are evenly balanced. Through the course of the year now, because today's policy decision comes not along with just 50 basis of rate cut, it comes along with the CRR cut. So as you said, the cost of borrowing is eventually going to transmit much more faster because of adequate liquidity. And that is the reason why there is a risk to our terminal rate being dropped to 5.25 now. Of course, 5.25 is the effective rate now, the way it stands. But having said that, there is clearly a risk. I think I would just say one thing, because now the decisions are going to be very data dependent. It is possible still that the terminal rate reaches 5.25, but that could be deferred into the next year. So it's going to be a more staggered way now.
Okay. No, I'm just wondering whether if he has given liquidity of a permanent nature, it's of course staggered, but 2.5 lakh crore, which means 70,000 crore comes right away, or 65,000 crores. What's your sense, Mr. Lakshmanan? Do you think he will not have to keep 1% of NDTL as surplus? He will not have to push the call rate to 25 basis below the repo. That may stop, do you think?
One,
he may start reverse repo.
Yeah, so the first 25 gets effective on the 6th of September is what has been stated. So to that extent, from a liquidity standpoint, the story remains the same for the next about 2 to 3 months. And I think the conversation, as I stated earlier, is give a direction to the overall liquidity position of the system more than anything else right now. So to that extent, from a liquidity corridor standpoint, at this stage, we have moved the call, which was perhaps in the 575, 580 mark right now, straight away about 40 basis points lower. And given the surplus liquidity that we see right now, take it to the sub 550 band. But are we saying that we're going to be jumping into the overall impact of 1% straight away? I think it is going to take a bit of time. Yes, the transmission with the 525 as the MSF, as the SDF, clearly gives the impetus for the rates to come in significantly lower, much faster than what would have happened otherwise.
I know, I'm very strong. I'm going to ask this question in the press conference. Whether now do you really need to keep the call rate 25 basis point below the repo rate? Do you really, or do you want to restart, reverse repo? VRRs hereafter would be my question. Rajiv, if you want to answer that. And secondly, more important, do you think loan growth, credit growth is going to be faster than you earlier thought, would you say?
And I think that is the key question. And I think both the MPC and the governor have been quite concerned about the fact that despite the fact that liquidity has significantly improved, pre 31st March, we have not seen any material change in terms of credit growth, whether it is on the retail side as well as on the wholesale side. And I think the key question to ask now is, given the fact that in general, lending rates are going to come down by, let us say, anything between 25 to 50 basis points, are we suddenly going to see a surge in credit growth? I think that is really the moot point at this point. And the other way to perhaps think of it, and to put out a cautionary note, the fact that RBI has cut rates by 50 basis points, they've cut CRR, and we're going to see adequate or more than adequate liquidity in the system. Does that indicate or signal that they are a bit concerned about growth as we go forward? And so therefore, they have decided to front load significantly more than what the market expectations were.
Yeah, he clearly said that in his, what was his last sentence? That we are aware that inflation is our, mandate, but we are not oblivious to the fact that there are uncertainties around growth, and we will have to push it therefore. So I think he said it, he did not shy away from it. Sakshi, would you therefore, pencil in a higher growth? Would you push up your own forecast because you see higher credit growth? Because you see an RBI which says that I am all out to stimulate growth.
Right, Lata, I don't think at this stage I'm looking at revising up the GDP growth forecast. We are at 6.3 for the year, right? I think we have to remember a couple of things. One, monetary policy, of course, works with a lag. Secondly, while, the RBI is trying to address the supply of money in the system by doing all these, durable liquidity injections, I think demand for credit also has to kind of, pick up, right? And that is a function of how consumer demand is doing and income growth is doing in the economy and so many other factors. So I think at this stage, I think it is too early for me to think of revising up the forecast. Although I think with this front loading of the monetary policy, stimulus, both in terms of rate cuts as well as liquidity, it does give me some optimism or a little bit upside to my forecast going forward. But at this stage, I would keep it unchanged.
All right, all the surprising big rate cut and the big CRR cut, that of course is getting all of our attention. But I think one of the big deviations in this policy that we're seeing is really no comments from the governor on other non-policy measures. Usually you'd have some of the norms tweaks, something related to UPI, so on and so forth. Not a word of that. I'm wondering, I've been refreshing the RBI website as well, and I don't see any other measures that the market was expecting. But, Rajiv, if I could ask you this, the only comment sort of for the banking system that we saw from the governor was that the stress in unsecured loans and credit card has abated. Do you take that as a cue that perhaps the Reserve Bank of India may look at lowering or rather reverting the risk weights, the higher risk weights for the segment?
Absolutely, Ritu. I was, given the fact that they have already done so much, rate cuts and liquidity, I would have liked them to reduce risk weights on unsecured loans, and I think that would have perhaps signaled to banks as well to indicate to them that RBI is a lot more comfortable as far as unsecured loan growth is concerned, and so therefore banks could potentially push that. So yes, will it come post the policy? One will have to wait and watch.
Yeah, absolutely. I mean, again, there is nothing yet on the RBI website on any other measures that were to be announced, and perhaps in the Q&A we'll hear more on the foreign bank holding and so on and so forth. Upasana, quickly, do you expect now this pause to continue for the remaining part of the year? Just give us a understanding of, you've given us your terminal repo rate, but when is the next likely move?
At this point, I would say in the near term, I can only foresee a pause, honestly. They have front-loaded a lot of their actions, and CRR cut was definitely not a part of this base case of ours. So I think this liquidity plus a repo rate cut, which is much more aggressive, does suggest that there is a need to pause for sure, at least over the next 2 to 3 policies, I would say. That would also give a window to evaluate the risks on growth either direction. Like, for example, even the RBI is expecting 6.5 with balance of risks on either side. I would say that there's a lot of uncertainty on the global front, how the investment environment is going to plan out. And that still poses some risks on the growth front. How much of that will time will only tell. So in all of this, I guess that was probably the reason behind such kind of front-loaded action by RBI. And hence, for the timing, I would expect as a pause in the near term.
Okay. Okay. Well, just to add to Ritu's questions, Upasana, you're also not raising your growth forecast?
Not at the moment.
Okay. No, I can imagine there are too many uncertainties, but this is a damn vigorous attempt by the Reserve Bank and the MPC to spur growth. I'm actually missing Soumya Kanti Ghosh in this conversation. He was the only one in our Citizens MPC who voted for a 50 bips rate cut, and in some stray conversations had also mentioned CRR cut. Rajiv Anand, actually, do you think that the governor will even stop at 3%? See, all these CRR cuts, etc., were set at a time when public sector banks ruled the roost, and that was the only way Indians saved. Now the whole structure of banking has gone into a huge change, and banking is not that languid banking that we could bank on in the 90s. So, I mean, is there even more, or 3 it is and done? Legally, he can't go below 3. The law needs a change.
Exactly. And I think, ultimately CRR is a liquidity tool. You yourself mentioned this many times, that this is sustainable, long-term, durable liquidity that has been infused into the system, and gives the banks the ability to increase lending on the other side. And I think, they've looked at this as a total package, CRR cut, liquidity, and the rate cuts. And as the economists on this panel have said, it looks like they front-loaded everything, and basically indicating to the market, don't expect very much more, at least for the next couple of meetings, unless the world changes dramatically.
Okay, very quickly, I know you will have to go back to your ALCO and your CEO and all that, but broadly, you think most banks may be upping their credit growth forecast this year, Rajiv? No?
As I currently stand today, that looks unlikely. I'm not seeing the impetus at this point in time. Like I mentioned, overall system liquidity growth is around 10%. I don't think we are seeing impetus yet to believe that over the next 6 to 9 months, this number is going to go up, even let us say 200 basis points.
Oh, okay. Lakshmanan, if you have a thought on credit growth, that, and the other question to you is, now what is your range for the 10-year? What is the market telling you? What are the OISs telling you even of the shorter term rates?
Yeah, so the first question, yes, credit growth. I think we've seen if you look at the banking system growth on the balance sheet, it has been on a downward trajectory. A lot will depend, of course, not only in terms of the monetary action that's happened today, but overall in terms of the consumer demand, the overall spending intent of corporates per se, given the cost of liquidity as we're talking about it, and of course a whole lot of situation across the border in terms of what's happening in the US. A lot of that is going to be driving in terms of how companies are going to be spending, how the customers are going to be having a nature for demand. So we still have to wait out and watch as to how the credit growth will happen. So I don't think the algos, in my view, are going to rush into increase the credit growth just because of this. It is still going to be wait and watch in terms of how various parts of the economy are faring. In terms of the rates for GSEC, I think, in a way, a 6-10 move that has happened perhaps has hit the bottom at this particular point in time. The 1 year, the 5 year OIs are in a way speaking that 550 to a 5-quarter kind of a terminal is what is there right now. So I'm not in favor of talking about a 10-year immediately going lower because of 50 pp cut that has happened and the liquidity infusion. In fact, the key thing to note is also the fact that the stance has been brought into a neutral right now. So given all of that, at this stage, I'm not calling for the 10-year going in significantly lower from perhaps the 6.5, 6.10, 6.10 that was seen today.
Sakshi and Upasna, both of you, I just quickly wanted your comments. Sakshi, starting with you. Given all of this, in summary, what are the comments, what are the questions you'd want to hear answered from the governor in the press conference that will start at 12? Sakshi, with you first.
Yeah, so Ritu, I think we've discussed a couple of issues already. I think one of the things that, I would be interested in knowing is within the liquidity injection that the RBI is doing, and the governor spoke a lot about our external sector, FDI, FII, the FX reserve position. Where does the, is there any thinking at the RBI in terms of its short, forward dollar book? Because, ultimately, if they're going to let that mature, that is negative liquidity, right? So I think just some perspectives around that is something that I would be interested in knowing.
Okay. No, everybody wants to know about what are you going to do with your short dollar positions. But they have managed from what a load it was. Was it, 80 billion or something? I mean, they've managed it well. So I would give them a lot of credit. Of course, you can't rule out some kind of a swap because of that. Some very, very long-term swaps. Digant Haria has joined us to give us an idea of how bank stocks should be approached now. Incidentally, the Bank Nifty is the best performing index now, and no prizes for guessing why. That unexpected whopping 1%. Shaktikanta gave only 50 basis CRR cut. Malhotra has given 100 basis points CRR cut. Digant Haria, do banks become attractive now? Will the margin crunch be less on a full year basis, even if it is a large crunch in the immediate quarter?
Yeah, morning, Lata. See, I think this rate cut and this liquidity infusion, it tells us one thing that, somehow the growth is not picking up. The economy has been slow. So, while it is a reason to celebrate, it is also an acknowledgement that growth is not as per, what the RBI is expecting or what, our country's potential is, especially if we see the consumption sector, the auto sector, or even the real estate sector slowed down. So I think this is a step in that direction. And see, banks, as we all know, right, that initially 1 or 2 quarters is something where they suffer because of these rate cuts, because the customers are expecting that some of these rate cuts will be passed on immediately. And the deposit rates are slow to respond. Even the rate cut which happened 2 months back, the deposit rates did not move down as fast as the loan rates. So I think another 3 months, another 3 to 6 months of margin pressures for banks is there. We just want that, the growth has to recover. The system growth is at 9% currently, the loan growth for the system. That has to go to 12-13% because that is where our equilibrium is. The global macros are good. Now the domestic macros will significantly improve after this. So I'm very hopeful that, after monsoons, we will see, good demand pick up. Banking stocks can do well. But again, in large cap banks, we are very careful because there's not much upside. But there are a lot of these weak liability franchise. That's our hunting ground, Lata.
Okay. Well, actually, on a external, extraneous point of view, one of the reasons why the loan growth is a little lower for the system is that the second largest bank is in a wanton low loan growth mode. But for FY26, their guidance is that they will grow as much as the system. So perhaps even that would be a push in terms of higher than the 9% loan growth that we now see. Digant, I mean, what stocks should one go for now? Since the cost of credit for the borrower has come down more than we thought, so would you go for real estate stocks? Would you go for NBFC stocks? Would you go for the usual borrower stocks?
Yeah, so Lata, firstly, I think the weak liability franchise stocks, the stocks like, say, an IndusInd Bank, an IDFC Bank, or a RBL Bank, and, all these small finance banks, the Equitas, Ujjivan and Jana Finance banks, I think they are the ones who suffered big brunt of the tight deposit and liquidity environment for the last 12 months. I think they will see a good reversal, not just in growth, but, even in margins and the asset quality. So I think that is where the biggest data in terms of earnings is. So we'll focus on, not the top 8-9 large banks, but the banks which are below that, which suffered over the last year. That should be the first basket one can look at. The second basket will obviously be the interest rate sensitive, the real estate stocks, not the luxury ones like Oberoi, because luxury is indifferent to real estate. But, at least somebody who is selling in that 50 lakh to 2 crore kind of ticket size, those real estate stocks. And auto stocks are also somewhat interest rate sensitive. So, something like, car stocks, car stocks will. And we also saw that budget, where consumers were given some bonanza. So I think combine all of this, we should be seeing very good festive season this time. At least that's our hope. So these three baskets is very focused for stock ideas.
Real estate and auto, of course, the first thing that comes to mind. But Rajiv, let me quickly ask you, in this rate cut cycle so far, what we've seen is a faster repricing of deposits. Then they've already come down by as much as 70 basis points for some banks. Is there scope for further reduction to protect NIMs as your external benchmark-linked lending rates come down?
Oh, absolutely. Ritu, what you've seen is that if you look at the liability stack, the institutional portion has repriced faster. CDs have dropped, from close to 8% to 6.25-ish, and they'll continue to fall. Similarly, non-retail term deposits have repriced very, very quickly. The stickier portion really is retail term deposits. There is a stock and there is a flow. Obviously, flow has already repriced and will continue to reprice. But I think it's as far as the flow is concerned, as far as the stock is concerned, it will take over the next 6 to 9 months for it to reprice. And I think one of the things that we've seen, like I mentioned earlier as well, one of the things that we saw earlier in the year is that banks have been able to reprice savings account rates. I do believe that we will see one more cycle of that as well, particularly among the larger banks.
All right, running out of time. Upasana, quickly, let me complete that question. What would you want to hear from the governor in the press conference?
So I think one important part is now that we have shifted the stance back to neutral. Does that, and there are two things basically. Liquidity has been provided in ample, and stance has been shifted to neutral. So do the overnight rates, will they be anchoring closer to repo rate, or there is still going to be effective easing with overnight rates still continuing to, hover around the SDF rate? So basically overnight VRRs can be introduced to ensure that at least, we do see some kind of an uptick and rates not falling really below the lower end of the corridor. So this is something which should be, I think, provided for as clarity. Maybe we'll have to wait for the new LAF framework, the liquidity framework, for such clarity. But yes, I think that is one important aspect. I just want to highlight one more point. Since we've talked about the forward outstanding, the CRR durable liquidity which is being provided for, which is going to be spread in 4 tranches, I think this could be an offsetter to the redemptions that will be happening on the forward book. So this could actually neutralize the book that is existing at this point. And as a result, in the second half of the year, wherein there was scope for additional monetary liquidity easing measures, that could be nullified now.
All right, those are important comments to take note of, but unfortunately we're completely out of time. Sakshi, Upasana, Rajiv, Lakshmanan and Digant, thank you so much for helping us pass through this very important policy, taken us all by surprise, that 50 basis point rate cut and 100 basis point CRR cut, along with the change in stance to neutral. All of you, thanks very much for your time here. I'll toss it right back to Lata for her closing comments.
Well, it is clearly a policy that has made us sit up. There's no denying that there is a fundamental shift in the way we have to approach banks as investors. The Reserve Bank is telling us that the days of easy banking are over, and therefore, squeezing out the banks with larger requirements, prudential requirements, should also be brought down. Give banks a fair chance to play as commercial players. That seems to be one of the thoughts. Of course, there is the growth angle, there is a macro angle, but I'm also saying that there is a banking regulator angle over here and a banking development angle over here. The second big point is that, at the moment, the governor has gone, or the RBI has gone all out to stimulate growth, which can mean two things. That if the global environment is not as horribly challenging as it had been on April the 2nd, then probably we have a better chance for credit growth and growth. But on the other hand, does the Reserve Bank know a thing or two about growth? Is it getting a feeling that growth is severely challenged, and that is why it has gone all out? There is that double-edged sword in terms of how you have to look at it. But for the moment, the stock markets are celebrating, and the anticipation is that borrowing companies like, autos, real estate, NBFCs are going to have a good time, at least in the near future. The worry will really be for the bond dealers, where, the expectation was that the yields will go below 6% because there was a goodish bit of a 5% expectation of rate cut. By going to neutral and by almost hinting a kind of a pause in the near to the medium term, the yield, the rally in the bond market has kind of will plateau for the moment. But there are lots of questions to ask the governor in terms of how they will handle liquidity on a day-to-day basis. On that note, once again, thanks to all my guests and from Ritu and me, thank you very much for watching this special show. After a break, it's time for HTR halftime report.
Hello and welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema. With me is Hormuz Fatakia. And the RBI has fired the monetary bazooka, slashed interest rates by 50 basis points, shifted the stance to neutral, and this bigger than expected easing has lifted the market moves as India perhaps is getting, according to the RBI, getting ready for this pro-growth stance. Benchmark indices up close to about 0.9%. The Nifty inching towards that 25,000 mark. The only question now is, as everyone's been pointing, what next, right? What's left in terms of a trigger? And RBI, the governor himself acknowledged that the MPC felt it is now left with very limited space to support growth. So it seems like all the good news, at least from the monetary policy side, for now is in the price.
What a roller coaster policy it was, right? If you look at that intraday chart of the Nifty, before the rate decision came, it was at the lows of the day, and then that 50 bips rate cut comes, and then the RBI governor's comments on very little policy room, and then you were being in a bit of a sluggish move, and then comes that big CRR cut that was announced, and since then the index has been in one-way traffic, of course predominantly led by the Nifty Bank, which is at a record high as of now. The Nifty 2 is heading towards that 25,000 mark, now a mark that it has managed to close above but not sustain at those levels. And the Nifty Bank now at 56,500 is where it stands, an almost 900 point recovery from the lows of the day. So it is a very, very strong move in the banking names. And of course, It is the NBFCs, the banks. IDFC First is up 5.5%, and Godrej Properties, real estate names too. Godrej Properties is up 5%, DLF up 4%, Oberoi Realty up 4% as well. And of course, the comments coming in on the unsecured space as well from the RBI governor has led to these credit card names doing well for themselves, be it SBI Cards, be it the likes of PNB Housing Finance, Shriram Finance, all of these NBFCs, and look at SBI Cards too at the highs of the day. So it is the banks and the NBFCs that have had a big up move, and that has contributed to the moves on the Nifty as well. Now, Ajay Srivastava, who is the CEO at Dimensions Corporate Finance Services, is joining us now. Ajay, good morning. Thank you for joining in. What do you make of this absolutely roller coaster policy? First the 50 bips surprise, then comes the CRR surprise. What does that do now to all these banking, real estate names?
Well, it's doing what's supposed to do. I think it's done already what's supposed to do is to take them up, because I think it's a brilliant move. It's a brilliant move because this is one RBI governor who knows what's happening on the street. And what's happening on the street was slackening demand, consumer demand was at historic lows, the stores were empty, the real estate was feeling the pinch as well after a bumper year. And he knew he had to do something to get the spirits up. And I think he's done what he has to. And I think I love the guy. He just went all in. He didn't go and saying 25, 50, and this kind of stuff. He just went all in and said, guys, here are my chips. Now I've dealt with all to you. Now it's up to the finance ministry now. Nothing more I can do. And I think the response has been tremendous in the market as well, because it's not only the fact that the rate reduction, it's the fact that the RBI is conscious of what's happening in the real economy and responding to it. I think that's the chief signaling one takes away is he's noticing demands fall, he's seeing consumer sentiment is down there, and he gives a bumper to say, okay, I'm going to give you some more money to your pocket, your EMI is going to go down. So I think it's more than just the policy gesture. I think it's also the response to what's happening on the field in the economy. That's a great positive coming from the move, and I think we should look at it positively to the manner that more should follow from finance ministry now on the GST side. I mean, that's the last leg left to get this economy up and going, because the demand is slow in the market.
Given that the RBI has done whatever it could, we've seen cumulative rate cuts of about 100 basis points, everything that the market would have hoped for, perhaps even 6 months later. Are you surprised with the kind of reaction? Would you have anticipated that with this kind of a policy, markets would have moved up more? And what is that telling you?
No, more, we behave like Oliver Twist. Can we have some more? Okay, yeah, we can have some more. We can have some more rate cut. We can have some more market going up and all. And nothing going to finish in one day. The market will carry on tomorrow, digest the news. See, it's also a reflection. It's a very important reflection in that the demand is slow. The loan growth demand is slow. People are not buying products, whether it's two-wheeler, whether it's consumer staple, whether it's apparels. And therefore, this is a response to a demand slowdown. So it's not like it's going to be gangbusters tomorrow morning. The demand will start to shoot up because EMI has gone down. So the market is smart. It knows the reality of demand will not change overnight. Yes, it gives an impetus to people with lower EMIs to spend more. I think that's what it does to this policy. And those rates will come down over time, etc. But therefore, market is fully cognizant that we are operating in a low demand scenario. So don't get carried away with what we are doing in terms of that this will open up some great growth of this thing. The growth forecast is still 6.5. It's not changed in the RBI stance. And I think lower inflation also reflects in an economy like ours, the demand slowdown. So, yes, you can expect market to have gone up by 3% or 4%. But the fact is, we are all cognizant that the April, May, June results will not be the best result for most companies, and therefore temper down expectations, react to it. A lot of it is short covering also in the market. Market was heavily short at this point of time. So a lot of it is short covering more than investment buying. So one has to temper down and say, good day. At the end of the day, we all end well. I think that's a good part. But signaling is more important, that RBI is willing to act. And I think we can take some comfort from that.
Promise less, deliver more is what would the street be expecting, right, when it comes to these companies going forward. But Ajay, does this mean that these larger private financials, the private banking, the giants, the HDFCs and the ICICIs, would they be the better placed ones now to put your money to work in, considering these cuts that have happened, and now will be better placed to increase their loan growth, to increase their growth in general as well? So does this large-scale private financial names, which has been a general consensus of the street as well, right, does this now become a more attractive opportunity than what it was?
Oh, it does, because two things happen. One, of course, is that the capital requirement goes down because the CRR releasing money, they don't need to, get more capital in. So capital dilution gets postponed. That's the biggest thing happens in a bank. The moment you expand, you need more capital apart from profit. So you keep diluting your shares. So I think this is important for the CRR cut, particularly is important from the perspective they have more liquidity to lend. They don't need to necessarily go raise capital and then raise debt and then lend to the market. So one big important factor is that they will now have postponement of capital dilution. So obviously it becomes a good story for all of us to buy into. But having said that, more important thing to realize is that banking as a sector always underperforms the real economy. So when you're investing and allocating capital, yes, HDFC Bank may go up or X, Y, and Bank may go up. But remember this always that real economy will give you better returns in India than the banking sector. It's true for the last 5 years. It will remain true for the next 5 years because banking is a heavily competitive sector, unlike most economy sectors where we have duopolies or reasonably strong companies with good margins. So you got to be careful to allocate capital to say, don't get carried away with financials because for a financial company to grow, the real economy has to grow first.
What about real estate? Do you see, at least at the lower end, buyers coming back with these cumulative rate cuts?
Oh, yes. I think it's a great relief. It's a great relief because people who had bought the properties were not been able to pay. Most of them were having trouble paying up the property rates. And therefore, it's a big relief to them that the EMIs would drop and they can buy more because the real estate price has also gone up. So I think it's a great relief for real estate buyers per se. They should come and buy it. Unfortunately, all the listed companies cater to the luxury space, which is not necessarily kind of affected so much by the loan interest. So I'm not sure there's a direct correlation for most listed companies, Rima. But the fact is, generally speaking, a lower EMI results in a positive outlook towards real estate, generally speaking. So I think it's a good move for all the real estate companies, although most of them sell to super luxury market for whom EMI rates make really no difference.
Ajay, now that the policy has been hogging the limelight, the other two sectors that have been hogging the limelight aside of the policy, one has been defense, the other has been railways. Stocks going up 80-100% in a month. Defense has had triggers, but that is also on a very, very long-term basis that their order inflows coming in. The executions will happen over a 3-4 year period. But stocks have gone up and they've gone up exponentially. Same is the case for railways. And despite the fact that they are still down almost 30-40%, these railway names, you still find them expensive?
Of course they're expensive. They're crazily expensive. But yes, a couple of companies had a lackluster 1 year or 2 years, which happens, but they're good quality companies for long-term growth. So, just to look at a perspective from a 1 year performance, I don't think it's fair to some of the companies. But having said that, any sector which is dependent on the government for the order book needs to be approached with great amount of caution to say, yes, these ride up because so much of liquidity goes to such a, how many defense names we're talking about listed? 5, 7 private listed? That's all the stocks in India are. And then there's the PSU bunch of 4 stocks. So, so there is a lot of money now chasing these 6 stocks. It happened, remember, almost 6 months back. This went crazily up. And then what happened? Every mutual fund came with a defense scheme, and I think 1 or 2 mutual funds have barely made it to the break-even point after 8 months or 1 year defense. I'm talking of defense-focused mutual fund. So it's a flavor of the season, and as you say, in the flavor you enjoy it, but learn when to get off and book your profit because it will not continue. The expectation of demand is such, valuation-wise is so high. It's not going to be satisfied at the end of the day. So yes, ride the tiger, ride the trend. But the fact is, when the music stops, it will stop every 6 months. When realization comes, orders are not coming. Are you going to be sitting on a chair? Are you going to be standing, waiting out in the mirror? That's the question to yourself.
Enjoy it till it lasts, as they say. Ajay, pleasure having you as always. Thank you so much for sparing time and joining us today. But to take this conversation forward on the RBI policy, we are being joined now by Mr. V. Vaidyanathan, the MD and CEO of IDFC First Bank. And Ritu is here to take this conversation forward. Ritu.
Thank you so much, Harmaz and Rima. And Mr. Vaidyanathan, thank you so much for joining us here on CNBC-TV18. Big surprise from the policy, that 50 basis point cut and the 100 basis point CRR cut and the change in stance, of course. First thoughts, what did you make of it and what does it mean for NBFCs like you?
Well, for everybody in the system, whether banks or NBFCs, it's pretty clear that RBI is doing everything they can to support growth. They can see the inflation trending down. So they have seen the data and accordingly taken this decision. and that's obviously going to, in our sense, will support growth.
Well, it will support growth, but tell us, Mr. Vaidyanathan, immediately the first thing that happens when we see a rate cut from RBI, of course, your external benchmark-linked lending rates for banks will go down. What happens to margins? What are the levers to protect it?
Well, I can share our own sense on this front, and maybe our representative was one of the representatives, I'd say, that in our case, about 30% of our book is repo linked. So a 50 basis points cut will give a 15 basis point reduction on that front. About 10% of our book is MCLR linked. Let's call it a couple of basis points there. And because the CRR cut will improve the NIM by about 5 or 6 basis points. So let me say on the existing book, all put together about maybe a 12 basis points on the reduction.
Only 30% of your book is linked to the external benchmark, Mr. Vaidyanathan?
Yeah. To the repo, yes, only 30%.
Okay, in that case, you see a limited downside, and on the liabilities front as well. We've seen in the rate cutting cycle so far, liabilities getting repriced faster. They've already come down by about 30 to 70 basis points for banks. Is there scope for further reduction from here on?
Yes, indeed it should. In fact, this morning anyway, we made certain cuts in our deposit rates. So on the fixed deposit rate front, we have dropped our interest rate straight down to 7%. We were paying about 7.8 to 7.9% maybe until a few months ago. So 7% meaning there is a particular bucket which is really representative because that's the peak bucket. Let me say we've taken a peak bucket down to 7%. So that's a reduction we have done. We have done some reduction on the savings front also. So maybe after this rate cut, we'll have to cut this further.
All right. That's interesting to hear. But coming back to that very surprising, large, permanent liquidity injection in the form of the CRR cut. And now that starts from the 6th of September, and it'll be in equal tranches. So assume about 62,500 crores of liquidity coming into the system starting September. How much additional credit could this unlock, Mr. Vaidyanathan? How will your own credit growth number for the year go up on the back of this additional liquidity that the bank gets?
Well, you know that credit has been quite tepid earlier. A couple of years ago, it was growing by 15, 16%. It's now people are talking of 10, 11%. It's been let me say, a significant slowdown on credit. This will definitely, without a doubt, support credit because, EMIs will come down. That amount of EMI coming down will leave that much more cash in people's hands. And this is a substantial cut. You can see CRR coming down and repo coming down by 50 on the back of a reduction already done in the last couple of months. So EMI should come down. That leaves extra cash in people's hands. And that should, no doubt about it, should support growth. And at least we can clearly see that, really RBI is doing everything they can. I have a sense that this, maybe it comes with a lag, but it will look up. And to your previous question on the NIMs, just to be clear on the record on what we expect, I read out. I know I said some numbers to you, but the impact on NIM will be a little more pronounced initially because the rate cut is immediate and customers get the benefit immediately. And the deposit rate reduction, when the FD is fixed deposit reprice, it takes about maybe 5 or 6, 7 months, 1 year to reprice. So the catch up on NIM, let me say the reduction on NIM that will happen the first 2 quarters, let me say by third quarter, fourth quarter, should normalize again. But we're running a bank for the long run. These small cycles, 1 or 2 quarters, we should be able to take.
Well, interesting that by the third quarter, you expect any sort of hit that the NIM will take for IDFC First Bank to be reversed once the liabilities also, catch up with the lag.
But start catching up, so to say.
Yeah. Well, Mr. Vaidyanathan, you did say credit growth is expected to be higher on the back of the CRR cut, but to what extent?
Well, I was talking for the system, for our bank, we have a plan. We're working to a plan. We'll watch this very carefully. Of course, if the market is more buoyant, naturally we'll participate in it. And, but our main thing is that we will want to keep credit quality really in good control. And that is our prime focus. And we will stay to our broad plan about how we want to grow credit, and we'll watch out for the opportunities.
All right, so but no numbers that you're sharing with us yet. We'll get back to that. But Mr. Vaidyanathan, another interesting comment that came in from the RBI governor was on the fact that unsecured loans, credit card loans, it seems that the stress has abated. I mean, is that the sense you're getting as well? And also, on the back of this, are you expecting RBI to revert to the lower risk weights?
Well, on the unsecured front, we have always been saying that unsecured is a cash flow driven lending, and cash flow driven lending on unsecured also behaves almost as good as secured, because cash is also security, and being able to debit a customer's bank account on the due date, having seen cash is as good as an escrow. To that extent, it does give comfort. But RBI has been watching this for a time. They have always asked us to be cautious and asked everyone to be cautious. I think the fact that they of course have a big vantage point to see, and at their vantage point, if they're seeing it, then it's more encouraging. And of course, they also pointed out that MFI stress has exactly not gone away for the whole system. So all in all put together, I mean, it's hard to say whether they will look at the risk weights again, but maybe they will watch it for some more time. Maybe they'll watch it for 6 more months, 9 more months. At some point of time, if they get more comfort, maybe they will.
All right. Well, RBI does have a bigger picture and a view of all of the banks and NBFC's balance sheets. So yes, Mr. Vaidyanathan, finally, as a banker, is there some clarity you would seek from the RBI governor we should watch out for in the press conference?
I think the picture that they're putting out is quite clear, that they see they'd like to see growth and they'd like to support growth. So I think that maybe, of course, this has to be seen in the context of what the government of India does, because government of also kept fiscal under good control. So it's not exactly a question, but just a remark that this whole movement has to be seen in the context of what government also does. And I think the really good news here is that I'm seeing that the RBI is doing its bit. After, as you know, RBI is very thoughtful and they really look long. But while they've done what they've done, apart from that, I think probably they're working very closely with the regulator. With the government. Looks to be a coordinated effort. So not really a question, but I'd just say that looks like everybody's aligned towards a broad direction of keeping stability and growth.
Well, yes, and RBI has clearly gone all out in support of that. Mr. Vaidyanathan, always a pleasure. Thanks so much for your time here on CNBC-TV18.
Thank you very much.
Thanks a lot for that, Ritu, for that interesting conversation there with the management of IDFC First Bank. By the way, the index now at 24,965, still finding a bit of resistance at that 25,000 mark. Despite this very, very strong policy from the Reserve Bank of India. The Sensex too 650 points higher. The Nifty Bank, though, continuing to trade at a new record high. Take a short break. On the other side, all things commodities with Manisha Gupta. Welcome back. Shifting focus now to the commodity space. Manisha is here with us. And today what's glittering is silver and not gold, Manisha.
Absolutely. And what a catch-up that silver has done with gold. If you look at the prices right now, well, we're trading at a 12-year highs in the international markets. And for the Indian markets, after making that all-time high at around 1,05,000 rupees a kg, thereabout is where we are trading at this point in time as well. Well, the gold-silver ratio after hitting 105 did give an indication that silver is a big screaming buy right now. So the gold-silver ratio right now stands at 94, and the silver run-up clearly indicates that. If you look at the prices then, we are gained up by 8.5% for this week alone, and we are up by 24%. So clearly catching up with gold, which is trading 29% higher for this year, while silver is up 24% till time. Well, it is about strong demand from the industrial sector, which is expected to be at record highs in this year after hitting a record in 2024 as well. That has been a supportive factor for silver. Also, this year is going to be a fifth straight year for deficit in case of silver by nearly 21%, and that clearly has been supportive for markets. Well, the industry anticipates that we've done $36 an ounce in the international markets already. Silver is headed to $38, perhaps $40 an ounce as well by the end of this year.
All right, Manisha, thank you so much for that update. Silver, of course, heading higher and higher towards multi-year highs, and that has had an impact on shares like Hindustan Zinc, which is, of course, the only pure play silver company in the country. And the shares were up yesterday as well, and in today's session too, up 1.25%. Take a short break. On the other side, a quick chart check with Somil Mehta from Mirae Asset Sharekhan on the other side, and some trading ideas as well. Stay tuned.
Welcome back. The Nifty is up more than 200 points, 222 points up as we speak. Sensex up close to about 700 points. The Realty Index is racing away. The Nifty Realty Index is up 3%. The BSE Realty Index is up close to about 4.2%. So to talk more about the moves that we're seeing, Ria joins in.
Well, yes, Rima, realty stocks are trading higher post these announcements from the RBI. So let's take a look at what this spells out for the sector. Largely, this is positive for the affordable and mid-income housing segments. Taking a look at what Anurag has said in terms of the impact of the repo rate cut, they've said that we can see a demand boost in the Indian realty space, especially in the affordable and mid-income housing segments. And this can also lower developers' borrowing costs as well. In terms of the impact of the CRR cut, developers can have more access to capital as a result of the increased liquidity in the banking system, and this can positively impact project completion timelines as well. And they've also said that this gives banks the option to reduce home interest loan rates as well, which can lead to positive sentiment going ahead. Knight Frank has also echoed this sentiment. They're saying that the RBI's 50 basis point rate cut marks a very strong and proactive stance aimed at lifting the low and mid-value housing segments. They've said that they expect rekindling of the lower segments as affordability will witness a meaningful improvement for home buyers going ahead. CLSA had also come out with a note on the real estate space this morning. They've said again that the affordable and mid-income housing segments will see increased demand going ahead. And the key beneficiaries on this front should include developers such as Sobha, Prestige, Godrej and Suntec. In fact, they've also highlighted that REITs and large rental players such as DLF and Phoenix Mills also stand to benefit from lower interest rates on their debt and a slight asset reflation as well. So on the back of this, all of these realty stocks have been trading higher in today's session. The biggest gainers include Hubtown and Ajmera Realty. Even other players like Kolte Patil, DLF, Purvankara, Godrej Properties, all trading with gains of anywhere between 3 to 5% right now.
Indeed, strong moves coming in there for a lot of these realty names, and the smaller ones in particular. They are the ones on DLF too is up 7% now, among the top gainers on the Nifty Realty Index. But the one constant factor that has been part of this week has been the slew of block deals that have taken place almost every single day, and today has been no different. Vivek is here with the latest updates on what happened today. Vivek.
Well, gush of liquidity on Mint Street and a gush of liquidity as far as Dalal Street too is concerned. Well, a lot of block deals. So the first one that we are looking at today is Bajaj Finserv, a significantly large one, almost 5,000 crores worth of block, of 5,500 to be precise. Two promoter entities, Bajaj Holding as well as Jamnalal Sons, were the sellers in today's block deal. Almost 1.8% of the total equity changed hands. What is it that we need to watch out for? Number one, usage of funds. A calculated, educated guess would be most likely that the promoter entities would use these particular funds to go ahead and settle the dues that they owe to their partner. And along with that, remember, there's a 60-day lockup on further sale of shares. So we'll need to see whether after 2 months there is another block deal that happens or whether there is a fundraise via another route. The other stock, again, that saw its block deal happen in the window itself was ZF Commercial. Here, it was actually, from our colleague Ruchit, who had indicated to us, the promoter WAPCO, sold a little over 3% stake in the company, almost 780 crore worth of shares exchanged hands. And Azad Engineering, this particular block happened as soon as market opened, almost 7% of the total equity changed hands, a little over 700 crore. And we understand most likely it was the promoter entity that probably trimmed their stake. And lastly, one particular QIP and again a fund raising, IREDA. Base size of this particular QIP at 1,500 crore, upsize option of 3,000 crores, so total almost 4,500 crore worth of fundraise being done by IREDA. Indicative issue price at 165 rupees a share, almost a 6% discount to yesterday's close. So again, this is an important development to watch out for. IREDA, post this particular QIP, the promoter stake will reduce.
Thank you very much for that. Let's address the market technicals. Somil Mehta from Mirae Asset Sharekhan is now with us. Somil, still not managed to conquer the 25,100 mark, which was the upper end of the trading band. But given the kind of pop that we've seen in the markets now, do you expect that level to be taken out on the way up? Is there a buying opportunity? And even banks, big move on the Nifty Bank, 1.5% up.
Absolutely. I think that this range will be breaking out very soon. We had a range between 24,500 and 24,800. That range has been broken on the upside, which is a good news. Markets have taken support at 20 daily moving average, 10 daily moving average, making hard ups, high bottom on the lower time frame. So all looking great especially the large caps like Reliance, HDFC, Axis Bank, ICICI Bank, all are looking great. Reality sector is looking great. So overall, good sentiments, high top, high bottom formation. This rally is expected to continue. The next target for Nifty would be 25,500 in the short term, medium term, probably 26,000 as well. In Bank Nifty as well, I think this is a clear breakout and the range has broken on the upside. In the very short term, I'll be expecting a target of 56,800 and above 56,800. And I think the next level would be 57,500. So overall, great momentum at this moment, and I will be focusing more on large caps now after a long time, and that's the reason I have two large caps in my buying radar. First one would be Tata Motors. Has been a laggard, has been in a range, but I think this is the right time to go ahead and buy Tata Motors. Stop loss would be 690 and the targets would be 755 in the short term. The second one is Axis Bank. It has just started moving and the targets are around 1280. The stop loss would be 1160.
Interesting. Tata Motors, a buy recommendation from Somil. The one who would not agree with that is JP Morgan, who downgraded the stock today and also cut its price target. But Somil, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. Well, it's time to take a short break. More on the markets on the other side. Well, Mount 25,000 is conquered on the Nifty yet again. We closed at that level just last week, but we could not sustain at those levels. Now, courtesy the RBI policy and the twin surprises of a 50 bips and a CRR cut, we are back at that 25,000 mark. We even mentioned this in the morning today that in case there is a 50 bips rate cut, it might just help the Nifty break out from that range that it found itself stuck in over the last couple of weeks. And there you have it, 25,000 now on the index, 250 points higher for the Nifty. And of course, a big contributor to that is the Nifty Bank, which is also continuing to make new highs. Saumil Mehta just mentioned a few minutes earlier that he's seeing targets of 56,800 on the index. So another 200 points higher is where he sees it. So now the Nifty Bank has recovered almost exactly 1,000 points from the lows of the day. So it's a 1,000-point recovery on the Nifty Bank, and that's showing up on the Nifty as well. We talk about the positives. There's not so good news in terms of the layoffs that are taking place in the US, and they're happening left, right, and center. And it's not just the smaller names; it's the bigger ones that are leading this, Reema.
You know, I think now the big change is that earlier it was more specific to tech. Now it's impacting the real economy jobs, the manufacturing jobs, particularly in consumer and retail, because these two sectors have the added headwind of the tariff impact. So there's all the more reason for them to tighten their belts and save costs. And then you're going to turn to AI to do that. So let me run you through the latest news. You can see that on your screen. So Procter & Gamble has announced its plans to slash 7,000 white-collar jobs. This is about 15% of its non-manufacturing workforce. They're planning to do this over the next 2 years. And the company is saying that the goal is to build a leaner, more agile organization. But they're clearly trying to say that they will be using more digital AI tools because they want fewer people to do more work using better tools. Just some more details. They haven't specified which department, which region is going to get hit as of now. But the company has budgeted $1 to $1.6 billion in pre-tax restructuring costs, which will include your severance payouts, system upgrades, other transition costs. But as I said, another reason why you're seeing this in the consumer retail sector is because of the tariff impact, because the company has said that they're staring at a separate $600 million hit in FY26, fiscal year 2026, because of tariffs and rising raw material. And it's not just P&G. On 21st of May, even Walmart, said that they will be slashing close to about 15,000 jobs. So it's Walmart and P&G's. And this time, as you said, right, earlier, maybe there was a one-off small one. This time, the scale and the numbers are hard to ignore, and it's happening in the real economy jobs.
You know, when the world's largest retailer is planning to cut 15,000 jobs, you can't really ignore it. And of course, it shows signs of worry in the US economy as well. Although, and the macro data that has been presented all through this week has been pretty disappointing, be it the private hiring, be it the initial jobless claims. And of course, today, the all-important non-farm payrolls that come in later this evening, and all eyes of Wall Street will be on that. But moving back to our own markets, then the two automakers that have had divergent moves today, or divergent opinions coming in from brokerages, Tata Motors and Bajaj Auto. We just spoke of Tata Motors a few minutes earlier. JP Morgan downgrading it, and CLSA has come out with a note on Bajaj Auto. Sudarshan is here to take us through both of those. Sudarshan.
So JP Morgan has downgraded Tata Motors to neutral, and target here is 740. JP Morgan believes that company is facing a multiple of headwinds. First one, tariff risks and aging portfolio in JLR, and second, that industry outlook for FY26 is muted for both commercial vehicle and passenger vehicle. So following that, JP Morgan believes that FY26 is going to be tough for Tata Motors, but things can improve in FY27. Also going forward, two things that will be in focus. Tata Motors is holding analyst meet on June 9, and JLR is going to hold analyst meet on June 16. So investors will be watching out these two meets very closely. Now coming to Bajaj Auto, CLSA maintains outperform call, and target here is 10,149 per share. It has laid out few reasons. First, company is saying that it's gaining market share in 125cc plus segment. Second, upcoming launch of new Chetak is going to help gain market share in electric two-wheelers. Third, company is confident of increasing its growth in export, and led by rising traction in North Latin America and recovery that company is seeing in Nigeria. So on the back of that, it's targeting growth range of 15 to 20% in the export segment. And last, it's eyeing turnaround in KTM by 2026. So factoring all these reasons, CLSA is positive on Bajaj Auto.
Thank you very much for that. Get into a break. But as we do that, we'll get you the latest on how Government of India aims to navigate China's move to curb rare earth magnets.
Welcome back. Now, sources are saying that no Indian company has received approval to import the rare earth magnets in the last 2 months. Parikshit is now joining in for more details on this. Parikshit.
The government is considering a PLI government is considering a PLI-like scheme for rare earth magnet manufacturing in the country. Now, this is coming in the midst of a crisis that the auto industry is grappling with. China has put a restriction on export of rare earth magnets around the world, and India is no different. We have to get an end-use certificate, which has to be validated at 7 different levels and finally by the Chinese government. And this is almost like a ban, so to say, and no Indian importer or Indian company has been able to get rare earth magnets from China since the 4th of April. Having said that, the government is now examining industry proposals for financial incentives in setting up assembly and manufacturing for rare earth magnets. Dialogue is on between the industry and the government for an incentive-based scheme. The government is also looking at financial support for both small and large companies in the short and medium term. The industry has proposed setting up of a magnet assembly and processing capabilities in the short term with government financial support, and this includes recycling of old and used rare earth magnets as well. Long-term self-reliance is something that the industry has proposed for rare earth magnets, and this, according to many industry sources, would need a heavy amount of incentives for the government and also public-private partnership so that this relationship and this endeavor to make rare earth magnets have a local ecosystem, a domestic supply chain, is effective and beneficial at the same time. In the short run, it is also being proposed that India should look at sourcing arrangements and agreements with countries such as Vietnam, Brazil, Japan, Russia, Ukraine for that matter, countries which have rare earth minerals, which have processing capabilities. We need to increase our sourcing from them as well. Currently, these discussions are at a very early stage. No draft notification has been prepared. But yes, we're told by top-level sources in the government that it seems it's quite clear that a PLI-like scheme will be needed for rare earth magnets very soon.
Thank you very much for that, Parikshit. Get into a break on the other side. Thanks.
investing.
Building on to the gains as we speak, the Nifty is now 270 points higher. 25,020 is where the index stands. The Sensex is now up 850 points, and a lot of these is attributed, of course, to the financial names. And the Nifty Bank too is now 850 points higher at 56,600 after that very, very surprising and a positively surprising RBI policy at that. Take a look at the contributors there: HDFC Bank, Axis, Bajaj Finance, Reliance. So it is private financials and Reliance that is moving on. With that, we call time on this edition of Trading Hour. From Reema, me and the team that put this show together, thank you so much for watching. Ritu takes the action forward in counting down to the RBI Governor's press conference.
Thank you so very much. May I start, sir?
All right. That is the top brass at the Reserve Bank of India set to address the media after announcing that outsized, surprising 50 basis point repo rate cut. Hear out what they have to say.
With us, Governor Shri Sanjay Malhotra, Deputy Governors Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, Shri Swaminathan J. and Dr. Poonam Gupta. I would take this opportunity to welcome Dr. Gupta to this press conference after taking charge as the Deputy Governor. We also have with us Executive Directors Dr. Rajiv Ranjan and Dr. Ajit Joshi and other friends from Reserve Bank. Before we begin, I'll request all of you to please either switch off your mobile phones or keep it on silent. Please restrict to one question per person so that everybody gets a chance. And then maybe going forward, we can take another question if time permits. And when you are asking question, please see that you switch on the mic which is in front of you. Because that's how, the people listening to this transmission would be able to hear whatever is transpiring here. And once you are done, please switch it off to avoid the interference. Sir, there are 23 participants from media today. And with your permission, I'll call out the names. I'll ask Lata to ask her question.
Thank you, sir. Lata from CNBC-TV18. Governor, thank you very much for the opportunity and for a policy that is giving us a lot of headlines. Okay, I wanted you to clarify things on the liquidity front. In the last few weeks, the repo rate, the call rate was not at the repo rate. You gave enough liquidity and the call rate was 25 basis points below the repo rate. Now that you have given a 50 basis cut, will you use liquidity in such a way to align the call rate more to the repo rate, which means you will do more VRRs, reverse repos, or will the reverse repo have to be suspended because your 40 billion short positions have to be, will mature? So if you can give us a little more color on liquidity. And on the stands itself, is it fair on the part of the market to assume an extended pause? Or, because the positive real rate, I mean, if you assume that that 1.4 to 1.9 positive real rate is what you are also going by, then with inflation at 3.7, you still have space to cut. So should the market assume that the terminal rate can still go down after the pause?
Yeah, so first of all, thank you, all of you, for coming here as usual and taking our message to everyone across the country. So thank you very much. You have asked 3 questions in 1 question. But we'll try to attempt to answer all of them. So first question is a very good question. In fact, what do we do with liquidity? Where do we actually maintain now the call rate? The call rate today is hovering at the lower end of the LAF as it was till yesterday. So it was at about 5.75%. Whether we now maintain it at 5.25 or at the policy rate, which is at 5.5. That's, as I said, we'll see how the situation goes. Of course, liquidity is abundant, and if we do not do any VRRs, then it's going to stay at 5.25. If we do VRRs, then, we can bring it anywhere between, depending on the amount. So we'll see, how the situation evolves, and we'll take a call. We have not really given it a thought on that, so we will decide, and you will come to know, in the coming few days. I'll not be able to give you a very precise answer, but having the policy at 5.5, and the stance, now going to neutral, so all that will, certainly come in the picture. We will take a call as to where, we will try to have the call rate. The second question is on where do we see the terminal rate. The MPC, I think, has very clearly, articulated that in the statement, in the resolution that has come in. We have changed the stance from accommodative to neutral. And it has mentioned that there is now very limited space
for the monetary policy, actually, given the current circumstances. And you are aware of the current circumstances, which is that growth is at about 6.5%. Inflation, we are projecting at 3.7% for this year. And next year, it's above 4, it's 4.5%, or roundabout. So given these current, if these were to play out, there is very limited space, is what MPC says, and that's why it has been reduced now. We have changed now to neutral. MPC also states that we will continue to monitor the incoming data, and basis that, given especially the uncertainties, what way now we will move will depend primarily on what the data suggests to us. There was a third question, which what was your? That's it. Thank you. So I've
That's
answered.
what I wanted.
Yeah, thanks.
If you can allow me another question, I will.
Yeah, we'll come back later. Come back and see if there is time.
Thank you, sir. Next, we'll have Mr. Mayur Shetty from Times of India.
Governor, you spoke about the uncertain environment, and a lot of uncertainty is coming from the behavior of the U.S. administration, and that is also resulting in a lot of volatility in dollar assets. So given this, how would you balance between rebuilding the forex reserves and managing exchange rate volatility?
See, our policy over there is very, very clear. It has been very consistent. And we do not manage, or try to target any price, any level, any band. You are aware of that. If there is any abnormal, that's a standard response, right? Any abnormal volatility, if it is there, that is what we try to counter, and we let the market prices be determined, prices be determined by the markets. Now, this question, and I think that was something that even Lata alluded to, and that was the third point, I think, that you mentioned.
40 billion.
Is, this 40 billion, etc. We are not unduly concerned about that. Even if you were to exclude that $625 billion, if you were to exclude this $65 billion, including, the one after 1 year that is coming in, we are not unduly worried, on that. It's a very, very comfortable level to be in. Yes, if there are opportunities and we can build reserves, that will happen. But that is not something which we will be unduly bothered about. Thank you.
Thank you, sir. अब मैं श्री अनुराग शाह से आग्रह करूंगा कि वो अपना प्रश्न पूछें. अनुराग शाह, ET Now स्वदेश से.
थैंक यू सर. थैंक यू सर. जो सर ने इतने बड़ा धमाका कर दिया, सबको चौंका दिया, जो मेन प्रश्न लेके आया था सर, वो भी पूछूंगा साइड में. सर ये आज के जो ऐलान से क्या बड़ा मकसद है और क्या संदेश आप देना चाहते हैं ब्रॉडर रूप में?
नहीं, ब्रॉडर रूप में देखो, संदेश हमारा यही है कि इन्फ्लेशन, आपको मालूम है, मुद्रास्फीति इन्फ्लेशन पे अब काफ़ी जो है नियंत्रण में है, और वो जंग जो है हम ये मान सकते हैं कि उसके ऊपर में हमने जीत हासिल कर ली है. एक मैसेज है, क्योंकि हमने 4% से उसको घटा करके जो हमारा अनुमान था उसको 3.7% किया है मुद्रास्फीति को. उसी प्रकार से जो ग्रोथ है वो 6.5% है, अच्छी है, लेकिन उसमें और गुंजाइश है, उसके अंदर में और बढ़ोतरी होने का. तो जो भी हमें कार्य करना है, हम ये बिलीव करते हैं कि वो डिसाइसिवली करना चाहिए, सही समय पे करना चाहिए, और एक जो निश्चितता है, इस अनिश्चित वातावरण में निश्चितता मेरे ख्याल से जो है हमें मार्केट्स को, सभी को, बैंक्स को, इकोनॉमी को निश्चितता देने का बहुत अधिक ज़रूरत थी. इसी वजह से ये जो आपने देखा कि एमपीसी ने कहा कि हमने फ्रंट लोड किया है, ताकि एक ये निश्चितता रहे कि हाँ 50% हमें बेसिस पॉइंट्स कम करना है, तो एक साथ ही उसको कर दिया. उसी प्रकार से जो सीआरआर का है, हम चाहते तो हम इसको 4 महीने बाद भी अनाउंस कर सकते थे, हमने आज ही अनाउंस कर दिया. पहले से ही, ताकि लोगों को, बैंक्स को ये निश्चित हो जाए कि लिक्विडिटी जो कि हमने कहा जरूर है लेकिन वो एक्शंस में भी तब्दील होना चाहिए, तो वो एक्शंस में हमने अपने तब्दील किया कि जो CRR है वो एक हमने उसको आज ही घोषणा कर दी। तो निश्चितता जो है जितनी होगी उतना हमें लगता है कि उससे हमारी जो अर्थव्यवस्था है उसको बल मिलेगा, और यही हमारा संदेश है कि हमारी अर्थव्यवस्था अच्छी चल रही है, और उस अर्थव्यवस्था को दोनों मुद्रास्फीति को ध्यान में रखते हुए वो हमारा प्रमुख संदेश है, उससे हम बिल्कुल नहीं भटकेंगे। वो हमारा प्रमुख प्राइमरी हमारा जो मोटिव है कि प्राइस स्टेबिलिटी, मुद्रास्फीति को हम कंट्रोल करें, उसके ऊपर में हम अंकुश लगाएं, और जो हमारे को टारगेट दिया है उस टारगेट की ओर हम उसको ले जाएं। जब वो हो जाए तो उसके बाद में हम जो ग्रोथ है, ग्रोथ के ऊपर भी हम ध्यान दें, वही हमने इसमें किया।
सर, जो स्टांस आपने चेंज किया था, पिछली पॉलिसी में ही आप न्यूट्रल से अकोमोडेटिव आए थे और इस बार वापस एक ही पॉलिसी में आप वापस उस स्टांस पे चले गए, तो उससे कहीं एक मैसेज गलत नहीं जाएगा?
गलत मैसेज से मैं नहीं समझा। हाँ, ये बात आप जरूर कह सकते हैं, ये बात हमारे भी दिमाग में थी कि हमने पिछले बार ही तो इसको अकोमोडेटिव किया था। हमारे पास में चॉइस ये था कि हम उसको अकोमोडेटिव रखते, जो हमने बोला था, जो मैंने आपको कहा कि बोलते रहे कि अकोमोडेटिव है लेकिन करें नहीं कुछ, तो एक्शन जो है वो ज्यादा इंपॉर्टेंट है, और जो भी हम बात कर रहे हैं वो एक्शन में तब्दील होना चाहिए। इसीलिए जो है हमने उन हमारे जो स्टेटमेंट्स रहे इंटेंट के, अकोमोडेटिव केवल एक इंटेंट था, उसको हम अकोमोडेटिव रखते रखते नहीं चेंज करते, अकोमोडेटिव ही रखते, तो क्या वो बेहतर रहता, या हम सर्टेनिटी दें कि हाँ हमने अकोमोडेटिव से जो हमने आपको वादा किया था कि हम इसको रेट को कम करेंगे, डिसाइसिवली कम करेंगे, वो हमने किया, और स्टांस को हमने न्यूट्रल कर दिया है। आज के सर्कमस्टांसेस में जो स्थिति बनती है उसके हिसाब से बहुत कम गुंजाइश, जैसा कि MPC ने नोट किया कि उससे बहुत कम गुंजाइश अब रह जाती है, वेरी लिमिटेड स्पेस, उन्होंने कहा वेरी लिमिटेड स्पेस, तो कम गुंजाइश रह जाती है आगे और पॉलिसी रेट्स को कम करने की। ये एक पूरा संदेश हम दें, इसीलिए उसको न्यूट्रल में किया गया है।
धन्यवाद सर। मूविंग टू दिस साइड ऑफ द टेबल, मिस्टर मनोजीत शाह फ्रॉम बिजनेस स्टैंडर्ड।
Good afternoon. Thank you, Puneet. Again on this stance, I mean, this
Thank you.
This policy has several surprises. The most surprising part is the stance. As you said in the last policy, the accommodative means the rate can go down or it can stay there. So in that, so neutral would mean the rates can go up. Are you saying rate will not go up, but there will be a long pause? And whether there is a voting on stance, if you can...
It will depend. See, it will depend on data now. This is what neutral means. We had explained it in our earlier MPC. I had explained it in the earlier MPC statement that neutral will mean that it can go either ways. It will depend on how the data comes in. If the growth is weaker, it can mean that it will go down. If the growth is good, inflation is going up, it can mean that, the repo rate policy rate can go up. So it will depend on how the data, both, on inflation as well as growth, turns out to be.
Was there voting on stance this time?
Stance, we have already mentioned that there is no, the statute does not, mandate a voting. There was a discussion on it, certainly, because we need to give a sense, we need to give a guidance. It's more of a guidance that we have to give to the market participants. And so there was a discussion, and everyone, all the 6 MPC members were of the view that we should change it to neutral. So there was no voting, but the view of all the MPC members is that going forward, the stance should be changed from accommodative to neutral.
Also, if you can add just one more, are you satisfied with the monetary transmission that has happened so far?
I think it has, going by past trends, the transmission has happened much faster, both on, in the money markets, in fact, you can see a huge transmission, more than what we have done, more than 50 basis points in the money markets at the shorter, especially at the shorter term levels. And on the credit side also, we are now seeing some initial signs. Deposit rates, in fact, have been reduced, retail as well as wholesale, by most of the banks. About 40 basis points, they have reduced. The average, of course, is about 27 basis points. It has reduced over there. 17 basis points is the reduction on the credit side, on the outstanding credit. And in terms of fresh loans, there is, that's a little slow, but it has started. It is about 6 basis points as per data that we have. So that's slow, but it is much faster than other times. Normally, it takes 6 to 9 months. It's only been 4 months from the first policy cut. So from first policy cut, or 25 basis points, against that, if 27 basis points on deposit side, 17 basis points on the credit outstanding side, and 6 basis points on the fresh loans, I think this is a very good transmission. However, we need to do it faster. And that's why we have front-loaded some of our actions.
Thank you so much. Thank you, sir. Next, we'll have Mr. Vishwanath Nair from NDTV Profit.
Good afternoon, Governor. Couple of questions, actually. The first one with respect to your GDP forecast, which has not changed. The estimates have not changed at all. What is the growth boost that you're expecting from this cumulative 100 basis point rate cut that you've afforded? And thereby, would there be a revision for FY26? And the second part is on the stance itself. I'm asking you again, in the past there has been criticism that the stance is more or less becoming meaningless because we kept saying withdrawal of accommodation, but it was a prolonged pause. Is this a way to then bringing it back into relevance?
So your first question is what impact it has on growth. Obviously, it has a positive impact. It will be very difficult to assess as to how this transmission from monetary policy to the credit rates and then to the real economy, how that transmission happens. As you are aware, it takes minimum of, going by history, 6 to 9 months. We would like, of course, to expedite it, but we'll see impact of this only in the later half. So for this year, in terms of numbers, especially when there is so much of an uncertainty, we would not be in any position to give you how it will, to what extent it will impact the GDP numbers. Your second question is on, I can't actually speak about the past, what has happened, but our policy will be very, very clear. Whatever we are saying, we mean it, every bit of it, and you will continue to experience that.
Thank you, sir. Next is Ms. Swati Bhatt from
Also
the right.
to be kept in mind is, whether it is past or present or future, a lot of it is dependent on data. So if the data kind of changes, even if it is, say, accommodative or tightening, it does not necessarily mean, that next policy itself, you are going to tighten it or you are going to reduce the policy rate. It does not mean that. It depends on how the data is actually coming in and how, what that data is showing. So if that data demands that you have to actually stay put, even if it is accommodative, it will, that's how, it will be done.
Thank you, sir. Next will be Swati Bhatt from Reuters.
Thank you, Puneet, sir. Sir, I just wanted to understand, you have front-loaded the rate cuts and the certainty obviously helps. But we've seen that despite the massive surplus liquidity that has been there in the market, there is very limited scope to lend because there is genuine lack of demand from companies and corporates. There's not much capex happening as well. How does this liquidity really translate to boosting growth? What is the advantage of having so much, flush of liquidity in the banking system? Similarly, on the CRR front as well, obviously you planned it in advance and announced it now. But CRR historically has been at the 4% sacrosanct level to some extent. Is there a renewed thinking on the CRR front, which is why you've gone ahead and cut it to 3%? Thank you.
Can I just add, nowhere you have told us why you cut the CRR. What was the RBI's thinking?
So let me take the second question first. I think the monetary policy statement that I read out, it did mention that it has two objectives. The first objective is that we need to, continue to provide liquidity, and I'll come to your first question relating to liquidity. And then we also mentioned that it will not only improve liquidity, but it will also help reduce cost of funding for the banks. So that is the other objective. And see, over the years, last 12, 13 years data I've seen, and one can even go back, the CRR has mostly remained at 4%, as you have rightly pointed out. During COVID, we reduced it by 1%. Now these reserves are basically kept for liquidity management. So the experience as of now does not suggest that perhaps, we do not need 4%. 3% can perhaps suffice. Having said that, we do not know what the future holds. So please don't hold me, to this number that, we are going to maintain this 3%. But as of now, it seems that 3% is a comfortable reserve ratio to have. And so from a liquidity management perspective, and so that's why, apart from providing liquidity, it will also reduce their costs and improve their NIMs by about 7 basis points, at least it should help, is our estimate. Why do we provide liquidity? So that, there is a better transmission, there is a faster transmission, and it is primarily, it's basically for that. Thank you.
Thank you, sir.
Take the next question.
Yeah, because so far banks are not lending. So how does that demand come in?
It will depend. We have said, even in the statement, that this is not a sufficient condition. Monetary policy is not a sufficient condition. It is a necessary condition. We have provided that. We are confident that it will certainly translate into better credit growth. I am not able to give you a number. Obviously and certainly, with confidence, one can say that it will certainly increase, the flow of credit. And so that's why, this liquidity is important. A reduction in repo rate is important. To what extent and what time frame it will take, that will be difficult to say.
Thank you, sir. Next will be Mr. Ankur Mishra from ET Now.
Thank you, Puneet sir. Good afternoon, Governor. I want to understand from you that you have given a statement in the monetary policy that today's steps should be seen towards propelling to a higher aspirational trajectory. You're talking about growth. You have kept your target intact at 6.5%. Is there a scope of further revision ahead which should be expected with the kind of actions you have taken? And also, I will once again ask on the stance front, but in a cricket analogy, if you can explain, it was a roller coaster kind of a policy. We saw you announced 20, expectation was 25 basis point, you announced 50 basis point cut. Similarly for CRR, the expectation was 50, you announced 100. But on the stance front, you got back to the crease and said, I'll wait and watch. So how should one understand?
Well put. The target, you are saying that the target, the 6.5% is not the target, 6.5% is the forecast that we have made. And the aspiration is certainly much more, between 7 and 8%, is our aspiration. Aspiration is 8%. We would like to grow, as fast as possible. You have said it all, I don't have to say anything more, on, you have put it out very well. As to what, this monetary policy, because everyone here in India, they may not understand our monetary policy, but they will understand the cricket lingo. So you put it out very well for your viewers.
Thank you, sir. अब मैं जी बिजनेस से एकता सूरी को आमंत्रित करूंगा।
Policy has been very well received by the markets. However, I want to ask questions which are a little different from the market how they've received it. So मेरा पहला सवाल होगा, पिछली पॉलिसी में हमने गोल्ड लोन्स के ड्राफ्ट के ऊपर बात की थी। उस पॉलिसी से लेकर अब आज की पॉलिसी में आपने कुछ चेंजेस सोचे हैं? क्योंकि बहुत से लोगों को ऐसा भी लगता है कि अगर सोना हम गिरवी रखने जा रहे हैं तो हो सकता है हमारे पास ओनरशिप का कुछ प्रूफ ना हो, क्योंकि वो हमें अपनी मदर या किसी और से मिला हो, या फिर हॉलमार्क ना हो। तो ऐसे जो ट्वीक्स हैं आप सोच रहे हैं नियमों में बदलाव? और दूसरा ये भी, क्योंकि अब हम देख रहे हैं कि फॉरेन बैंक्स की बहुत दिलचस्पी है भारतीय बैंक्स में, तो आप FIIs को लेकर भी कुछ नियमों में बदलाव सोच रहे हैं? 26% का जो वोटिंग राइट है वो भले ही सरकार के पास है, या फिर फॉरेन बैंक कितना स्टेक ले सकते हैं भारतीय बैंक में?
अच्छा, आपने सवाल किया है जो गोल्ड लोन के बारे में, ये भी काफ़ी चर्चा में रहा है। मुझे लगता है कि ये सभी के लिए एक रुचि का विषय होगा, तो इस पे निश्चित रूप से आपका सवाल जो है बनता है। और मैं आपको बताना चाहूँगा सबसे पहले कि जो गोल्ड लोन के बारे में जो हमने रेगुलेशंस जारी किए थे वो केवल ड्राफ्ट थे, मसौदा थे, वो फाइनल नहीं थे। आपको ये भी बताना चाहूँगा कि हमने अब एक फ्रेमवर्क रेगुलेशन मेकिंग के लिए हमने एक जारी किया है, जो सबको हमने पब्लिक नोटिस के थ्रू हमने सबको बताया है कि कोई भी मेजर, जब भी हम कोई परिपत्र या रेगुलेशन या डायरेक्शन इशू करेंगे तो उससे पहले हम दो चीजें करेंगे। एक चीज हम कंसल्टेशन करेंगे, दूसरा हम उसका क्या इम्पैक्ट है उसका हम स्टडी करेंगे। तो उसी को ध्यान में रखते हुए ये भी हमने मसौदा गोल्ड लोन के बारे में हमने जारी किया। दूसरी चीज बताना चाहूंगा कि ये जो हमने जारी किया है इसमें कोई नयापन नहीं था, इसमें कोई नई चीज नहीं थी, ये केवल कोई नई बात नहीं थी। पुराने जो हमारे परिपत्र थे, पुराने जो रेगुलेशंस थे, उन्हीं को हमने कंसोलिडेट किया था, उनको कंसोलिडेट किया था और उनको रिआइटरेट किया था, क्योंकि ऐसा देखा जा रहा था कि कुछ जो हमारे रेगुलेटेड एंटिटीज हैं उनको वो अक्षरतः पालना नहीं कर रहे थे, क्योंकि उसमें क्लैरिटी नहीं थी और इसके बारे में उनको बताया गया था। इस कारण से इसमें कोई नयापन हालांकि नहीं था, लेकिन फिर भी जब वो बात बिल्कुल ब्लैक एंड व्हाइट में सामने आ गई तो इसलिए उसके ऊपर में हमारे पास में उसके कमेंट्स आए। तो मेरे ख्याल से आज ही हम जो है उसका फाइनल जो रेगुलेशन है, फाइनल डायरेक्शन है, आज नहीं तो एट द मोस्ट मंडे, सोमवार तक हम उसको जारी कर देंगे। आपने जो बात कही ओनरशिप के डॉक्यूमेंट्स के बारे में, वो जो हमने ड्राफ्ट जो इशू किया था उसमें भी ये बिल्कुल क्लियर लिखा हुआ है कि अगर आपके पास में उसके इनवॉइस नहीं है तो आप उसका एक सेल्फ डिक्लेरेशन आप दे सकते हैं, तो उसमें कोई चिंता की बात नहीं थी। उसको और हम उसमें और क्लैरिटी हम प्रोवाइड करेंगे। दूसरा ये एक बात आई कि क्रेडिट अप्रेजल, अब छोटे छोटे लोन के लिए क्रेडिट अप्रेजल नहीं किया जाए, तो वो भी हम इसमें डाल रहे हैं कि छोटे जो लोन्स हैं 2.5 लाख रुपए तक के जो लोन्स हैं उसमें गोल्ड से जो जिसमें कोलेटरल आ जाता है उसमें क्रेडिट अप्रेजल की आवश्यकता नहीं है। तीसरा एक एंड यूज के ऊपर में बात आई थी कि एंड यूज की मॉनिटरिंग करनी है, उसमें भी हमने ये स्पष्ट किया है कि एंड यूज की मॉनिटरिंग तभी आवश्यक होगी जब आप उसका प्रायोरिटी सेक्टर लेंडिंग में उसका लाभ आप लेना चाहते हैं। चौथा और पांचवा जो कि महत्वपूर्ण प्रश्न है एलटीवी के संदर्भ में है, वो हमने कहा है कि एलटीवी केवल जो कंजम्पशन लोन्स हैं उसमें ही, कंजम्पशन लोन्स में ही एलटीवी का सिद्धांत लागू रहेगा। बाकी में आप क्रेडिट अप्रेजल करेंगे, उसकी और अन्य इनकम्स हैं और सिक्योरिटीज हैं, उसके हिसाब से अगर एलटीवी रेशियो से ज्यादा भी देते हैं तो वो रीपेमेंट कैपेसिटी के बेसिस के ऊपर में उसका आकलन करके वो दिया जा सकता है। और पांचवा और महत्वपूर्ण जो प्रश्न है एलटीवी से ही संबंधित है, वो 75% हमने उसमें अभी आज के दिन में हमने ड्राफ्ट डाला था, उस 75% को हम छोटे लोन्स के लिए 85% तक करने का हमारा प्रस्ताव है। 85% छोटे लोन्स के लिए, बिलो 2.5 लाख के लोन्स के लिए पर बोरोवर 85%, लेकिन इस 85% में इंटरेस्ट जो है वो भी इंक्लूड करना होगा। तो पहले वो केवल हमारा 75% था और प्रिंसिपल एंड इंटरेस्ट का ही था, जो कि कुछ कंपनियां, पब्लिक सेक्टर बैंक्स जो हैं, अधिकतर सभी पब्लिक सेक्टर बैंक्स 75% पे ही दे रहे थे, इंक्लूडिंग इंटरेस्ट। प्रिंसिपल, इसलिए वो प्रिंसिपल जो है केवल 65, 66, 67% तक ही दे रहे थे। लेकिन कुछ अन्य एनबीएफसी इत्यादि और कुछ छोटे बैंक भी हो सकता है, वो जो है 75% प्रिंसिपल दे रहे थे, तो इंटरेस्ट मिला करके बुलेट रिपेमेंट लोन में विशेषकर वो 88% तक भी चला जाता है। क्योंकि अगर 18% का लोन है तो आप रिवर्स कैलकुलेट करोगे तो वो 88% तक चला जाता है। तो छोटे लोन 2.5 लाख रुपए तक के लोन के लिए इंक्लूडिंग इंटरेस्ट 2.5 लाख प्रिंसिपल प्लस इंटरेस्ट। तो ये पूरी स्पष्टता जो है हम अपने सर्कुलर में देंगे। हमें उम्मीद है कि इससे जहां पे मिनिमम रिस्क के साथ में इस गोल्ड लोन की श्रेणी को हम अच्छे से रेगुलेट कर सकते हैं। दूसरा आपका प्रश्न है कि क्या हम एफआईआईज वगैरह के लिए हम कुछ लिमिट्स वगैरह, फॉरेन बैंक्स वगैरह के लिए लिमिट्स वगैरह कुछ बढ़ा रहे हैं। तो देखिए, ऑलरेडी लिमिट्स तो 74% की लिमिट है, ऑलरेडी 49% की लिमिट है ऑन ऑटोमेटिक अप्रूवल रूट, एंड अनदर 25% तो अप टू 74% गवर्नमेंट अप्रूवल रूट में जा सकते हैं। तो उसमें तो कोई बदलाव की आज के दिन में कोई ऐसी कोई बात नहीं है, उसमें कोई चेंजेस मुझे नहीं मालूम ये प्रश्न कहाँ से आ रहा है कि उसको हम चेंज कर रहे हैं। एक दूसरा उससे जुड़ा हुआ है, 15% हम अलाउ करते हैं नॉन रेजिडेंट्स के लिए, लेकिन केस टू केस बेसिस पे 15% से ऊपर भी वो जा सकता है। तो उसमें कोई ऐसा बदलाव अभी अतिशीघ्र कोई भी बदलाव उसमें नहीं हो रहा है। हाँ, हमने ये इस बात जरूर कही है कि हो सकता है उसका आप लोगों ने उसको आपने देखा हो, कहीं पे पढ़ा हो, कि हम ये पूरा जो ओनरशिप स्ट्रक्चर है, जो एलिजिबिलिटी कंडीशंस हैं, जिसके अंदर में एफएफआई नॉन रेजिडेंट्स के लिए आज के दिन में 15% है, उस सबको हमको पूरे को एग्जामिन हम कर रहे हैं। वो इमीडिएटली नहीं होगा, उसमें समय लगेगा। ये जो है बहुत डीपर क्वेश्चंस हैं जिनको क्रिकेट की एनालॉजी में जो है 2020 मैच की तरह से नहीं देखना चाहिए। तो वो हम उसको पूरा सोच समझ करके ही क्या हमारे अर्थव्यवस्था के लिए क्या उचित है उसको ध्यान में रखते हुए, क्योंकि बैंक्स में देखिए एक आम साधारण आदमी ट्रस्ट करता है बैंक के ऊपर में, जैसा मैंने एक जगह पे इंटरव्यू में कहा, ही ट्रस्ट्स हिज मनी विद द बैंक्स। तो उस प्रकार का ट्रस्ट वर्दी आदमी, ओनर और मैनेजर बैंक में होना जरूरी है। उसके लिए हम किस प्रकार की एलिजिबिलिटी क्राइटेरिया रखें, किस प्रकार की कंडीशंस रखें, उसके लिए सबसे बात करके और उसको निश्चित रूप से हमारी इकोनॉमी ग्रो कर रही है, अर्थव्यवस्था हमारी बढ़ रही है, तो उसमें हमें और अधिक बैंक्स की आवश्यकता है और उसको ध्यान में रखते हुए जो भी उसमें यदि कोई बदलाव की आवश्यकता होगी तो उसमें बदलाव किए जाएंगे।
धन्यवाद सर। Now I'll request Ms. Sangeeta Mehta from Economic Times to ask her question.
Most of my monetary policy questions are taken away. So I'm going back to the annual report, which was very insightful. It had a lot of data points also. But there's one question on the one thing about the annual report where you have said that in FY 25-26, RBI would be considering differentiated regulatory framework for type 1 NBFCs, which are without public funds and non-customer facing NBFCs.
See, it is our policy to have, to as far as possible customize the rules basis the risk profile. And so it is only, in continuation of that particular policy that we have, that mention has been made in the annual report. I'll request DG in case he would like to add something more on this.
No, I think review is done as a regular process, and type 1 is one which doesn't face outside to the system. So we are having a look at the regulations. So that is an ongoing process. We are doing that. That's it.
There would be kind of new guidelines coming for this kind of NBFCs on fundraising. I mean.
No, type 1 typically doesn't have outside liability.
Yeah. So is there any
it will
new?
Be depending purely on the internal resource accruals from there.
Yeah. No. Are there new guidelines coming for this type 1 type of NBFCs? That is what I
review and then see what kind of regulations.
It only means a review will be carried out.
Okay.
If at all there is a need, then we will do it.
Okay.
So that's the third part of our regulation making framework that we announced. Let me, I mentioned about two important elements for those, because I answered that in Hindi. I think it is important for everyone to know and understand that we have issued a regulation making framework now. There are three critical elements in it. One, that we will do a public consultation. And when I mean a public consultation, it is not only in letter, let me assure everyone, it's not only in letter, it is also in intent. So, so that, the important stakeholders, their views, we get all important stakeholders. The second thing is that we will also do an impact to the extent possible. It may be qualitative. Every time, it may not be possible to do a quantitative impact analysis. What will be the impact thereof on the banking system, on the regulated entities, on the customers, on all the stakeholders. That is the second element. And the third element is that we will regularly review our regulations, directions, etc. because it is dynamic. Policies have to change with the times. And so it is only in that context that we are going to review some of these policies related to type 1 NBFCs.
Thank you, sir. Now it will be Mr. Anup from Bloomberg.
Thanks, sir. Sir, Anup here from Bloomberg. Interesting choice of words. Monetary policy is left with very little space to support growth. Does it mean that you would expect fiscal authorities to support rest of the growth and your growth aspirations that India should have? And also, even after all these measures that banks
I believe in doing my work, right?
Right, sir.
And we have done, that bit. And obviously it is expected that, everyone else will be doing, their bit. So that is not something for me to say, right? It's not appropriate. I believe in doing my job, and that's what, we will continue to do.
Right, sir. Sir, one more question. If, despite everything that you have done for banks, they have ever asked for, banks really do not do the transmission, can you take actions? Or what kind of actions can you take?
See, it is ultimately, we have said this in our policy statement also, that monetary policy is a necessary but not a sufficient condition, right? So for monetary policy transmission to happen, there are so many other things, including demand, which has to be there, and so it will depend on the macroeconomic conditions and the demand and the appetite and the demand for credit. Only then, it is the market forces ultimately. See, we have to leave it to market forces. We cannot start regulating that, no, you give credit or you reduce rates. No, you can't do that. It's the market. We believe that our markets are deep, credit markets. There are so many banks, there are so many NBFCs, there are alternative investment funds, now vying, for credit. There is private credit. And so the market forces will certainly, be able to push prices basis demand for credit.
Thank you, sir. Hamsani from Money Control.
Thank you. Hi, I'm Hamsani from Money Control. My question is
with regard to the health of the banking system as such, sir. You mentioned in your speech earlier today that you're convinced, you remain quite confident about the health of the banking system. But there's one of the private sector banks where the auditors have recently qualified certain developments as likely to be fraud. Has that been escalated to RBI? What sort of actions you are planning to take on that? And it's been about 4 months since we saw RBI issue a statement in favor of the bank saying that deposits are healthy. What is your assessment of the picture right now, sir?
Well, normally, see, we do not comment on individual banks. As I said, system as a whole, banking system is very, very robust. And I also mentioned, that these events or episodes, I would call them, these will happen. They should not bother us too much, as long as, they are far and few between and limited. I think the bank has taken enough number of steps to put their to improve their accounting and other practices, and on the whole, I think the bank is doing well. I will request DG Mr. Swaminathan, if he would like to give more details to the extent.
Sir, thank you. I think you've summed up in terms of what is the current situation as far as this particular entity is concerned. You would recall that in the last MPC presser as well, we had said 2-3 things that all of them have been sort of complied with at this point in time. Number one was our priority to have that accounting done properly, accounting for all the discrepancies duly supported by both internal and external audit, and it must be accounted for in Q4 itself. So that has been accomplished by the bank already. Second, we said that forensic audit and accountability must be held so that people are held accountable, and the examination of fraud has to be completed, and law enforcement should take over from there. So that has been accomplished already. And third, of course, our priority is always to ensure that no customer is put to any loss or any inconvenience. That is something which has been ensured, and there is no systemic impact arising out of these kind of episodes. And fourth, we had also said that each of these crises gives us some lessons, so we sharpen our supervisory tools and we calibrate our supervisory approach based on the lessons that we learned from this. So we are going forward. We will look for these kind of red flags so that we are in a position to anticipate them much in advance. So last, in terms of succession planning, anyway, all of you know that the board and management has been sharing with you the updates. So as Governor said, whatever that was supposed to play out over the last 3 months has been is more or less on track, and I'm sure that it should be, if not immediately, but at least very soon, it should settle down and then be back to normal. And we will keep monitoring this. Not only this, but the system as a whole.
Thank you, sir. If I can be allowed to ask one question. On the deposits front, a large part of transmission would be dependent on what banks decide on.
You are taking away someone else's time. Huh? So hold on. If your question is not taken up by someone else, then we can come back.
Thank you.
Okay. Thank you, sirs. Next we'll have Gopika from Mint.
Thank you, sir. Good afternoon, Governor. You have lowered your FY26 inflation forecast to 3.7%. What would be your FY27 inflation forecast? Did you mention
6.5%? Sorry, 4.5%.
Right. So you're expecting it to go beyond 4%.
Yes.
And also on CRR, you're expecting it to be staggered from September till November.
Yes.
What if the global situation, I know you are giving a clear indication to the banks, but what if globally the environment changes, inflation shoots up? I mean, if there's some risk, how would you sort of then ensure that the CRR is?
We have enough tools. See, CRR is not the only tool for monetary policy or liquidity. You have the OMOs, you have the swaps, and you have, the VRRs and the VRRs. So if liquidity has to be managed, which we actually do not, today feel that there would be a need to reverse any of those things, we have sufficient tools to do it.
Hamsini's question on the private sector lender, how will RBI ensure accountability from the board? So far we've not seen any action at that level, but don't you think the board is also responsible for what has happened?
See, individual, so you are talking about the IndusInd Bank, etc. I think, see, the MD CEO, has resigned, and it says, for taking, moral responsibilities. I thought, that should be good enough. Do you expect that all the board members? I mean, what are you hinting at? I think the MD CEO, who's also a member of the board, if he has taken responsibility, that is at the board level itself.
So, sorry for interruption. Just even SEBI has now issued an interim order saying that there is some kind of insider trading which might have happened, and where the notices have been issued. Bank is claiming that fraud has happened to them. So I want to understand, sir, have they reached out to you particularly, because they mentioned in the call that they will reach out to regulator or the investigative agencies due to the fraud scenario. So, I mean, this is something which is related to one bank, but it is the system of trust.
There are other criminal acts that have happened, and the law will take its course. Please be assured. And in case RBI has to step in and take any action, then RBI will not be failing in its duty. Let's leave it at that. Let's leave it at that.
Thank you, sir. Thank you, sir. Thank you. No, please, sorry, because there are others.
Let's not be, there are other people. You've already, asked your question.
Thank you, sir.
And let's not, preempt. Let's not preempt, and let's not be speculative about it.
Right? Thank you so very much, sir. Next, we'll have Mr. Piyush from Hindu Business Line.
Good afternoon, Governor, DGs. Thanks, Puniji. Sir, on unsecured loans, you said personal loans, the stress has come down a little bit, but MFI stress continue to, be present. So, are you looking at taking any other measures to address this? Sir, there have been, couple of payment bank had applied for a SFB license around more than 18 months ago. Then 2 SFBs have now applied for universal license. Is there any timeline, sir, as to, in all the other things, RBI has a timeline of approval. So, is there any timeline where you will, give the approval? And, sir, just for clarity, this time you did not issue any statement on developmental and regulatory policy.
3 questions you are asking me.
This is our clarification, sir. We didn't see this time.
Clarification, what do I clarify if it is not there? But I'll only say this, that we believe in actions. We don't believe only in making statements. There are already, enough work that, we have on our hands. And so, we will first, we will try to, because a lot of drafts, you are aware, a lot of drafts are like gold loans you mentioned, and there are others. Thank God you are not asking me about those. You are not asking me about those, what about those drafts? You are asking me, to give more and more and more. So we will rather, be trying to therefore consolidate, whatever we have already put in the pipeline, what we have already, we have promised. And so we don't have to necessarily, speak if there is nothing to be spoken, right? What are your other questions? Banks. Banks licenses, see, I don't think there is a timeline, but it does not mean that, we don't have an internal timeline. Let me assure you that work is in progress in all those applications that you have mentioned, and very soon you will find our decisions. We have already articulated a decision on one of them, which we have rejected. One of them is already rejected. If you are not aware, then let me mention it's already there, and the others also we will quickly.
Sorry, sir. What was which application was rejected?
It's not.
It will be coming out.
It will be coming out
as a press release.
As a press release, it will be coming out. You will know.
Today it will come out?
Can't promise, but we will try.
We'll do it shortly.
MFI, sir, will you take any more measures? Thank you.
There are no specific regulatory measures planned for MFIs. There are none. There is something else, related to MFIs, but that is not, for this particular purpose. On the supervisory side, if you would like to add anything, on the MFI, because they have been actually recalibrating their business. We have been engaging with them, through supervision. And so, if you would like to add, on the MFI portfolio, that will, I think.
Yeah, thank you, sir. But I think that has been already articulated in the MPC statement in itself, that the entities that are predominantly in this particular segment have already identified, recalibrated their business models, stepping up upon their collection methodologies. And you've also seen a shrinkage of that portfolio on account of that because of their recalibration. So maybe over a period of time, maybe over the next couple of quarters, this should stabilize. Like the other two segments also, we saw outlier growth, we took some steps and then it moderated. So this also should going forward, but it also depend on the overall economic conditions, income level, because MFI book is to the most vulnerable segment. So that's something which we will have to bear in mind, give it a little more time for normalizing. But we'll keep watching those numbers. But as Governor said, on none of these segments, there are any regulatory actions or measures that is warranted at this point in time.
Thank you, sir. Sir, with your permission, last three questions.
Yes.
Thank you, sir. Next, I'll have Mr. Ashish Agashe from PTI.
Thank you so much, sir. Sir, this is a follow-up to Piyush's question on the unsecured lending bit. So, given that, okay, there's an explicit intent to push credit growth, so should we expect some bit of going back on the risk weights order as well of November 23? And so secondly...
Whatever had to be done has been done on that account. Whatever was there, see, prior to COVID, whatever were the risk weights, some relaxations were given during COVID, which were withdrawn, and that's all. If there is any tightening which has happened, that has also been withdrawn. So there is no more, thing on the risk weights.
And so following the Supreme Court pronouncement on the crypto matter, has there been some conversation regarding, like the RBI stance has been clear from the past itself, but given that...
There is no new development insofar as crypto is concerned. There is a committee in the government, which is looking after this. Of course, you are aware we are concerned about crypto in case, because that can hamper, financial stability and monetary policy, etc.
Thanks.
Thank you, sir. Doordarshan se Shama, you may please ask your question.
Namaskar, sir. So your docu-series are out and they are good. I want to know that generally RBI is known as conservative. So this idea of telling your own story, how did it come from?
I think I'll have to ask, those people, who were involved in, so maybe DG Ravi Shankar, you can throw more light on how this idea came.
Yeah, this came in the context of the RBI at 90 events that we held. As we continued holding those events, and we also held events for international, policymakers, other central banks and all that. So the feedback we got in the process of doing that was that there is a lot of scope for Reserve Bank to convey, particularly to the general public, about its functions. General public has an idea of currency, of prices and monetary policy, but we wanted to expose RBI's workings more to the general public. And in that context, we thought of, this docu-series. The idea of this docu-series is to show what RBI does in a language and visually that an average person understands. Thank you.
So only one episode is out yet. So how many total episodes are there? And
there are 5 episodes. They'll come one after the other.
Okay.
Thank you, sirs. Lastly, we'll have Mr. Hitesh from Indian Express.
Good afternoon, sir. Sir, in your annual report, you mentioned that one of the agenda for you would be studying monetary policy transmission. As part of it, you will be revisiting optimal level of system liquidity. So what is that liquidity level which you are looking so that transmission is effective?
So the study will look into those aspects. That's why it's there. I mean, if I knew the answer, then it would not be there in the report. The study will, go into those details as to how the liquidity should be maintained, so as to be able to transfer or translate monetary policy into the money markets and then to the credit markets.
Thank you, sir.
Mr. Governor, my question's not been asked. Therefore, if I can be allowed to ask my question.
How many are left?
I haven't had an opportunity.
Only
so just one question.
Okay.
So there are three actually.
Okay, we take last three.
Okay, continue. You can.
Thank you. With respect to transmission, much of transmission will depend on how banks look at their deposit rates. And where we are today, we've not seen much of a correction on the deposits front. Banks continue to keep deposit rates higher, and because the fight for deposits is still clearly there in the system. So how do you expect this particular aspect to pan out, sir? And what sort of transmission do you expect to happen on the deposit side? How soon you expect that to happen for the lending rates also to recalibrate?
I think this question was already asked and I already answered it also. But I'll still repeat it. See, 27 against 25 basis points cut that we did in February, there is a lag, you are aware. It will not happen overnight. On the asset side, about 45% of our loan book is linked to external benchmarks, which gets immediately transferred. But on the deposit side, there is no such mechanism. Despite that, and so there is a lag. So we need to understand, as I already mentioned, that there is a lag. Despite that, 27 basis points, it has already, transferred on the deposit side against 25 basis points. Ultimately, you see, the other thing I mentioned is, certainly, this will have an impact. It will be with a lag. It will happen. This is what we have seen over the past two cycles of both, tightening and easing, that it happens. It happens with a lag of 6 to 9 months. And it will happen, even this time around.
Thank you.
Thank you, sir. I'll request Mr. Laltendu Mishra from the Hindu. Sorry, you want to...
If I may, sir, since you had asked earlier to...
There are two more questions.
Oh, I'm so sorry.
Mr. Laltendu, you may please ask your question.
Good afternoon, sir. Sir, we fought a war with Pakistan last month. There is a ceasefire right now. Was there an impact on the economy during this period or after that? Because now both sides have also hardened stance. We're going around the world telling our point of views. And secondly, about COVID, there's some rise in COVID cases. Is there a matter of concern there, sir? Thank you.
COVID is not a matter of concern as of now. I think it has become one of the viruses. Hopefully, it should stay like that. The conflict that we had was, or a skirmish or whatever, you may call it, that had a very, very limited, negligible impact on economic activity. Yes, it did have some impact for those days, especially in northern India, airports being closed, air passenger traffic, did certainly, decrease. But there was no major supply chain disruption, etc. So it does not have any impact, on economic activity, growth, inflation. A few days, the prices in those regions, those sectors had gone up, but it's all normalized. It does not have any major impact on the economy.
Thank you, sir. And lastly, Mr. Aryan from The Informist.
Thank you, sir. This is Aryan from Informist. This question actually is for the Governor as well as for DG Shankar and Gupta. The steeper yield curve has shown to deter rate cut transmission to corporates in the past.
What has deterred?
A steeper yield curve, sir.
Now, today's the MPC actions today and the RBI's actions today have steepened this yield curve further. So, are there any steps to curb this? And then secondly, in terms of the liquidity management framework, there have been some discussions in the market. Any timeline on a draft for that coming up, sir? Thank you.
See, liquidity management framework, there is no timeline that we have, but of course we would like to do it as early as possible. These are intricate matters which need to be understood in detail, because actually in our country the money market is not kind of unified. There are 3 different markets. The participants are different, collateral and non-collateral. So from a transmission perspective, therefore, we need to understand these issues deeper. We have been examining this issue, and I cannot give you a time frame really on this. First, on the yield curves, I'll request, and you can also supplement, on the liquidity management framework.
Yeah, as you know, government securities yields are affected by a lot of factors. One of those factors is monetary policy and expectations of monetary policy, and liquidity is another factor. But there are also, it depends on demand in particular sectors and so on. Typically, what you would see is that in response to monetary policy, the short end adjusts quicker than the long end. Therefore, when rates are being cut, the curve tends to steepen. When rates are being raised, the curve tends to flatten. That happens. But the market, over a period of time, these get adjusted. So like we said, we don't target any particular rates in Forex. Similarly, in government securities yields also, there are no rates. Market will find its own level. If market feels it is too steep, compared to what it should be, they would adjust that. So we would leave it to the market for such adjustments. On the liquidity, I think, what the governor said, we are looking at that. Once internal examination is over, we will come out with that framework. Thank you.
Thank you so much.
Thank you, sir. With this, we come to the close of this press conference. I'll thank the top management of Reserve Bank for answering all the questions and making it.
All right, so that was the top brass at the Reserve Bank of India addressing the media, and what a policy it's been. To quickly recap for our viewers, a surprise outsized 50 basis point rate cut accompanied by a 100 basis point cut in the cash reserve ratio, and we also of course had the change in stance to neutral, surprising the street completely. Apart from what has been done in the policy, let me also quickly highlight a few things that came out of the press conference. Importantly, the comments on the reports around foreign bank ownership, in private banks, foreign ownership in private banks, where the RBI governor made it very clear there's no rethink on the 74% FDI in banking overall. There is no rethink on the non-resident 15% cap in private bank ownership, and there are exceptional cases which are considered on a case-to-case basis that the RBI will continue to do. Overall, it is reviewing the framework as part of its regular discourse, and that will take a long time before some decision is reached. Secondly, on gold loans, good news for gold loan financiers, because the 75 LTV limit will be actually increased to 85% when it comes to the small ticket loans of up to 2.5 lakh rupees. So that is a positive to watch out for. And lastly, on IndusInd Bank, the Deputy Governor making it very clear that the matter will settle, and I quote him, very soon, indicating the action that had to be taken by the RBI has been taken, and also responding to a question on the board accountability, saying the MD CEO resigning itself is accountability at the board level and no more action is expected on that front. So those are the 3 key headlines coming out of the conference, apart of course from the policy. But for now, we're joined by a set of experts to further, go through some of these comments that have come in. Neeraj Gambhir of Axis Bank, Pranjal Bhandari of HSBC, Madhvi Arora of MK Global Financial Services, Rajiv Radhakrishnan of SBI Mutual Fund, and the man of the moment, Soumya Kanti Ghosh of State Bank of India, Chief Economist, the only man on the street to have, predicted a 50 basis point rate cut from the RBI. Mr. Ghosh, let me begin by congratulating you on getting that right, and also on your appointment at, to the Prime Minister's Economic Advisory Council. But on your first take, the 50 basis point cut accompanied by the 100 basis point cut in the cash reserve ratio, what will that do for the economy?
Thank you, Ritu, for the comments. I think, Ritu, there are 2 points in the policy. It's very clear and unambiguous. There has been an unanticipated surprise, of course, in terms of the rate action. But on the rate action, I think it has been front-loaded clearly to aid an investment revival and to lower the cost of borrowings. The second point on the CRR cut, what is most important is that I think the CRR cut has been front-loaded in statement, and it is being cut in September, October, November, December. I think the important point during the CRR cut, where the market actually is thinking about why there has been a CRR cut when the liquidity has been abundant. I think one of the primary reasons of CRR cut could be that it's having a significant impact on the money multiplier. And in an inflation targeting regime, the money supply growth is always endogenous. So if the base money growth is on the smaller side, a higher multiplier actually translates into a larger monetary base. So I think that is one of the thinking which has possibly gone into a CRR cut. And also the second factor is that the CRR cut will have an impact on the MCLR going forward, not now. And that will be actually in the busy season. So overall, while the front-loaded rate cut would now actually cajole the investors in terms of taking up activities which they were thinking of not doing it because of the uncertainty. The action on the liquidity front and the CRR will actually make it happen in the second half when there is the busy season credit policy. So I think this is the overall line of thinking in the RBI, if I am correct, Anna.
Well, we take your point there. Neeraj Gambhir, the fact that the stance has been changed to neutral, how is the street reading this? How extended could the pause really be? And is that a bit of a dampener for the bond markets, even with the large rate cut and the CRR cut that we've got?
So the pause can be really extended. Very hard to put a number on it. We'll have to see how the data comes out, particularly on the growth side over the next 2 or 3 quarters. But I think at least 2 to 3 quarters will be on pause, given what Reserve Bank has done now. Market was actually expecting 225 basis point rate cuts between June and August. That has been delivered now, with the possibility of any further rate cuts in the near term over the next 6 months looking very low. Obviously, the longer end of the bond curve has not taken very positively to it. We are seeing yields go up. Initially, they came down, then they have gone up by roughly 4 or 5 basis points. But I think that's just a immediate reaction. On the contrary, we are also seeing a fairly significant reprice or yields moving down in the shorter end of the curve, both in government bonds as well as in CPs, CDs, and corporate bonds. Corporate bond yields are actually down by roughly anywhere between 10, 15 to 20 basis points across the curve. So I think the benefit is largely being seen currently in the shorter end of the curve, and the curve has steepened. And the benefit is being seen in the corporate spreads, which had widened initially, but now seem to be tightening a little bit.
All right. And Pranjal, your key takeaways and what is now your expectations in terms of this pause and what the terminal repo rate could be?
Yeah. Thank you. A couple of points. One is, I think this was a very clear case of front-loading, as Soumyakanti Ghosh pointed out. Steps that the RBI wanted to do, but didn't want to stagger it over a few months, rather wanted to do it all at once early on. So it's front-loading. Number two, it wanted to give a package. I think, it wants to give liquidity. It wants to lower the cost of funding, but in a way that NIMs are supported. And I think that's where even the CRR made an entry. The third point I would make is that I think we have to now think about what role the RBI wants to play in the state of the economy. And I think there's been a big change here. It's not just about cyclical growth, about trying to tackle growth today or inflation today, but I think they want to affect the medium-term growth of the economy, the potential, the structural growth of the economy. And I think things like cutting the CRR by 100 basis points at a time when it's not a crisis-like situation just basically, talks about that to me, that they want, credit growth to rise in a way that over time, for multiple years, credit GDP growth in India is actually raised. In terms of where we go from here, look, my sense is a lot has been done so far. We were thinking terminal rates will be 5.25, but we were not expecting the CRR cut. So now that the CRR cut has come as well, our sense is that, maybe this is good where they are for now. I don't think there's much space to cut rates at this point of time. And I think it's fairly responsible of the governor to reiterate in the presser that, it's a neutral stance. Extra space for more monetary easing at this point of time is limited. Inflation in FY27 will be close to 4.5%. So maybe, giving the signal very loud and clear that at least in this calendar year, there'll be no more rate cuts or liquidity easing.
Yeah, in fact, the Reserve Bank of India governor put it in so many words when he said the MPC finds no space right now to act in the current environment, and hence the change in stance to neutral. But Madhvi, what is your sense on this pause and the terminal rates? And like Pranjal pointed out, perhaps the focus is very much centered on growth now. I think the governor at some point even said 6.5% is good, but the aspiration is 8%. And therefore this, cut in CRR at a time when liquidity is in surplus.
Hi, Ritu. So I think the front loading of rate cuts, I think is a very smart move by the policymakers when they're very certain as to where the macro dynamics are headed, at least in the near term. We may see inflation even going below 3% in the coming months or so. So they're front loaded at a time when there's a global calm. They wouldn't want to really take action at a time when maybe there could be a global chaos, probably 3 or 4 months down the line, where there could be more noise with regard to trade dynamics not really finding a new equilibrium. So I think the decoupling that emerging markets are enjoying from developed markets has been very well optimized by the Reserve Bank of India, especially when they have a clarity with regard to where the macro dynamics are headed, which are still growth supported, supported of a much lower monetary policy rate. Most of us were expecting the policy rates to go below 5.5% in the terminal rate. Our own expectation also was a 5.25. So I think it's a very commendable thing that they have front-loaded at a time when there's supposedly a global calm and supposedly a decoupling on emerging market fronts as far as their policy assessment is concerned, and as far as even their risk-free rates are concerned. Now, secondly, coming on the liquidity aspect of it, I think we've been reiterating in our notes and to our clients as well that we were never of the view that there was an excess liquidity fraud that RBI is infusing in the economy. Insofar, they've done more than 9 lakh crore of primary infusion. Our own math suggests that even if they had to reach a 1.5 or even a 1% of NDTL soft liquidity target that they have, sort of indicated in their pressers last time, they still would have to infuse at least 2.5 to 3 lakh crore of new liquidity from the RBI's own book. Of which, I think a large part would now come from CRR. We were expecting more OMOs, more towards second half of the year, and that is sort of taken away. But, if you look at the past transmission cycles as well, be it the Rajan era or Patel era, or even pre-2019 rate cuts that we saw, all of them actually saw liquidity surplus being towards a 2% of NDTL or more by the end of the cycle. So there was, I think this time around the surplus is still much lesser than the past cycle. They have obviously front-loaded that, but one has to see that, if you look at the still tepid growth in base money, which again is emanating from the fact that RBI's own balance sheet actually over the last 3 years has barely grown by less than 6-7%, also implies that they had a lot of role to do in terms of expanding their own balance sheet by doing more primary infusion in the form of OMOs, CRR cuts or FX swaps or whatever that takes to basically increase their own balance sheet to ensure that there's a percolation down the base money route. And this was Shomit was also mentioning that the role of central bank in infusing primary liquidity was not yet over, and we were expecting them to do more on the infusion bit apart from cutting rates. It was more towards through the end of the year, but I'm very happy that they've actually been much more front-loaded in terms of, using current global calm as an opportunity to actually deliver.
Well, yes, that, 2.5 lakh crore liquidity bazooka from the CRR cut and coupled with the dividend, I think the target of 1% of NDTL surplus liquidity will be more than adequately met. But Rajiv, on the bond market side, we went into this policy expecting a 25 basis point rate cut and accommodative stance. It's turned out quite the opposite. Where do you see the 10-year settling?
Yeah, I think it's an interesting question. In fact, from bond markets perspective, you got a policy repo cut which was higher than what the market had priced in, and you had a 100 basis CRR cut as well, which was unanticipated. But I think the big change has been, or the dampener, if I may were to use that word today, it has been on the stance change, wherein they have gone back to neutral. And effectively, even with the FY20 2026 CPI projection being brought down by 30 basis points, the market possibly could have been looking at the terminal rate being even lower than 5.5. I think that's possibly the dampener from a market perspective, and which is what is getting reflected at this point on the long end of the curve. But in terms of where you expect the 10-year to eventually settle, I think what needs to, even with 50 basis rate action, and given that the liquidity surplus is likely to sustain and will be aided by the additional, the CRR reductions that will percolate down to the system. So the effective funding rate will be much lower than 5.5. So you're looking at the effective rate around 5.25 for the foreseeable future. So in that situation, given that we don't really expect any immediate reversal of the policy trajectory, you could possibly see the 10-year benchmark trading lower over the next few months. Possibly closer to 6 is clearly possible in this cycle, given that we really see that surplus liquidity environment to sustain, which basically would be reflected in the effective overnight rates, which will stay much lower than the policy rate.
Okay, well, I'm back from the press conference, so if I can squeeze in a couple of questions. Neeraj, do you agree with Rajiv's interpretation? You know, I directly asked the governor, do you want to keep the call rate at the repo rate? He said, we have not made up our mind. So I don't know what you took away from that. Do you expect the call rate to remain at 5.25? And again, the same question that Ritu asked Rajiv. Is there still a bond rally left, or is it over?
So there are two parts to this. One is the intent and second is the mechanics. Let me first answer the mechanics. As long as the system is in surplus and Reserve Bank is not taking out that surplus through, VRRs at the policy rate, you will see call market rates and overnight rates settle towards the STF rate, because that's the only place where banks can park the liquidity. So for Reserve Bank to bring the overnight rate from 5.25 to 5.5, they will have to actively intervene through the VRRs in the system at the policy rate or near the policy rate. So I think that's the decision that they need to take. My guess is that they might not take the decision early on as yet. They might allow this situation to persist so that there is faster transmission. That's what they seem to be wanting. And if the overnight rates stay close to 5.25, then the transmission obviously will be far faster. So I think once they get a sense that transmission is done and the liquidity in the system is doing the job that it is supposed to do, maybe they can steadily bring it back towards the repo rate. But that remains to be seen. So I think it'll evolve over the next, I would say, month or 2 months.
Okay. Well, I got a sense that we have to wait and see. There may be a possibility they will do the repo auctions. He didn't quite say no or yes to it. But again, bond rally, you think it is over? We are at the possibly the lowest point of the yields because it looks like an extended pause. In fact, do you expect another cut at all?
So firstly, I don't expect another cut as yet. I think for the foreseeable future, we'll have to see how the growth pans out. Second, is the bond market rally over? I don't think so. The size of liquidity infusion that is being done, the intent and the front loading of the rate cuts, I think provides a lot of space for the bond market rally to continue. It may not be seen in the 10-year benchmark because all of us tend to focus a lot more on 10-year benchmark. But I think you will see, as I mentioned earlier, that there is steepening of the yield curve that has happened, which means that the front end of the curve has performed a lot better. We are already seeing CP/CD yields come down quite dramatically, and they could potentially come down some bit more. And the corporate bond spreads can actually tighten up from here as well, because they had widened as the government bond yields were actually coming down. So I don't think that if you're seen as a whole, the bond market sort of play is yet done. I think it'll happen over the next 3 or 4 months.
Oh, okay. I wanted to ask Sakshi and Madhavi. Sakshi, first you and then Madhavi. Have you all changed any forecast in terms of where you see the terminal repo rate now and growth forecast for the year? Sakshi? Sorry, Madhavi. Sorry.
Is it for Pranjal or for me? Okay, so as of
I'm
now...
sorry, I meant Madhavi and then Pranjal. Yeah.
Lata, as of now, I think given the fact that they have front-loaded their rate cut and they've given a sense that they would wait and watch, near term, the data is going to be supportive for, comfortable policy. I don't think near term we are looking at any policy action from the RBI. I think it will also be a function of how the global dynamics play out, because that will be, again, a very important factor in their own reaction function as we go ahead. Near term, I think we will also wait and watch. Our terminal rate otherwise was at 5.25. I think as of now, I'll still wait and watch, because I think they have delivered a lot in the immediate run. And I also believe they would want to wait and watch and see how the transmission really plays out for them. Anyway, the big liquidity bump up is going to come from the Reserve Bank only from September. But before that also, because of the RBI dividend, we'll have ample liquidity in the system. So through the year, we are very comfortable on liquidity, maybe some drying of liquidity towards the end of the year. But generally, we will end the year at around 1.2, 1.3% of NDTL, which is more than the RBI soft target as of now. So I think near term, we'll wait and watch and see. But as of now, I don't think that there will be any rate cut, at least in the next 6 months or so. And plus, a lot will happen globally. I think gradually markets are shifting their call on the Fed rate cut as well. We don't know how China's response would be after the 3-month moratorium with the US would end on the trade front. So a lot will also be playing a part. And plus the global bond route, which is happening at a very rapid pace. So we'll have to see how that eventually transmits to our economy. As of now, I think emerging market, as I was mentioning, are in a very calm state. So I would just wait and watch rather than pushing for a further rate cut immediately.
Okay. No, I want to know actually whether because of the extraordinary loose policy today, CRR cut and more than expected repo cut, Pranjul, changing any growth forecasts?
Lata, there have been 3 positive surprises on the growth front lately. We've all spoken about weak growth, but there's been positive surprises. One, the reciprocal tariff, at least temporarily was reduced from 26 to 10%. Second, inflation suddenly started falling like a brick, which I think has improved real purchasing power for mass consumption. And third, that liquidity is a lot more looser than anybody had predicted, for the foreseeable future. I think all of this is very positive for growth. All of us who were worrying that growth could be sub 6%, I think that's now behind us. I think growth could be anywhere between 6 to 6.5%. 6.5% for me is potential growth. So, RBI's forecast at 6.5 seems to be, all right at this point of time. So I'm not really worried about growth right now. I'm not worried about inflation too this year. I think, in fact, inflation will be more like 3%, much lower than the 3.7% that the RBI has forecasted. But my worry about inflation is just in the way we have benefited this year from a high base. Next year, we will have to live with a low base. And just with the same monthly momentum next year, actually FY27 inflation can easily become 4.5%. Again, something that the governor spoke about. So if you think about growth not being that bad and inflation being perhaps closer to 4 over a 2-year horizon and not much lower, I would say I think we are good right now where we are with the repo rate at 5.5%. I think for me, this is neutral. 4% inflation target plus 1.5% real neutral rate adds up to 5.5% repo rate. I think this is neutral, and RBI stance is also neutral. So I feel no real pressure for any changes at this point of time.
Okay. No, actually, I think the governor almost gave it away when he said, yeah, this year it is 3.5 or 3.7, but next year it is going above 4. So that almost seemed like a giveaway that, I cannot take this as the base and then go ahead and cut even more. Or at least that seemed to me. Neeraj, do you see loan growth increasing? At the moment, system loan growth is 9%, but with this gush, do we end the year with a much better loan growth? Your bank in particular, even.
Yeah, I don't think we are changing our forecast of loan growth as yet. I think loan growth is not just about the price at which money is available, but also the kind of other dynamics that are playing out, particularly the uncertainty on the global front, etc. So I think the private capex cycle and the demand from consumer side has many other variables to deal with before we can see a sustained uptick. But I would say that with the current action and the cumulative action that Reserve Bank has taken over the last few months, I think the monetary policy has done pretty much what it could for setting the stage for higher levels of loan growth, including the surprise CRR cut. Because effectively what the CRR cut does is it allows the banks to create more money with the same amount of base money infusion by RBI. So I think the ground conditions have been set, but nothing much can be done about the global volatility and the overall economic conditions that are playing out. We will need some bit of settlement of that for people to gain the confidence and start thinking about private capex, etc. And that is going to be the key driver for growth.
Yeah, may I just hurry you? Is it fair to say that for the banking system, margins fall in the first half but rise in the second half because the CRR becomes effective?
Yeah, I mean, not just the CRR, but the transmission of rates into the liability side. I think the asset side will reprice first, and liabilities reprice with the lag. So I think that dynamic will play out.
Okay, all right. I'm being rushed. We have taken a lot of time. Thank you very much, Pranjul, Madhvi, Neeraj, and Rajiv for being with us. Over to you, Ritu.
Well, thank you so much, Lata, for joining us there. And thank you for all of our guests. On that note, we're going to have to wrap up this discussion. Big policy, bigger takeaways, and the guidance ahead. As far as the non-policy measures are concerned, we'll continue to analyze them right here on CNBC-TV18. Don't go anywhere. We're back in a moment. But for now, we'll step into a short break.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Dhoria and with me is Vivek Iyer. Well, Vivek, it's been a day full of shocks, surprises, and there's no stopping the bulls in today's trading session. What an eventful day, week it has been.
Absolutely. Good afternoon, Bamakshi. Absolutely nothing to complain about as we end this week. Couple of hours yet to go, but the Nifty, Bank Nifty, the NBFC Pack, Fin Nifty, all of them very, very strong. It's a gush of liquidity, both from D Street as well as Min Street. We have quite a lot lined up on the show. Let's start off with the top headlines. Nifty stamps 25,000 after RBI front loads easing to drive growth. Realty, auto and financials lead the charge up. Midcap index up a little over 1%.
Banking stocks surge after RBI cuts the repo rate by a bigger than expected 50 basis points and doubles up with a 100 basis points CRR cut. Central Bank adds there will be no change on the 74% FDI in banking.
Muthoot Finance and Manappuram Finance gain after RBI announces that loan-to-value for small loans has been revised to 85% from 75% for loans below 2.5 lakhs per borrower, including the interest component.
Real estate stocks surge in trade after RBI cuts repo rates by 50 basis points and CRR to 3% in 4 tranches. The liquidity infusion in the market is likely to spur real estate demand. Well, today's day can be actually divided into 2 halves. One before the RBI meeting, outcome, and the second half as well. We've seen a 300-point recovery as far as the Nifty is concerned from the day's lowest point. We managed to briefly surge past the 25,000 mark as well. And a large leg of this rally is being led by the Nifty Bank. We're seeing over 1,000-point recovery out here, as well as the growth that we're seeing in the realty pack. The realty space has spurred up in today's trading session. Look at the gains on Godrej Properties, up almost 6%. Prestige, TLF, all of these counters are doing quite well. Most of the sectoral indices are holding in the green, and the mid-cap end of the market is also doing quite well for itself. Today, it's outperforming the benchmark indices, the advanced decline ratio in favor of the advances. But let's move on to our special segment then, Mid-Cap Movers. We now have Hormaz to take us through the mid-caps that are moving around in trade. Good afternoon, Hormaz. It's a screen that is filled with a lot of green.
Oh, good afternoon, Vamakshi. And as you just mentioned, a tale of 2 halves, if you could categorize it at that. And of course, everything today is about the reactions to the RBI monetary policy, but there are some that are non-policy reactions as well. Some of the gainers in the broader markets. You start off with those. First up, Godrej Industries is one of them, 15% higher now on that stock, and it's at the highest point of the day. The top gainer on the Nifty 500 today. Newland Laboratories is one such gainer as well, 11% higher, continuing to move from strength to strength. And Ramkrishna Forgings has surged up today, and 9.5% higher on that stock on very strong volumes as well. Now moving into policy reactions then, and some of the first movers on that policy reactions were the NBFCs and Chola Investment, 5-star, M&M Financial. Take any BFSI name today and you would find that in the green, 5 to 6% higher for these names. The gold financiers have had a boost as well after the potential relaxations in LTV norms. Muthoot is up 7. Manappuram, of course, in the ban, but of course 5% higher here. And IIFL Finance too, seeing healthy gains in today's session, and that has also had an impact on the real estate names. The realty index had already rallied 5% in anticipation of the policy, and it is continuing to build on to those gains. And look at these names: Godrej Properties, DLF, Ajmera, Oberoi, all of them seeing gains of anywhere between 6 to 7% today. And lastly, some of the volume-led movers, and of course most of them not related to policy though. Root Mobile is up 4.5%, GMDC is up 6.5%, Praj Industries after that contract in Paraguay is up 4%, and Nippon Life too. And a lot of these AMC names, even UTI AMC today has seen some healthy gains on very strong volumes. Back to you guys.
Hormaz, I'm sure today was a challenge to find a single stock in the red for you.
I chose not to.
Keeping it optimistic. Thank you so much, Hormaz, for joining us, giving us a sense of all of the stocks that are doing quite well as far as the broader end of the markets are concerned. Well, we'll now slip into a short break. The management of Signature Global and Mahindra Lifespace developers join us next to discuss the impact of the RBI slashing its repo rates by 50 basis points and the impact it will have on the realty space.
How you came back to India in 2015.
the height of the Maggi crisis.
My father later on told me, when I called him up, I said, Dad, should I take up this? So he said, son, nobody puts an idiot into a crisis.
Mr. M. Naik of L&T, in his voice, "Kai nathi thai rayu, ane kai thai bhi nahi ghana varas sudhi."
What is the best piece of advice that you've received?
To get control, you must give up control.
What have been the biggest lessons from a marketing point of view that you would like to leave?
Kodak did not fail because it was a lousy brand. We did a small experiment to have Maggi counters in weddings. A Maggi stall attracted far more attention than the other traditional food fare.
In a wedding?
In a wedding.
Indian stocks are not cheap. They don't go down because they don't deserve to go down.
The natural thing for everyone is to say that you're doing great and everything's perfect and yes, we agree with everything you said, and then they're dangerous.
How difficult and how different is the Gen Z customer?
They don't come in with a reverence for any brand.
Why do you say so?
Welcome back. You're watching Midcap Radar on CNBC-TV18. Just a few stocks that I'd like to highlight from the capital market theme. Look at MCX. That stock has surged by almost 5% today. It is sitting comfortably at 7,450 thereabouts. Over the past 1 month itself, all these capital market stocks have done quite well. MCX, in fact, has gained around 24% and is sitting at an all-time high. Pull up the chart for HDFC, AMC as well. The stock is seeing an uptick of 5% as well. BSE as well, as we've been highlighting all throughout last week, has been doing exceptionally well. In fact, today as well, the stock has managed to reach an all-time high. But let's focus in on a CNBC TV18 exclusive now. Sources tell CNBC TV18 that Road Ministry is considering hiking motor third-party premium for FY26. My colleague Yash Jain now joins in with details. Tell us more, Yash.
Well, it's been a long wait for general insurance companies. They've been pushing for this motor third-party premium hike for about 3 years now, wanting to see some hike there in terms of motor third-party insurance premium. And seems like things are moving indeed as far as that particular front is concerned. What we've been given to understand is that Ministry of Road Transport and Highways, that is the Road Ministry, is considering a hike in motor third-party insurance premium for FY26. According to our sources, the ministry has received recommendations from IRDAI, which is suggesting that IRDAI is seeking an average of 18% hike when it comes to the motor third-party insurance premium, with one of the classes, vehicle classes under that, seeking an increase of 20 to 25%. It's a large business segment for all general insurance companies, ICICI Lombard, New India, as well as Go Digit. For the industry, 20% of the total premium comes from motor third-party insurance. Under motor insurance, 60% of the premium comes from motor third party. Now, we've just looked at some numbers. A 20% increase in motor third party insurance premium, if it indeed comes through for FY26, could lead to an improvement of about 4 to 5% when it comes to combined ratios of these general insurance companies, that is ICICI Lombard, Go Digit, as well as New India Assurance. So an important development under works, and we'll have to see how this proceeds. We've been given to understand that in the next 2 to 3 weeks is when the ministry could take a final call on increasing the motor third party premium, after which a consultation paper, the usual process, will be rolled out.
Thank you so much, Yash, for highlighting that extremely important story, especially as far as motor third-party insurance premiums are concerned. Good news if you are a shareholder of these companies, but bad news if you are a car owner or a vehicle owner. Well, moving on, it's not short of news flow today.
Absolutely.
Lots going on. Very important discussion lined up. We have Rajat Kathuria, CEO of Signature Global, and Amit Kumar Sinha, MD and CEO of Mahindra Lifespace Developers, who join us now. Thank you so much, gentlemen, for joining us. I'm sure you're rejoicing given the kind of liquidity gush you've received from Mint Street. Mr. Amit, you've been a regular on the show. First up, decode this particular move for us. What does this mean for a home buyer?
Well, this is a great news for home buyers. In fact, it's great news for consumers all across. I'm hoping the low repo rates will be passed on to consumers by all the banks. That's the key assumption, and that has happened before. So what happens is whenever you have low rates, it stimulates GDP in multiple ways, because people look at EMI coming down, their auto, housing, many of the other consumer durables, the EMI and the outflow comes down significantly, and it stimulates their purchasing, their spending even more. So overall, it's good for the economy. So from a consumer point of view, it's a great news. I heard you talk about the insurance going up. Hopefully this will counterbalance some of the pain they may have on the insurance side, having a lower EMI. So great news on the consumer side. But on the other side, from a corporate perspective, like as a corporate for us, I think the rates coming down has a huge improvement for us on the balance sheet side. Our debt burden, some of us has a healthy debt to equity ratio, but the liquidity will improve, the interest rates will come down, the interest payout will come down significantly. And that allows us to do more. We can do more capital allocation toward projects that have higher returns. And that same applies to the other industrial clients also. Like I have an industrial business, and many of the clients are looking for expansion. They say when the burden comes down, they'll say, hey, this is an opportunity for us to do more capital allocation, more capex towards growth. So overall, from a consumer point of view, from a corporate point of view, as well as from a industrial investment point of view, this is a great news for all of us.
Well, thank you so much for that, Mr. Sinha. But moving on to then Mr. Kathuria, because you have a very strong presence in the affordable as well as the mid-income segment, and this is one part of the real estate market, especially the lower end of the market, that was not doing so well. Now we've had 3 rate cuts so far this year. How have the earlier 2 rate cuts impacted your demand thus far? And with this rate cut now coming in, how do you see demand panning out going forward?
Yeah, Amakshi, thanks for inviting us to your show. So, I'll start with a very motherhood statement that, real estate is a very capital hungry sector, and financing cost tends to be very critical either for the developer or for the home buyer. And if you'll see, as a country, we are still at a very nascent stage in terms of supply creation, in the housing space. Top 7 to 8 cities, we are still, after 2 to 3 good years, we're supplying about, let's say, 500,000 new homes as an economy. And if we compare that to, let's say, China, it will be probably doing 10 times more new homes after a fairly long and strong housing cycle. So, there's a lot of work which needs to be done in the space, and all these policy initiatives by the government, whether it is in terms of the earlier rate cuts, tax benefits in the last budget, and this, welcome surprise where it's actually a 50 basis points cut, is a big boost for the customer, which really sees a big impact on their affordability of homes. And I think it very positively impacts all product segments, whether it be affordable, mid-income, and even to that extent, premium housing space. So we are seeing a good, demand scenario in the market. This move should definitely have a positive bearing on it.
Rajat, can you quantify a few numbers for us? A 50 basis point rate cut by the RBI, assuming that transmission is done almost immediately, in terms of EMI burden for the customer, how much does that reduce by? And number 2, Amit did tell us that it improves the balance sheet as far as developers are concerned. So at what rate, would a developer like you, Rajat, actually, borrow from banks? And what will be the kind of positive impact it will have for you?
So as an industry, the balance sheet of multiple developers is much healthier than what it used to be 3 to 4 years ago. So if you look at top 8 or 10 housing companies in the country, if we were doing, I'm giving ballparks here, let's say as an industry, if we were selling about 50,000 crores about 5 years ago, today that number's comfortably jumped to, let's say, 1.5 lakh crores of sales are happening. In addition, there've been a lot of equity infusions into the balance sheets by almost all developers. Net debt or debt levels are significantly lower. So availability of capital is not a challenge. Yes, any reduction in rate definitely reduces the interest burden. But the advantage is more for the consumer because, we fortunately have like a 30-year product available today for the customer. It used to be 25 years, till few years ago, and maybe it used to be 20 years earlier. So 30 years like a long enough product. A half, 50 basis point cut, does move the needle in terms of the EMI payout.
Well, Mr. Sinha, my next question is for you. You have said that you will be exiting the affordable segment completely over the next 5 years. Given how the rate cuts have panned out, is there probably a rethink or a realignment of strategy for you going forward, or do you largely stick to the same?
No, so I think it's, first of all, the definition of affordable is very important for us. I think we will go away from the low end of the affordable segment. We'll continue to play the high end of the affordable segment, I think, is what we call mid-premium. We'll continue to play in that segment. And that's a healthy segment, as you all have discussed. I think the rate cut will stimulate demand in that segment. So we are excited by it. And I think just to quantify this, 0.5%, 50 basis point will have either people keep the same EMI and reduce the duration, but many people will actually see a EMI come down by 3 to 5%, which is a meaningful reduction in the EMI. So that's very good for this segment. So overall, we will probably continue to exit the low end of the affordable segment that we call it, and then focus on mid-premium, premium, which are slightly better for the market we operate in.
Amit, both a qualitative as well as a quantitative question. First up, in past rate cut cycles, typically, when a rate cut of 50 basis points or a 25 basis points, do come about, what has been the subsequent increase in demand? And typically, you said that, most consumers go in for a lower EMI. Do they also go ahead and upscale in terms of the size of apartments or the area that they go ahead and buy?
Yeah, so let me take that question. I think there is, I wish there was a like-to-like correlation, but many times the rate cuts are not always linked to the launches that we have. But generally, what we have seen in the past is when the timing works perfectly, when there's something like this announcement happens and you have launch immediately happening, it just really create a huge amount of footfall for our projects. And as you know, we are focused on 3 major cities, Mumbai, Pune, Bangalore. In case of we had a previous rate cut, we saw a good amount of boost in the footfall for some of our Mumbai projects. So that was very helpful. My sense is that will continue to be there, and people will be very excited to take benefit from the rate cut that they are seeing. The sentiment changed completely. In terms of the upgrade question that you had, I think you are absolutely right. What we are seeing is it's not the per capita income that drives demand in this market in India. It's the per household income. It's not only you are contributing, your parents are contributing. Sometimes, parents, children are contributing. So multi-generational, decision making happens here, and they pull all the investment together. And so when you see that not only more than one person in the family is able to see the benefit of the rate cut, the upgrade desire actually is really can be fructified. So we do see a significant interest in people who say, oh, we're looking at a 2-bedroom apartment, can we go to a 3-bedroom or something like 2-bedroom large? So we do see an increase in appetite of people to see to explore larger upgrades as we look at it. And for Bombay, that is a huge thing. Go from 800 to 900 to 1,000. That's a big increase, and that helps developers from a ticket size point of view.
So demand is good. There's no complaining about that. This does, boost the sentiment. But Rajat, now coming to you, I just like to understand from you because, when we talk about the real estate cycle as a whole, there are several steps involved, right? You have the land, then you, of course, go ahead with the RERA approvals, and then you go for the launch. So my question is, how long will it take for the affordable inventory to now come in for the industry as a whole, because supply has, not come through as much as expected for at least the lower end of the market?
So, Amakshi, we as a company, we started with affordable housing, and we've probably done, in terms of volume, probably the largest number of affordable housing units in the country. In the first 5 years of our initiation, we probably did close to 20,000 units in the affordable category, and this was like absolutely pure affordable, like homes coming in the range of 25 to 30 lakhs. Post 2020, and just to add on, the affordable housing, we used to do it like within the city limits, not going too far away from the city, and hence, calling the project affordable because land prices there tend to be quite low. Over the last 2-3 years, however, there's been a reasonable spike in the land prices in the city limits. At least, in the area we operate, the land prices have gone up, and hence it has made hardcore affordable housing a little unviable for developers. So last couple of years, we've been focusing on mid-income segment. Definitions could vary, but the way Amit was saying that, the upper end of affordable is what they are focusing on. Likewise, we call ourselves more mid-income, but this is a fairly wide spectrum of mid-income, houses starting at about, let's say, 1.5 crores going up to about 4 odd crores. So, that's the spectrum we are playing in. But affordable housing supply is dependent on land cost, and at current land prices, a lot of supply in affordable segment looks tough, at least in the NCR market.
Thank you so much, Amit, as well as Rajat for joining us, giving us a sense of how exactly the entire real estate space and investors should look at this particular rate cut coming in from the RBI. Clearly a positive sign. And the entire real estate pack, actually the entire week, in anticipation of a 25 basis point cut, the stocks have rallied. So 50 basis point cut is actually a cherry on the top, and that is what has caused the rally to extend even further. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. And it's a good afternoon that's shaping up for the market, a good day that's shaping up for the market. You can see green coming in across the screen. The Nifty, the Sensex, the Nifty Bank, mid and small cap, all of them are managing to hold on to good gains in today's trading session. At one point of time, we'd seen the Nifty even touch the 25,000 mark. Then it came back down. And why is all this happening? Today we had the RBI's rate cut decisions, the MPC meeting decisions that came in finally, where RBI cut the repo rate by 50 basis points. Also in terms of liquidity, the CRR cut came in by 100 points. And that is why Nifty holding on to gains of around, more than 200, 250 point uptick there. Sensex up more than 700 points. Nifty Bank also trading with strong gains in today's trading session. So we've seen a good move coming in across the board today. What is, leading the gains? We have realty that's leading the gains. We have financials that are leading the gains. Metals also among the top sectoral gainer today. So that is interesting to watch out for in today's trading session. What's not doing well? Only one sector, that's Nifty Media. But yes, not a major contributor there. So Nifty Media a bit subdued in today's trading session. That is something to watch out for. But all in all, a good day that is coming in for the markets, especially after the RBI's decision that came in this morning. But this is a show where we solve all your stock-related queries, and we're going to be doing just that in the next 20-30 minutes. We have our independent market expert Shaina Mukaddam joining with us, as well as Vaishali Parekh of Prabhudas Leeradhar to answer all your stock-related queries. Vaishali as well as Shaina, very good afternoon, and thank you so much for joining in with us as always. Vaishali, a quick check on the market technicals before we jump to the queries. 25,000 on the Nifty did touch that, and again it came back down. Is there still some bit of resistance that's coming in there? What are we watching out for in terms of support levels for the Nifty?
Oh, well, very good afternoon, all of you. And yes, it's quite a good day with RBI policy, and post that, we have seen a euphoric move. So I think Nifty, of course, it's still well within the range. And I would say 24,700 acts as a near-term support. And we are waiting for Nifty to cross 25,150. That would trigger us a further up move towards 25,700 levels. Whereas Bank Nifty has already done its part. It has given a good surge, and we were looking forward to our technical target of 57,000. So that's where we are nearly there. So yes, there is good participation coming from realty, from NBFCs, from the banking and metals. And now we are looking some pickup coming in pharma. So overall, it's quite a good day.
Okay, quite a good day coming in there as well. Keep an eye out on those levels also that Vaishali mentioned. On that note, ladies, let's get started with the stock-related queries for today. The first query we have is coming in from Ravi, who's writing to us from Hyderabad. He's holding 20 shares of Bajaj Finance. This is at a price of 2,615 rupees per share. Oh, it's a long-term investor in this one and wants to know whether he can book out his profits, continue to be positive on this one. What's the view? Shaina? Clearly, the viewer has had those patience to hold the stock as well. Today, 9,000, about that mark is what Bajaj Finance is trading at. Should they book out some bit of a profit? Continue to hold. What's your view?
Well, see, there is the bonus issue. That is 4:1. There is a split. So I would say you hold on, hold with a stop loss, of course, because, stock has rallied a lot. But and then subsequent to the it going X bonus at whichever date it does, then you could look to, do some bit of tax planning as his question is, and look to book part profits because valuations, are not cheap. If you look at it on a if you look at it over a 2 to 3 year basis, you have valuations now still at about 4.5 times. Even you look at FY27 nearer term, so it is going to consolidate once you have the bonus issue out of your hand. At the same time, if you're holding for very long term, the rest of the stock, it's expected to grow. AUMs are expected to grow about 25%. Also, today's RBI policy is a positive for the overall sector, the NBFC sector, banking sector. So to that extent, book part profits post the post it going X bonus, not right away. Hold with a stop loss.
Okay, hold with the stop loss. That's the view from Shaina. But let's move on. And Vaishali, your view coming in for Bajaj Finance. Should the viewer continue to hold or maybe book some bit of a profit now?
I would say, of course, the stock has run up quite a bit. And today, post the outcome, we have seen a new round of momentum setting in. So according to me, 9,000 should be taken as an immediate support level. And I think if this momentum continues, looking at the volume, I think the stock is ready for a target of 10,000 and above. So 9,000 should be the stop loss and hold for a target of 10,000 to 10,300.
Okay, let's move on to the next query for today. This is coming in for TVS Motors. We have Rahul, who is writing to us from Mumbai. He's holding 150 shares of TVS Motors. This is at a price of 147 rupees per share, and he wants to know if he should continue to hold this one or book the profits, or can he look to add some more in terms of quantity at the present rate as well. Shaina, your view for TVS Motors in the two-wheeler side, TVS Motors, or would you look at any other player for two-wheelers?
The TVS Motors is a good stock to hold for the long term. But at the same time, there are a couple of issues. So you have to hold with a stop loss. One is that valuations are not cheap. If you look at it, price to book, it's about 16 times, and EV by EBITDA 20 times. Again, you're hearing about the raw material issues. We are hearing that China is putting certain restrictions, or we are likely to see some slowdown in terms of production because of availability of the raw materials that are required for two-wheeler, essential raw materials. So to that extent, one has to be careful, because any disappointment in earnings will see the stock either soften or consolidate for a longer period of time. In terms of competition also, competition is aggressive and is likely to continue. I think competition will be quite substantial over the next couple of quarters. So you hold as of now because it's a quality management, quality stock, good products, at the same time keep a stop loss.
Okay, keep a stop loss. Vaishali, your view coming in, right? The viewer has bought this at 147 rupees, and I think when I'm looking at it, the last time it was 147 was in somewhere around in 2014-15. So they've been holding it for a very long amount of time. Would you just say that book out some bit of a profit? They are okay to add some more as well. So it seems like they're a long-term investor already. What's your view on the technical?
Since it's a long term, I would say no harm booking partial profits if 2600 levels break, because that will let you buy the stock once again at a lower level of 2400 levels. But also, right now it is in a consolidation. There is no confirmation of any trend. It is in a positive mode. So I would say hold on. If you get a chance at 2400, 2500, add more, and the stock would gain further more strength if the stock moves about 2900, and that would give you a target of 3300. So that's how I would deal with this stock, and that would be the view from the technical eye.
Okay, that's a view there coming in from the technical front on TVS Motors. Next stock for today is Sula Vineyards. We have A. Subramanian, who's writing to us from Chennai. He's bought it at 100 shares of Sula Vineyards. Price is 643 rupees per share, making a loss on this one. Shaina, your view coming in for Sula Vineyards. It's Friday, but clearly they are not celebrating, given that they are making a loss on this one. So would you suggest some other Alcobev companies if that's the category they're looking at? And what should they do right now with Sula Vineyards now?
Well, yeah, so actually, we as consumers are going to have a lot of more choice going forward, given the fact that, India is having these new arrangements, new FTAs with UK, with Europe. We'll have it with hopefully good tariff, levels with US. So to that extent, I think wine and the competition that is there in the particular segment is going to increase, and this will put further pressure on your prices, or maybe the cost will go up. So to that extent, I would say that while the investors made a lot of loss, it is better to switch from here. And in fact, if you want to be in the same segment, I think Radico has better opportunity going forward. Also, it has done well. If you look at numbers for Sula, were very disappointing fourth quarter. I don't see too much of improvement. So I would say switch.
Okay, switch. That's a view coming in there. And Vaishali, on the technicals, your view?
I would say, of course, this is absolutely a weak stock, and I'm not even seeing any clarity whether it's showing signs of bottoming out. So I too would agree that it should be a switch. In fact, even in the cash category, we have quite a few stocks like Associated Alcohol or United Breweries. If this is the sector that you're looking at, then I would ask for a switch and go to these stocks.
Okay, let's move on to the next query for today. This is coming in from one of those sectors which have been very hot in the last month specifically, and that is from the defense side. We have Anuj Kumar writing to us from New Delhi. He's holding 1,000 shares of Garden Reach Shipbuilders. It's at a price of 2,000 rupees per share. Wants to know the short-term view on his investments. He is making a profit on this one right now. We've seen all these defense names buzzing away in trade China. there's a lot happening on that front as well. Should the viewer continue to hold, or maybe, now book out the profits? Again, you would get it at a lower level. What's your suggestion?
Well, he can look to part book profits. If you see the rally in the last just month or even 3 months, if you take, has been very sharp. Now it has gone up almost 150% if you see over the last 3 months. Steep rally, I would see a bit of, it is better to hold either if you're hold with a very strict stop loss, or then you can part book some profits and then hold the rest for the long term. Because in terms of valuation, it is expensive for the near term, short term query. Near term, it is expensive. Longer term, India now will get a lot more orders for shipbuilding. We are positioning ourselves in that manner, as well as defense orders are, the order book position is pretty strong. So, and also if you see fourth quarter numbers were very healthy, very strong numbers. So if you have that sort of a growth, long term, it's a hold for at least part of the quantity that is bought.
Okay. Vaishali, your view coming in for the stock as well. Garden Reach Shipbuilders, last just 6 months only we've seen 81% return, right? On the technicals, is it indicating a bit more of an upside now?
So technically, there is no exhaustion in the trend, but it is a perpendicular rise right from 1600 to 3,500 levels, and now we are at 32. Still, there is no damage to there is no sign of exhaustion, nothing. But I would say keep a stop loss of 3150, because if these levels break, then it could come into a profit booking mode and go towards perhaps 2800. So strict discipline or book partial profits.
Okay, strict discipline or book partial profits, that's a word coming in from Vaishali. So keep an eye out on Garden Reach Shipbuilders. On that note, viewers, we're going to slip into a very short break. And here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store, Google Play Store, or you can just scan the QR code on your screen. Welcome back to Your Stocks on CNBC-TV18. We still have with us our expert, Shaina Mukaddam, as well as Vaishali Parekh, to solve all your stock-related queries. Let's move on to the next query now. We have this coming in from Rahul Khanna, who's writing to us from Pune. He's holding 18 shares of Honasa Consumers. Price is 220 rupees per share. Wants to know the future prospect of his investments on this one. Shaina, what's your view coming in for Honasa Consumers? Q4 numbers, that turnaround that we saw coming in, good numbers that came in, the stock had run up, after that as well, on the day of earnings, the next day as well. What's your view? What should they watch out for? And given now that, these rate cuts are coming in, how do you see this consumption story play out?
Well, valuations are pretty expensive. So, Vinny, while you have said that, numbers were good, but they were good only on terms of the top line. If you look at the EBITDA or profitability, I think they were under pressure. So, I would say that it will depend on how well they're able to manage their costs and, improve their revenues going forward. Because any disappointment now, because of the valuations being expensive, the stock will take, a bit of a hit. And it will correct. So I would say you can hold, but hold with a stop loss, which is important for Honasa.
Okay, hold with the stop loss is the view coming in on the fundamentals. Technicals, Honasa Consumer, how is it looking like, Vaishali? Should we expect a bit more of a run-up, or is it better to just book out the profit that you're making right now?
Actually, I think it is ready for a run-up, because if you see, the stock has fallen right from 540 levels, and for a very long time, it has been consolidating at 240 levels, 220, 240. And from there on, we are seeing a good gradual upward move. So yes, currently the stock is consolidating. So 290 would act as a support. And once the stock moves above 340, I think this opens the road for targets of 400, 430. So I would say yes, continue holding, but keep 280 as a stop.
Okay. The next query for today is coming from Anil Kumar, who's writing to us from Hyderabad. He's holding 100 shares of PG Electroplast. This is at a price of 811 rupees per share. He's a long-term investor and wants to know whether he should continue to hold this or look to sell, making some bit of a loss on this one right now. PG Electroplast, what's your view, Shaina? What should they be doing?
So the numbers that we saw in the fourth quarter were very strong. In fact, they reported much better numbers than what I was expecting. And really, because they have been showing this very strong growth, both across all parameters, turnover, EBITDA, profitability, and it's made itself a niche player in the AC manufacturing space. Valuations are a bit expensive, but at the same time, one can hold. You can hold it with a stop loss again. So, that's all I can say about this, because, the potential is very high, but at the same time, valuations are also a bit expensive. Company is doing very well in terms of growth. So, you hold, keep a stop loss.
Hold, keep a stop loss. That's the word coming in there. FY26 had given a guidance also of growth of around 30.3% and group level revenue guidance of 33% as well as what the company's spoken about so far. Valuations are expensive is what China is highlighting, but hold is the view on the fundamentals. Technical front, PG Electroplast, what should the viewer be doing? Last 12 months, we're seeing a bit of a run-up that's surely coming for the stock, a good run-up. So now, what should they watch out for, China?
So of course, yes. So the long-term trend is intact, and right now it's at a make or break levels. It's currently sitting on a 200-day moving average on a daily chart at 770 levels. So keep a stop loss of 700. If this stock goes below 700, it calls for a further corrective move. And likewise, if it bounces, because this level, as I said, is a make or break, if it goes above 800, 820, this is ready to get back on track to go towards 1,000 levels.
Oh. 1,000 levels is we could watch out for, but it's that make or break level, so keep an eye out on that before you decide anything. Okay, let's move on to the next query for today. That's coming from Deepak Rupani, who is writing to us from New Delhi. 100 shares of Jio Financials is what they're holding. Price is 290 rupees per share. He's a short to medium term investor, so not a long time period in terms of holding, maybe a year or so. Shaina, your view for Jio Financial Services?
I think everything is in positive for Geo Financials and is working in its favor. Valuations, in my view, are not expensive. It's just slightly over about 1.1 time book. Secondly, I think the tie-up that they've had with Blackstone, the 50-50 joint venture, is a very positive, because mutual fund industry is growing, and both are strong in their own areas of expertise, and they can leverage each other's strengths. So I would definitely say a hold, and any declines, any softness you can add.
Okay, any decline, any softness, you can instead add. That's a view coming in as well from China. Vaishali, on the technicals, Geo Financials, what's it shaping up like now?
So yes, my view matches with China's because it is on a very strong uptrend. It is making a good higher bottom, higher top formation, and it's right now above all the resistances. So I would say continue holding. If a year is a holding period, then this can go towards 360 to 400 levels also.
Okay, keep an eye out on those levels over there. Hold is the view coming in on the technical and the fundamental front. But, Vaishali as well as Shaina, thank you so much for joining in with us because that was the last query for today. Hope you all have a great weekend. And viewers, thank you so much as always for sending us your queries. Keep sending the queries to us. You can see that the email ID is flashing at the top of the screens for you all. So do send us your queries and we'll solve them Monday, Wednesdays, Fridays. Thank you so much for tuning in. Up next, now we have Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
So look at the Taiwan index. That's very, very muted down. Negative bias that we're seeing.
Elon and I had a great relationship. I don't know if we're well anymore.
Trump might have initiated the call likely out of his anxiety of China's export controls.
Almost 1.8% of the total equity worth over 5,500 crore exchange hands.
24,754 on the Nifty. The Nifty bank is absolutely flat.
The reduction recommended by the MPC is for 50 basis points.
This bigger than expected easing has lifted the market move.
Government is considering a PLI-like scheme for rare earth magnet manufacturing in the country.
So should the market assume that the terminal rate can still go down after the pause?
Liquidity is abundant, and if we do not do any VRRR, then it's going to stay at 5.25.
The Nifty, Bank Nifty, the NBFC pack, Fin Nifty, all of them very, very strong. It's a
Well, that's the day so far, and what a day it has been. I don't think very much needs to be said. You can just look at the screen and just sort of, gauge what's happened. 10:30, the rate decision essentially was the point where the market took off, went up like a rocket, and then it sort of kept going through the atmosphere, through the stratosphere and beyond, and I don't think it's come off very much. So we're at the day's highest point. The Nifty Bank, of course, making a new record high. And broader markets also not really being left behind. Lots of sectoral gainers, banks, financials, of course, top of the board, but real estate also doing very, very well. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Surabhi. Hi, afternoon.
Hi, good afternoon. I don't know who gave the cue to whom, whether it was Reema to the Reserve Bank of India or Reserve Bank to Reema. Yeah, she read it. No one thought that we'll get the kind of bonanza that we did, right? On a lighter note, I was joking in the newsroom upstairs that maybe Donald Trump will feel if he could just call Governor Malhotra to the US, talk to Jerome Powell, and see, this is how it's done, Jerome. But yeah, I mean, what a policy, and we'll talk about that as we go forward.
Indeed, and all the risk assets are up and about. So interest rate sensitive. So whether it's realty, the realty index is up 4.5%. Banks are doing well. So banks have a gain of close to about 1.5%. Capital market players are active. Auto is up and about. There's no complaint in this market. Everything's green. There are just a handful of stocks in the red.
Yeah, no, absolutely. And, so, yeah, 25, basically the market's now 25,116. That is, and you're almost there. I mean, of course, it needed a little bit of help from the Reserve Bank, but it got it. So 25,116 is the next resistance, which is nothing but the high that we saw on the 15th of May. That's it. And, let's see if you're able to get to it. Not today. I mean, I think 260 is good for today, but I think between now and the all-time high, 25,116. Let's see if this is the trigger which is needed for the market to take out the range, which it has been with 463 on the downside and 25,116 on the upside. Real estate index is up 4.7%. DLF, last I checked, was up 6. Godrej Properties is up sharply. Capital markets is another index which is up 2.5%. So Nifty Realty, Nifty Capital Markets, and maybe you look at of course, the private bank index, which is up about 2% as well. Metals are higher, about 1.9%. Autos are up 1.5%. I mean, it's the economy and that aggressive rate cut, hoping that maybe it'll help spur demand, which has been rather poor, subdued in many segments, especially in the lower end of the marketplace.
Prashant, I remember in Bazaar you were saying that how is it going to be? RBI is going to be the second headline today.
No, it's the first.
And then the RBI said, hey, never discount the central bank, right? But just to talk about the global cues as well, we are seeing this beautiful rally play out on our screens. And there is fresh ammunition in terms of international positioning right now. US futures are up and about. Remember, today is the all-important non-farm payrolls report as well. So unless there's a massive disappointment or a howler there, the expectation is 125, 1,25,000 jobs should be added in the US economy in the month of May. And right now the market's going in with the positive expectations for that as well. So it's local plus it's global. It's turning out to be a good Friday.
So how should you position yourself for the last hour of trade? 1 hour to go to wrap up the day and the week. Ashish Kyal from Wave Strategy Advisors is with us on the show now with a few closing trades. Ashish.
Hi. Afternoon to you and all the viewers. It has been a fantastic day. And what a surprise by RBI governor with the 50 basis point cut and across the board. Having said that, I think markets were waiting and consolidating for nearly around 12-13 trading sessions just in a very narrow range, and it has given a very strong breakout in today's session. Having said that, stock-specific action will continue. I think the interest-sensitive sector is going to be buzzing from here on. The first pick is going to be PNB Housing Finance. We can clearly see a very strong candle form today, bounce back from its 20 DMA. Huge volumes picking up there, and the stock can move towards the level of 1,200 on the upside. And on the downside, the support for the stock is going to be around 1,060. The next stock that is on my radar is going to be from the Bajaj Housing Finance. We can clearly see a very strong move in today's session. It has not done much for quite some time, but there is a possibility of it giving a very strong breakout, and one can create long positions here. Expectation is that the stock can go towards the level of 135, and on the downside 120 is going to be an important support for the stock.
Okay, all right, Ashish, got that. Thanks very much for the strategies. We will come back to you in a bit for more question and answers. In the meantime, now let's address, of course, the big story of the hour and just a very quick summary of what's happened today and why is this such an important RBI policy, because the RBI has defied all expectations. You know, the near consensus on the street was 25 basis points. We got 50 basis points on the repo rate, but it didn't end there. No one was talking about a CRR cut, but guess what the RBI did? Not 25, not 50, not 75, 100 basis points of a CRR cut. And the sense is very clear that the easing has been front-loaded. And this was also adequately captured in the commentary that came in after the announcements, where the RBI governor said that the stance has been now changed from accommodative to neutral because the MPC feels that it doesn't have any more elbow room left after today's cuts to do more on the rate front. And the RBI went on to say that the Reserve Bank feels that the war against inflation has been won. Remember, the inflation projections have also been lowered for the current year from 4% to 3.7%. There are a slew of other very important measures, including, of course, easier norms for gold loans below 2.5 lakh rupees. There was commentary on indices and what's happening with that bank, commentary on what happens with foreigners owning bigger stakes in Indian banks. So we'll get to all of that bit by bit. But let's start by listening into the governor on the big rate announcements and the monetary steps taken today.
After having reduced the policy repo rate by 100 basis points in quick succession since February 2025, the Monetary Policy Committee also felt that under the present circumstances, monetary policy is now left with very limited space to support growth. Hence, the MPC also decided to change the stance from accommodative to neutral. From here onwards, the MPC will be carefully assessing the incoming data and the evolving outlook to chart out the future course of monetary policy in order to strike the right growth-inflation balance.
Okay, so that's on the policy itself. And then, of course, journalists also quizzed the RBI governor and the deputy governors on the latest with IndusInd and whether the RBI is satisfied with the manner in which things are progressing. Hear out what the governor had to say on this.
I think, see, the MD CEO, has resigned, and it says, for taking, moral responsibilities. I thought, that should be good enough. Do you expect that all the board members? I mean, what are you hinting at? I think the MD CEO, who's also a member of the board, if he has taken responsibility, that is at the board level itself.
Okay, well, sort of slightly sharp exchange there on IndusInd Bank specifically. We'll get a comment in on what the stock, what it means for the stock, if anything at all. But before that, let's just also get the gold loan bit, because that indication came from Delhi, and I think it's been followed through from the Reserve Bank of India. So these are meaningful relaxations which have come through. Ritu is here with what's happened. Ritu.
Well, Prashant, first, overall for the sector, falling interest rates are never good for banks. It affects their margins. But that said, most of the bankers we've been speaking to have been talking about somewhat of a turnaround by the third quarter as liabilities also balance. For NBFCs, of course, this is good because the cost of borrowing comes down. But for gold loan lenders in particular, there is lots to cheer for because the draft rules which had come out were already much easier than what the street had feared, and now further relaxations have been announced by the Reserve Bank of India. What are these relaxations? To begin with, the loan-to-value cap for small ticket loans of up to 2.5 lakh rupees has been relaxed from 75% earlier to 85% now, which essentially means if the gold, for instance, is valued at 1 lakh rupees, earlier lenders could give a loan of up to 75,000 rupees, which has now been extended to up to 85,000 rupees. But important to keep in mind, they should also include the interest component along with the principal, so that LTV has to be maintained throughout the tenure of the loan. The second relaxation is that for small ticket borrowers of up to 2.5 lakh, in general, they will be exempted from any sort of additional credit appraisals to make it a lot easier for lenders to lend to this category of borrowers. And as far as the use of gold loans for commercial users is concerned, the end-use monitoring will only apply for those gold loans that are taken under the priority sector lending. So a slew of relaxations being announced for gold loan financiers. Yes, as you rightly pointed out, the North Block very clearly making recommendations that small borrowers of up to 2 lakh should be exempt from these stringent requirements, and the Reserve Bank of India has followed through on how the biggest gold loan lenders, the likes of Muthoot, for instance, where almost 95% of the book is gold loans and nearly half of the book is to small ticket borrowers. These lenders stand to benefit significantly. They can extend more loans. This will boost loan disbursements. This will attract more borrowers and, of course, improve their earnings on the back of this. And then Manappuram, CSB, City Union and IFL are some of the other lenders that will, benefit from this.
Okay, all right. And a lot of those stocks are rising exactly for that reason. Ritu, thank you very much for, all the context over there. There you go, a rally between 5% to 6.5% on the key gold financiers. Let's take this forward with Prakash Diwan, who's joining us on this leg of the show. Prakash, hi. The RBI governor has ensured indeed it's a happy Friday for the street, right? So have to discuss, trades across financials. But let's start with the gold loan companies, Muthoot, Manappuram. Would you buy anything after today's announcements?
Good afternoon, Sabi. So I think Muthoot, post the numbers itself, was looking so promising. You didn't need this particular, tailwinds to kind of back things the way they're growing. And my sense is you'd rather be better off focusing on some of the other smaller banks that are now going to be in a position to actively lend gold loans. Gold loans is a portfolio that's much easier for most banks. They really don't have to worry about, the risk weights. And it's self-fulfilling in that sense. So, there's no reason why the other banks, the banks that have already been doing a lot of this work, and I can tell you South Indian Bank, City Union Bank, there are lots of them who are, including SBI for that matter. Let's not talk about just small banks, but this is a segment that's growing phenomenally. But raising the LTV to 85 is always fraught with risk. Gold is at elevated levels. If something goes wrong on the valuation itself, you'll probably have the value itself coming down, and that becomes a bit of a risk management challenge. So the seasoned players are the ones you should go with. But I don't buy these things on the day where you're celebrating. Today, it's a day where defense is sulking, and that's the time to look at some of the defense stocks. Gold loans, NBFCs, financials, they probably look after a couple of days, maybe sometime next week when all this enthusiasm peters out.
And these gold financiers, I'm just checking, so far this year, they've actually done pretty okay. Manappuram is up 31%, 15% on Muthoot, when the market has been struggling in a range. Very quickly, Prakash, since we're talking policy, what would be your other, best picks just to play this liquidity and this, rate transmission, spree? Any bank, any NBFC stock that you'd go with?
Not really. See, I'll tell you the RBI policy, and it's been discussed. We had a full house discussing it post the presser. So I don't want to add to that or be repetitive. But what stands out is that the front loading of the easing is with the confidence that the transmission will happen very quickly, right? And that's why you also have the CRR cut giving you that backup. And the accommodative stance moving to neutral is precisely because of that. There's no more pampering that banks need or financial services companies need. You better do that yourself and quickly, brace yourself up to this reality of reducing interest rates. How this benefits is the biggest beneficiary, the second order effect is not going to be just NBFC, it's going to be cement companies. I'll tell you why. We spoke to you, you must have heard the conversation between Mahindra Lifespaces and Signature Global, and all of them are talking about being able to expand the balance sheet much more aggressively. All these months, there's been no land acquisition, land parcel acquisition, except for some of the big names. That was under JDAs, right? So if this were to happen, you will probably have a seeding of a lot of greenfield projects. And when that happens, immediately with a lag, cement companies do well. So I know it's like a little bit of a indirect way to look at things, but I would believe that this will cascade into benefits where cement sales will start picking up, the pricing will come back because real estate is doing well, because funding is better. So that's the way to kind of look at it. But today, it's a day worth celebrating. We didn't expect this; it's come as a surprise, so you should enjoy that. But I would believe going forward, some of the largest cement companies which have done well in terms of capacity augmentation, cost control, efficiency, they will sparkle brilliant.
Got that. For today, the real estate companies are doing well. So the first order impact is visible in Godrej Properties, DLF, Prestige. These stocks are up between 6 to 7%. But let's focus now on a CNBC TV18 exclusive. Sources tell CNBC TV18 the Road Ministry is considering hiking motor third-party premium for FY26. Yash joins in with the details.
Well, this is a very important development for all the general insurance companies. What we've picked up from our sources is that the Road Ministry is considering a proposal which was sent by the insurance regulator IRDAI when it comes to hiking motor third-party insurance premium. Of course, under motor insurance, there are three important segments: motor own damage, motor third-party and motor personal accident. Motor third-party is mandatory to be bought with every vehicle as per the law. Now, as far as the price revision is concerned, it's regulated by, of course, the Ministry of Road Transport and the insurance regulator. And there hasn't been an increase in the premium for motor third-party premiums for about 4 years. The industry has been wanting it. Every year there has been a presentation which has been made by the industry, but there has been no movement as far as that premium increase is concerned. This time, there is a possibility that things could be different. The regulator sent a proposal asking for an average of 18% increase when it comes to motor third-party insurance premium. In fact, one of the vehicle categories, of course, in motor segment, has been asked for about 22 to 25% increase when it comes to that motor third-party insurance premium. Now, it's an important segment. I mean, it's a big business segment for insurance companies. About 20% of the total premium collected by the general insurance industry comes from motor third party. Out of the motor segment, it's 60% coming from motor third party. The loss ratios have been increasing because there has been no premium increase given by the government. But indeed, if it comes through this time about a 20% increase in motor third party insurance premium, that could lead to an improvement of about 4 to 5% when it comes to combined ratios for these general insurance companies.
That's an interesting story there. Yash, by the way, what is the tagline for the mutual fund, it's not mutual fund, the insurance campaign?
I mean, you're not wrong. The inspiration here has been the mutual fund industry. Mutual fund sahi hai is for, of course, the mutual fund industry. Acha kya insurance liya.
Acha kya insurance liya.
Yes, and I think they have very interesting the advertisements which they've made, which completely justify that tagline. Acha kya insurance kiya.
They need to get some cricket stars. I've not seen any cricket stars.
No, there's a dog and there's a cat, and they've been the brand ambassadors for this campaign. So,
all right, well, I see some of the billboards around here while driving in as well. Yash, thank you very much for that. ICICI Lombard is the big winner, 6%, and all of it, I think, after our story. Prakash, any thoughts here? Lombard or the others, Go Digit and the other general insurers, anything you like?
So I think it's a very important reset, and some of the players who are newer to the market will benefit without having to worry about the backlog. So let's say Go Digit comes to my mind. Again, it's not a specific recommendation, but if you had to kind of pick and choose something which probably does better than the rest, it'll probably be some of these names which don't have a backlog of claims that they've lost. I mean, the claim loss ratio that he's talking about, which so that's something which you don't have to worry. The important thing, what it does is the third party insurance entry barrier going up or threshold going up actually is because there's a huge pre-owned market that's flourishing in India. In fact, it started about 3-4 years back, but it's getting more and more organized. So you have the car techs and the cars 24 and all of that. So what's important is that this segment is the one that usually wraps it up in the pricing itself. I mean, all cars which you buy out from any of these portals, any of these platforms, come with these insurance schemes, so insurance coverage. Now, that is something where, their margins will get impacted a bit, but the market will get much more cleaner and organized. So I think it is more, I would say it is more structural in terms of the salience rather than specific to some stocks. ICICI Lombard, of course, is reacting because it has the lion's share. And rightfully so, they'll not be bleeding out of this because 60% of their premium collection is on that. It's only the higher end cars that you have insurance, which is productive or very remunerative for most players. So I think it's structural, but I would believe a Go Digit will also benefit. Of course, it's not discussed much because it doesn't have a history yet post listing, but these are some of the names that will do better.
All right, Prakash, great conversation as always. Thank you very much for joining us. Appreciate it here on CNBC TV18. So that's the bit which is coming through. So 250 odd points on the Nifty at this stage. We are at 25,000 basically. Let's go back to the big story, which is the Reserve Bank of India and what they've done. Lata in the morning was telling us that, I think, Lata, you used the word fireworks. It is fireworks.
Yeah, absolutely.
See, Prashant in the morning was saying that RBI will be second story and Trump and all, Musk are the first story. No,
I think Malhotra heard it and decided to come back with a vengeance.
But I think we have the SBI chairman.
Yes, Mr. Sethi, the SBI chairman is with us. Mr. Sethi, really grateful that you've pulled out time after, telling us that it is an extremely busy day for you. At first sight, what are your first views on the policy? You get a higher than expected rate cut. To be fair, your colleague Saumya was the only one who guessed it at 50 bips or forecast it. So congratulations on his behalf as well. But what are your first thoughts?
Thank you, Lata. I think on the rate front, obviously, we had some house view on that through Saumya. Probably, it was not as big a surprise for us as to the market, but CRR cut obviously pleasantly surprised every one of us. For a long time, we've been asking the RBI to have a relook at the CRR, and it's a good move in the sense that while the CRR mathematically does not impact any lending rates and deposit rates, it definitely augments the liquidity, and RBI has been providing sufficient liquidity. And also CRR will have reduction in CRR also will have a money multiplier impact.
Yes.
So that's a very positive in my view. Okay. And I hope that, though the governor has given some disclaimer that they may always relook at it, but it will be a sustained one.
Yeah. So let me just explain money multiplier to those of our viewers who don't use these words on a daily basis. What the chairman is trying to tell us is that the CRR is not a one-time. What does it mean? 2.5 lakh crore of 1% of total bank deposits, which were lying at zero, at cash, can now be lent out at 8%, 7%, or whatever they choose to. It is not just that money that they make. The multiplier is every loan creates its own deposit. So whenever you go and ask for a loan, the SBI just creates a deposit in your name. And that deposit, they don't have to keep 4.5% as they used to last November. They have to set aside only 3% as cash. And again, you create more deposits. So this multiplier means, there is a fall in cost of funds for a sustained period, as long as the multiplier works. And I don't think that's very, easily understood by equity analysts, because this is not the daily thing. So I take your point on that, sir. Therefore, Mr. Sethi, would you say that loan growth you may have to relook? Because if you look at your November versus November CRR, last November 24, you were 4.5 CRR. And this November, you are going to be at 3% CRR. Would you say you may end the year with a higher than expected or higher than guided loan growth?
Obviously, in the last a few months, with the availability of liquidity obviously has never been a constraint for credit growth in the last few months. But the very fact that RBI further took steps in terms of increasing primary liquidity and a durable basis is something remarkable. So, and I'm sure that, which is the stance of the regulator is more towards propelling the growth. And we are sure, I think it's a no-brainer to expect retail growth to be more robust than what we have had seen in the last few months. I'm sure that will pick up with the NMI, EMI, ratios getting improved. Two things. One is this rate cut, and the other one is that the tax rate cut, which is available up to 12 lakh rupees.
Yes.
We will be seeing some additional money in the hands of the people. So the NMI, EMI profiles of the retail borrowers is improving. So which means that there definitely would be an improved growth in the retail. The question is the next question, before you ask, I'll answer that on the corporate credit growth. So I think we may have to see that the stage is set for availability of liquidity and a reasonable interest rate regime now. And it is for the corporates to take a call in terms of the investments. I'm sure some of the pipeline which we've had will get strengthened. And more importantly, Lata, the consumption coming back, both in terms of the housing loan-driven consumption, personal loan-driven consumption, may make everyone to look at their capex programs.
Okay. So more than capex, I want to get the margin picture, sir. Is it fair to say that your margins are going to fall in this quarter rather badly, but you will exit the year with much better margins?
I think we need to look at the Q4 exit margins. I think we should not be looking at next 2 quarters. The two reasons. One is, obviously, we also will get benefited by the margin improvement, which will accrue by the CRR cut from September onwards. So there will be a U-shaped curve in terms of the NIM movement, in my view. It will, there will be a reduction in the margins, and then we'll pick up as we move towards the Q4. I think we should look at the end state margin for the financial year, where we will not be badly off. I think both the liquidity availability and the CRR cut, to a large extent, helps us to protect the margins. And as you also know, the incremental deposit rates are getting readjusted faster. The issue is only on the stock, and the stock will take about 6 to 9 months to meaningfully get repriced.
Yours is a large stock, sir, 30 lakh crore or something. So it'll take time. But if you can put some numbers, your U-shaped is very helpful. But how much does it fall and how much does it rise? I mean, 20 basis, 30 basis, how much do margins fall?
I mean, it's difficult to take give a number at this moment. So we'll also have to see how quickly we can transmit the deposit rates. And that will impact how deep is this U-curve and how shallow it is.
Mr. Sethi, sir, good afternoon. Surabhi here. I just had one supplementary question to your point on growth. What was your expectation for the year, for SBI and for the system at large? And SBI is a giant part of the system. I mean, was it, some economists are saying earlier it was 9-10% credit growth expectation for this year. Now that gets bumped up to 12-13%. What is your assessment? And within that, unsecured, we heard the governor very clearly say that unsecured stress has abated. Should we expect retail to drive the growth? And then therefore, what will be the retail growth, the overall growth, and within that, the unsecured retail portion as well?
So we have given a guidance of 12% for the current financial year. And the system generally 1 or 2% less than SBI. This is a typical the way we look at the industry. But if retail picks up the way we expect now, maybe, we will be in the 13% range, and the industry will also push towards 12% range is what I expect. As far as your unsecured personal loan question is concerned, as I mentioned right in the beginning, it's not only the stress in the unsecured loan seems to be better off. We have not seen Of course, our portfolio is completely different from the industry portfolio. But we also understand from the industry that the large pain on the unsecured loans is no more there, which also gives the confidence that a combination of the softening interest rates and the consumption drive will bring back the unsecured personal loan growth rates. Because we almost hit the bottom now on the unsecured personal loan growth rate at the industry level. And it is only probably going to go up.
So if overall growth is at 13%, courtesy the pickup in retail, I'm just trying to understand the number. At what rate do you expect system-wide unsecured portfolios to grow at now?
I don't have that number, Surbhi. I won't like to hazard a guess now at this juncture.
Okay.
That's a fair point, sir. Thank you very much for squeezing out time for us. And I think the chairman has given us a very important way to look at bank margins. We are going to see a fairly important cut because every loan is going to be 0.5 percentage point lower in terms of return, because I think they have an external benchmark linked loan book of nearly 30% or 27% or thereabouts. So all those loans get cheaper immediately. By the time it works its way to deposits, it will take a little while, but not very long because of the generous liquidity. And then the cost of funds even falls faster by the time you come to September, October, November because of the CRR cut. And therefore, there is a U-shaped recovery in margins.
Margins will be U-shaped this year.
You know,
I think that's the headline he's giving us.
From a very consumer point of view, a friend of mine was telling me he banks with SBI, he's got a loan. I don't know, Mr. Sethi is still listening, but he was saying that every time there's a rate cut or a rate hike, actually it's in terms of rate cut, right? He says that, well, you know, he's got to reach out to the bank and ask them, can you please give me the lower rate? Otherwise, the rate doesn't. I don't think it's true for most. I don't know why it is, but I think you have to tell them to.
Especially home loans. I hear that all the time on Let's Talk Money as well. Yeah, you have to call up and say, if you don't cut, I'm moving to a different bank.
If you forget, you pay the higher rate for 6 months, and then you know. So anyway, I don't think it's an SBI specific thing. It's just an industry practice, I guess. But that is how things are. Well, I think another important voice, right, is Keki Mistry. And basically he's praised rate cuts from the RBI, banking sector veteran, former vice chairman, CEO of HDFC, saying that the central bank has done more front-loading this time only to inject growth back into the system. Excerpts out of that conversation with my colleague Shireen.
My personal view was that it would be a 25 basis points cut. But I think there's been more front-loading that has happened in the rate reduction, largely to fuel the growth back into the system. We had seen a little bit of a slowdown last year. We started seeing a big pickup in consumer behavior in the last 3 months or so, and this will fuel that growth further. You know, last year our GDP would have grown by, let's say, 6.5%. And we would say 6.5% is low compared to the 8.2 or the subsequently reported 9.2 of the previous year. But 6.5 still makes us the largest and the fastest growing economy in the world. So what are we talking about? But whatever little slowdown happened last year, to my mind, will change completely with this new reduction in rate. It's a big benefit for banks because the amount of money that we were putting with RBI where they were not getting any return, that amount will reduce. And if that amount reduces, obviously they can lend that money to the public at a higher rate. So the profitability of banks increases when CRR is cut. Interest rates being cut doesn't make so much of a difference because you have to pass the benefit back to customers. So, and the cost reduction may come a little over a period of time. The passing on of the interest rate cut is immediate. But the CRR is a huge, huge benefit for banks. So this will fuel growth. And we saw the growth coming back last quarter, where I think the growth was around 7.4%. And to my mind, this 50 basis points cut and the CRR cut is the confidence RBI has on inflation.
Okay, welcome back. Rajesh Bhatia is with us now. Rajesh, good to have you with us here. I don't know if you heard the conversation with the SBI chairman, but what's the thing to do? On the back of this rate cut, what would you buy?
Yeah, I think, the last two interviews were really very informative for your viewers. I think they laid out, Mr. Sethi of SBI just laid out the fact that the growth, which was a challenge, is something that they will address by increasing their loan book. And I think that's great for the stock markets as well. And I think, as Mr. Mistry also said, the slowdown that we were witnessing in the last year is also getting addressed. Look, I think the challenge for the market was the slowdown in earnings, which was really by way of slowdown in GDP, because the government expenditure, which was really the one which was driving growth in India, was ebbing because we had to control our fiscal deficit. The other components of GDP were not firing. Fortunately, we have a very good deflationary environment. I would say inflation is very benign across several parameters, and that has given us tremendous monetary policy leverage to jumpstart growth. And I think the RBI governor has been courageous enough to go a 50 basis point plus a CRR cut to jumpstart growth. And when we talk to banks, they say that they are ready to lend again in the retail category. So this is going to accelerate growth, which is great for earnings and great for the stock markets. Left to our own devices, I would not be surprised if India goes to a new high. As far as your sector call is concerned, of course, look, I think the immediate beneficiaries of the interest rate cut are NBFCs. You have seen this, there's a very strong market. Look at how real estate, capital market plays, engineering companies have bounced back. As an aside, I would say it's probably automobile companies also, which have not participated so far, could also be beneficiaries as you move forward.
So incremental money, when you have to put it to work at this juncture, it would be NBFCs and auto?
So my incremental money has gone into NBFCs. It has gone into auto. It did go into quick commerce companies, and I bought some public sector banks. So that is really where my incremental money has gone. I rue the fact that I have not bought enough real estate or capital marketplace, but I think those are also sectors which can do well as you move forward, given what has happened.
You want to name any names, especially in NBFCs, Rajesh?
You know the challenges that we face, but I have added a gold finance company where a private equity major has taken a stake because it was available at a one-time price to book multiple. So that is something that I've added as far as NBFC is concerned. Of course, we have other NBFCs as well. We continue to like the fast-growing NBFC, which had become extremely expensive, only to become slightly more cheaper over the years as the price consolidated. We think it's catering to the right consumer segment, and it can kind of continue to grow as you move forward. So that's another large holding of NBFC that we have.
Real estate was a missed opportunity. In some way, that's what you said. Now, would you look to add to real estate, or it's too late?
So not my money incrementally is not going to real estate. Honestly, like I said, it is a missed opportunity. But when we speak to real estate companies, they are very excited about their pre-sales that they are witnessing. We asked them about whether they are seeing any slowdown given the stock market decline, etc. They were, quite affirmative that they are not seeing any slowdown. So even though they are hearing of an economic slowdown and a stock market slowdown, they are not seeing any pre-sales slowdown. And given this boost that you're going to get from for the economy, I think it's going to be a sector which is going to remain elevated. But for me, my margin of safety is a little low as far as real estate companies are concerned.
Yeah, no, absolutely. The other one is defense sector. By the way, the defense index, we've forgotten about it. It's down. The index is down after a huge amount of outperformance. Do you own anything here, Rajesh?
Yeah.
And the question is it are these viable now at these levels?
So again, I own only the frontline companies. But I can tell you, we were in a defense conference, and the kind of visibility that these companies are talking about, growth rates, etc., they seem to be full for a 5 or 10 year kind of a period. They kind of are alluding to the fact that they can actually grow for a very long period of time. But But I think you've kind of hit the nail on the head. Are these at valuations which are comfortable? But look, I think that's the challenge for our equity market. There's just too much money chasing these growth stories. I mean, look, I've been to like 5 or 6 conferences in the last month or so. When you talk to electronic manufacturing companies, engineering companies, right, defense companies, the confidence for growth rate for 5 or 10 years is incredibly high. But these stocks are also not cheap. So that's really the challenge that we have. So India is in a very good spot. The risk will be only global. Our macros are very strong, and I think we are again poised to accelerate as we move forward.
No, absolutely. Another sector, Rajesh, like defense, where, you're asking the question, what's going on with the market caps, which have ballooned, right, is rail. And we're going to focus on that. Nimesh actually is now joining us. Nimesh is going to talk about, not rail now, but rail later in about 30 minutes time on Editor's Roundtable. Nimesh, but for now, what's the chatter? What are you picking up? What's the mood like?
Well, Prashant, it's all about RBI policy, right? And we've seen a big rally in the financial stocks today. The Bank Nifty is up 1.5%. The top gainers in the FNO are all part of the financial names, whether it's NBFCs or private banks. So actually, it's come as a big surprise. The whole policy was much more than what the street was anticipating, especially in the CRR. Nobody was anticipating such a big cut coming in. So that's been a big talking point in the daily rooms as well. And we've seen a reaction across the financials and rate sensitive. So I spoke about buying interest in the bank names and small private banks and NBFCs. Even the real estate, which was seeing a bit of profit booking yesterday, have again seen a big rally today. So all the real estate stocks are buzzing in trade and on large volumes as well. I guess from a technical point of view, 24,950 is the level on a closing basis to watch out for. If that's the case today, you might see further short covering rally in the days to come. So clearly, the RBI policy was the center stage today and has led to a big rally across the financial names.
What are you picking up in terms of specific stocks, Nimesh?
So the first stock on my list today, Prashant, is Ramkrishna Forging. That stock is buzzing in trade, up 10% for a couple of reasons. One, I understand there was a selling going on from a domestic mutual fund. That seems to be largely over. So supply is gone. And also the fact that the promoters, earlier this week, announced putting in money at 2,100 rupees per share. The question mark there was on the warrant by when they will convert. The sense I'm getting from the investors or some of the buy-side fund managers is that maybe that money will come much before the 18 months of the warrant period. So I guess that's also a bit of the reason why we're seeing a bit of traction in that name today. So that's the first stock. Second stock is Azad Engineering, which we highlighted a large block till in the morning trade, nearly 8% equity got changed hands. Again, I understand the promoter entity was a seller in today's block, and that's the reason why that stock is under pressure, because the entire deal happened at a much discount. The third name is ITC. This is going to be interesting. Well, the stock has been consolidating off late. I understand some couple of large, global FIs have bought also ITC in the last few weeks. But for ITC, the sense I'm taking is there could be a corporate development very soon, and that is potentially an inorganic move by the company in the foods business. So that's the buzz as far as ITC is concerned. And the last one is Elecon Engineering. Again, something I ended up putting out at least one stock where there's a large block coming in, and the next could be in Elecon Engineering. So while the stock has been consolidating, the sense is that could be a large block coming in Elecon very soon.
Swiggy, and there's the other one, right, which has been moving around. So RK Forgings is, of course, is the biggest volume-led gainer, by the way, right now. Azad Engineering, Elecon, and ITC are some of the names which Nimesh is highlighting. We'll keep an eye on these stocks. Well, we'll take a break here, but as we do that, let's just sort of revisit that story, which is, of course, the big talking point globally, the fight between President Trump and Elon Musk. The question I asked Leif Eskesen, chief economist at CLSA, is this. Can this fight lead to a toning down of the trade war rhetoric? Can this actually at the margin be a net positive in that regard? Listen and take that break. See you on the other side.
The more voices you have from corporate titans, right, that are pushing back at this sort of more aggressive tariff strategy, right, and a warning about the broader macroeconomic implications, but also the sector implications of these tariffs, right? The more people you have from that side of the spectrum talking out against that, it could, on the margin, as I said, soften the stance of the Trump administration in their negotiations with other parties, right? But I also think the sort of, should we say, the tariff strategy as an ideology runs deep in the Republican Party with Trump and with other advisors as well, right? So I don't think it's going to lead to an U-turn on that front, but maybe a somewhat more, should we say, constructive dialogue in the ongoing negotiations with other trading partners, right? So again, on the margin, it could soften the stance a little bit, maybe move us on the margin a bit more forward on some of these trade negotiations, right? But again, it's not going to stop them. It's not going to reverse them, but it could sort of add a little bit of reality check to the ongoing debates.
Welcome back. We're on the final leg of closing bell for today and for this week. And we have Mayuresh Joshi joining in with some ideas. Mayuresh, I was just looking at the tally for the week and what a stupendous week it's been, right? Not only is the index practically back at the top of the trading range, but look at the individual plays. I mean, the capital markets, Nifty capital markets index is up 9%. Real estate stocks have done so well. And then, of course, you have the RBI bazooka. Okay, let me ask you this. Give us one or two stock names. If you are to play this cycle, this monetary easing cycle, give us a name. It could be a real estate stock. It could be a bank. It could be an NBFC, gold financing company. What would you go with?
Afternoon, Surabhi. No, again, I think a basic tenet, I think with the cut that we've seen and the CRR cut as well, the expectation that gets broadly laid out, if you go back in history, is that corporate earnings might actually improve by 200 to 250 bips. So you might actually see a bump up of a couple of percentage points in terms of forward-looking numbers. So I think that's going to be a huge positive in terms of how the market looks at the micro earnings. Having said that, I think the expectation largely with the rate cuts that have probably come through is that financials as a space should continue doing well. And therefore, I think within the larger names, larger NBFCs, Shriram Finance is something that our belief is might still continue doing well. I think 2-3 reasons. One, I think in terms of the overall book structure of Shriram Finance, I think extremely well diversified as we speak, both in terms of the borrowing mix that it probably has, and also in terms of the lending profile. And that will give it the ammunition with the rate cut that has probably happened in terms of expanding its balance sheet quite significantly with very, very superior capital adequacy ratios that Shriram Finance has. The second element in terms of the unsecured book, because there is some sections of the street that believe that with the kind of rate cut that has happened and the impetus given to lending, will that mean that there might be some exaggerated lending happening specifically on the unsecured side, and therefore some element of stress building up happening if credit underwriting is not completely covered up. I think Shriram Finance also has that liberty because they have only 4.5% in terms of personal loans and secured loans to a large extent. And therefore, I think the balance sheet growth can be quite substantial for a leadership stock like Shriram Finance within the NBFC space. The rating, rankings, institutional holding are all top class. Again, a clear disclaimer, we own this stock both in our local and our global portfolios and continue to remain extremely positive on that. The second element, obviously, in terms of rate sensitives, are going to be your real estate and real estate ancillary stocks to a large extent. And therefore, I think the entire cycle that one keeps speaking about in terms of how the real estate inventory is moving, how pre-sales velocity are expected to take place, the asset-light model that real estate developers are undertaking at this juncture with taking minimal leverage in terms of their balance sheet exposure as well. Our own sense is that Prestige Estates has hardly done anything compared to the rest of the market as we speak. The expectation, if you probably look at the management transcript, in terms of how numbers might actually stack up for FY26, how numbers might actually stack up for FY27, might actually be far better compared to what they've delivered in the last year. And expectations in terms of analysts are probably pegging out. Again, a diversified model in terms of residential, commercial, and the annuity part of the business. And they've got a huge pipeline. So as that gets monetized, a large part of the cash flows will start coming through in the next few quarters. And comparatively, I think the underperformance has been stark compared to other players. So I think a couple of stocks that we have.
Okay, by the way, I think we'll just flash that news in the next couple of seconds on our screen. It's finally happening. Starlink is coming to India. Our colleague Ashmit is reporting this, that the DoT has issued that license to Starlink to set up SATCOM operations in India. It's been in the works for a long, long time. A lot of back and forth about what that will mean for incumbent operators, but finally it seems that this is going to take place. The third operator after OneWeb and, of course, Jio to get that license. So on a very interesting day when, Mr. Musk has had other things on his mind, he does get access to one of the world's fastest growing markets, right? At least it's something positive while he battles other issues back home.
Well, let's see if there's a tweet or not, right, acknowledging it. But anyway, we'll take a quick commercial break here. There's about 5 minutes to go for close. Stay tuned.
Welcome back. Closing exactly at the 25,000 mark with a 250-point bump up, 1% up on the Nifty and the Sensex. Mid-caps participating in the rally today, 1.25% higher. Very strong advance decline ratio. This is after the Reserve Bank of India provided that monetary bazooka of 50 basis points rate cut, 100 basis points of a CRR rate cut, and the stance has been changed to neutral. The bell is gone and markets are closing up at strength. NBFCs with the leaders today, led by Shriram Finance, 5.5% up. Bajaj Finance also gaining close to about 5%. In fact, the Nifty Bank also closed at a fresh 52-week high. Across the board gains, Axis Bank, Innocent Bank, up and about, Kotak Mahindra Bank rallying hard. At one point of time, Pharma was the only index in the red, and to some extent defense stocks saw a bit of profit booking. But outside of that broad-based rally, most of the sectors, higher in trade, rate sensitives, flourishing. Then look at the Nifty Realty Index, 5% gain on that, with names like DLF, Godrej Properties, Prestige, Brigade rallying hard. Capital market plays were active today. The Nifty Capital Market Index was up nearly 2%. On the way down, just 5 stocks in the red. One of them is HDFC Life. The other one is BEL and Bharti Airtel. Mid-cap index also very, very active. Small-cap index closed up with a gain of about 1.5%. PSU banks slightly under pressure. So UCO Bank, IOB, Bank of Baroda, Bank of Maharashtra in the red. But on the way up, you've had an Ujjivan Small Finance Bank, IDFC First Bank, gold financiers like Manappuram Finance rallying close to about 5%. So NBFCs were really the toast of town. That brings us to a close in this edition of Closing Bell. Don't go anywhere. Our special editors roundtable is up next.
The Reserve Bank of India's big growth bazooka lifted the Nifty back above the 25,000 mark, while the Nifty Bank soared to a record high. Friday's rally helped Dalal Street end the week in the green on a positive note. On this week's edition of Editors Roundtable, we decode the RBI's monetary policy, put the spotlight on railway stocks, and also take you through the bitter feud playing out between Donald Trump and Elon Musk. I'm Surabhi Upadhyay. With me, as always, Prashant as well as Nimesh. Guys, what a week,
right? Oh.
Thank God it's Friday.
I know. This week looked like let the Friday come. It was really a hectic week.
Conferences,
conferences,
RBI.
so many blogs, Trump fighting with.
You know what I'm going to do is I'm going to go back to all our episodes and every Friday.
We see the same.
I mean, I think
No, but this time we really felt it. Like this Friday couldn't come soon enough. And when it did, the Friday itself was a bang.
This week also looked big.
Yeah,
because of conferences, blogs, so much happening.
Hectic.
But I think the week itself, I was just doing a wrap for the evening, and there's no point really doing Friday to Friday because I think, the day itself defined the week.
Yeah.
And I think when you think about it, when you come back on Monday, you're not going to look at the whole week, what markets did. You're going to pick off in terms of just where sentiment is, where markets are. And all of that has been defined by the RBI. And maybe over the weekend, if something comes from the US with that phone call, etc. But I think the defining moment, the defining day was really the RBI. And Surabhi, that you put that interestingly, it lifted growth. I think it's lifted the Nifty.
Yeah.
Now it needs to lift growth
the actual growth as well.
Growth also.
That's true. So very quickly, just to sort of wrap this up and why Friday became the defining day of the week. It's the RBI bazooka, right? And the central bank decided to fire way beyond the market's expectations. We went into the event with the expectation of a 25 basis points rate cut. What we got, 50 basis points repo rate cut and a CRR cut and a whole host of other measures as well. For instance, for gold financiers, which makes lending easier when it comes to small ticket gold loans. And we'll talk about some of these issues as we go forward. For the market, this has meant that we are right at the top of the recent trading range. 15 trading sessions, the market has been in a band of about 550 points. The lower end has been about, 24,450. The upper end has been 25,116 to be precise, and we are right there. The Nifty is just about 100 points away from that peak that we hit on the 15th of May. The RBI governor, while discussing the policy and why they have done what they've done, he said that the RBI believes that we've won the war on inflation. It's time to put the focus on growth. And we'll get in Lata to sort of explain some of these steps and what the implications could be. Let's talk about the numbers now. For the week, because of Friday, and thank God it was that Friday, we're up 1% on the Nifty as well. But the mid-cap and the small-cap story anyway was firing earlier in the week. And the final tally is looking so good. 3% almost on mid-caps, 4% almost on the small-cap index. And look at the individual pockets. Real estate stocks, of course, a lot of that was Friday because of the policy action. 9% up on the real estate index. Capital market index up almost 8.5%. So you had specific pockets. Defense was patchy, one day on, one day off. But on an individual stock level, there's a lot of action. And finally, the Nifty is now firing up. The bank Nifty, in contrast, is up 1.5%, finally also hitting those all-time high levels. Now, while we're celebrating the RBI move here in India, let's also keep in context that in general, global markets have been completely looking through all the tariff noise, all the headlines, all the skirmishes and the drones in Russia and in Ukraine and the Twitter and the social media barrage. Markets have been going higher, 1 to 1.5% higher on the US. The Kospi is up, 4.5% this week. The Hang Seng is up 3.5% this week. In general, the sentiment in equities seems to be up. And we'll only hope, equity bulls will hope that the non-farm payrolls data that we get later this evening, that Prashant will watch very closely, that just keeps the good sentiment on and it doesn't kind of spoil the equity party.
Yeah, absolutely.
No, absolutely. I think let's bring in Aman Chauhan into the conversation. He's fund manager at Abacus Asset Management. Aman, great to have you with us here. Thank you for your time. Hi. Where will this RBI boost show up most from a stock market perspective? Which today, for example, it was banks, NBFCs, your capital market companies, the Nippon Mutual Fund and HDFC AMC. SBI card was up sharply. So it was all, financials, holding companies for some reason were jumping. But where will the real estate was another? Where will this show up in a big way, in actual way, in a sustained way, durable way? Aman.
I think at least for the next few weeks, it has to be financials, but more so NBFCs than banks. It can also happen in say now mid-sized PSU banks, because you have seen large private banks already moved up. You have seen large PSU banks also moved up. So mid-sized PSU banks, mid-sized bank, NBFCs, that's where I think where the buzz is going to be. Ultimately, what will happen is whatever is not moved up will move up once. Then people will try and realize to which is better way on price to book, ROA, ROE. That will all come subsequently. But for now, once whatever is not moved has to move up once. So today was the first day. I expect something similar to continue next week also.
You know, Digant Haria Aman was with us, and he was saying that banks, institutions with weaker liability franchises, and he named a few names also, RBL and Indocent and Yes, etc. These may benefit disproportionately. And these are also, I think they also kind of fit what the criteria you mentioned, things which have not done very well in that sense. You talked about PSU banks. Would you agree?
These are more of catch-up trades because for a genuine and justified reason, they are all trading below book, right? But now, when everything else is now moved beyond book, you want to have a relative trade. So in that relative trade, all this fits in. So the mid-tier PSU banks, RBLs and independent banks of the world, they also see and you can say a push up. So it's like tide lifting all boats. So the bigger boats are already there. The smaller boats are now going to follow.
Okay, big boats and smaller boats, but they're all going to go flying, as Aman put it. Aman, coming back to you, but let's go across to Lata now, who in the morning was telling us this is a preview that maybe we should expect fireworks, and I think fireworks is what we've got. Lata, over to you.
Well, since this is RCB week, let me start with some cricket analogies. The governor actually came out and batted like Josh English, didn't he? I mean, who expected so many sixers? A double rate cut, 50 bips, and a 100 bip CRR cut. I can't remember when we last got a 100 bip CRR cut. Was it during the Lehman crisis or something? Even last November, Shaktikanta gave us only a 50 bips. So that was like really mind-boggling innings. But then he just got converted himself into, what do you call it, Rahul Dravid? I know that's my times. So, but just went back to the crease, as it were, and changed the stance from accommodative to neutral. So what does this mean? It doesn't mean more cuts. It means the August cut has been advanced to June. That's the only way you can read the word neutral. And also, neutral should more likely mean that there are no more rate cuts. You know, there is the chances of a further rate cut and taking the repo to 5/4 now drops very steeply, because I specifically asked the governor that, and he said, you know, you may have a 3.7% inflation cut now, but next year it is 4.5%. So that is exactly what the market wanted to hear. If your inflation, if you are looking at the inflation at 4.5%, then you have to add that 1.5% positive real return. Then you are at already at 5.5%. There is no further scope to cut rates. So chances are the market will get used to that idea. That's about bonds. So the bond rally kind of peters out. Because of that, it kind of, has to stop over there. The other important point that he made is the impact on banks. That's the CRR cut. Immediately, the repo cut is what comes into effect. CRR comes into effect from September. The repo cut of 0.5% not expected, which means about 30% of the loans of every bank suddenly gives you 0.5% less. So it's going to be a bad first quarter for banks as far as their margins are concerned. But it starts improving. Because once the CRR cut starts factoring in, then, your cost also becomes cheaper. And as the year goes by, all your deposits start getting repriced. And therefore, banks are likely to exit the year with a very good margin. What the SBI chairman very beautifully put up as a U-shaped curve as far as the margins are concerned, fall and then rise just as dramatically. That's the story on banks. Exit FY26, very good. And for the rest of the market, the interest rate sensitives, NBFCs, real estate, those depending on consumer loans, even autos for that matter, I think it's a very, very good deal indeed, because we are going to see retail loans actually, getting cheaper and cheaper as the year goes by.
No, absolutely. Lata, thank you very much for that. And I think, important to set the context as Lata did. More money in the hands of the consumer, hopefully, which will come back into the economy. Let's just talk about the other thing, right, which is sectors which have been zooming higher with regards to what we've seen in the market. Defense is one, and we've spoken about this quite a bit. But the other is railways. And Nimish, you've looked at this in some detail. What have you found?
Last 1 month, all the railway stocks have been buzzing. Even if you look at the valuation, they look very punchy. But the bigger thing is, if you look at the last 2 years of growth, that is what will surprise the market in a negative way. I'll just go to the wall and explain why I'm saying this. So let me put the data on the wall. If you look at the railway stocks in the last 1 month itself and the kind of rally the railway stocks have done, the chart will come up for you. In the last 1 month, all the stocks have been buzzing in the last 1 month or so. IRFC, Ircon, Railtel, RITES, RVNL. Look at the kind of move in the last 1 month, all in double digits, between 25% to 45-50% as well in terms of the 1 month move. But having said that, they're still down from the peak between 30 to 40%. So they've not hit the peak yet, what we saw earlier this year. But the rally has been pretty sharp in the last 1 month. But the question is the valuation. Now, if you look at the valuation chart for all these names, look at the valuation of all these companies. Ircon is sitting at 28 times 1 year forward versus the 5-year average of 15 times. Railtel is at 47 times now on 1 year forward. RITES is at 34 times versus the 5-year average of 21 times. And RVNL, which is the new entrant in the F&O, that is now trading at 60 times on 1 year versus that 5-year average of just 12 times PE. So that's the valuation picture. Next, the table which is going to come, that's going to surprise and shock a lot of investors. Look at the kind of growth these companies are reporting. On a sales, this is a 2-year sales, profit and EBITDA CAGR. Ircon, just 2% sales growth, negative profit, as well as just 9% or 10% EBITDA growth. Same is the case with IRFC as well. Look at the numbers, 3% sales growth to almost 3% profit CAGR and nothing for EBITDA. RVNL, the stock has been a big mover in the last few months. It's been a negative growth over the last 2 years, and the stock is quoting at 60 times. So that's what I wanted to explain, that earnings have not been supportive in many of these companies. The only stock or only company which has done relatively well is Railtel. That has consistently outperformed in the last 2 years in terms of sales CAGR of 33%, profit CAGR of almost 30-odd%, and EBITDA CAGR of 17%. Even RITES, for that matter, in the last 2 years, it's been a negative. In fact, there has been a degrowth, and the stocks have been buzzing. So, just to put into context, while we've seen a big rally, the valuations are quite punchy, the earnings are not very supportive, and that is what investors should watch out for. There is a bit of exuberance in the PSU basket, even in the rail basket, but when you look at the numbers, it shows you that it's not all good as far as the numbers are concerned. The last 2 year CAGR for someone like RVNL has been negative. Stock is at 60 times and quoting at almost 90,000 crores of market cap. So again, it's for viewers to just take a bit of an informed call that not everything in railway or not everything in PSU is going to do well. And just look at the numbers, and that's a bit of a shocking number that many of them have not grown for the last 2 years.
I'm glad you picked this up, Nimesh, because indeed the fact that the railway rally started is really perplexing, because it's not like we've seen some mega bids or any order announcements or order wins this week. Let me throw this to Aman.
In fact, just to add to this, even the railway budget, or in the budget, the capex for railway is pretty much been flat for the last 2 years. There has been not incremental new capex that the government has announced.
Yeah.
And look at the kind of valuation these companies are quoting at. I was surprised with RVNL's entry into the F&O market. The stock is in the F&O from this series, 60 times flat growth or a negative growth, and 88-90,000 crore market cap. I mean, it's really surprising that people are still looking to buy into this. And I missed out the last part on the retail participation in all these companies in last 2 years. The only segment which has seen an increase in the shareholding is all the retail investors.
Yeah,
so from that perspective, one needs to be a bit careful in
Nimesh,
in
you
the
mentioned that Kotak, there's a Kotak note as well.
There's a Kotak note as well. I've picked up.
Is there anything on defense in there? Because
not really. This was on railway. But Prashant, that's what maybe I'll work on that as well. So again, initially what I wanted to do was look at all the PSUs and classify into 3 different buckets. Something which has done well but supported by earnings. I think defense to some extent will be backed by earnings as well. Okay, but there are some pockets which are just buzzing, just going up because of the euphoria, without backed by real solid earnings growth.
So actually, let's throw this to Aman. Aman, both the sectors, one by one if you can. Let's start with railways. Defense, like Nimesh is also pointing out, some numbers are very good, some like Mazgaon were disappointing. But let's get back to railways. I mean, did you make any head or tail out of the sudden interest in railway stocks? What's your own, take and positioning on them?
As you rightly said, it's more of retail frenzy in this segment than any institutional frenzy. And I guess what could be the reason was that 1 year back, the segment that was doing well was defense and railways before the market started to correct. Right now, the defense has come back. For the retail guy, he is now feeling that railway defense has already performed. That has bounced back. Now it is time for the railways to come in. I believe that could be the only reason. Because first, rightly so, it's as Nimesh mentioned, valuations are stretched. There is nothing much exciting happening there. There is no news. There is no event. Besides the only fact that maybe it's a catch-up rally after defense.
No, absolutely. And I think that's the only the rationale that I could think or come up with as well. I mean, nothing else in terms of news flow. On defense, because there's a big debate now, on defense. I mean, brokers like Kotak, for instance, are raising the red flag on, for instance, some of the shipbuilding stocks, saying that, what really is going to be the EPS CAGR. What's your thought? What do you still like here and what would you completely avoid?
The EPS CAGR or near-term earnings is still next 2 to 3 years what you're factoring in. When somebody's defense stock is back, factoring the macro story that India wants to reduce import dependence, now with a very hostile equation with the neighbors, the defense spending will go up. Even if the spending doesn't go up, the urgency goes up. So what we wanted to do in 3 years, now we want to do it in 2 years. So near term, the base effect of the earnings growth comes in. That the people are buying for these reasons. They're not buying for immediate EPS growth, because anyway, whether they're shipbuilders or it is a large BL or a HAL kind of thing, when you deliver is when you make the maximum margin, and the delivery is 2, 3, 4 year cycle, right? So nobody is looking at the near-term earnings that way. So defense is more of a top-down macro approach that this is the government focus. We are forced to spend more, forced to spend fast, and just import substitution means that these companies can still be 2 to 3x of what the current size they are. And that's what the opportunity is. That's what the excitement for defense is. I don't think anybody is buying for the next quarter or for the next year.
No, fair enough. But I mean, do valuations still offer some support? Even if you take a three-year view, got it? I mean, these are lumpy businesses. These are very large orders that take time to execute. But do the valuations still leave something on the table?
Not much. We don't own most of the defense names that got discussed. So that will give you an answer.
Defensive on defense. That makes sense. Aman, we're going to take a quick commercial break here. We're going to come back and continue this conversation on the other side. Stay tuned. Okay, welcome back. This is the Editors Roundtable, and we are talking about what's happened and what's likely to happen. Aman is, of course, with us from Abacus. Nimesh, but blocks, what's the pipeline looking like?
Well, that's going to be a strong pipeline, Prashant. There are still a lot of names which are still pending, and the blocks are going to come. So that supply is there. But, again, somebody just pointed out a very interesting point, which we can discuss with Aman as well. If you look at the last, like, say, 2 weeks of blocks, most of the blocks have happened at a much discount from the peak levels. Okay. For example, Ola. The peak of Ola Electric was around 140 something. After listing, it went up there. The last block happened where the PE sold, so that Hyundai sold at $50. And that's been the trend with a lot of these companies. So maybe, from a mutual fund perspective, while we all say that, they are trying to bail them out, but they're also buying at much lower levels than what it was from the peak level.
But is it true? Have you noticed that with other
is it Ola specific?
weaker profile companies? No,
Absolutely. No, with a lot of companies, that's been the case. Though this, mid-cap
that
correction
deals are happening at a discount to CMP.
At a discount to CMP and also from the discount from the peak level. So maybe if Aman can throw some light on it. Aman, have you been participating in all these blocks? Any opportunities that you guys are finding out in the recent block deals or any of those QIPs or OFS?
Recently, we did participate in IndiGene. That's
correct.
That event. Besides that, not much. And I'll tell you what our assessment is, why suddenly there's a rush. Prior to the correction, everybody was waiting for the party to go on, and as long as you wait, you will get a much higher valuation. Suddenly the market's corrected and you had an ambition that I need a $10 billion valuation before I sell something, and you suddenly saw a 20, 30, 40% drawdown. That made you panic. Now there's a recovery. Now it's like, I don't want to wait for 10 billion, even if it is 8 billion, let me cash out on something before market goes volatile again. It could be Trump, it could be some other issue. Maybe today's event might change that thought process that, okay, now I can wait on, because now India is on a clear growth path, things can go better. Relatively, anyway, we are doing better. But till yesterday, the scene was this only, that let me cash on something. Earlier, I wanted to direct 20%, maybe at 10 billion. Today, let me just get 10%. Maybe at $8 billion is also okay, but let's get some cash home. It's basically cashing on, because this time around you're seeing more offer for sale than in QIP or prefab.
Yeah.
So, Aman, finally, as we get to closing comments, what's the advice? What to do now? Your market is, racing towards the all-time high. I think we're just 5% away from it at a Nifty level. Mid-cap rally has already started. Valuations is a never-ending debate. And people will wonder, and with more liquidity, if you're saving on your home loan, you'll put that money in mutual funds. So essentially, go back to the same question. Kharidna kya hai?
The sentiments definitely have turned for better. Even earlier, the major risk was global, which still stays. The way things are moving in US, it's anybody's guess as to what can happen tomorrow or what can happen the next week per se. But for India, clearly things are now getting back on shape. The slowdown that we saw last year, things have started to move up. Government has decisively acted. RBI has decisively acted. So there is no reason to be bearish on India, right? So now the only call is that at what valuation you are comfortable with. So for us, something like a chemicals, besides the obvious financial banking which I discussed some time back, chemical sector is looking good. EPC sector is looking good. In some pockets, your engineering companies are looking good. Maybe not a mid cap, but a small cap tech, that is also looking good. So wherever relatively valuations are much better than what it was 6-9 months back, or wherever growth rates can pick up, I think that's what the investors will start looking at again.
So you asked Aman on abhi lena kya hai. I was expecting that he will say hamare fund le lo, abacus ka fund le lo. So
but he gave a flavor of, I think, the areas that they like.
But Aman, you said you mentioned basically chemicals for the next few weeks, financials should rule the roost, right? Sentiment should be quite buoyant and positive. And you specifically also mentioned PSU banks right in the beginning, right? PSU banks.
The mid-cap PSU bank, because the large cap PSU banks have done up. Now it's going to be a catch-up rally. Fundamentally, if you ask me, will I buy a mid-cap PSU bank in my portfolio? No. But for an investor who wants some momentum, some quick returns, where relative valuation is still supportive, then yeah, it's going to be a mid-cap PSU bank, where people will start coming in because something has already moved up. Now what is going to happen is, what has not moved up is what going to move up. That is what is maybe happening in railways also. Same thing can happen in financials also.
And today, by the way, we were firing the graphic. The Nifty PSU index is up only 0.5%.
It's flat.
So even today, it's all been SBI card and mutual fund companies and housing finance companies, NBFCs.
Gold financiers.
Aman is saying PSU banks, mid-tier PSU banks from here.
Okay, so that's the specific takeaway, some ideas that you can look at when you examine your portfolios. Aman, great conversation as always. Thank you so much for joining us on the show this week. And with that, it's curtains from the entire team that puts Editors Roundtable together. Thank you very much for watching. Do stay tuned. News and updates continue on CNBC-TV18. Hello and welcome to Business 360. I'm Arundhati Ramnan, and here are the headlines that we're tracking for you this evening. RBI Monetary Policy Committee springs a surprise by front-loading rate cuts to boost growth. Repo rate cut by 50 basis points, CRR cut by 100 basis points. RBI governor says no more room left for easing, and the stance changes from accommodative to neutral.
इन्फ्लेशन पे अब काफ़ी जो है नियंत्रण में है और वो जंग जो है हम ये मान सकते हैं कि उसके ऊपर में हमने जीत हासिल कर ली है.
Governor Malhotra says it is safe to assume that RBI has won the war against inflation. RBI also leaves FY26 growth forecast unchanged at 6.5%, says there is room for improvement. Gold financiers cheer as RBI set to ease gold loan rules, also proposes to do away with credit appraisal for small ticket loans up to 2.5 lakh rupees after a nudge from the government. An official notification is expected soon. RBI's growth bazooka lifts the Lal Street Sensex gains over 1%. Nifty reclaims 25,000. Bank and real estate stocks rally. US President Trump and billionaire Elon Musk trade insults as their relationship implodes in full public view. Tesla stock plunges after Trump threatens to cancel federal contracts and tax subsidies. Musk calls for Trump's impeachment and mocks his connections with convicted sex offender Jeffrey Epstein. US President Trump dials Chinese President Xi amidst a stalemate between two nations on trade talks. Chinese state media reports that Xi stressed on dialogue and cooperation as the only correct choice. Trump said that the call resulted in a very positive conclusion for both countries. Government allows Starlink to provide satellite internet services in India. The Elon Musk-led company is the third after Bharti's OneWeb and Reliance's Jio to secure a SATCOM license. The telecom department is yet to approve regulators' recommendations on allocating spectrum to SATCOM companies. Government considering a performance-linked incentive-style framework to boost local production of rare earth magnets to cushion impact of Chinese curbs. Talks, however, are only at an early stage. Russian missiles rained down on Ukraine's capital Kiev, killing 4 people. This comes after Russia's President Putin promised to retaliate after Ukraine destroyed dozens of Russian fighter jets. Israel bombs Lebanon's capital Beirut despite a ceasefire agreement with the Hezbollah. No food distribution in Gaza for the third straight day as the aid agency backed by US and Israel remains shut. United Nations warns children in Gaza are suffering from acute malnutrition. Bengaluru police arrest one RCB official and an event management executive after 11 people died in a stampede during the IPL victory celebrations. 2 more people also taken into custody after their alleged involvement. Those were the headlines that we're tracking for you this evening, but the top story today. The RBI Monetary Policy Committee has surprised the street with a bigger than expected repo rate cut of 50 basis points. The repo, which is the interest rate at which RBI lends to banks, now stands at 5.5% after 3 consecutive cuts. 5 out of 6 members voted for the 50 basis point cut. It's not just the repo rate. RBI has also decided to reduce the cash reserve ratio by 100 basis points in 4 equal tranches starting September. Cash reserve ratio is the percentage of a bank's total deposits that must be held as reserves. Governor Sanjay Malhotra said rate cuts have been front-loaded to give certainty to the markets. The policy stance has been changed from accommodative to neutral, and the governor made it clear that there is no room for any further easing.
There is now very limited space for the monetary policy, actually, given the current circumstances. And you are aware of the current circumstances, which is that growth is at about 6.5%. Inflation, we are projecting at 3.7% for this year. And next year, it's above 4, it's 4.5% or roundabout. So given these current, if these were to play out, there is very limited space, is what MPC says, and that's why it has been reduced now. We have changed now to neutral.
And as Governor Malhotra was mentioning there, the RBI has left the FY26 GDP growth forecast unchanged at 6.5%, while adding that there is room for improvement. The FY26 inflation forecast has been cut to 3.7% as against the earlier estimate of 4%. However, inflation is expected to inch towards 4.5% by the end of this financial year. Governor Malhotra said it is safe to assume that the RBI has won the war against inflation for now.
इन्फ्लेशन आपको मालूम है मुद्रास्फीति इन्फ्लेशन पे अब काफ़ी जो है नियंत्रण में है और वो जंग जो है हम ये मान सकते हैं कि उसके ऊपर में हमने जीत हासिल कर ली है। तो एक मैसेज है क्योंकि हमने 4% से उसको घटा करके जो हमारा अनुमान था उसको 3.7% किया है मुद्रास्फीति को। उसी प्रकार से जो ग्रोथ है वो 6.5% है, अच्छी है, लेकिन उसमें और गुंजाइश है उसके अंदर में और बढ़ोतरी होने का।
Lata Venkatesh joins us now with the editor's take. Lata?
What can we say about the governor's performance today? It was more like one of those swashbuckling T20 batsmen, Sai Sudarshan or Virat Kohli, just coming out and hooking sixer on sixer, a double rate cut and 100 basis point cash reserve ratio cut. This is, I can't remember when we last had such an easy policy. Cutting by 100 basis was probably after the Lehman crisis or something. So this is a very big giveaway, gift for the markets and for the borrowers. But he immediately turns out to be a Rahul Dravid or someone, because he comes and says in the next sentence that I'm changing the stance from accommodative to neutral. What it basically means in plain English is that the chances of more rate cuts are not there. All he has done, he has advanced a possible August rate cut to June and given 2 cuts in June. But the only way to read this is that there are probably no more rate cuts. There are some people who are, focusing on possibility later on. But when we asked the governor, inflation is at 3.5%, he pointed out that next year it is 4.5%. So clearly, it didn't look like a governor who's, going to relent and give us any more rate cuts. So that's as far as the policy is concerned. Let's come to what happens to the banks. For the banks, a rate cut of 50 basis more than expected is actually negative. Why is it negative? Because many of the banks' loans are linked to the repo rate. So immediately, what they get from a home loan, what they get from a corporate loan will all fall. About 30% of the loans are linked to the repo rate, and so they're going to earn less in the coming quarter. And therefore, the margins will fall. Deposits take time to fall. But the CRR cut is very important. What is the CRR? If you have 100 rupees, you had to keep 4 rupees as cash. Now you have to keep only 3 rupees as cash. You can lend 1 more rupee and earn, 7-8% on that. For the banks, if you take the stock of money, they can lend 2.5 trillion rupees more in the system at 7 or 8%. Until now, it is only earning 0. So that means by the time you come to the second half of the year, banks are going to find the cost of their funds low, and it is what you call a money multiplier. Every new deposit, they're going to keep less money aside for CRR, and they're able to lend more. So what it is going to mean is that banks have better and better times. They will see a steep fall in margins in the first quarter, and then a U-turn in the margins by the time the year ends. They exit the year very well. That is if you are a bank shareholder. If you are in an NBFC or real estate a company or a shareholder or an auto company, or you're going to buy a car, for all these people, things are really good. Loans are going to get cheaper and cheaper as the year progresses. It's already falling by 0.5%. It's going to fall even more as the amount of money available with banks, goes higher. So there's a lot of cheer. The only caution I would leave on the table is, has the governor come out of the crease a bit too much and whacked the ball? You're exposing all your stumps. If something goes wrong, he has just put all the cards on the table. I would just worry a bit about that, especially because the tariff war goes ugly or monsoons don't live up to the early promise. Then, inflation can play a nasty trick on us. Let's hope all those things don't happen.
Absolutely, Lata. Many thanks for taking us through all of those details. And Governor Malhotra also revealed that the Reserve Bank is looking at the rules governing ownership structure of banks. Governor said the FDI cap currently stands at 7.4%, and there is no plan to change that. However, he also added that the central bank is examining the ownership structure, while also adding that no immediate change to the regulations are likely.
हम ये पूरा जो ओनरशिप स्ट्रक्चर है, जो एलिजिबिलिटी कंडीशंस हैं, जिसके अंदर में FFI नॉन रेजिडेंट्स के लिए आज के दिन में 15% है, उस सबको हमको पूरे को एग्जामिन हम कर रहे हैं. वो इमीडिएटली नहीं होगा, उसमें समय लगेगा. ये जो है बहुत डीपर क्वेश्चंस हैं जिनको क्रिकेट की एनालॉजी में जो है 2020 मैच की तरह से नहीं देखना चाहिए. तो वो हम उसको पूरा सोच समझ करके ही क्या हमारे अर्थव्यवस्था के लिए क्या उचित है उसको ध्यान में रखते हुए.
And shares of IndusInd Bank rose in trade. This after RBI Governor Malhotra said that bank has taken enough steps to improve their accounting practices. He said that the bank's managing director and CEO have taken a moral responsibility and resigned, and that should be good enough. This comes after IndusInd Bank declared a 2,000 crore rupee loss, citing derivatives accounting lapses in March this year.
I think the bank has taken enough number of steps to put their to improve their accounting and other practices. The MD CEO, has resigned, and it says, for taking, moral responsibilities. So I thought, that should be good enough. Do you expect that all the board members? I mean, what are you hinting at? I think the MD CEO, who's also a member of the board, if he has taken responsibility, that is at the board level itself.
In the money market, the Indian rupee gained 16 paise against the dollar after the monetary policy. The rupee remains just below the 86 mark against the greenback. 10-year bond prices gained today and the yield softened to 6.24%. On to the day's market action. The Reserve Bank's 50 basis points repo rate cut brought cheer to the market. Frontline indices rose over 1%, with financials witnessing the biggest move. Today's gains helped the market turn positive for the week. Sensex and Nifty recorded weekly gains after giving negative returns for 2 consecutive weeks. Broader markets outperformed the mid-cap index, rising 3% this week. On that note, it is time for us to head into a short break. But coming up next, US President Trump and billionaire Elon Musk trade insults as their relationship implodes in full public view. More details on the other side. Stay tuned. Welcome back. You're still with us on Business 360. US President Donald Trump announced that he held a 90-minute call with Chinese President Xi amid trade tensions between the two countries. Trump said that the call was positive and primarily focused on trade. Both the leaders extended invitations to visit each other's nations. This is the first time both the leaders spoke to each other since Trump launched a trade war on China in February. US President Trump's alliance with billionaire Elon Musk has imploded in full public view. Both have traded insults on their respective social media platforms, Truth Social and X, since last night. Tensions escalated after the US leader expressed disappointment with the Tesla CEO after his relentless criticism of the president's big, beautiful bill on social media last week. Speaking to reporters during a conference with German Chancellor Friedrich Merz, Trump said Musk knew the inner workings of the bill. In a post on Truth Social, Trump accused Musk of going crazy after the EV mandate was removed from the bill. Tesla lost $150 billion in market capitalization after President Trump threatened to pull government contracts for Elon Musk's companies. This is the biggest hit to its market cap ever and puts it below the $1 trillion benchmark. Meanwhile, Musk continued his online onslaught, claiming that the president would have lost the elections without him and even called for his impeachment. Dia Epan joins us now with more details. Dia, take us through the sequence of events.
Donald Trump kicked things off during an Oval Office meeting with German Chancellor Friedrich Merz. Asked about Elon Musk's criticism of his big, beautiful bill, the US president told reporters, "Elon and I had a great relationship. I don't know if we will anymore."
Look, Elon and I had a great relationship. I don't know if we will anymore. I was surprised because you were here. Everybody in this room practically was here as we had a wonderful send-off. He said wonderful things about me. You couldn't have nicer. Said the best things. He's worn the hat. Trump was right about everything. And I am right about the great, big, beautiful bill. We call it a great, big, beautiful bill because that's what it is.
President Trump also told reporters he was very disappointed in Elon, telling them he knew every aspect of this bill. He knew it better than almost anybody, and he never had a problem until right after he left. He said the most beautiful things about me, and he hasn't said bad about me personally, but I'm sure that'll be next. I'm very disappointed in Elon. I've helped Elon a lot.
But I'm very disappointed because Elon knew the inner workings of this bill better than almost anybody sitting here, better than you people. He knew everything about it. He had no problem with it. All of a sudden he had a problem, and he only developed the problem when he found out that we're going to have to cut the EV mandate because that's billions and billions of dollars, and it really is unfair. We want to have cars of all types. Electric, we want to have electric, but we want to have a gasoline, combustion. We want to have different. We want to have hybrids. We want to have all. We want to be able to sell everything.
Musk responded by live tweeting a flurry of posts on his X social media platform as Trump spoke on live television, saying that Trump would not have won the 2024 election without him and slammed him for ingratitude. He said, and I quote, "The bill was never shown to me even once and was passed in the dead of night so fast that almost no one in Congress would even read it." The president followed up by threatening to terminate Musk's government subsidies and contracts. Musk then went on to suggest Trump should be impeached and that J.D. Vance should replace Trump. He also warned that Trump's global tariffs would cause a recession in the second half of this year and claimed Trump was in the Jeffrey Epstein files. Meanwhile, U.S. Vice President J.D. Vance on Friday said he was proud to stand beside President Donald Trump. Posting on social media platform X, Vance wrote, "President Trump has done more than any person in my lifetime to earn the trust of the moment he leads. I'm proud to stand beside him." In a turn of events, Musk has reversed course and signaled there could be a cooling off period between the two.
So they are there with the latest on what happened between Musk and Trump. But moving on, the telecom department has issued a license to Elon Musk back Starlink for satellite operations in India. Starlink is the third operator after OneWeb and Jio to secure a SATCOM license. Ashmit Kumar joins us now with the details. Ashmit, what are you picking up?
Well, a big break for Elon Musk's Starlink here in India. Bear in mind that it was just a month back that the letter of intent had been issued, and since then things moving at an express pace. In less than 4 weeks after the issuance of the LOI, now we understand that the DOT has issued a license to Elon Musk-backed Starlink. Now this, of course, comes on the back of compliance with a whole host of security protocols. There were very granular details that had been added as a part of these security protocols that Starlink had to comply with, and we understand that those have been met, and therefore the license has been issued. As far as the rollout of operations now is concerned, a number of key steps, however, still remain in the pipeline, which do need to be completed. Number one, trial spectrum will have to be issued over the next couple of weeks to Starlink so that they can test their systems in place. Number two, after issuance of license from the DOT, they will require authorization from InSpace. So that is something that will be next on the cards. Subsequent to that, one key factor in all of this, as far as the rollout is concerned, one key factor will be, of course, spectrum. Now, the TRAI has done its bit, has given its recommendation. Now, it's on the plate as far as DOT is concerned. DOT will now have to decide whether it can go ahead with the recommendations that the TRAI has given. Amongst the key recommendations, well, the TRAI has backed, number one, administrative allocation of spectrum, and number two, has recommended a 4% spectrum user charge for spectrum in use. No cost of acquisition as far as spectrum for SATCOM players is concerned. And finally, there will, of course, have to be ground infrastructure. This is the last and the final step. Earth stations will be critical as far as operation of these satellite communication services are concerned. So that's something, these steps are something that Elon Musk-backed Starlink will now have to look ahead at after the issuance of the license from the DOT. Back to you.
All right, Ashmit, many thanks for those details. And with that, it is a wrap on this edition of Business 360. More news and updates coming up on the other side. Stay tuned.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. It is the age-old dilemma, buy or rent. What is the best route to get to your dream home, your abode? Well, there are several pros and cons on both sides. You have to, of course, take stock of how the property markets are doing in the country, in the city and the country that you're staying in. And then, of course, there is the math and the financial planning aspect to it. And today we are going to be covering all of these issues. I have two guests with me right here in the studios, Ghulam Zia from Knight Frank and Harshvardhan Roongta from Roongta Securities. Gentlemen, thank you so much for joining in. I'm so glad both of you are here because this promises to be a charged up conversation and debate, right? Very close to people's heart. So, okay, in one word, buy or rent?
So, well, I would say, Surabhi, if you can afford, you should, at least the first house that you should have at least one house for yourself. It could be your current occupation, self-occupation, it could be for future self-occupation, or you may just keep it as a last resort saying that, okay, I have a roof to myself. If everything goes wrong, then at least I have a house, the roti, kapda, makan. So the basic elements, I think one house you should own and the rest you can be treating it as investment and evaluate pros and cons accordingly.
Fair enough. I can tell you this, that I think I've been speaking to Ghulam for the last 10 years or maybe longer. And I have my own admission to make. Because of my constant conversations with Ghulam, I have not bought a real estate asset till now. Because we talk about the low rental yields, we talk about very high capital values in a city like Bombay, and the prospects of making better returns if you put that money smartly in financial investments. So Ghulam, where do you stand on the buy versus rent argument?
Well, since you asked the answer in one word, my answer is rent.
There we go.
And it hasn't changed in the last 10 years.
So I called you again. Now let's see if the answer is different.
Yes. So one word, rent. Let's go ahead.
No, but seriously, we have to, I'm sure, get into second order, third order sort of implications, issues. What's the starting point? Because he's right, Harsh is right. I mean, for most people, owning a real estate asset is a very emotional, there's an emotional connect to it as well.
That's true. That's true. And, when we are looking at India walking into the next century, etc., we are talking about, high growth economy and so on. So once again, the question is, if I look up to those economies, Europeans and Americans, what is the trend? Majority of them rent. My problem is we are carrying this burden, which is with us for last so many decades, if not ages, that we connect a lot of emotional value to a house. The moment I disconnect that, the moment I plug it out, I look at it as purely as a place where I'm, putting my money in, which would be held up for 10, 20, 30 odd years, very bad liquidity. And in a situation like that, if other asset classes are giving me in double-digit kind of a return per annum, why would I be stuck with something which is half of that, 5-6%? Yeah. So the logic to me is simple: rent it is.
But what you're saying is important. You're saying 5-6% appreciation. The traditional mindset has been that, you buy a house and over generations, 3-4 decades, I mean, it's supposed to be a significant wealth building asset. So, bust the myth or the reality versus myth. I mean, where do we stand on this? That over 30 years, your house is supposed to treble in value, etc., and therefore create good wealth.
Well, those are very far and few examples I would pick up, because for every such instance that you are highlighting, you may find hundreds on the other side where people have burned their fingers. So typically, this is the tendency that we eulogize the success and don't talk much about failures. But when you look at the weighted average of both sides, you will agree with me that it's not really so rosy a picture to invest in real estate.
That's a very important distinction, and viewers, let's keep that in mind, that the purpose of this conversation today is not to talk about residential housing as an investment. We're talking about buying a house for self-use, whether you stay in that house today or you plan it for the next, say, couple of years down the line where you want to move in that, residential asset. Now on this, Harsha, let's even here, let's go over the pros and the cons, and how do you start planning to have that one house asset, as you said?
So, Surabhi, again, just to reiterate, investment in the form of an investment, there are better opportunities to invest your money into. As Ghulam said, I mean, there are financial assets that you can put your money into, which will grow at a much faster rate. What we're talking about right now is that one house that either you're planning to stay in it right now or sometime in the future.
Sure.
Okay, so very clearly, I'm an advocate to that theory to say that have one house of your own, something that you may not be buying in the same city as which you're living in right now, But that has to be a backup for you to say that if everything else goes wrong, I have one roof to myself. I may go and house myself and my family safely into that house. Okay, so that is the theory we're talking about.
Sure.
Now come to the pros and cons. Okay, so mathematically speaking, it will not make any sense. We're not talking numbers. Okay, if you put numbers to this entire discussion, it is I think a given that you have to invest into financial assets. Why? Because if the ticket size of a house is say 1 crore, for example, you can rent that house at probably 2% of that cost annually. So you would say that I put that 1 crore into a bank deposit, earn 6% on it, pay 2% as rent, I still enjoy the same house. Okay, so we're not getting into that debate.
Yeah.
Now purely understand that what is the non-financial factors that you will need to consider for buying that house for yourself. Why do I say so? So one is that it becomes the safety of last resort. Now we're assuming one thing, that we're going to be earning, we're going to be in our careers, we're going to do X, Y, Z, we're going to earn income and pay rent.
Yeah.
Now there could be situations in life where our cash flows get affected because of job loss, because of disability, because of anything else.
Yeah.
Now what if I'm not in a position to pay rent? Then what do I do? So when I have a house of my own, at least I know for sure that I don't need to go anywhere else.
Or you'll still be paying the EMI on the house. I mean, if it's not an outright purchase.
So we come to the point of affordability.
Yeah.
So that's where we're saying that you do not extend yourself beyond a certain point. You buy within your affordability, plan it well. So in case of job loss, okay, nothing much can be done. But in case of disability, in case of death, you can have insurances which take care of the liabilities of your loan. So the idea that I'm trying to advocate is very simple. Roti, kapda, makan. I mean, this thing has been in existence for generations.
Forever, yeah.
Right? So I am of that view that buy that one house if you can afford. Okay, I'm again and again underlying this fact where I'm saying that if you can afford, buy one house. You may not want to stay in it today in the city that you're working in, but in some city where it is affordable, where you believe that in future you may go and live.
Okay, so I'll come back to the affordability aspect of it. It's very important because we all might want a dream home, but if it's costing 10 CR overlooking the sea face in Mumbai, I mean, do we really do that? We don't want to burst the bank and completely mess up our financial plan. So back on that in just a bit. But before that, Ghulam, now this buy versus rent argument, does it vary? Does your answer vary depending on which city we are talking about? A city like Mumbai where property values are very high, is it better to rent? Is it better to buy if you're talking about tier 2, tier 3 cities where, maybe houses are more affordable?
Well, it's not just a discussion on affordability because when we are talking about regional variance in the theory of where should I or should I not buy or rent or whatever, the issue is about how this city is treating the population which is coming from different places and setting in. So like today, if I have to give an example, not in India, but the best of the rental yields globally are enjoyed in Middle East, especially Dubai. Because very few people who stay there, the Emiratis who own it, otherwise almost 70% are the population which is coming from various places, expats, and who are essentially taking in on rent.
Correct.
A few policies have changed where expats can also own. In last 5-6 years, things have changed. But if I talk about, say for example, Bengaluru, in case of Bengaluru, the requirement of rental housing is so huge. Same is the case with most of these tech-related cities, be it Chennai, Hyderabad, or even Pune. These are places where rental requirement would be far bigger than actual ownership requirement.
Okay.
And that is where, unfortunately, in absence of a organized or a big retail renting platform, it's mostly people like you and I who buy an apartment and give it on rent. So lack of a policy on rental housing has given way to a lot of people buying those houses to then put it on rent.
Sure.
So that is what changes a bit.
Yeah. So simplify it. I mean, if we talk about India and say take 2-3 different regions, and again, I'm buying from the home consumer's point of view.
Right.
And the decision to whether go in for that 3 crore or 4 crore property, take that loan, versus like how Harsh said, just rent it at a fraction of the capital value, the cost.
So here again the discussion will go into affordability, which you a short while back said that we will address it slightly later, but then it is all hinging on that. So a city like Mumbai, which is extremely difficult to afford, the choice would ideally be to rent it.
Okay.
In a place like Hyderabad, you can even own it, in spite of a huge inventory available for renting it, because it's within your reach, you can own it. But again, the problem, whether you want to really own it, if you're non-Hyderabadi, you want to own it, all those discussions will come up. But in terms of sheer calculations or Excel sheets, I would say Mumbai, because it's unaffordable a city, it's very difficult. I would rather say if you're in Mumbai, you should only rent it. At least in a place like Delhi, so not Delhi, of course NCR is also turning extremely costly, like Gurgaon, etc. But if you're in Pune or Hyderabad or even Chennai, you have both options, but still I would go back to where I started. Renting is the option.
Okay, all right. So he's a strong proponent of renting.
Indeed.
Very, very clear. But now let's expand on the affordability point, Harsh. Like I said, dream home might be costing 10 CR. Not everybody will have that money. What are the thumb rules? Basic financial planning principles. How do you plan what you can purchase without straining your overall plan?
So from a financial standpoint, you evaluate it in this way that your EMIs should not be more than 50% of your take-home income.
Okay.
So not your CTC. I'm not talking about CTC. I'm talking about whatever net take-home is what you get net in hand. Your EMI should not be more than 50% of that. So then it is within your parameters of affordability. Why? Because if you are going to go beyond that, then there are other responsibilities that get affected. You would have to save for your retirement, you have to save for your children's education, you have to save for many other things. So just ensure that the EMIs do not cross 50% of your net take home.
Okay.
Now you start working backwards. Okay, so you say that if my 50% is equivalent to say 50,000 rupees per month. So your EMI, if it's 50,000, the loan that you're eligible for would be approximately 50 lakhs.
Okay.
So if it's not affordable in the city that you're living in right now because of work reasons, and you believe that there's another city that you might move into later on, and that because that's your purpose, right? Eventually, I'm saying that has to be for self-consumption. So if it's not in the current city of your occupation, it could be another city. There you may want to secure yourself a house. I say this because we've had several cases in our own professional life where we've been advocating that there's no point in buying a property, etc. But when we see non-monetary reasons, like we've had families where the daughter is divorced, for example, and she comes back. Now, where does she afford a rent? So that time you have a house that you can take care of. Some children are not settled yet. So rent essentially comes out of the income that you're generating. With career graphs being so volatile now, I mean, you could be well settled in your career and believe that I'm getting a steady source of income, and suddenly that income goes away.
Yeah.
So when you have a house of your own, at least you're not under the threat of being pushed out of the house because rents are not affordable.
Sure.
So have one house is what I'm saying, but keep in mind the affordability factor, because you cannot go overboard. The moment you go overboard, then everything else gets disturbed. It's like shaking the apple cart.
Yeah.
Then everything else just falls down like domino effect. Your education, children's education, your own retirement, everything falls apart.
Absolutely.
So be within the affordability, know exactly why you're buying. It's not an investment that you're looking at, it's only self-consumption.
And that to make sure your total EMIs, including your home loan and all the other loans, don't exceed 50% of your net take-home income.
And if there are joint, if there are two earning members, then you can collaborate both together.
Yeah,
and then
the total net income of the household.
Correct.
Got that point. All right, we'll take a very quick break on that note, but we come back on the other side and then we'll discuss the very important aspects of what all to check before you go ahead and buy that house. I mean, it could be a minefield out there. How do you ensure that you don't make mistakes? Back with that in just a moment.
Let's talk money. Let's Talk Money.
Welcome back. You're with us on Let's Talk Money. And this week, it's the buy versus rent debate when it comes to housing. And a house for self-use, your dream home. And it's a big debate that's been raging, almost 50-50 in the middle between the buy and the rent. But I think we have consensus on the panel that if it is one home for self-use, for self-security, then you can go ahead, but don't break the bank. That's the most important thing. So speaking of breaking the bank, Ghulam, I have to ask you, I mean, the markets really recovered quite a bit, the real estate residential market in India last 2-3 years, right? Now, give us some sense of the key 4-5 metros. Where are things reaching or going beyond reach? Where is there still that window where you can find something reasonable and affordable?
Well, you spoke about breaking the bank. I was wondering, stealing the bank is what it should be. Because the way things are heating up in a few of these markets, especially say Mumbai, a few of these South Mumbai markets and Gurgaon in NCR. In fact, to my amazement, the highest price growth has been seen in Bengaluru. I thought Bengaluru was one of the most affordable markets, but even that, last 3 years have been completely going bonkers. So the concern is that the price appreciation in last 2.5-3 years, and let's not forget that these 2.5-3 years, golden 2.5-3 years from the supply side have come after about a wait of almost about a decade. So here they want to get maximum out of the situation. So the price rise is going completely berserk right now.
Just give us some sense. Say Bengaluru, where the price rise is quite sharp. How much is it? Mumbai, most markets, how much is it?
So the highest growth we have seen was in Bengaluru, which is almost about 20% in last 2 years, 2.5 years, because that's where post-COVID, a year of a lull, and then the thing started moving up. So in last 2.5 years, Bengaluru has been breaking all records, about 20+% growth in Bengaluru. NCR and NCR also has been 15+%. Mumbai is 12-13%, is still lesser of the lot. But a few of these projects in Mumbai which are under arc lights are the ones where things have gone completely crazy. You know, for the first time in India, we have seen a developer selling for more than 2 lakh rupees a square feet, first time. And while we were just about, you know, looking at that and wondering what's happening, somebody else spoke about 250,000. So this is actually a kind of a rat race going on to see how best you can extract from a willing buyer. So I'm a little worried the way the prices have shot up.
But these would be specific transactions in very niche markets, right? They would not be representative of an overall overheating.
That's true. Absolutely right. However, when the guy next door is selling for 200,000 rupees, you cannot sell for 100. You have a pressure to go as close to that number as possible, lest people start believing that something wrong with you if you are still holding on to your price of a lakh. So that's what it is, you know, the peer pressure, I would say, which gets the whole price momentum coming across. But that's a lot to do with location as well. So as I said, most of the very marquee transactions are coming up in Worli Seaface, which is today the billionaires row of late last 2-3 years. It is the most talked about location in the country. But that said, for every Worli Seaface, you would still have places in Panvel or Vasai Virar where, and mind you, something very surprising, when you talk about affordable housing, which is below 50 lakh, would you believe that Mumbai sells maximum number of below 50 lakh apartments compared to all 8 cities? But that's true. Because we have lots of these locations which are suddenly getting connected because of good infrastructure.
Trans-harbour, Sea-Link,
exactly,
etc.
Exactly. So people are finding options in slightly remote areas which are going to be well connected with the city. So overall, while there's a huge maddening rush to get the prices high, but at the same time, there are new locations coming up which will give you affordable housing also if you are a buyer.
And if you're willing to stay a little far away from the center of the city. Very quickly, Ghulam, so that's an overview of how capital prices are moving. What about rentals? I mean, in the Mumbai market, we know rentals have been going up last couple of years, ever since the COVID low. But in general, Hyderabad, Bengaluru, what's the general scene with rentals and the expectation?
First, the rental value appreciation happened a lot in Bengaluru. Again, demand-supply scenario because a lot of those techies, the tech industry, headquartered in Bengaluru for that matter. So, huge number of jobs created in Bengaluru. So, you require huge rental housing there. And the demand-supply scenario, rent shot up in Bengaluru first. Mumbai, it was more because of the wave of redevelopment. Many of buildings were about to be broken. So, all those who are living there suddenly will be out there locating, trying to search for a rental house for 2 years, 3 years or 5, as long as the redevelopment takes. So, these are the two cities where rental yields have shot up a lot.
And do you expect them to keep rising?
Not really, because there's a lot of even redevelopment that we're talking about. It's a lot of euphoria created artificially around it. I don't believe the kind of numbers that are floated around, there's so much of redevelopment of Mumbai is happening, is not true the way numbers are talking about. But that said, there is already a stability here. Be it Bengaluru or even Mumbai, the rent growths have been saturating, and the other cities like Hyderabad, Chennai, etc. In any case, the rents were pretty well within the range. So rental yields, if that is a parameter that you have to look at, in case of Bengaluru, it is going upwards of 3.5 odd %, whereas in Mumbai, it is closer to 2%.
Okay.
So it also talks volumes about the demand-supply scenario in these cities.
The mismatch there. Got that point. So it gives us a good overview of both if you want to buy and also if you're renting, what can you expect going forward. Harsh, now let's come to the critical decision. If you've decided to buy that dream home, then what is the checklist like? What all do you need to think? Beyond obvious things like connectivity, etc., but to make sure that you're not getting caught in any kind of a trap.
So one is, of course, you need to see all the approvals that the project has. If you're buying something under construction, you have RERA's website now where all the project related details have been uploaded. So you should do that basic due diligence wherein you would go and check whether the project is approved, plans are approved, what is the progress, who's the ownership, etc. The builder, I mean the developer, I mean you need to see the reputation of the developer, whether they have a reputation of projects being delayed or stalled, or there is going to be, they have a good track record of projects being completed, because you don't want a situation wherein you've paid like 10, 20% or 50% or more than that and you don't have the property in your hand, right? Because the life savings that we're talking about.
Ghulam, on that important checklist, the mistakes and the traps to avoid when you're zoning in on a developer, signing that contract, what to look out for?
I would be wary of getting into, since we are in Mumbai, a redevelopment project where we haven't really seen the building coming down, because a lot of things can change. So redevelopment, you have to be very cautious because it's a very complicated business. You're not getting a free land for developer to come and construct. Lot to worry about. Don't be in a haste to buy an apartment in redevelopment building.
Okay.
If you're getting nearer to completion, perfectly fine. But otherwise, if you have a clean land where a developer and a known developer, the listed players, etc., who are doing a good job, always pay that extra premium because you have a reliability on that developer. RERA, of course, a lot of pains have been sorted, but not all. So RERA still is not a complete solution to the miseries of a buyer. So be cautious. Don't just depend on RERA. You need to do a little more than that. Get a proper legal advice as well. At least in Mumbai, where you're spending 10 crores, you can spend a few lakh to get a good lawyer to advise you. The other cities, of course, if you're buying a 50 lakh to a crore apartment, seeking legal advice is a little of a stretch, but you should try to at least.
Finally, it becomes a lot more easier if there is an existing residential or a real estate asset in the house, which can be sold and then the proceeds be reinvested in buying that dream home. So Ghulam, what are the do's and don'ts, and also, what are the regulatory / tax implication if, you want to sell an existing property and then reinvest that into a new one?
Well, here, if you're hinting at long-term capital gains as a key factor to be considered, now LTCG actually squares off if you are selling an apartment and buying an apartment.
Okay.
But if you're selling a shop, you don't get that benefit to buy an apartment. And then there are a few more complications, like typically, at least in Mumbai, when you are going up the corporate ladder, you would want to sell 2 apartments and buy one because now you want a bigger one, better one, and so on. That is also not available. Only 1-to-1 is what it is. So
one residential house sold for one bought. Okay.
Yes. So those complications should be seen. Again, you need to consult your chartered accountant as well while doing that. A lot of complications. And those squaring off against the selling of the old property to buy a new one is pretty simple. But if you don't want to buy another property, then the long-term capital gain, in spite of indexations, etc., can really leave a huge hole in your pocket. So be careful when you're selling an apartment. It should be for some purpose, some reason, not just to keep money at home.
That's and the window of reinvestment, Harsh, is what?
2
I
years.
think you have to reinvest within 2 years.
So if you've sold an apartment today, either you would have bought another apartment 1 year prior to sell of today, so that can be offset, or within 2 years of selling your apartment right now. And if it's under construction, you have the window to 3 years.
Okay.
So that's the basic condition. However, there have been a lot of changes where there are sub conditions. As you know, one apartment can be used for another apartment or not. Then you already, if you're owning 1 or 2 apartments already, and then you're selling one and buying another one, maybe that's not allowed. So I think
Best
to
to
go
check.
into the sub conditions and clauses, because there's again a 10 crore cap on it.
Yes.
Then there is one deadline. I mean, I think it's July 23 that if you bought an apartment before that, indexation is allowed.
The previous budget, when they made it
Yeah.
optional, you may choose indexation, not 12.5%.
Yeah.
Without
so
indexation.
the primary
Yeah.
conditions are that you sell today within 2 years or 1 year prior.
Yeah.
Or 3 years if it's under construction. That's the basic condition.
Yeah.
Other than that, if whether you're eligible or not will depend upon a lot of sub conditions, which it's best to check with a tax expert.
Okay, absolutely. I think this has been a very helpful conversation, gentlemen. Thanks very much. There's no straight answer, but I think the answer, like we said, is that if it is a house for self-use and if your heart is set on it and you're doing your math and your financial planning properly, then maybe it's not a bad decision at all to go in and buy that dream home. Thank you so much for joining in and shining the light on this very, very emotional subject, shall I say. Thanks for joining in. Well, viewers, hopefully you found this conversation useful. Keep sending us your feedback, comments and queries. We'll see you again another time, another theme next week.
Let's talk money.
Hello and welcome to Global Eye. I'm Parikshit Luthra. The top story we are tracking this evening. China's grip on rare earth magnets has left the global auto industry in a bind. The Chinese government has imposed export restrictions on the magnets due to national security concerns. Importers will now have to provide an end-use certificate to ensure that the magnets are not being used for making weapons or not being given to a third party. Now, without meeting these conditions, China will not export the magnets. They will also have to provide assurance that there will be no transfer to a third party. So why does China have an edge? Let's take a look now. China accounts for around 70% of the global rare earth metals mining and holds nearly 80% of the global production. The impact on Indian auto industry is estimated to be quite steep. The industry's annual demand for rare earth magnets stands at 850 tons, while the import cost is around 310 crore rupees. So why are these magnets so important? Well, rare earth magnets are 10 times stronger than conventional magnets. They help maintain performance at high temperatures and have a longer lifespan. These magnets are largely used in components that are essential in manufacturing both ICE and EVs. Without these, it will be impossible for companies to provide components, and production will come to a halt. So what are the next steps the government will have to take? In the short term, the centre will have to engage with China to fast-track approvals and seek exemptions from end-use certificates. In the medium term, the government will have to look at partnering with other nations, including Australia and Vietnam, and also work towards building a domestic supply chain. Lastly, in the long term, the government may have to consider a PLI-like scheme for self-reliance and provide financial incentives to larger companies to manufacture rare earth magnets in India. Now, joining us to discuss the geopolitics of rare earth magnets and what really is the way out for countries like India, we're now joined by Jeffrey Pyat, Senior Managing Director for Energy and Critical Minerals at McClarty Associates. He was also the former U.S. Assistant Secretary of State for Energy Resources. Mr. Pyat, thank you so much for joining us on the program. Let me begin by asking you, Trump and Xi Jinping have had a phone call. Donald Trump has said that this was a successful phone conversations where they also discussed rare earth metals. Do you think if Trump and Xi Jinping have a breakthrough in those trade tensions, then globally China would give a reprieve to everyone on the rare earth magnet issue?
Parikshit, good evening. It's good to be with you. I think there's certainly the possibility of a short-term understanding as part of the broader U.S.-China trade negotiations. But I don't think that changes the message to all of us from this Chinese export control. What's happened in the past few weeks reminds me very much of May of 22, when I was U.S. ambassador in Greece and Gazprom began to restrict sales to the European Union, starting with Bulgaria. It's a wake-up call, demonstrating that China is not a reliable supplier. So what we need to do is exactly what you suggested in your intro segment, which is to develop the alternative supply chains, to make the investments required to bring the processing back to our countries, back to reliable suppliers, and to work together as the United States, as India, in the Quad perhaps, in order to build the alternative supply chains that will provide the greater volumes of these materials we're going to need for our energy transition, but in a way that doesn't jeopardize the security of our economies.
Right. Ambassador, when it comes to China, China not only dominates rare earth resources, but also the processing of it in China itself. Could you give us a sense of to what extent does China control the rare earth supply chain, not just in Southeast Asia, but also in countries all the way into Africa, into Brazil?
So 2 points. First of all, rare earths are not exactly rare. They are called rare earths because the materials are difficult to separate. But the geological resource is widely dispersed. Brazil, for instance, has substantial rare earths resources. We have the same here in the United States. And it's important to remember also, Parikshit, that while it's auto supply that's getting the headlines right now, these magnets are used across our economies, importantly for India and the United States in defense applications like F-35 aircraft. They are essential to wind turbines, like the turbines that GE Vernova is building there in Pune, where I visited about a year ago. They also are in every one of our cell phones. The vibration motors that when you put your phone on silent mode, those use rare earth magnets. So these are materials that are pervasive to our modern digitized economy. Because we weren't paying attention, for the better part of 2 decades, we allowed China to achieve a near monopoly in the processing of these magnets. But we are beginning to develop diversification. I was in Brazil last year in Minas Gerais, where the state government has a national rare earths processing industry. Ironically, Brazil is a major producer. Most of their rare earth clays are exported to China and then come back in the form of industrial imports. Likewise, in the United States, we have MP Materials, a company which is mining rare earths in the United States. Until very recently, MP Materials was exporting for processing in China, but now they're accelerating their plans to develop a national processing supply chain. That's exactly what we need to do. We need to do it working together. For instance, we have the example in India of Epsilon Materials in Bombay, which has developed a national supply chain for graphite anode material for batteries, another material on which China has placed export controls. So we know how to do this. What we have to do is work together to develop the alternatives.
Right. Ambassador, what I'd also like to ask you, and you said this in a previous interview, that US has 1.3% to 1.4% of rare earth reserves globally. India has quadruple of these reserves. Now, from your experience and understanding, you were someone who in the State Department was dedicatedly looking at this issue. Weaponization of critical rare earths, critical minerals. How soon can India, if we get onto this in a mission mode, how soon can India set up at least a domestic supply chain for assembly, processing and recycling of used rare earth magnets?
So I mentioned earlier, Parshit, the example with Russian gas. And if you look at what happened to Europe in 2022, there was short-term disruption, just as there's short-term disruption right now in auto industries because of these Chinese magnet controls. But what came out at the end was a more sustainable and more secure situation. I'm very proud of the fact that when I was in government, I led the effort to bring India into the Mineral Security Partnership, something that was announced when Prime Minister Modi and President Biden had their state visit 2 years ago in summer of 2023. And that has created a framework for our governments to work together. I was deeply impressed by the partnership, the work that we did together with Secretary Mines, K.L. Kantha Rao, and the effort that the Ministry of Mines has been making to identify the opportunities that you described in your intro, looking at the PLI process, looking at the capacities of Indian industry, whether it's Tata Materials or what's happening in the auto industry itself. I remember 2 years ago when I was in Bombay, I had the opportunity to catch up with my friend Anand Mahindra. And then I traveled to Pune to see what Mahindra Autos is doing with its EV manufacturing, which is deeply impressive. But we all became complacent about some of the upstream inputs. And China has now demonstrated a willingness to exploit that complacency in order to weaponize its monopoly control. So the answer is not to negotiate a new agreement with China. The answer is to develop diverse and reliable supply chains. And that's going to be easier if we're working together to mobilize our resources. For instance, the geological resources that India enjoys in its territory, but also the capacity of Indian and American industry to work together. For instance, in East Africa, a region where Indian industry has a very strong presence, or in Southeast Asia. And I mentioned earlier the Quad, where we have a good example already of cooperation between Japan and Australia through Linus Rare Earths, an initiative of those two governments after China placed controls on Japan's rare earth supply chain. But we should be taking that example and projecting it out into the political construct that the Quad provides for our four countries.
Right. Those are very strong long-term recommendations that you're making, Ambassador, and we're glad to hear that. But, you know, in the short term, there is a worry. We've been speaking to electric vehicle manufacturers in India like Bajaj Auto, TVS Motor Company, and they've gone on to the extent of saying that you'll bring the industry to a halt because you cannot manufacture electric vehicle motors, other ICE equipment without these rare earth magnets. The only supplier right now is China. We can't diversify so quickly. In the short run, what can we do to secure our supply chains to make sure our manufacturing does not get affected?
So first of all, we have to negotiate smartly and collectively, because yes, we are dependent on China, but China is dependent on us because their industry cannot absorb all of their output. So you have significant Chinese firms that are going to be lacking in a market if the government does not relax these controls. That's why I said I'm confident that we can find a pathway for some kind of a negotiated solution over the short term. But we need to be smart about it and not allow a situation where we all say, well, that was unpleasant, but let's go back to being dependent on a sole source of supply. We need to invest in alternatives. Right. That's exactly what we've been doing with the Mineral Security Partnership in the Biden administration. And I'm glad to say India was one of the Biden administration's strongest partners in understanding the imperative of developing the alternative supply chains that we have the capacity to accomplish. This is a financial problem. Right. It's not an innovation problem. Our companies know how to do this. We just need to build the market and the supply chain so that we don't find ourselves in a position where China can use its resource control as a sword hanging over our throats.
Right. Ambassador, what's your worry for U.S. manufacturing, U.S. electronics majors, electric car companies like Tesla for that matter, or even Ford? How badly would they be impacted because of these restrictions on rare earth magnets?
Well, Parkshi, just like in India, this is front page in the business sections right now. There was a long Wall Street Journal article yesterday reporting on some of the discussions among our big Detroit auto manufacturers. The Wall Street Journal reported that Ford has already slowed down production of one of their large electric vehicle models. The reporting has also pointed to efforts both to identify alternative supplies where possible. That is to say, using less powerful, less durable magnets. But if you do that, you're going to have a less competitive product. And that's why we have to make the investments in alternative supplies. If you look at what MP Materials is doing in the United States, they are scaling up their alternative supply chain very rapidly, but they have an exclusive supply agreement right now with General Motors. That was struck several years ago. In retrospect, it looks like a very forward-looking move by both companies because they recognized that this was a key vulnerability in the EV supply chain. And again, I want to emphasize something that I'm sure officials in South Block are also focused on. This is not just an auto industry question. And in particular, it has implications for our defense industry because of the application of these magnets, in particular in areas like electromagnetic sensors and fifth generation fighters like the F-35. So this is a national security challenge as well. And we need to meet it in that spirit.
Right. You're absolutely right. This is not just a manufacturing issue or a supply chain issue. It is a national security and almost a war-like scenario, because if you weaponize supply chains around critical minerals, around semiconductors, around rare earth magnets, this is in a way a war, so to say. Having said that, the big worry right now, Ambassador, in the industry here is what if China puts similar restrictions on lithium batteries? That would also cripple the automotive industry, not just in India, but worldwide as well. What do you think India and US can do right now? Do you think Trump administration is critically looking at this issue with the Indian government under the compact framework? Recently, we saw Vikram Misri, the foreign secretary, visiting the United States. This was one of the key issues on the table. Do you feel that this is something that is getting a lot of attention from the Trump administration vis-a-vis India?
It certainly is getting attention vis-a-vis the Trump administration, but it's also an issue of wide concern and bipartisan concern in our Congress. And what I would highlight, Parkshi, is that we have more than 2 years of history of India and the United States collaborating closely on these issues. This was a huge part every time I visited New Delhi, precisely because of the expectation we had at the time that China was going to continue to leverage its controls over these vital inputs to the clean energy economy. So I mentioned already the example of Epsilon Materials. In the solar space, of course, the two largest investments in the world by our Development Finance Corporation, with Tata Renewables in Tamil Nadu and First Solar. We need to take exactly the same approach on batteries, on anode material, on other key clean tech inputs like hydrogen electrolyzers. You have the example of Greenco in Hyderabad, which is working in this area. India is on the right path with its PLI scheme, and recognizing that government needs to play a role in putting in place the incentives that will reshore some of these key inputs. And we're having a debate in our US Congress this very week over the same issues for our Inflation Reduction Act, which you can think of as an American version of the PLI scheme.
All right, Ambassador, thank you so much for joining us with that comprehensive perspective on where the problem lies with regard to rare earth magnets, how critical this is for India and the United States to work together, not just to negotiate a short-term solution with China, but also for looking at long-term supply chain resilience around that. We're taking a short break, but don't go anywhere. China's stranglehold over supply of rare earth magnets has caused concerns among Indian auto companies. A special discussion with Puneet Gupta of S&P Global Mobility on the other side. Stay tuned. Welcome back. You're watching Global Eye. China's stranglehold over supply of rare earth magnets, a critical component used for manufacturing electric vehicles, has caused concerns among Indian auto companies. Leading automakers have warned that the issue has the potential to impact production massively if it is not addressed on war footing. So what are the options available for Indian EV makers? Puneet Gupta of S&P Global Mobility is with us. Puneet, first of all, which automakers do you believe will get more impacted in the month of June and July?
Right. Hi, Parikshit. Nice to be here. So I think one thing is very clear, auto industry is going for another crisis, right? So we have multiple crises. I think you talked about semiconductor crisis, supply chain crisis, COVID crisis, and I think now rare earth material crisis. So I think though, as per our analysis, we clearly see, that June we may skid off, right? So June may be a month which will go in tensions, but, July is a month, where we may see production halts, and where, I think industry will start panicking. And already I think we know that this year, when we started the year, every OEM, was talking about a tepid growth, a very low single digit growth. And now any production halts, can really be linked, to a negative growth, where industry may be heading to. So now if you talk about OEMs, so one thing is very clear that, obviously the OEMs which are large manufacturing large volumes, so they will be more probable, to default. So it may be players like TVS, which may be on radar, or maybe players like Maruti Suzuki. But we personally feel, that July is a month, where we will really see, things becoming more, tricky for the industry.
All right. Okay, so July would be when things become tricky. Is there alternative right now in terms of getting these rare earth magnets? Other suppliers only in China, but are they there in Vietnam for that matter? Australia, Japan, Ukraine, United States? Are there any processing facilities there from where magnets can be procured?
Yeah, so I think generally, magnets, so companies have been, like if I talk about Tier 1, Tier 2 suppliers, they have been keeping such inventories, for 3 to 6 months. But then, if you really talk about, there can be even one supplier, who may be working, or who may have low inventories. So I think obviously right now there is a clear rush, clear race, towards procuring even sub-assemblies, for example, from other countries, if possible. So I think we may see those things happening, but I think the best solution, would be, quick diplomatic talks, and maybe then, obviously our supporting associations, rushing toward China, and supporting, and expediting the whole consignment. So, but I think obviously even if there are alternatives, you may not be able to, immediately incorporate them in your components because they may lead to low performance, which is critical. And also you need a lot of homologation before you really get on and change your raw materials.
Right. Puneet, but it's not just EVs. Rare earth magnets are also used in ICE components. Certain components are common to ICE and EVs, and some are there only in ICE for that matter. They're also used in speedometers. Speedometers are used everywhere. So not just electric vehicles, but even in terms of ICE cars, ICE EV, ICE two-wheelers and three-wheelers, what's the kind of impact that you are estimating?
Yeah, so I think if we see, 7 rare earth elements which have been where the restriction is there, for example, cerium, right, clearly impacts the catalytic converters. If you talk about terbium, really impacts the lighting, because that gives the color. So I think every of these rare earth elements, impact different category of components. So you are absolutely right. It is not only the EVs, which will fare this restriction, right? It will be across segments, across category of vehicles. And, but yeah, one thing what we can clearly say that, vehicles which are having higher variants, the models with higher variants will obviously be more probable, in terms of disruption. So primarily, here how we see is that OEMs may be looking for, restructuring their model mix, or really rethinking around what can be done with the variant mix, because that's a clear strategy, because, is it really make sense to make Swift or focus on Swift Desire, for example, so, or focusing on mid-end variants or low-end variants, rather than high-end variants. So I think all those equations, have to come in picture, and obviously, as I said, sub-assemblies can also play a critical role.
All right. Thank you very much, Puneet, for joining us on the program. Clearly a big worry for the auto industry right now. And even the ICE industry, as you're pointing out, will have to start making choices on how they want to prioritize production for the highest amount of revenue and not to lose out on profits as well. With that, it's a wrap on this edition of Global Eye. Thank you for watching. Stay tuned to CNBC-TV18. News continues on the other side.
Welcome to our monetary policy special. The Reserve Bank today delivered a volley of sixers, typical of a Virat Kohli or a Sai Sudarshan in the just concluded IPL series. It announced a 50 basis point repo rate cut. The market expected 25. And it also announced a 100 basis point cut in the cash reserve ratio, the cash that banks have to maintain as a percentage of their deposits in cash, which they can't lend. Now, the combined impact of these should drive interest rates down considerably by the end of the year, by the end of FY26, and that can boost growth. But on the other hand, like a Rahul Dravid, the Reserve Bank moved back to the crease by changing the stance from accommodative to neutral. What it means is it is probably signaling that it is ending the rate-cutting cycle. Now, how much can its steps its easing steps stimulate growth? What will be the future liquidity steps that the Reserve Bank may take, considering that it has already given a 100 basis point cash reserve CRR cut? And what happens to bond yields? What happens to the rupee? For all these questions, I'm joined by an elite panel, three stalwarts. I have with me B. Prasanna, the head of global markets at ICICI Bank, Mridul Sagar, former Reserve Bank of India MPC member and now professor of economics at IIM Kozhikode, and Samiran Chakrabarti, the chief economist from Citibank. Gentlemen, thank you very much for your time. But before I come to you, I want you to hear out what the governor said when I asked him these two questions, for which I was given time. One, what is he going to adjust the liquidity in such a way that the call rate is along with the repo rate? At the moment, until yesterday, the call rate was 25 basis points below the repo rate. So will he align it, was one question. And the other question was, is he signaling that there is no more space for rate cuts given the inflation and the real policy rate? Or is there more space after a pause? Let's just listen to the governor, and I'm coming back with questions.
First question is a very good question. In fact, what do we do with liquidity? Where do we actually maintain now the call rate? The call rate today is hovering at the lower end of the LAF as it was till yesterday. So it was at about 5.75%. Whether we now maintain it at 5.25 or at the policy rate, which is at 5.5. That's, as I said, we'll see how the situation goes. Of course, liquidity is abundant, and if we do not do any VRRs, then it's going to stay at 5.25. If we do VRRs, then, we can bring it anywhere between, depending on the amount. So we'll see, how the situation evolves, and we'll take a call. We have not really given it a thought on that. So we will decide, and you will come to know, in the coming few days. I'll not be able to give you a very precise answer. But having the policy at 5.5, and the stance, now going to neutral, so all that will, certainly come in the picture. We will take a call as to where, we will try to have the call rate. The second question is on where do we see the terminal rate. The MPC, I think, has very clearly, articulated that in the statement, in the resolution that has come in. We have changed the stance from accommodative to neutral. And it has mentioned that there is now very limited space for the monetary policy, actually, given the current circumstances. And you are aware of the current circumstances, which is that growth is at about 6.5%. Inflation, we are projecting at 3.7% for this year. And next year, it's above 4, it's 4.5%, or roundabout. So given these current, if these were to play out, there is very limited space, is what, MPC says, and that's why it has been reduced now. We have changed now to neutral.
Okay. See, now let me come straight away to the question that everybody will have. Samiran, is there another rate cut at all? The governor seems to be at pains to say that next year inflation is going to be above 4%. And now we are at 5.5%. So is he practically like 99% ruling out a rate cut?
So, Lata, the way for us to think about it has been that this policy has been very pro-growth policy, and the new set of RBI things that we have seen in recent times also seem to be supporting growth. The way the growth has been characterized has also been lower than aspirations. So purely from a growth standpoint, one can always argue that there is some space for even more rate cut. We also have a lot of uncertainties around the growth number going forward. So we'll have to probably can argue for a rate cut, may not be in the August policy, but in the October policy, purely from a growth angle. But also we have to take into account the fact that when we get into October, the forward-looking inflation numbers, particularly for the Jan-March quarter, for which RBI has put the forecast at 4.4, we think it could be slightly higher also. Then the real policy rate based on that expected inflation turns out to be barely about 100 basis points. And that's where I think the governor is mentioning that there is very little or very limited space for further monetary policy easing. So only in a scenario where that forward-looking inflation also comes down sharply below 4%, then both the growth and inflation combination, one can think of a further rate cut in October, but that's not our baseline scenario at this moment.
Your baseline scenario is no more cuts?
Yes, that's the scenario, that's the thing. But yes, we have put it very carefully in our report that if at all a rate cut can be considered, that's not before October.
That is not? Sorry? If you, I didn't hear your last line.
No, I was saying that if at all a rate cut has to be considered, that cannot be before October. August will be too soon.
No, I want to ask all three of you, is there a 5-quarter of repo? Prasanna, do you see a 5-quarter at all?
So I think, Lata, even before the policy, our terminal repo rate was for 5.5, and with liquidity easing, taking the interbank rate lower to 5-quarter to 5.35. But of course, we thought that it will happen over 2 policies, this policy as well as the next policy. I think what the governor has done is to use up all the ammunition that he has in this policy. And that is also one of the reasons why he has shifted from the stance from accommodation to neutral. But having said that, see, this is the stance at this point of time, and this is his view at this point of time. There are 2 or 3 things which can happen, which can potentially make the 5-quarter repo possible. One of it is, of course, like Samiran was saying, inflation estimate coming down drastically. If there is a further incremental downward surprise in inflation. The second is, of course, if growth were to take such a hit that the push towards potential growth needs that much more thing, and it requires a lower real rate of interest. Today, if you can argue 370 plus around, say, 170 comes to 540. So real rate, the repo rate is very safe at 540 to 550. But if real rates, if the growth were to take a hit, then, real rates can come down. And the third is, of course, if Fed were to cut rates. Now, at this point of time, we think that getting even a 25 basis point, we'll be lucky if Fed cuts this, right? But that can also change going forward. So these are the 3 things. Having said that, at this point of time, we do feel that the next couple of policies are possibly going to be a pause. At least the next policy is going to be a pause. And then we'll have to see how incremental data falls. I think the RBI has now become truly data dependent.
Okay. No, I'm a little surprised by your answers, because in my book, when I read, I went with the expectations of more. But after his speech and his answer to me, I thought he had blocked, like 99% no more rate cuts. Did you get that impression, Mridul? That's why I played that bite.
Lata, I did get that impression, to be honest. I mean, it does look that the RBI seemed to have used up all its ammunition. So this was a very unique sort of policy, extraordinary, unusually activist. And what we are seeing is that they have introduced a monetary policy surprise along with monetary policy uncertainty getting reduced. So you have added a surprise on the one hand, and you have reduced the uncertainty going forward about the monetary policy. Now, the bond markets apparently haven't liked that. I mean, the bond yields haven't really softened at all. They moved a bit north. So one has to wait and see what the outcome is. But at least till the October policy, I don't see any chance of a rate cut. December, only if forward-looking data is dramatically different from forecasts, what it appears to be in RBI's mind. The crunch would really come at end March. That sort of number of inflation, expected inflation being 4.4% projection. So if there is a downward surprise, then it opens up some room for further cut. Or if growth slumps dramatically from 6.5, if global condition extraordinarily deteriorates, that's only the possibility. Otherwise, it seems RBI has used up the ammunition, because they have done a 50 basis point, and with a real rate of 1.1%, given the Q4 inflation expectation, what they put out projection. So it becomes like real rate of 1.1%. Now, compared to 1.65% neutral rate midpoint estimate of the RBI, it means the policy is already accommodating. So that really takes up the room, and therefore the chances of cuts are very dim. It requires fundamental change in forward-looking data.
Okay, I would more align to that. I can't see a cut from the language used by the governor. Prasanna, now to come to the other point that should be plaguing the market. Do you think going forward, the governor did not give a clear answer, I thought, but what is your sense? Is he going to keep the call rate at 5/4 or at 5/2?
So before that, Lata, I think one that we need to recognize is that this is, you have to describe this policy as one for the real economy and for the multiple stakeholders at large, because it's going to lead to lower EMIs and lower borrowing costs, but not necessarily for the financial markets and the bond traders who always want the carrot to be dangling in front, that in some time there will be another rate cut and all that. So I think to that extent, I agree with what Mridul had to take away. But in terms of your question on the liquidity front, Lata, I think the stance, I think the governor has clearly indicated in the previous policy that the stance is related to the interest rate movement that we expect to going forward. So he has delinked the stance from the liquidity part of it. Having said that, if you want to keep surplus, so there are two things when you come to liquidity. One is, are you keeping surplus or deficit, and what is the extent of surplus or deficit liquidity that you want to target? And the second is, what is the price of that marginal liquidity? So while the first part has always been a part of active RBI enunciation, like whether they're going to keep it surplus or deficit and how much, like for example, the previous policy, he did, I think, tell you that he is targeting 1% of NDTL as surplus liquidity. Yeah, but the second part, which is what is the price of the marginal liquidity, is never publicly stated by the Reserve Bank. And it is always deduced by the kind of actions that they do, whether they do VRRs to suck out liquidity, whether they do VRR to give liquidity, and so on and so forth. So that is why I feel that we are not going to get an answer from RBI in so many words over the next days that they will keep liquidity in order to get the interbank rate to 5/4. I think you need to deduce it from a series of actions that they will do over the next 10, 15 days. My guess is, despite the answer that he gave to you today, my guess is he will continue what he has done in the last 2 months or so, which is in effect means that let the liquidity remain in the system so that SDF or closer to the SDF rate becomes the operating rate, rather than, take money out using VRRR and bring the rate to repo rate. Because if he does that, then what is he actually achieving? He did a 50 basis points, but he's taking away 15. So then it becomes a 35 basis point rate cut. So I think we are splitting hairs then. So my prediction at this point of time is to believe that he will not announce VRRs to aggressively take out the surplus liquidity and let the interbank liquidity find a pricing between 5/4 and 5/2. But of course, if he does it, then I'll be proved wrong. I'll be watching for those moments.
Yeah, actually, even I don't know how to guess. He left us guessing. But Samiran, besides the liquidity, which he can always squeeze out with a with a reverse repo, there is also the CRR liquidity that will come, and that is a substantial amount of liquidity, 2.5 lakh crore, that will start coming from September to October. So do you see that actual lending cost of banks is going to fall rather sharply? That is one question. And therefore, do you think there is an upside surprise to everybody's growth forecasts?
To start with, I think our own growth forecast at 20 basis point higher than RBI's forecast at 6.7, because we think that there is a substantial amount of monetary stimulus that has been given to the economy in a short space of time. And as we move in the latter part of the year, this monetary stimulus should show up in the activity data as well. In fact, we thought that there was a possibility that RBI could have raised its forecast even in this policy itself, but maybe they decided to see some more high-frequency data before changing those numbers. So in short, I think this policy is going to work in stimulating the growth numbers. Maybe that's why our inflation forecasts are also slightly higher than RBI's inflation forecast, particularly for Q4 of this year. Now, how quickly this gets translated into lower lending deposit rates, that's a tougher call because historically the lag between the MCLR and the 10-year bond yield has been of about 6 months or so. Now, this time around, as Prasanna was mentioning, that the bond markets have reacted slightly. The 10-year bond yield has slightly actually gone up. The term premium has started expanding quite fast because of this expectation that we are already at the fag end of the rate cutting cycle, if not at the terminal rate. And that's where the MCLR transmission might have to be much faster now, because the EBLR transmission will work much quickly, as we know, in the current setup. So our estimate is that only the EBLR kind of move itself, that whole 100 basis point, if it gets translated into the average cost of borrowing coming down by 100 basis points, that's about 40 basis point of GDP impact on the household balance sheet in a positive way, which should play out. And then on top of it, this should lead to banks lending more to even NBFCs. So the overall banking and NBFC credit improving could add more to that overall stimulus. So with a 6 to 9 month lag, I think this should significantly start affecting the consumption demand, is what our sense is.
Wait, you have raised your growth forecast, correct?
We were at higher than RBI's number even before this policy. It's just because, I mean, we all anticipated.
You mean you were at 6.7 even before the policy?
Yes. I mean, we thought that this overall 100 basis point rate cut would have a positive effect on economic activity. The only question for which we don't have a good answer is that what happens to this durable liquidity surplus?
Okay.
Because in our view, this durable liquidity surplus stays in the system for almost the entire year, at least till December. Okay. And how that gets translated into the non-real economy variables, the financial market variables, that's something which we have to observe now more closely, because if the real economy cannot absorb this additional liquidity through higher credit demand, then will there be any spillovers into financial market excesses? That's the area that we need to watch now more closely.
Yes, there can be an accusation that the Reserve Bank has been perhaps more generous than it should have been. That accusation stands, at least from some economists. I have to take a break, but since you spoke about external benchmarks and therefore banks' loans immediately becoming cheaper, let me leave you with the soundbite we got from C.S. Setty, the chairman of State Bank of India, who believes there'll be a sharp cut in their margins in the earlier part of the year, and then an equally sharp rise in their margins because money will become cheaper for them because of CRR cut. Hear him out. We'll take a break and be back.
There will be a U-shaped curve in terms of the NIM movement, in my view. It will, there will be a reduction in the margins, and then we'll pick up as we move towards the Q4.
Welcome back to our monetary policy special. I have been discussing this rather surprisingly bazooka rate cuts and CRR cuts that we got with B. Prasanna of ICICI Bank, Mridul Sagar, formerly of Reserve Bank, now with IIM Kozhikode, and Saviran Chakrabarti of Citi. Gentlemen, thank you very much for your patience and for staying on. Mridul, I wanted to ask you exactly what I asked Saviran as well. Because of this ultra-easy policy, are you seeing an upside surprise to your own growth numbers?
Yes, but in short run, yes. It could create a bit of support to the asset prices, which will then feed into sort of higher growth numbers. But it will also probably hit the inflation numbers at some point. This is the amount of liquidity which is being infused is pretty large. I mean, we were
Mridul,
at surplus liquidity.
One minute, Mridul. Like Samiran, you are also expecting an asset inflation in that case.
I do. I thought you were asking Samiran now.
No. I'm asking you.
Okay, me. So I do expect it to have some impact on at least equities and real estate in particular. So that would then probably, if we don't get that much of effect on real economy, the capacity utilization rates now are marginally above the long-term trend, and ordinarily it would have kicked in some investment. But given the uncertainties which exist globally at this juncture, it will be hard to kick in investment cycle at this point of time. So essentially some consumption boost will come through. But eventually what I fear is that if you move on to 7 or 8 lakh crore of durable surplus liquidity once the CRR cuts get effected, so I do not know if the forward positions would take that off substantially, their unwinding. But if that kind of situation occurs, it will have some impact on inflation going forward towards the end of the year.
Oh, so that's important. That means the governor and the RBI has probably been more generous than it ought to be. That argument, that criticism can come if things pan out in a certain way. Prasanna, a more sedate question. What is your sense of bond yields? Where do you see the 10-year benchmark itself going, and any impact at all on the rupee?
So I think, Lata, before that, very quickly on the liquidity front, since he has done the CRR cut from September, you have to assume that he's planned it in such a way that when the outstanding bond forward positions are maturing and that sucks out liquidity, that's when this liquidity will come in. So you have to assume around $40 billion of forward outstanding can mature, which can kind of offset the kind of CRR cut, the liquidity infusion through the CRR cut. So I think RBI has possibly thought it through and wanted to give certainty to the banking system that even in the second half, don't worry, we are going to be in a surplus, but maybe not that much as what we are fearing right now, but much lesser, but still a surplus nevertheless. On the bond yields, Lata, I think the curve has done a very interesting twist today. The short end has fallen. The 10-year has gone up marginally in terms of yields, and the long bonds have gone up even more. So I think we are going to see a typical steepening of the curve as we go forward, because like we all rightly discussed so far, we are not really sure about the next rate cut anymore. It is completely data dependent. So there is no carrot dangling in front of the long bond trader. So to that extent, I think you're far better off assuming that the surplus liquidity will keep your borrowing cost lower. So I'm better off investing in the shorter end of the curve, maybe up to 8 years to 10 years, rather than the really long part of the curve. So the bond yields are not likely to move much lower beyond maybe 610 or 615. I would call a range of between 615 to 635 as a range for the next 2 to 3 months. As far as rupee is concerned, while a rate cut is actually negative for a typical economy, I think the way the market read it today is that it's a very equity positive kind of a policy because it really makes matters quite positive from the real economy perspective. Like I was mentioning earlier, that the rate starts filtering in right from tomorrow when the EMI start coming down and the corporate bond borrowings start falling. So to that extent, if equities are going to be positive and the fact that the CRR cut actually leads to an increase in money multiplier and the ability of M3 growth to sustain a much higher GDP growth, the conditions for that has been opened up. So from that perspective, if equities were to become positive, then maybe capital flows can come in during the second half of this financial year, or maybe slightly later, and hence it's slightly positive. Nevertheless, I think we go with a range of around 85 to 84.5 to 86.5 kind of a range.
Okay. Actually, out of time, but Samiran, I'm squeezing two very quick, if you can give me monosyllabic answers, if possible. One, do you think that, did you hint at asset inflation? Is that a fear? And secondly, will you now say that credit growth could be like 14-15% this year?
Not that much of credit growth at this point of time. And on the asset inflation question, yes, we have put it that both asset inflation as well as any sign of pricing power for corporates, we will be watching both these signs more closely now than we were earlier.
Okay, again, a small, brief answer from you, Mridul. Do you think they have been a little recklessly optimistic?
I wouldn't say recklessly optimistic. It is a bold experiment. We do not know whether it will succeed or not succeed. But I think it's moving away from conservative central bank sort of dictum. And there is an element of risk which has come in with more than expected monetary stimulus.
Okay. Yeah, I have not seen a 100 basis point CRR cut in normal times. As well, we have got a double repo cut. So yes, we have to be cautious that this can be, we are running faster than we are capable of. And therefore, is there a fall ahead? That danger exists, but otherwise, at the moment, in the short run and the medium term, there is a very good growth prospect that we are staring at. That's the message from the experts. I think I've understood them well. Samiran, Mridul and Prasanna, thank you very much for joining me in this Monetary Policy Special.
Well, thanks very much, guys. It is that time of the year when entrepreneurs from the world gather in Monte Carlo to compete for the title of the World Entrepreneur of the Year. This year, we have 43 finalists from 43 countries competing for the title of the EY World Entrepreneur of the Year 2025. The winner will be announced on Tuesday night in Monaco. And representing India as the India Entrepreneur of the Year is Nitin Kamath, who won in India for Zerodha's transformational impact on changing the landscape for retail investing, becoming one of the top brokerage houses in the country and democratizing financial inclusion. Joining us now is Nitin Kamath all the way from Monte Carlo. Nitin, congratulations once again and many thanks for joining us here on CNBC-TV18. I would imagine that this is a different moment for you because you're used to being awarded, but this is not just an award for Zerodha. It's also Nitin Kamath of Zerodha competing for India on a global stage with 43 other entrepreneurs from the world over. Nitin, explain to me how you feel today.
No, thanks, Shane, for having me on this. No, I feel good. As when yesterday we had like one of these group discussion types, so I felt like I'm back in some school or college, so I haven't done that in a while, so no.
Yes, I would imagine that it took you back to school. But Nitin, part of the story that you're going to be telling there at the EY Entrepreneur of the Year Awards is the Zerodha story, the last 15 years, the journey made, the impact created. Explain to me, as you look at what you've been able to establish, what you've been able to achieve, if you could highlight the key milestones of the impact, but more importantly, as you look at India today, what the aspiration for Zerodha now is over the next 15, 20 years.
Yeah, I mean, I would say, starting Zerodha itself was critical because, there was very little money on the table. Then I think 2015, when we launched the in-house product, which was called Kite. Then 2015 December, when we went zero brokerage on equity investing. Then the real tipping point of the business was 2016, when Aadhaar for online onboarding started. So, and then 2020, of course, COVID. I mean, the kind of the growth that COVID brought us was just immense. So there were many tipping points in this journey. So I guess, these were the few, sir.
Well, speaking of tipping points, Nitin, you've been very transparent about the growth trajectory of the business as well as of the industry. So when we last spoke, you had spoken about how the 7 regulatory changes were going to have a material impact on both profit as well as revenue. As we look at the picture today, for FY24, that's the disclosed number, profits are up 62% at 4,700 crores, revenues in excess of 8,000 crores. What have you been able to hedge in terms of being able to bring down the regulatory risk as an impact on the business? And what do you see today as the hit on the business on account of those changes?
In terms of, we started our MTF business last December, which has grown significantly, which is around 3,000 crores of book size. So it kind of cushions some of these, some of the losses from the options trading business. But that said, the hit is still there. So I guess we would have done all right if we did a flat year this year. And from the operations of broking, as in the overall business, should be still all right because. We do some, treasury operations and also, and it's, until last October, until December is like not bad at all. So overall business should be all right, but broking business as such, I think, will still be down like 10-20%. But that said, we are kind of investing into other startups, and these startups have now maturing. So like there's insurance startup, there is AMC, etc. So I guess it has to be given some time for it to materially start impacting our revenues as such.
You said broking is going to be down by about 10 to 20%, but overall you're still hopeful of this being an all right year. Can you qualify what all right means, Nitin? Just to give us some color on how we should read all right as far as the business is concerned, outside of the 10 to 20% drop that you expect on the broking side.
No, I mean, see, the thing is, we were kind of expecting the markets to go down, especially since whatever was happening to the first half of the year, first quarter of the year. Now that it's kind of seems like that was like a near-term bottom. So the business has picked up, because our business is directly proportional to the activity in the markets. Based on how the markets behave. So markets are behaving well. So that's why I said, it should be all right and not a dreadful year.
Okay. You talked about the margin trading facility book, which has grown to about 3,000 crores since the launch 6 months ago. And this, you believe, has been a hedge as far as revenues go, given the regulatory changes that you've seen. What's the expectation now? I mean, if the markets continue to trade as they are, which again have belied your own expectations, what do you believe this book size could be?
Well, I think we should be getting to 10,000 crores by the end of the year or the financial year. So, and 10,000 crores we potentially could negate any kind of any impact due to the regulatory burden on transaction charges not being the pop not being to the brokers, and the option trading volumes drop. So at around 10,000 crores we should be kind of okay in that.
Okay, so margin trading facility, the book should be about 10,000 crores by the end of the financial year, mitigating some of the impact and offsetting the impact of some of the other changes that you spoke of. But, Nitin, you haven't changed brokerage rates and there's been no change on the DP charges as well. Again, on account of what you've been able to do on the margin trading facility side, do you believe that that will remain? I mean, the status quo there stays?
Yeah. I mean, for now, there's status quo. We had thought about the same when we were launching margin trading funding. The whole point was to see if we can somehow recoup whatever is the revenue outgo because of the regulatory changes. So that's happening. So I think the brokerage rates will stay where it is. The brokerage rates, DB charges, and all of that will stay where it is. And we haven't changed this in the last 15, 16 years. So in a way, we want to be like that. We want to be, people should have predictability in terms of how much they charge, so yeah, that's good.
So no change there as far as the brokerage rates are concerned. But Nitin, overall, as far as the inflection point from an Indian market perspective is concerned, you detailed some of the big changes and some of the milestones that we've seen, which has seen more investors come to the markets. As you look at the story today, as you look at the picture today, what's your read on where we could potentially be? I mean, you have about 8 million active users today, or around that much. What do you believe that number could potentially be, given the concentration of the equity culture, given the diversification of the equity culture in India today?
Yeah, I mean, we hope that the participation will increase. So we have 18 million customers. We have around almost 9 to 9.5 million people who have stocks in the demat accounts with us. And we hope that this market participation will keep increasing over time. Of course, the speed at which they increase will kind of you can't expect the same speed which we saw in the last 4-5 years. So long term we hope to compound this at around 15%. So I mean, in terms of market participation, and if we do that, that'll be good, So,
well,
and not just for us, it's basically across the brokers, So.
Yeah, 18 million accounts on the Zerodha platform. But Nitin, speaking of potential changes, and this is something that we were discussing in our newsroom, and I'm going to put this out as an idea for your thoughts. Do you believe that the time has come to look at increasing the LRS limit of $250,000 at this point in time? Do you believe that that will give Indians the options to diversify the way that they invest? Do you think that that would potentially be an idea that you would back and support?
I don't know if increasing LRS will really mean increasing market participation. LRS is like $250,000 right now, and $250,000 you basically will have to go to the top 0.5% of the population for to increase that. And so LRS, I don't know. I mean, of course, we would be supportive in terms of any regulation. I mean, any kind of regulation which will reduce the increase the LRS limit, and more importantly, is to not have the tax at source when the money is sent abroad. So we'll support that for sure, but I don't see how market participation overall will really increase because of that. So.
Nitin, let's talk valuations, and I think that debate, of course, perennially continues. Are we pricey? Are we cheap? What's your take at this point in time? Where are you on the valuation spectrum?
No, I mean, given the uncertainty around, with AI and all of that, I think we're probably fairly valued, So, in terms of all the sectors, because uncertainty has to be factored into the price. It doesn't seem to be factoring right now, in a sense.
So you're saying uncertainty hasn't been factored into the price?
Yeah. I just tweeted about this. The pace at which the AI is compounding is really, it's ridiculous. So it's, so, and you don't know where the markets will be in the next 1, 2, 3 years. So, given that all the uncertainty, it has to be somehow factored into the price, and it doesn't seem to be, and not just in India. It's even globally. So globally, all the markets are kind of taking it pretty easy, I guess. So.
Well, we will head into a break, but there's a lot more coming up. Don't go anywhere. We're in conversation with Nitin Kamath, representing India at the World Entrepreneur of the Year Awards in Monte Carlo. We're back in a moment. Welcome back. You're watching the CNBC TV18 special. We're in conversation with Nitin Kamath, representing India at the World Entrepreneur of the Year Awards in Monte Carlo. You know, Nitin, let's talk about the next course as far as Zerodha's journey is concerned. You talked about the AMC business, the insurance side of the business as well. I know the aspiration of a bank license continues to be a hope. But whether or not that eventually fructifies into anything is a different story altogether. So given where you find yourself today, you know, what could Zerodha potentially look like over the next decade or so, you know, in terms of diversification, in terms of the kinds of investments that you're likely to make, the bets that you're likely to take?
Yeah, I mean, since we started Rainmatter in 2016, the idea has been to partner rather than try to build everything ourselves when working in adjacencies. So, and Rainmatter as an initiative is almost like 120, 130 startups now, part of the portfolio. So, and we're doubling down wherever we see any kind of fraction. So apart from insurance, which we partnered Ditto to do, or AMC, which we have partnered Small Case to do, the NBFC is in-house, so we are essentially doing only loan against securities. Like this, as in. But the thing is, for a lot of these companies, we're probably in the first 3, 4, 5 years of the business. Like the first 3, 4, 5 years of our business was spent trying to prove that we are real for all our customers. So I think while these companies have it quite easy that they have us for distribution, but still, as in, it takes a while to build trust and credibility as such, you know. And so in 10 years from now, we would want to be a full-fledged financial conglomerate as such, you know. So and hopefully banking will happen somewhere along the way.
A full-fledged financial conglomerate, and you're still hoping that a bank license could potentially come your way. You're not giving up on that. But, you know, I want to talk about one of the other investments that you've made, picking up a stake in the Metropolitan Exchange. Do you believe that there is room for a new exchange in India today between the NSE and the BSE?
Yeah, I mean, see, the thing is, I think there are segments, like there's, for example, a debt segment, in which both the existing exchanges aren't, you know, kind of really focusing on, because of, you know, in terms of it, it's not very it's not very easy in terms of revenue generation and all. So, I think, you know, this exchange will have to kind of take the hard way out, and which is to build the liquidity in markets, you know, like debt segment, for example, or mutual funds and etc. So, and then hopefully in the next 5-10 years, they'll have, you know, we'll probably have another exchange.
So you feel confident of that?
I mean, it's confidence is there, but I don't know. As in, I don't know if it will really play out that way. As in, we have to see how the other exchanges also react to it. But India definitely has an opportunity to be in to have at least 3 exchanges in a sense.
India has the opportunity to have 3 exchanges. But Nitin, the much asked question, and I want to know from you at this point in time, any change at all in the thinking on whether or not you intend to, at some point in the future, IPO? I mean, just about everybody, including your own competitor, is heading in that direction. Any change of heart, any change of mind there?
No, not at all. Because as in, the problem still remains the same, which is we have enough cash to do whatever we wish to do, and I feel that being listed on the exchanges is kind of tough to, you know, for a company like ours. It's kind of tough, you know, because a lot of times what is right for the investor isn't really what is right for the customer. Like, for example, customers trading more is right for the investor, but it's not really right for the customer. So I don't know, as in we're still caught up in all of this. So so for now, that's how we're staying, So
Enough cash to do whatever we want to do. I don't know how many, forget startups, how many companies can actually unequivocally make that statement on live TV. But Nitin, let's talk about what you intend to do with that money. You talked about the 120, 130 startups that you're investing in. Are you looking, for instance, at the quick commerce story? We were just talking about how Zepto may not IPO anytime soon. They're out looking for funds again. I mean, in the spaces that you observe today, where do you believe that there is value? Would there be value in quick commerce, for instance? Would that even be a consideration for you?
No, I mean, basically investing across fintech, health, and climate. And this is an area of focus. And I think, when people raise capital, there are so many people giving capital, and then you have to have a reason why you take the capital from that person. So in these three spaces, I think we kind of build a moat in terms of our capital also. And also with the foundation, we are supporting quite a bit on climate startups. Climate social entrepreneurship. So yeah, it's an extension of what we do in the foundation, what we do through, to the investing arm as well. So yeah, so I have no, I don't know about Zepto and etc., but no, not really quick commerce at all.
You have no plans to IPO, but what do you make of some of the IPOs of the tech companies, the new age tech companies that have listed and are potentially likely to list? There's a whole long list of them, a long line of them heading to Dalal Street. What do you make of the listings as well as the potential listings?
No, I mean, it's actually quite a great thing that Indian markets are deep enough, to provide liquidity and provide to earlier venture capitalists and PE guys, etc. So, essentially, it's amazing. The only thing the startups will have to do is to keep some, not really look at IPO as an exit, but look at IPO as the beginning of a new type of journey. Because a lot of founders I know are primed to think of IPO as an exit, but it is not. It's really a beginning of a new journey. So, I think, but that's it. It's amazing that Indian startups are having all of these exits on the stock exchanges.
Well, Nitin Kamath, we wish you the very best of luck. We hope you enjoy yourself there at the World Entrepreneur of the Year Awards as you represent India. And we look forward to hearing more from you. And of course, we wish you the very best of luck. It's been a long line of very distinguished winners from India who won the World Entrepreneur Awards, starting from Mr. N.R. Narayanamurthy to Uday Kota, Kiran Mazumdar-Shaw, and most recently, Vellayan Subbiah. So you have big shoes there to fill too. But many, many thanks for joining us, and here's wishing you the very best of luck from all of us here.
Yeah, thanks a lot, Shreen.
Well, with that, it is time for us to wrap up the CNBC-TV18 special. That was Nitin Kamath. We are going to take a break, and the news will continue. Stay with us. We're back in a moment with more.
Hello and welcome to Startup Street. I'm Arundhati Ramanan, and these are the top headlines that we're tracking from the startup world. Course MCAI, a social commerce infrastructure startup, has raised $200,000 in pre-seed funding from a group of undisclosed angel investors across India and the Middle East. The capital will be used to strengthen its no-code product suite, grow its affiliate integrations, and expand operations across India and Southeast Asia. IPO-bound OYO expects to raise booking revenue from company service hotels to 44% from 22% by the end of the current fiscal. As part of its increasing focus on India and premium property expansion, Varun Jain, Chief Operating Officer of OYO, said the program is in line with OYO's strategic focus for 2025 for the India market, which aims to drive profitability. PhonePe rolls out UPI payments tailored for feature phone users, leveraging its recent acquisition of JustPay technology. Phone UPI app will provide essential capabilities such as peer-to-peer transfers and offline QR payments, specifically designed to cater to the often overlooked demographic. Government allows Starlink to provide satellite internet services in India. The Elon Musk-led company is the third after Bharati's OneWeb and Reliance's Jio to secure a SATCOM license. The telecom department is yet to approve regulators' recommendations on allocating spectrum to SATCOM companies. Amazon has agreed to clamp down on fake online reviews of products advertised on its UK site. Britain's competition regulator said Google agreed to a similar UK commitment in January after the Competition and Markets Authority launched an investigation into the matter 5 years ago. Those were the headlines that we're tracking for you this evening. In what's brewing, South Korea's CJ Logistics is doubling down on its India play. The logistics giant has infused $32 million to raise its stake in CJ Darsal from 50% to 56%, reinforcing its commitment to one of Asia's fastest growing logistics markets. Now, the fresh capital will be used to ramp up multimodal infrastructure, invest in green transport, and scale tech-enabled logistics solutions, positioning CJ Darsal for leadership in India's next phase of supply chain evolution. Joining me now to discuss this further is Nikhil Agarwal, the president of CJ Darsal Logistics. Nikhil, thank you so much for taking time out and being here with us on Startup Street. If you could sort of take us through what prompted CJ Logistics to increase its stake to 56% in CJ Darsal at this stage of the India growth story.
I think, hi, first of all, good evening, everyone. I think it's, the bullishness on the Indian market and the way logistics industry in India is booming and the way infrastructure is growing in India. I think that's been the key positioning statement for CJ Logistics to further invest into us, to double it down and show their focus on the Indian market.
Right, absolutely. And they've infused about $32 million to power the next phase of growth for the Indian market for CJ Darsal, right? If you could sort of take us through how you're planning to spend these funds and what's going to be new, what are the new offerings on the anvil?
So as CJ Darsal, we have 4 key business developments that we generally focus on. One is road, wherein we are looking in alternate fuels as a solution, such as LNG and EV. Then there is multimodal. We further want to increase our portfolio when it comes to railway services. Currently, we operate almost 150 rakes across India. We want to further invest more into the rail business. Third is warehousing and distribution. That's been one of our key growth areas. Today, from 2.5 million square feet of warehousing space spanning across 20 warehouses, we further want to invest and develop that. And fourth bit is technology. So these are the 4 aspects that we are looking into to invest further.
Absolutely. And what would be the immediate priorities for CJ Darsal's nationwide expansion? Are there, any specific regions or sectors that you're currently targeting?
So we are a pan-India company. I think we've, been there across India and subcontinents, right? So I think key focus areas are alternate fuels, which are on the cards, right? Where we are very aggressively exploring LNG as a fuel. Some of our clients have also been asking for the same. And on the other side is warehousing and then the multimodal that I mentioned.
Absolutely. And if you could sort of take us through the kind of clients that you're currently servicing and working with, what's the demand that you're seeing and how do you plan to sort of grow this client base of yours?
So I think who's who of India's industrial base, we are a B2B contract logistics company. So we work across sectors with some of the top names that, we all know, right? And I think ESG as a norm is being talked about a lot more in the recent times. Now we believe that OEMs have started offering good EV products and LNG. Infrastructure also is, catching up and being developed. So that's why we are more bullish on them. And that's where, we are trying to be more focused upon. As a matter of fact, from last 2 years, entire emissions for CJ Darcel are mapped. We rather work closely with our clients, show them the emissions that we are today incurring and how that can be saved through rail, multimodal, as well as through such alternate fuels which are available.
Right. And if you could sort of take us through the kind of revenues that you're currently clocking, how big is the India market right now? And, where do you hope to end this year? What's profitability looking like?
So last year, we almost, I think numbers are being audited as of now, but we are close to around 5,200 crores in revenue, which was almost a 15% growth. We believe similar sort of a growth level should continue in the coming years. And hopefully more of, alternate fuels would come in, more focus on rail multimodal would be there as, some of the key projects that we are undertaking.
Right. And speaking of alternate fuels, what role will next generation technologies play in CJ Darcel's transformation? Can you sort of share examples of digital or AI-led solutions in the pipeline?
Still under a lot of exploration. We've already kicked in our AI bit of work. We are still exploring where all can that play a big role. Some bit of, I think, a lot of technology-led initiatives are being taken at grassroots levels where, we could have our pilots, drivers, being connected to it. There could be more visibility of things, how we are taking all this technology and visibility to our clients end of the day so that better optimizations at all stakeholders levels can come in. So that's where the key focus is.
Right. And you also kept mentioning alternate fuels. How is CJ Darcel integrating sustainability into its logistics offerings? Are there plans to adopt electric or alternative fuel fleets? And how soon will we see that happen? Because you've mentioned that you're working on it.
So I think this year we should definitely see some of those active role play in investments going into EVs as well as LNGs. EV, I think primarily we believe it's a short haul intra-city sort of a solution where we've done some bit of trials. It has shown us good. Obviously, they are more environmental sustainable, as we all know. But I think financial sustainability also plays a key role. And we believe there is a solution in the intra-city distribution model. On the LNG, we believe is a more long-haul, heavy-haul segment. That's where, from diesel, we can migrate into LNG. Infrastructure is still a concern there because we don't have enough LNG fuel pumps on most of the sectors in India today. We've been talking to a lot of fuel suppliers or the gas suppliers for LNG. Hopefully, we'll be able to connect all the dots here and move forward in the next 3 to 4 months' time.
Right, absolutely. All right, Nikhil, we're completely out of time, but thank you so much for joining us here on Startup Street.
Thank you. My pleasure. Thanks a lot.
And moving on, menswear brand Snitch recently raised $40 million in its Series B funding round. My colleague Ritu Singh caught up with its founder and CEO Siddharth Dungarwal at their Bengaluru store to get the inside scoop on what's next for the fast-growing brand. Take a look.
Well, I'm here at a Snitch store in Bengaluru, a direct-to-consumer fashion-focused brand that is known for its focus on men's apparel and a digital-first approach. Now, the brand has recently raised a $40 million led by 360 ONE Asset and other investors. And that's a significant moment for the company that started just about 4 years back in the middle of the pandemic. Now, in a market which is crowded with fashion startups, Snitch has been able to scale quickly, build an online following, and also expand offline in the past year or so. So today, I'm here to speak with its founder, Siddharth Dungarwal, to understand the significance of this funding, the company's growth plans ahead, and how it plans to navigate the challenges of this fast-growing D2C space. Well, I want to start by actually telling the viewers that Snitch has started bang in the middle of the pandemic, July 2020. Yeah. Just start by telling us, what were you thinking starting up a business when the world was shutting down?
So apparently we started in 2019 more like a B2B brand, but then within 9 months the pandemic hit us, and we were left with a lot of inventory. Offline was completely shut. The first thing that came on my mind was go on a marketplace, try and liquidate stock, but then realized A, maybe we wouldn't be making any money. B, the brand may not get that recognition. That's why we took that leap of faith and started our own platform on July 2020. Clearly remember 4th of July. Barely about 35 products, team of 4 people and 2 racks in the corner of our office was the warehouse. And yeah, I mean, since then it's been a roller coaster ride.
Well, let's talk about the brand philosophy. What does Snitch stand for, and who is your target audience? Who's a typical Snitch guy?
So, I mean, Snitch is a trend-driven men's apparel brand. And by trend-driven, we mean that, we want to be not only people who follow trend, but also start going beyond, a lot of other international brands as well. Our typical TG is anyone in the age group of 20 to 30. And then, over the last 6 months since we've started expanding offline, what we've seen is consumers in the age group of, 40 to 50 buy almost 2x of absolute value compared to an, 20 to 30-year-old.
Yeah.
So, I mean, there's no sort of a fixed TG, but as an entry, it becomes very easy for us to enter any household, with these, 20 to 30-year-old because, they're more digitally active.
All right. You've got this $40 million Series B fundraising. Congratulations on that.
Thanks.
Tell us how you're going to deploy that money for growth. What will be the priorities?
This fundraise is more like, sort of protecting the brand, creating a shield for ourselves. We've barely utilized, the fund that we received. Yeah.
Okay.
So I think this one is more, protecting the brand. I mean, our aspiration has been very clear that we want to grow offline aggressively. We are at 59 stores. Hopefully by December we'll cross the 100 store mark. Quick com is something that we're very bullish about. So we would utilize stores as well as our other infrastructure to get into the quick commerce world and obvious aspirations of going global. So hopefully by December this year we should start piloting.
Well, let me get a little bit of a detail on each of those things, starting with the 100 stores by the end of the year. Where will be the focus geographies? Where do you see potential for more growth?
I think, since we're a digital-first brand, it becomes very, very easy for us to, sort of select stores because we exactly know where our consumers are. And, so
what are those
choices? The obvious choices are the top 10 to 15 cities, including Bangalore, Delhi, Pune, Mumbai. We're coming up in UP now. The idea is to, sort of start with one store in every city and then, sort of cover up across the city and then go deeper into the tier 2 and 3s.
And when you're talking about these global expansion plans, ambitions that you have, what are the markets? Have you already identified them, and how soon will we see Snitch overseas?
I think in terms of identification, I think we would start off with Middle East, hopefully, end of this year, and then, see the journey from there on.
All right. And, this quick commerce space, that's quite interesting. Of course, we're all used to getting our food and groceries in 10 minutes. Myntra is one of the brands that has started this quick commerce sort of experiment. What are your plans on this front? And from your initial understanding, how much of the additional revenue generation can come from the quick commerce part?
No, honestly, it's not a revenue channel for us. It is more that, consumers love speed. Any sort of snappy experience that you give consumers, they would obviously, remain sticky. And that's the only idea. I mean, we would at least see a 20% incremental growth immediately. But the idea is not to get, extra sort of revenue through that, but more from a, consumer experience perspective.
Okay, and where will you be launching this pilot, and how many cities across your 59 stores?
So I think Bangalore is obviously our hometown, so we would start off. We're already on the last leg of completing our tech stack. Probably by, end of next week onwards, we would start off with Bangalore and then, learn from whatever sort of optimizations that we need to do and then roll out across all stores.
What is your USP? Why do you think you'd be able to pull a customer away to your brand?
I think we're fairly widespread. Over the last 5 years, we've sort of created a brand. Becomes much more easier for consumers to choose us because of the sort of experience they've already had. And when it comes to the entire experience of the brand, I think from day one we've been very, very consistent in whatever that we've promised. That is launching new styles every single day. Making sure our experience in consumers across both online and offline is very, very seamless.
Yeah.
Third, we've always been a true and honest sort of a pricing brand.
And we wish you the best with that, Siddharth. Thank you
Thanks.
very much for your time here today. Thank
Thanks
you.
a lot, Ritu. Thanks for having me.
Thank you.
And on that note, it is time for us to head into a short break. But coming up next, Bollywood actor Riya Chakrabarti's brand Chapter 2 opens its first retail store in Mumbai's Bandra. A special conversation on the other side. Stay tuned. Welcome back. You're still with us on Startup Street. From navigating a high-profile crisis to launching a bold new chapter, Bollywood actor Riya Chakrabarti and her brother Shouvik Chakrabarti have turned personal trials into a powerful fashion statement with Chapter 2 Drip. With a flagship store launched in Mumbai just 10 months after their online debut in August 2024 and strategic funding from retail giants Ashni and Kishore Biani, they're redefining what it means to rise above. My colleague Zenia Baria caught up with the sibling duo to dive into their journey. Take a look.
Chapter 2 is about rewriting your story. It's your canvas. Today it's valued at about 38 to 40 crore rupees. Can you tell us about what was the moment of doubt that turned into the spark of you building this brand, and how is it redefining others to rewrite their story?
So, you know, when we went through the tragedy that we went through, we kind of both lost our careers. I stopped getting any acting work, and Shovik had got 96th percentile in CAT. And he was going to a very big, prestigious MBA college, but that's the same time that he got arrested. And so when he came back out, the first trimester was already lost, and so was his MBA career and his future planning. We realized that we wanted to create something that gives people a voice, makes people feel seen, makes people feel heard.
Okay.
And that's when we thought about what could that product be.
Yeah, and I think it's done really well from an online store. It's now moved to an offline in less than 10 months. August 2024 was when you guys started.
Yes.
What's the leap of faith you all took in starting the store?
I did not even have the guts to open a store, because when you open a store, your overheads increase naturally, right? And Bandra, Linking Road, the rents are like ridiculously high.
Soaring.
And I was like, listen, we're doing well online. Let's just stay online.
Right.
Life is easier. But he went and found the place, and then he's like, send me the video, and then he's like, come and see it. You have to see it. We need to open a store, because we also are trying to build a community. So if the community does not have a headquarter,
right,
where are they going to go? So like we're like, okay, we also want to do events. We want to get people together.
Right.
We want to chat with people about their chapter 2s. That can't happen if we're an online store. So it's pretty much
We also did one thing very nicely, is that wherever we traveled, like maybe it be North India, Delhi, Jaipur, Raipur, I realized that online you can't touch and feel the product, right? Offline, as soon as someone touched a product, felt the quality, they're like, okay, wow, the price points are very good, they're reasonable. And I was like, how can we not have an offline space? And agreeing to her that we need to build that community out more.
Talking about expansion plans then, starting a flagship store here, are you all planning to move to other metropolitan cities or tapping into tier 2, tier 3 cities? Where's it headed?
So I feel like, again, he's the one who wants to take all the risks and the chances. And so he's like, come on, let's do this. Let's open like 12 stores. Let's open 14 stores. And I feel like, okay, let's just see how this store does.
Right.
And then if we can, of course, let's open.
Okay. But is there any in the pipeline right now?
The goal is that.
The goal is that. And I think in the next 6 months, we'll take it phase by phase. This has to stabilize a little bit first.
All right.
If it was to me, I would just go all out and do like 12, 15 stores.
Any cities in mind?
Tier 2 is what we want to target.
Okay.
Ludhiana is a place. We're looking at Raipur, we're looking at Jaipur, we're looking at Northern Belt. And we also want to get into the metros, Delhi, Bangalore. So that's the plan. So we're just trying to phase it out. See, this has just been a week over here.
Right. You know, talking about even the funding, you guys got a funding from the Bianis, which is a big move. So can you tell us, go back to the time when you pitched, and how do you go about with the entire thing?
I called them for a podcast just to chat about, like, I thought I'll get some insights.
Right.
But while we were talking and I started asking for advice from sir, he's like, you can give us free equity. I was like, 1 second, I don't want to give you free equity, I can give you equity.
That's such a smart move.
Yeah. So I think it just happened in the spur of the moment, and it just turned out well, because if it didn't happen, then, you know, bahut besti ho jati. You know? On my own show, I called someone. And it was really bizarre, because I called up Shovik as soon as the funding happened, and I said, hey, guess what? The podcast is over and I got funding. He's like, podcast karne gaye the ki kya karne gaye the? So I think that sometimes there's just a plan that destiny has for you, and I feel like that just fell into my lap.
What was that one line that you said, like that, you know, made you more confident as an entrepreneur while you were pitching it?
I think I was already confident about my numbers.
Okay.
I think beyond a point for any entrepreneur, how much ever jagran you give and how much ever you talk about your brand, if the brand is not doing revenue, then nobody will invest in you.
Absolutely.
But I knew that our brand is doing revenue. We were profitable. And that's why I was like, okay, I can tell you what I'm offering you is still a steal deal.
Right.
I didn't go for some crazy 4x, 5x, 6x valuation, which is oftentimes what a lot of startup founders do. I want A-list sharks on my table, so I have to give them a good deal.
It is Friday, and it's time to take a stock of all the deals that happened in the startup world this week. This week saw 16 deals worth over $314 million. Some of the notable deals include fintech firm Grow, which will raise $202 million from GIC and Iconic Capital. B2B e-commerce firm Udan raised $39 million from Lightspeed Ventures and others. That's not all. EV cell swapping operator Battery Smart bagged $29 million from Leapfrog Responsibility, Rising Tide Energy and others, while EV tech player Vecmacon will raise $8.7 million from Avishkar Capital, Bloom Ventures and others. Finally, menswear brand Snitch bagged $7 million in a Series B round from 361, Ivy Cap Ventures, SWC Global Fund and others. This year has seen a total of 389 deals worth over $3.5 billion. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Rhythm this eye of Morgan Stanley. Here we are on day 2 of the Morgan Stanley conference, and Rhythm is as excited and charged up as ever. Pleasure to have you here with us, Rhythm. So tell us, how's the Josh at the conference and otherwise?
Yeah, no, the Josh is high. There's a lot of interest in India, except that it doesn't actually convert into flows, which we'll come to later in this conversation. But yeah, there's a lot of interest.
Rhythm this eye of Morgan Stanley. Here we are on day 2 of the Morgan Stanley conference, and Rhythm is as excited and charged up as ever. Pleasure to have you here with us, Rhythm. So tell us, how's the Josh at the conference and otherwise?
Yeah, no, the Josh is high. There's a lot of interest in India, except that it doesn't actually convert into flows, which we'll come to later in this conversation. But yeah, there's a lot of interest. There's no doubt that people need to understand India from multiple angles. See, I'll tell you how these things have changed. We've been doing this for 27 years. Yeah. So many years ago, people would come because they had portfolios or they were looking to buy stocks in India, and they had to check on companies and understand the macro. That has now changed to the extent that, of course, that people do that for a living and they have to do it. But they also need to understand India from a global perspective. So you're not now just coming to India because you have a couple of investments in India. You're also coming to India because India is moving the world. You know, as I've recently said, the world may not slip into recession this year because of India. Now, it's important to know whether India is going to do well or not, because if India is not going to do well, then the world may have a recession, which is going to have implications on everyone else. So I think India's stature in global markets and in global macro has completely changed in the last 10 years. And we're now significant, we're important. People need to understand this country, even if they don't have investments here. So that is the change.
Before we talk, the usual earnings, valuations and the market targets, just describe to us India's place in this new world, at least for the next 3.5, 4 years, till we have the present US dispensation in place. There's a lot of talk about whether India can, quote-unquote, seize this opportunity as a dislocation in global supply chains. Do you see that happening? I mean, industrial is a sector that, for instance, you're overweight on. What does this new Trump order, global order, mean for Indian companies? And then, therefore, we'll talk about their stock prices.
See, Surbhi, the decision on setting up a local manufacturing facility in India, I don't think has much to do with the tariffs that President Trump is proposing. A lot of these plans were already underway pre-April, and I don't think are changing dramatically because of the tariffs. There may be some delays because people want to have clarity, and that is exactly why global growth is slowing down. Because companies are pushing back on their investment plans, just waiting to see how the environment pans out in the next few months. That aside, there is really no impact on these investment plans. India is still a favored destination for what we call as China Plus One. And one of the primary drivers for that is what I mentioned earlier, that India's home market is very critical to a lot of multinational corporations. You look at the industrial companies from Europe, and they're all telling you that India is going to be a big driver of their growth. You look at the electronics sector, look at phone companies, India is a major part of their growth, and likewise. So that has not changed on April 2nd. So that story is continuing, and India will continue to attract. That said, one thing which we need to bear in mind is India is not becoming the next China. I don't think the world has appetite to create capacities like it did in China in the last 20 years. The unfortunate thing is that the world is heavily indebted and is aging. And therefore, growth on a structural basis for the world at large, ex-India, is likely to be a whole lot slower than it has been in the last, say, 15 or 20 years. And therefore, the appetite to build large capacities is not there. But the appetite to diversify supply chains, the appetite to build facilities in India to cater to India's home market, that's clearly there. So India's manufacturing share of GDP will rise, but you should not be holding your breath for the next China. It's not happening, in my view.
Which is fine. Take your point on that. Then let's talk about earnings. And I think in your latest review, you do speak about how, because of a confluence of a lot of positive factors, you're expecting on a sustained basis, mid to maybe even high teens earnings growth. And I think that's a little above consensus, going by other estimates on the street. What makes you confident that earnings are coming back?
I'm never confident. I'm always skeptical. but we are in an earnings upcycle. Very simply put, earnings tend to move around the nominal GDP trend. The nominal GDP trend in India is largely a straight line, except for the COVID dip when things turned a little bit bad. But that's those rare things that happen. And earnings, of course, do this. So earnings don't go up in a straight line, and we are somewhere here right now. Trend line GDP is here. So this damage happened between 2011 and 2015. Earnings fell well below trend. And now we are playing catch up. And then again, we got a bit of a setback during COVID, and now we're playing catch up. So the likelihood is, and it's very simple mathematics, earnings will catch up with nominal GDP and then go above it. And then that will be the peak of the cycle. I think we're somewhere halfway through that cycle.
We're still away from that peak.
Yeah, we're somewhere halfway. We consider the COVID bottom as the start of this earnings cycle, though I do think the earnings cycle started slightly before that, but COVID has distorted the data. So we are somewhere halfway through that, and it is largely driven by a slow and steady rise in capex. And the reason why this cycle looks more durable than the previous one, which was from 2004 to 2008, is that capex is not going to go up like this. So in that cycle, what happened is capex went up like this and then came down, right? So earnings also went up like this and came down. This time it's more good. I think it's more likely to be like this. Also, a lot of people are saying, oh, there's no capex in India. The reason I think they feel that way is because the nature of capital spending has changed. We're not going to now build the massive steel and cement plants that we saw in that era. Again, a lot of the capex is being written off on the balance sheets. It's not been actually capitalized because that's the nature of capex. And most importantly, in the last 10 years, there's a technical term called incremental capital output ratio, which is how much capital do I need to create 1 unit of output. That amount has actually fallen because India has become more productive.
The other factor has been the technical factor of supply of paper. We've seen massive blocks and massive promoter and PE exits in the last few weeks. How do you read that developments, and is that a red flag according to you?
So, Nimesh, two things I'll say. Is that most people thought that if the mid-cap index fell 20-25%, retail will run away. So first of all, let us accept that retail is not a short-term player. And if you talk to people, really large distributors on the ground, and you should interview some of these people because they have a far better handle on the retail sentiment than the people who are actually managing the money. Okay, so they will tell you that retail in India is not looking at their prices every day. They're not your audience. They're buying the stocks and just going to sleep. Okay, And that's, you know, the average holding period, I've done this computation, of Indian retail investors is 36 months. Nowhere on the planet do any class of investors hold stocks that long as the average investor in India holds.
And I remember you saying this for many years now, that the retail money is very sticky and it's only going to surprise on the upside.
Yes, so that is done. Okay, now as far as supply is concerned, yes, we had a little bit of bunching up, but that was in 2023. Okay, there was a bit of a bunching up that happened. And then things
Even
eased.
now we are seeing this 4-5 deals every day.
But you have to add up the numbers and you have to divide it by the market cap. So whatever number you see, whether it's a weekly or a monthly number, if it's a monthly number, multiply it by 12 and divide it by market. That number, if it starts crossing 2.5-3%, then I will get worried. What is 2.5-3%? It's $10 billion of issuance every month for 9 to 10 months on the trot. We're not there as yet.
You're not there, of course.
We are going to get there, but we're not there. When we get there, the market will have to correct, because I think that will then exceed the bid on stocks.
I'm going to come back to that first point that you made, right? And you asked that question before we could, which is that when are these foreign investors coming? Because the narrative is strong, the macros are strong. And there's this big shift about diversifying away from US assets, right? Yeah. But where will we figure? Because China is a great competitor and maybe the argument is they have valuations on their side.
So the China valuations have always been on the Chinese side for 25 years. There's not been a single year in the last 25 that China traded at a premium to Indian X stocks. Okay? Yet, in the last 25 years, India has handsomely beaten Chinese stocks. So if you invest in stocks looking at P ratios, it's a disaster. Price to earnings has nothing to do with value.
Is that what you're telling the foreign clients?
No, I'll explain this to you. Give me a little minute. Give me a little time. So price to earnings is just another way of expressing price. You can express price in US dollars. I can say this is worth $6. Then I can say it's like worth half a gram of gold. I mean, its price. Its price is 500 rupees, or its price is 5 times earnings. Value is something very different. It's about a company's ability to generate cash flows and what expected return I have from that. So the reason I can't explain this is because a lot of the tourist money is also very lazy and wants convenient thumb rules to make their decisions. And very wrong. Okay, you look at private sector banks in India 25 years ago. They all traded significantly higher price to multiples than today. Yet for 20 years, they were amongst the best performing stocks in India. Yeah. If the starting point of price to book or price to earnings is going to determine what return you make, then I think then investing would be a very easy game.
Yes.
So it's not so simple. In my humble opinion, and it's not even humble, I think stocks are cheap. Okay. Stocks are inexpensive in India. I wrote that day before yesterday. My title of my report is Equities are inexpensive. Bond yield in India, 10-year bond yield is 6.2%. The equity yield is 5%. India is a growth market. The gap is -1%. This is cheap. Yeah. Look at Nifty in gold ounces. Either gold prices fall or Nifty goes up. It's cheap.
That's refreshing. Indian stocks are cheap. We don't hear that every day. So to complete...
So the reason I'm saying that is because as a consequence of the policy decisions that we have made in the last few years, we have dampened our inflation volatility, which therefore means we have dampened our interest rate walls. And if interest rate walls are low, growth walls are low. Yeah. Equities thrive in a predictable growth environment. If you can figure that a company has a 20% CAGR in growth for the next 5 years, you will pay 60 times earnings for it. Yeah. You're not going to say, oh, 60 is expensive, because predictability of earnings or predictability of dividends, to be more precise, is the trickiest thing in equities. It's not the issue in bonds. In bonds, you know the coupon and you know it exactly for how many years. So there's no valuation debate in bonds. The debate arises not only because of this, that your forecast and my forecast on cash flows is different.
Now that's
justifying the bull.
That's the India bull, turning the valuation argument on its head, and that tells me why.
So it's logical as well.
It's not about turning it. This is not a spin. This is the fundamental reality.
Perhaps a different lens.
Now, see, I can go wrong on my cash flow forecast. And that's why I will go wrong on stocks, not because they're trading at 20 times earnings.
Yeah, that explains why the 1 lakh target on the Sensex is intact, the bull case. All right, Rhythm, fantastic conversation. Thank you so much for taking out the time and being with us.
Morgan Stanley sees a serious growth slowdown due to the tariffs. It expects US growth to slow from 2.5% in 2024 to 1% in 2025. Global growth is expected to slow from 3.3% last year to 2.9% in 2025. Asia's from 4.6 to 4.3, as the table is indicating. And India's growth is expected to slow from 6.7%. This is calendar, okay? Calendar 2024 to 6.2% in calendar 2025. Now, what does this mean to inflation, interest rates, yields, dollar, rupee? I have with me Chetan Ahya, the chief Asia economist for Morgan Stanley, joining us from the sidelines of their conference. Good morning, Chetan. Thank you very much indeed for your time. Well, let me start with my India bias. The latest GDP numbers were stronger than expected. It beat our poll even in a full year basis. So our poll said 6.3. The numbers come at 6.5. Does that enthuse you a bit that India may do better than the 6.2 you have forecast for the current year?
Yeah, I think it's possible. But look, I know the GDP numbers were a bit stronger. But if you look at it adjusted for the indirect tax effect, then the number was 6.8. So I think the underlying number was less robust than the headline number. But nevertheless, I think it's definitely indicating that India is at least having a starting point before the tariff effect takes in. Which is, it's much stronger than, in fact, everybody in the rest of the world as well.
Okay. So it's possible that our FY, I mean, yours is a calendar forecast. Will the FY forecast have an upward bias? Is there a chance it'll be upped?
Well, I think at this point of time, we are saying that the risks are like balanced, because, from a global perspective, you have this tariff uncertainty. And, our global team thinks that there are downside risks to that global view, which lends some downside risk to India numbers as well. But at the same time, the India-specific factors, i.e. that policy support has been great. As you saw, March number for both central and state government for CapEx were extremely strong. So the starting point for India is from the policy support such that you could have that downside risk being balanced by the domestic factors. So at this point of time, Lata, we are still maintaining our base case growth numbers for India.
Okay. Let me come to disinflation. You make a strong case that disinflation is likely to continue in Asia. Will that apply to India as well? Very strong disinflation?
Yeah, exactly. I think all the points that we're thinking about for the region is applicable to India. The starting point of inflation is low, i.e. that it's actually below target. You have lower oil prices. You have this tariff effect, which is deflationary for emerging markets and Asia and India. And at the same time, you have the strength in the local currencies in the region, including INR. All of these factors mean that inflation is likely to remain below 4%, and that actually provides great comfort to the RBI to go ahead and take up rate cuts.
Okay, and that's what I was coming to. If I mean, your inflation forecast will run alongside as you speak. You have a 3.8% inflation for the full year, and yet you say that the RBI will give only 2 more cuts. Why can't they go more aggressive if your expectation is that by Q4 we go as low as 3.6? Isn't there space for more cuts?
Well, I think the framework that we are approaching this is that, you will have real interest rates in the ballpark of about 1.5%. Okay. And considering that, we are not expecting a big dent to India's growth story, since growth conditions will still be reasonable, we think RBI should take up 2 more rate cuts. Now, if we are seeing further downside to our growth numbers, then we are saying there's a possibility the RBI does 75 basis points instead of 50 basis points more. But I think anything more than that would really be dictated by the growth outcomes. They have to be much worse than what we are building in right now.
Okay, much worse than the 6.2% that you all are factoring in right now.
That's right.
Okay. Well, let me come to the dollar. You know, we have been surprised by the kind of weakness that we have seen. Will this pass? Do we see it go back above 100, the DXY that is? Or is dollar likely to remain, you know, a weaker currency?
Well, our house view is that the dollar will remain weak. We are expecting another 9% odd depreciation in the DXY. We think euro and yen are going to be appreciating strongly against the dollar, but also emerging markets will see some upside. Not as strong as euro and yen, but they will also see some upside. So yeah, that's the dollar view. The driver for that thinking is essentially twofold. That tariff-related uncertainty plus the additional policy actions that the U.S. has taken will slow U.S.'s growth more. Just if you take the example of, you know, growth differentials between U.S. and Asia, U.S. will slow from 2.5% in fourth quarter last year on a year-on-year basis to 1.1% by fourth quarter of this year, whereas Asia in all will slow by 90 basis points. So U.S. will slow by 150 basis points, Asia will slow by 90 basis points, and India will slow even less by like 50 basis points. So we are going to have that dynamic where growth differentials are moving back in favor of Asia and also rest of the world. And then the other driver is that the U.S. is running relatively high fiscal deficit, which is in turn drawing current account deficit of 4% of GDP. These are the main fundamental factors. And on top of it, there are some concerns related to you know, the provision that they have made in the bill that has been passed in the House. It's called Section 899. That is raising some concern in investors' mind about potential taxing of income from investments in the U.S. So I think a whole lot of factors are at play, but net-net we are expecting this weaker dollar trend to continue.
Yeah, actually, the Section 899 has not been discussed enough, probably because it impacts OECD countries more. But be that as it may, what is your US team telling you about US yields and the Fed action? I mean, can we continue to have such a interest rate differential narrowing between India and the US?
So we are expecting the U.S. 10-year bond yield to go down to 4% by end of this year. And the assumption that we are making is that as U.S. growth slows and job growth slows, market will begin to price those rate cuts that we have, a lot more of those in 2026. But market gets ahead of that and starts to price in from the back half of this year. And that's how we are seeing 10-year bond yield going down to 4%. So, yes, there are concerns on fiscal deficit, but to the extent to which the private demand will slow, that will result into job numbers slowing and then expectation that the Fed will cut rates.
Chetan, you know, there is one factor that is not getting discussed enough in terms of growth, and that is the way in which China is sitting over the rare earth magnets. You know, it was a month ago that Rajiv Bajaj told us that I fear we don't have enough rare earth magnets and the Chinese are stopping them. Yesterday, we had Sudarshan Venu of TVS telling us, and today we understand SIAM, the Society of Indian Automobile Makers, has written to the government saying that, you know, production can come to a standstill. Will this be an unexpected quarter, the area which can impact our growth, the Chinese behavior?
Well, I think that risk is there, but from what I understand is that there is a process that China government has put out, and unfortunately, if the process is such that every country and every country's private institutions have to give some kind of an undertaking, to indicate that this is not going to be used for defense. That process is a very time-consuming process. If you want to deal with the whole world in an individual manner, so I think that time limit that is involved in processing those documents and requests is what is, I think, causing that delay.
Let me come back to India and Asia. How do you expect currencies to behave? You said that your team is expecting dollar depreciation to be a theme, continued theme. Do you expect rupee strength? How will the dollar rupee behave?
Yeah, we are expecting strength in rupee as well. In fact, we are expecting a modest 2 to 3% appreciation across the region. But, one of the main anchors for region will be RMB, right? And for RMB, to the extent to which they have deflation problem in China, we think that there will be less appetite on the part of the Chinese policymakers to resort to some meaningful appreciation, like what you're seeing in euro and yen. And at the same time, tariffs are unfortunately going to hit China the most. So both those factors, we think, will mean that RMB will sort of constrain the overall, region's currency appreciation. It won't be as strong as what you're seeing in euro and yen.
Okay. So you're likely to see a very rangy movement. Just a final point. Is this pain about to last for a year more? Because then the US midterm elections come in, and then low growth and high inflation could become election issues. So do you think there's greater relief in FY26 for India and for Asia?
Yeah, I think we should see an improvement in growth trajectory for back half of this financial year itself. Because, we are seeing that tariff effects will be most acutely affected until fourth quarter of this year. And then from first half of calendar year next year, you should see improvement in growth across the world, but particularly out in India as well.
Rhythm Desai of Morgan Stanley. Here we are on day 2 of the Morgan Stanley conference. And Rhythm is as excited and charged up as ever. Pleasure to have you here with us, Rhythm. So tell us, how's the Josh at the conference and otherwise?
Yeah, no, the Josh is high. There's a lot of interest in India, except that it doesn't actually convert into flows, which we'll come to later in this conversation. But yeah, there's a lot of interest. There's no doubt that people need to understand India from multiple angles. See, I'll tell you how these things have changed. We've been doing this for 27 years. Yeah. So many years ago, people would come because they had portfolios or they were looking to buy stocks in India. And they had to check on companies and understand the macro. That has now changed to the extent that, of course, that people do that for a living and they have to do it. But they also need to understand India from a global perspective. So you're not now just coming to India because you have a couple of investments in India. You're also coming to India because India is moving the world. As I've recently said, the world may not slip into recession this year because of India. Now, it's important to know whether India is going to do well or not, because if India is not going to do well, then the world may have a recession, which is going to have implications on everyone else. So I think India's stature in global markets and in global macro has completely changed in the last 10 years. And we're now significant, we're important. People need to understand this country, even if they don't have investments here. So that is the change.
Before we talk, the usual earnings, valuations, and the market targets, just describe to us India's place in this new world, at least for the next 3.5, 4 years, till we have the present US dispensation in place. There's a lot of talk about whether India can, quote-unquote, seize this opportunity as there's a dislocation in global supply chains. Do you see that happening? I mean, industrial is a sector that, for instance, you're overweight on. What does this new Trump order, global order, mean for Indian companies? And then, therefore, we'll talk about their stock prices.
See, Surbhi, the decision on setting up a local manufacturing facility in India, I don't think has much to do with the tariffs that President Trump is proposing. A lot of these plans were already underway pre-April, and I don't think are changing dramatically because of the tariffs. There may be some delays because people want to have clarity, and that is exactly why global growth is slowing down. Because companies are pushing back on their investment plans, just waiting to see how the environment pans out in the next few months. That aside, there is really no impact on these investment plans. India is still a favored destination for what we call as China plus one. And one of the primary drivers for that is what I mentioned earlier, that India's home market is very critical to a lot of multinational corporations. You look at the industrial companies from Europe, and they're all telling you that India is going to be a big driver of their growth. You look at the electronics sector, look at phone companies, India is a major part of their growth, and likewise. So that has not changed on April 2nd. So that story is continuing, and India will continue to attract. That said, one thing which we need to bear in mind is India is not becoming the next China. I don't think the world has appetite to create capacities like it did in China in the last 20 years. The unfortunate thing is that the world is heavily indebted and is aging. And therefore, growth on a structural basis for the world at large, ex-India, is likely to be a whole lot slower than it has been in the last, say, 15 or 20 years. And therefore, the appetite to build large capacities is not there. But the appetite to diversify supply chains, the appetite to build facilities in India to cater to India's home market, that's clearly there. So India's manufacturing share of GDP will rise, but you should not be holding your breath for the next China. It's not happening, in my view.
Which is fine. Take your point on that. Then let's talk about earnings. And I think in your latest review, you do speak about how, because of a confluence of a lot of positive factors, you're expecting on a sustained basis, mid to maybe even high teens earnings growth. And I think that's a little above consensus, going by other estimates on the street. What makes you confident that earnings are coming?
Hello and welcome to Global Eye. I'm Parikshit Luthra. The top story we are tracking this evening. China's grip on rare earth magnets has left the global auto industry in a bind. The Chinese government has imposed export restrictions on the magnets due to national security concerns. Importers will now have to provide an end-use certificate to ensure that the magnets are not being used for making weapons, without this end-user certificate, China will not export the magnets. They will also have to provide assurance that there will be no transfer to a third party. So why does China have an edge when it comes to rare earth magnets? Let's take a look. China accounts for around 70% of the total mining of rare earth metals and holds nearly 90% of the global production. The impact on Indian auto industry is estimated to be quite severe and steep. The industry's annual demand for rare earth magnets stands at around 850 tons. The total import cost would be around 310 crore rupees. So the cost is not much, but why are these magnets so important? Well, rare earth magnets are 10 times stronger than conventional magnets. They help maintain performance at high temperatures and have a longer lifespan as well. These magnets are largely used in components that are essential in manufacturing both ICE and electric vehicles. Without these magnets, it will be impossible for companies to produce components, and production could come to a halt. And this includes components such as e-axle, speedometers, crankshaft sensors, ignition coil, electric water pump as well. So what are the next steps the government will have to take? In the short term, the centre will have to engage with China to fast-track approvals and seek exemptions from end-use certificates. In the medium term, the government will have to look at partnering with other nations, including Australia and Vietnam, along with building a domestic supply chain. Lastly, in the long term, the government will have to consider a PLI-like scheme for self-reliance and provide financial incentives to large companies. And all of this is essential to make sure we can manufacture rare earth magnets in India. We're now joined by Jeffrey Pyat, Senior Managing Director for Energy and Critical Minerals at McLarty Associates. He was also the former U.S. Assistant Secretary of State for Energy Resources. Mr. Pyat, thank you so much for joining us on the program. Let me begin by asking you, Trump and Xi Jinping have had a phone call. Donald Trump has said that this was a successful phone conversations where they also discussed rare earth metals. do you think if Trump and Xi Jinping have a breakthrough in those trade tensions, then globally China would give a reprieve to everyone on the rare earth magnet issue?
Parikshit, good evening. It's good to be with you. I think there's certainly the possibility of a short-term understanding as part of the broader U.S.-China trade negotiations. But I don't think that changes the message to all of us from this Chinese export control. What's happened in the past few weeks reminds me very much of May of 22, when I was U.S. ambassador in Greece and Gazprom began to restrict sales to the European Union, starting with Bulgaria. It's a wake-up call, demonstrating that China is not a reliable supplier. So what we need to do is exactly what you suggested in your intro segment, which is to develop the alternative supply chains, to make the investments required to bring the processing back to our countries, back to reliable suppliers, and to work together as the United States, as India, in the Quad perhaps, in order to build the alternative supply chains that will provide the greater volumes of these materials we're going to need for our energy transition, but in a way that doesn't jeopardize the security of our economies.
Right. Ambassador, when it comes to China, China not only dominates rare earth resources, but also the processing of it in China itself. Could you give us a sense of to what extent does China control the rare earth supply chain, not just in Southeast Asia, but also in countries all the way into Africa, into Brazil?
So 2 points. First of all, rare earths are not exactly rare. They are called rare earths because the materials are difficult to separate. But the geological resource is widely dispersed. Brazil, for instance, has substantial rare earths resources. We have the same here in the United States. And it's important to remember also, Parikshit, that while it's auto supply that's getting the headlines right now, these magnets are used across our economies, importantly for India and the United States in defense applications like F-35 aircraft. They are essential to wind turbines, like the turbines that GE Vernova is building there in Pune, where I visited about a year ago. They also are in every one of our cell phones. The vibration motors that when you put your phone on silent mode, those use rare earth magnets. So these are materials that are pervasive to our modern digitized economy. Because we weren't paying attention, for the better part of 2 decades, we allowed China to achieve a near monopoly in the processing of these magnets. But we are beginning to develop diversification. I was in Brazil last year, in Minas Gerais, where the state government has a national rare earths processing industry. Ironically, Brazil is a major producer. Most of their rare earth clays are exported to China and then come back in the form of industrial imports. Likewise, in the United States, we have MP Materials, a company which is mining rare earths in the United States. Until very recently, MP Materials was exporting for processing in China, but now they're accelerating their plans to develop a national processing supply chain. That's exactly what we need to do. We need to do it working together. For instance, we have the example in India of Epsilon Materials in Bombay, which has developed a national supply chain for graphite anode material for batteries, another material that on which China has placed export controls. So we know how to do this. What we have to do is work together to develop the alternatives.
Right. Ambassador, what I'd also like to ask you, and you said this in a previous interview, that US has 1.3% to 1.4% of rare earth reserves globally. India has quadruple of these reserves. Now, from your experience and understanding, you were someone who in the State Department was dedicatedly looking at this issue. Weaponization of critical rare earths, critical minerals. How soon can India, if we get onto this in a mission mode, how soon can India set up at least a domestic supply chain for assembly, processing and recycling of used rare earth magnets?
So I mentioned earlier, Parshit, the example with Russian gas. And if you look at what happened to Europe in 2022, there was short-term disruption, just as there's short-term disruption right now in auto industries because of these Chinese magnet controls. But what came out at the end was a more sustainable and more secure situation. I'm very proud of the fact that when I was in government, I led the effort to bring India into the Mineral Security Partnership, something that was announced when Prime Minister Modi and President Biden had their state visit 2 years ago in summer of 2023. And that has created a framework for our governments to work together. I was deeply impressed by the partnership, the work that we did together with Secretary Mines, K.L. Kantha Rao, and the effort that the Ministry of Mines has been making to identify the opportunities that you described in your intro, looking at the PLI process, looking at the capacities of Indian industry, whether it's Tata Materials or what's happening in the auto industry itself. I remember 2 years ago when I was in Bombay, I had the opportunity to catch up with my friend Anand Mahindra. And then I traveled to Pune to see what Mahindra Autos is doing with its EV manufacturing, which is deeply impressive. But we all became complacent about some of the upstream inputs. And China has now demonstrated a willingness to exploit that complacency in order to weaponize its monopoly control. So the answer is not to negotiate a new agreement with China. The answer is to develop diverse and reliable supply chains. And that's going to be easier if we're working together to mobilize our resources. For instance, the geological resources that India enjoys in its territory, but also the capacity of Indian and American industry to work together. For instance, in East Africa, a region where Indian industry has a very strong presence, or in Southeast Asia. And I mentioned earlier the Quad, where we have a good example already of cooperation between Japan and Australia through Linus Rare Earths, an initiative of those two governments after China placed controls on Japan's rare earth supply chain. But we should be taking that example and projecting it out into the political construct that the Quad provides for our four countries.
Right. Those are very strong long-term recommendations that you're making, Ambassador, and we're glad to hear that. But, you know, in the short term, there is a worry. We've been speaking to electric vehicle manufacturers in India like Bajaj Auto, TVS Motor Company, and they've gone on to the extent of saying that you'll bring the industry to a halt because you cannot manufacture electric vehicle motors, other ICE equipment without these rare earth magnets. The only supplier right now is China. We can't diversify so quickly. In the short run, what can we do to secure our supply chains to make sure our manufacturing does not get affected?
So first of all, we have to negotiate smartly and collectively because, yes, we are dependent on China, but China is dependent on us because their industry cannot absorb all of their output. So you have significant Chinese firms that are going to be lacking in a market if the government does not relax these controls. That's why I said I'm confident that we can find a pathway for some kind of a negotiated solution over the short term. But we need to be smart about it and not allow a situation where we all say, well, that was unpleasant, but let's go back to being dependent on a sole source of supply. We need to invest in alternatives. Right. That's exactly what we've been doing with the Mineral Security Partnership in the Biden administration. And I'm glad to say India was one of the Biden administration's strongest partners in understanding the imperative of developing the alternative supply chains that we have the capacity to accomplish. This is a financial problem. Right. It's not an innovation problem. Our companies know how to do this. We just need to build the market and the supply chain so that we don't find ourselves in a position where China can use its resource control as a sword hanging over our throats.
Right. Ambassador, what's your worry for U.S. manufacturing, U.S. electronics majors, electric car companies like Tesla for that matter, or even Ford. How do you think, how badly would they be impacted because of these restrictions on rare earth magnets?
Well, Parkshi, just like in India, this is front page in the business sections right now. There was a long Wall Street Journal article yesterday reporting on some of the discussions among our big Detroit auto manufacturers. The Wall Street Journal reported that Ford has already slowed down production of one of their large electric vehicle models. The reporting has also pointed to efforts both to identify alternative supplies where possible. That is to say, using less powerful, less durable magnets. But if you do that, you're going to have a less competitive product. And that's why we have to make the investments in alternative supplies. If you look at what MP Materials is doing in the United States, they are scaling up their alternative supply chain very rapidly. But they have an exclusive supply agreement right now with General Motors. That was struck several years ago. In retrospect, it looks like a very forward-looking move by both companies because they recognized that this was a key vulnerability in the EV supply chain. And again, I want to emphasize something that I'm sure officials in South Block are also focused on. This is not just an auto industry question. And in particular, it has implications for our defense industry because of the application of these magnets, in particular in areas like electromagnetic sensors and fifth generation fighters like the F-35. So this is a national security challenge as well, and we need to meet it in that spirit.
Right. You're absolutely right. This is not just a manufacturing issue or a supply chain issue. It is a national security and almost a war-like scenario, because if you weaponize supply chains around critical minerals, around semiconductors, around rare earth magnets, this is in a way a war, so to say. Having said that, the big worry right now, Ambassador, in the industry here is what if China puts similar restrictions on lithium batteries? That would also cripple the automotive industry, not just in India, but worldwide as well. What do you think India and US can do right now? Do you think Trump administration is critically looking at this issue with the Indian government under the compact framework? Recently, we saw Vikram Misri, the foreign secretary, visiting the United States. This was one of the key issues on the table. Do you feel that this is something that is getting a lot of attention from the Trump administration vis-a-vis India?
It certainly is getting attention vis-a-vis the Trump administration, but it's also an issue of wide concern and bipartisan concern in our Congress. And what I would highlight, Parkshi, is that we have more than 2 years of history of India and the United States collaborating closely on these issues. This was a huge part every time I visited New Delhi, precisely because of the expectation we had at the time that China was going to continue to leverage its controls over these vital inputs to the clean energy economy. So I mentioned already the example of Epsilon Materials. In the solar space, of course, the two largest investments in the world by our Development Finance Corporation, with Tata Renewables in Tamil Nadu and First Solar. We need to take exactly the same approach on batteries, on anode material, on other key clean tech inputs like hydrogen electrolyzers. You have the example of Greenco in Hyderabad, which is working in this area. India is on the right path with its PLI scheme, and recognizing that government needs to play a role in putting in place the incentives that will reshore some of these key inputs. And we're having a debate in our US Congress this very week over the same issues for our Inflation Reduction Act, which you can think of as an American version of the PLI scheme.
All right. Ambassador, thank you so much for joining us with that comprehensive perspective on where the problem lies with regard to rare earth magnets, how critical this is for India and the United States to work together, not just to negotiate a short-term solution with China, but also for looking at long-term supply chain resilience around that. We're taking a short break, but don't go anywhere. China's stranglehold over supply of rare earth magnets has caused concerns among Indian auto companies. A special discussion with Puneet Gupta of S&P Global Mobility on the other side. Stay tuned.
I'm never confident. I'm always skeptical. but we are in an earnings upcycle. Very simply put, earnings tend to move around the nominal GDP trend. The nominal GDP trend in India is largely a straight line, except for the COVID dip when things turned a little bit bad. But that's those rare things that happen. And earnings, of course, do this. So earnings don't go up in a straight line, and we are somewhere here right now. Trendline GDP is here. Okay. So this damage happened between 2011 and 2015. Earnings fell well below trend, and now we are playing catch up. And then again, we got a bit of a setback during COVID, and now we're playing catch up. So the likelihood is, and it's very simple mathematics, earnings will catch up with nominal GDP and then go above it. And then that will be the peak of the cycle. I think we're somewhere halfway through that cycle.
We're still away from that peak.
Yeah, we're somewhere halfway. We consider the COVID bottom as the start of this earnings cycle, though I do think the earnings cycle started slightly before that, but COVID has distorted the data. So we are somewhere halfway through that. And it is largely driven by a slow and steady rise in capex. And the reason why this cycle looks more durable than the previous one, which was from 2004 to 2008, is that capex is not going to go up like this. So in that cycle, what happened is capex went up like this and then came down, right? So earnings also went up like this and came down. This time it's more good. I think it's more likely to be like this. Also, a lot of people are saying, oh, there's no capex in India. The reason I think they feel that way is because the nature of capital spending has changed.
Yeah.
We're not going to now build the massive steel.
Welcome back. You're watching Global Eye. China's stranglehold over supply of rare earth magnets, a critical component used for manufacturing electric vehicles, has caused concerns among Indian auto companies. Leading automakers have warned that the issue has the potential to impact production massively if it is not addressed on war footing. So what are the options available for Indian EV makers? Puneet Gupta of S&P Global Mobility is with us. Puneet, first of all, which automakers do you believe will get more impacted in the month of June and July?
Right. Hi, Parikshit. Nice to be here. So I think one thing is very clear, auto industry is going for another crisis, right? So we have multiple crises. I think you talked about semiconductor crisis, supply chain crisis, COVID crisis, and I think now rare earth material crisis. So I think though, as per our analysis, we clearly see, that June we may skid off, right? So June may be a month which will go in tensions, but, July is a month, where we may see production halts, and where, I think industry will start panicking. And already I think we know that this year, when we started the year, every OEM, was talking about a tepid growth, a very low single-digit growth. And now any production halts, can really be linked, to a negative growth, where industry may be heading to. So now if you talk about OEMs, so one thing is very clear that, obviously the OEMs which are large manufacturing large volumes, so they will be more probable, to default. So it may be players like TVS, which may be on radar, or maybe players like Maruti Suzuki. But we personally feel, that July is a month, where we will really see, things becoming more, tricky for the industry.
All right. Okay, so July would be when things become tricky. Is there alternative right now in terms of getting these rare earth magnets? Are the suppliers only in China, but are they there in Vietnam for that matter, Australia, Japan, Ukraine, United States? Are there any processing facilities there from where magnets can be procured?
Yeah, so I think generally, magnets, so companies have been, like if I talk about Tier 1, Tier 2 suppliers, they have been keeping such inventories, for 3 to 6 months. But then, if you really talk about, there can be even one supplier, who may be working, or who may have low inventories. So I think obviously right now there is a clear rush, clear race, towards procuring even sub-assemblies, for example, from other countries, if possible. So I think we may see those things happening, but I think the best solution, would be, quick diplomatic talks, and maybe then, obviously our supporting associations, rushing toward China, and supporting, and expediting the whole consignment. So, but I think obviously even if there are alternatives, you may not be able to, immediately incorporate them in your components because they may lead to low performance, which is critical. And also you need a lot of homologation before you really get on and change your raw materials.
Puneet, but it's not just EVs. Rare earth magnets are also used in ICE components. Certain components are common to ICE and EVs, and some are there only in ICE for that matter. They're also used in speedometers. Speedometers are used everywhere. So not just electric vehicles, but even in terms of ICE cars, ICE EV, ICE two-wheelers and three-wheelers, what's the kind of impact that you are estimating?
Yeah, so I think if we see, 7 rare earth elements which have been where the restriction is there, for example, cerium, right, clearly impacts the catalytic converters. If you talk about terbium, really impacts the lighting, because that gives the color. So I think every of these rare earth elements, impact different category of components. So you are absolutely right. It is not only the EVs, which will fare this restriction, right? It will be across segments, across category of vehicles. And, but yeah, one thing what we can clearly say that, vehicles which are having higher variants, the models with higher variants will obviously be more probable, in terms of disruption. So primarily, here how we see is that OEMs may be looking for, restructuring their model mix, or really rethinking around what can be done with the variant mix, because that's a clear strategy, because, is it really make sense to make Swift or focus on Swift Desire, for example, so, or focusing on mid-end variants or low-end variants, rather than high-end variants. So I think all those equations, have to come in picture, and obviously, as I said, sub-assemblies can also play a critical role.
All right. Thank you very much, Puneet, for joining us on the program. Clearly a big worry for the auto industry right now. And even the ICE industry, as you're pointing out, will have to start making choices on how they want to prioritize production for the highest amount of revenue and not to lose out on profits as well. With that, it's a wrap on this edition of Global Eye. Thank you for watching. Stay tuned to CNBC-TV18. News continues on the other side.
Plants that we saw in that era. Again, a lot of the capex is being written off on the balance sheets. It's not been actually capitalized because that's the nature of capex. And most importantly, in the last 10 years, India's, and there's a technical term called incremental capital output ratio, which is how much capital do I need to create 1 unit of output? That amount has actually fallen because India has become more productive.
The other factor has been the technical factor of supply of paper. We've seen massive blocks and massive promoter and PE exits in the last few weeks. How do you read that developments, and is that a red flag according to you?
So, Nimesh, 2 things I'll say is that most people thought that if the mid-cap index fell 20-25%, retail will run away. So first of all, let us accept that retail is not a short-term player. And if you talk to people, really large distributors on the ground, and you should interview some of these people because they have a far better handle on the retail sentiment than the people who are actually managing the money. Okay, so they will tell you that retail in India is not looking at their prices every day. They're not your audience. They're buying the stocks and just going to sleep. Okay. And that's, the average holding period, I've done this computation, of Indian retail investors is 36 months. Nowhere on the planet.
Hello and welcome to India Business Hour. I'm Ashmit Kumar and here are the headlines that we're tracking this evening. RBI Monetary Policy Committee springs a surprise by front-loading rate cuts to boost growth. Repo rate cut by 50 basis points, CRR cut by 100 basis points. RBI Governor says no more room left for easing and the stance changes from accommodative to neutral.
इन्फ्लेशन पे अब काफ़ी जो है नियंत्रण में है और वो जंग जो है हम ये मान सकते हैं कि उसके ऊपर में हमने जीत हासिल कर ली है.
Governor Malhotra says it is safe to assume that RBI has won the war against inflation. RBI also leaves FY26 growth forecast unchanged at 6.5%, says there is room for improvement. Gold financiers cheer as RBI set to ease gold loan rules, also proposes to do away with credit appraisal for small ticket loans up to 2.5 lakh rupees after a nudge from the government. RBI's growth bazooka lifts the large street. Sensex gains over 1%. Nifty reclaims 25,000. Bank and real estate stocks rally. US President Trump and billionaire Elon Musk trade insults as their relationship implodes in full public view. Trump threatens to cancel federal contracts and tax subsidies. Musk calls for Trump's impeachment and mocks his connections with convicted sex offender Jeffrey Epstein. Government allows Starlink to provide satellite internet services in India. The Elon Musk-backed company is the third after Bharti's OneWeb and Reliance's Jio to secure a SATCOM license. The telecom department is yet to approve regulators' recommendations on allocating spectrum to SATCOM companies. The competition watchdog is likely to order a probe against Asian Paints based on a complaint filed by Birla Opus. Sources tell us the Aditya Birla Group company has alleged abuse of dominant market position by Asian Paints. Government considering a performance-linked incentive-style framework to boost local production of rare earth magnets to cushion the impact of Chinese curbs. Talks, however, are only at an early stage. A sign of thaw in the strained relationship between India and Canada. Prime Minister Modi accepts an invitation to attend the G7 summit after a phone call from Canada's new Prime Minister, Mark Carney. PM Modi says both nations will work together with renewed vigor. Russian missiles rained down on Ukraine's capital, Kyiv, killing 4 people. This comes after Russia's President Putin promised to retaliate after Ukraine destroyed dozens of Russian fighter jets. Israel bombs Lebanon's capital, Beirut, despite a ceasefire agreement with the Hezbollah. No food distribution in Gaza for the third straight day as the aid agency backed by the US and Israel remains shut. The United Nations warns that children in Gaza are suffering from acute malnutrition. Bengaluru police arrest one RCB official and an event management executive after 11 people died in a stampede during the IPL victory celebrations. 2 more people also taken into custody for their alleged involvement. Well, here's the top story this evening. The RBI Monetary Policy Committee has surprised the street with a bigger than expected repo rate cut of 50 basis points. The repo, which is the interest rate at which the RBI lends to banks, now stands at 5.5% after 3 consecutive cuts. 5 out of 6 members voted for the 50 basis point cut. It is not just the repo rate. The RBI has also decided to reduce the cash reserve ratio by 100 basis points in 4 equal tranches starting from September. Cash reserve ratio is the percentage of a bank's total deposits that must be held as reserves. Governor Sanjay Malhotra said that rate cuts have been front-loaded to give certainty to the markets. The policy stance has been changed, however, from accommodative to neutral, and the governor made it clear that there is no room for any further easing.
There is now very limited space for the monetary policy, actually, given the current circumstances. And you are aware of the current circumstances, which is that growth is at about 6.5%. Inflation, we are projecting at 3.7% for this year. And next year, it's above 4, it's 4.5% or roundabout. So given these current if these were to play out, there is very limited space, is what MPC says, and that's why it has been reduced now. We have changed now to neutral.
Well, just as Governor Malhotra was mentioning there, the RBI has left the FY26 GDP growth forecast unchanged at 6.5%, while adding that there is room for improvement. The FY26 inflation forecast has been cut to 3.7% as against the earlier estimate of 4%. However, inflation is expected to inch higher towards 4.5% by the end of this financial year. Governor Malhotra said it is safe to assume that the RBI has won the war against inflation for now.
इन्फ्लेशन आपको मालूम है, मुद्रास्फीति इन्फ्लेशन पे अब काफ़ी जो है नियंत्रण में है और वो जंग जो है हम ये मान सकते हैं कि उसके ऊपर में हमने जीत हासिल कर ली है। एक मैसेज है क्योंकि हमने 4% से उसको घटा करके जो हमारा अनुमान था उसको 3.7% किया है मुद्रास्फीति को। उसी प्रकार से जो ग्रोथ है वो 6.5% है, अच्छी है, लेकिन उसमें और गुंजाइश है उसके अंदर में और बढ़ोतरी होने का।
What can we say about the governor's performance today? It was more like one of those swashbuckling T20 batsmen, Sai Sudarshan or Virat Kohli, just coming out and hooking sixer on sixer, a double rate cut and 100 basis point cash reserve ratio cut. This is, I can't remember when we last had such an easy policy. Cutting by 100 basis was probably after the Lehman crisis or something. So this is a very big giveaway, gift for the markets and for the borrowers. But he immediately turns out to be a Rahul Dravid or someone, because he comes and says in the next sentence that I'm changing the stance from accommodative to neutral. What it basically means in plain English is that the chances of more rate cuts are not there. All he has done, he has advanced a possible August rate cut to June and given 2 cuts in June. But the only way to read this is that there are probably no more rate cuts. There are some people who are, focusing on possibility later on. But when we asked the governor, inflation is at 3.5%, he pointed out that next year it is 4.5%. So clearly, it didn't look like a governor who's, going to relent and give us any more rate cuts. So that's as far as the policy is concerned. Let's come to what happens to the banks. For the banks, a rate cut of 50 basis more than expected is actually negative. Why is it negative? Because many of the bank's loans are linked to the repo rate. So immediately, what they get from a home loan, what they get from a corporate loan will all fall. About 30% of the loans are linked to the repo rate, and so they're going to earn less in the coming quarter. And therefore, the margins will fall. Deposits take time to fall. But the CRR cut is very important. What is the CRR? If you have 100 rupees, you had to keep 4 rupees as cash. Now you have to keep only 3 rupees as cash. You can lend 1 more rupee and earn, 7-8% on that. For the banks, if you take the stock of money, they can lend 2.5 trillion rupees more in the system at 7 or 8%. Until now, it is only earning 0. So that means by the time you come to the second half of the year, banks are going to find the cost of their funds low, and it is what you call a money multiplier. Every new deposit, they're going to keep less money aside for CRR, and they're able to lend more. So what it is going to mean is that banks have better and better times. They will see a steep fall in margins in the first quarter, and then a U-turn in the margins by the time the year ends. They exit the year very well. That is if you are a bank shareholder. If you are in an NBFC or real estate company or a shareholder or an auto company, or you're going to buy a car, for all these people, things are really good. Loans are going to get cheaper and cheaper as the year progresses. It's already falling by 0.5%. It's going to fall even more as the amount of money available with banks, goes higher. So there's a lot of cheer. The only caution I would leave on the table is, has the governor come out of the crease a bit too much and whacked the ball? You're exposing all your stumps. If something goes wrong, he has just put all the cards on the table. I would just worry a bit about that, especially because the tariff war goes ugly or monsoons don't live up to the early promise. Then, inflation can play a nasty trick on us. Let's hope all those things don't happen.
Well, the RBI is also set to ease proposed gold loan rules to allow lenders to lend more against the gold. The proposals also include doing away with credit appraisal for small ticket loans of up to 2.5 lakh rupees. Ritu Singh is standing by with more details. Ritu.
Well, gold loan financiers buzzing in trade after the Reserve Bank of India announced further relaxations to its earlier proposed gold loan rules. And those were easier than what the street had feared to even begin with. Now, what has the RBI done? It has essentially eased the loan to value, or the LTV ratio for gold loans, from 75% proposed earlier to 85% for small ticket borrowers of up to 2.5 lakh rupees. This essentially means, let's say if the gold was valued at 1 lakh rupees, earlier, the lenders could give loans of only up to 75,000 rupees, and now with this 85% cap, they can extend loans of up to 85,000 rupees. However, keep in mind that will also have to include the interest component. Apart from this, we heard from the Finance Ministry in very clear words that small borrowers must be excluded from these most stringent rules, and that is exactly what the Reserve Bank of India has done when it said that the credit appraisal will also not be required when it comes to small ticket loans of 2.5 lakh rupees, and the end-use monitoring that will also be limited to gold loans only under the priority sector rules. So this is a whole bunch of relaxations that the Reserve Bank of India has now announced. The biggest beneficiaries, of course, Muthoot, Manappuram, CSB, City Union Bank, that have large gold loan exposures. So this is overall going to boost the gold loans by these lenders. It is going to attract more borrowers and, of course, improve the earnings for these gold loan financiers.
Right, Ritu, thanks so much for that. Now, Governor Malhotra also revealed that the RBI is looking at the rules governing ownership structure of banks. Governor said that the FDI cap currently stands at 74% and there is no plans to change that. However, he also added that the central bank is examining the ownership structure, while also adding that no immediate change to regulations are likely.
हम ये पूरा जो ओनरशिप स्ट्रक्चर है, जो एलिजिबिलिटी कंडीशंस हैं, जिसके अंदर में FFI नॉन रेजिडेंट्स के लिए आज के दिन में 15% है, उस सबको हमको पूरे को एग्जामिन हम कर रहे हैं. वो इमीडिएटली नहीं होगा, उसमें समय लगेगा. ये जो है बहुत डीपर क्वेश्चंस हैं जिनको क्रिकेट की एनालॉजी में जो है 2020 मैच की तरह से नहीं देखना चाहिए. तो वो हम उसको पूरा सोच समझ करके ही क्या हमारे अर्थव्यवस्था के लिए क्या उचित है, उसको ध्यान में रखते हुए.
Shares of IndusInd Bank rose in trade. This after the RBI Governor Malhotra said that the bank has taken enough steps to improve their accounting practices. He said that the bank's managing director and CEO have taken a moral responsibility and have resigned, and also that there should be good enough. This comes after IndusInd Bank declared a 2,000 crore rupee loss, citing derivatives accounting lapses in March of this year.
I think the bank has taken enough number of steps to put their to improve their accounting and other practices. The MD CEO, has resigned, and it says, for taking, moral responsibilities. So I thought, that should be good enough. Do you expect that all the board members? I mean, what are you hinting at? I think the MD CEO, who's also a member of the board, if he has taken responsibility, that is at the board level itself.
Well, on to the day's market action. The Reserve Bank's 50 basis points repo rate cut brought cheer to the market. Frontline indices rose over 1%, with financials witnessing the biggest move. Today's gains helped the market turn positive for the week. The Sensex and the Nifty recorded weekly gains after giving negative returns for the last 2 consecutive weeks. Broader markets outperformed, with the mid-cap index rising 3% this week. And in the money markets, the Indian rupee gained 16 paise against the dollar after the monetary policy. The rupee remains just below the 86 mark against the greenback. 10-year bond prices gained today and the yields softened to 6.2%. Now, competition watchdog CCI is likely to pass an order to initiate a probe against Asian Paints. Sources tell CNBC-TV18 that the probe will be launched based on an antitrust complaint filed by Birla Opus Paint. Parikshit Luthra is standing by with more details. Parikshit, tell us more about Birla Opus Paint's complaint and the issue that they've raised with respect to Asian Paints.
Well, the news that we've just picked up is that the Competition Commission of India is set to launch an investigation into abuse of dominant position by Asian Paints. Now, they are likely to issue a formal order to initiate such an investigation. Now, this complaint was received from Grasim Industries by the CCI on behalf of Birla Opus Paints in November 2024. Since then, a preliminary inquiry had been happening at the level of CCI. They sought more material from Birla Opus Paints and also sought a reply from Asian Paints. So both parties were aware of what was happening. Now, we have been told by sources that the reason why Asian Paints was able to use or abuse its dominant position was that it holds 53% of the installed capacity in the decorative paint segment. It has 1.6 lakh touch points across the country and 74,000 plus dealers. What was Asian Paints actually doing as per the complainant? Now, as per the complainant, Asian Paints abused its dominant position by threatening dealers and telling them that if you dealt with Grasim Industries or Birla Opus, or you served them in any way, or you sold their products, then Asian Paints would reduce the credit limits for you, would deny you contracts, delay supplies, and all of this would be hurtful and harmful for the dealer in the long run. Asian Paints also allegedly delayed supplies and restricted access to tinting machines to warn their dealers. The complainant has alleged that Asian Paints exercised unfair dominance over its dealers to cut off access for Birla Opus in the market. So these are some very strong allegations that are being made. It's happening at a time when Birla Opus is also increasing its market share in the paint sector. Let's see what happens. But net, a formal investigation is now likely to be launched by the CCI very soon.
Right, Parikshit, thanks so much for that. So a formal order for an investigation is expected, is around the corner. Well, moving ahead now, a consortium including Sunil Bharti Mittal and Warburg Pincus is in talks to pick up the stake in Indian arm of China's Haier Smart Home. According to a money control report, the consortium will pick up a 49% stake, with the Chinese parent expected to hold 49% as well. Both parties will exercise joint control going ahead. An official announcement on the proposed transaction is likely this month. And the National Company Law Appellate Tribunal has refused to grant nod to Baiju-backed Akash for a fundraise. The court upheld NCLT's order that had directed for a status quo to be maintained pertaining to Akash's shareholding. Remember, private equity firm Blackstone had opposed any equity fundraise by the company, alleging that the move would lead to erosion of rights of minority investors. Now, US President Trump's alliance with billionaire Elon Musk has imploded in full public view. Both have traded insults on their respective social media platforms through Social and X. Now, since last night, tensions escalated after the US leader expressed disappointment with the Tesla CEO after his relentless criticism of the president's big, beautiful bill on social media last week. Here's a report.
But I'm very disappointed in Elon. I've helped Elon a lot.
The alliance between President Donald Trump and billionaire Elon Musk has quickly disintegrated in a very public breakup.
But I'm very disappointed because Elon knew the inner workings of this bill better than almost anybody sitting here, better than you people. He knew everything about it. He had no problem with it.
Trump started the feud in remarks from the Oval Office on Thursday. Musk then hit back with posts on his social media platform X saying, quote, "Without me, Trump would have lost the election. Such ingratitude." He even said yes to a post that said Trump should be impeached. Trouble between the two have been brewing all week, after Musk on Tuesday started denouncing Trump's sweeping tax cut and spending bill.
Look, Elon and I had a great relationship. I don't know if we're well anymore.
Trump has now threatened to cut off government contracts with Musk's companies, which has led to the billionaire announcing that his rocket company SpaceX will begin decommissioning its Dragon spacecraft immediately. The capsule plays a critical role in the U.S. government space program.
Fight, fight, fight!
Musk has been one of Trump's most visible advisors as head of DOGE, or the Department of Government Efficiency, which mounted a sweeping effort to downsize the federal workforce and slash spending.
And the Department of Government Efficiency is going to fix that.
Their sparring hammered shares of Musk's electric vehicle maker Tesla. A prolonged feud between the two could make it more difficult for Republicans to keep control of Congress in next year's midterm elections.
Meanwhile, U.S. House Speaker and Republican lawmaker Mike Johnson also weighed in on the public spat between President Trump and Elon Musk. He said that he wished that the issues between the two are resolved soon. Johnson also responded to Musk's criticism of the spending cut bill. He said that policy differences are welcome, but Musk shouldn't argue with lawmakers on how to legislate.
I really like Elon. He's a friend. I've come to truly respect his acumen. The Doge effort was heroic, patriotic, helped us find a lot of savings and abuses that Congress was not able to uncover previously. So huge contributions. And look, we can have policy differences. We have that here in this building, every day, but it's not personal. It shouldn't be personal. I don't tell my friend Elon I don't argue with him about how to build rockets, and I wish he wouldn't argue with me about how to craft legislation and pass it. But we've had some good discussion. I thought it was helpful, fruitful, but it's just disappointing. I hope it all resolves today. Look, these are two titans. I respect them both. I'm of course a huge fan and supporter of President Trump. I was with him in the Oval Office yesterday afternoon when some of this was unfolding, and he was disappointed. I was disappointed. I just hope it resolves quickly for the sake of the country.
Coming up on India Business Hour, Prime Minister Narendra Modi accepts an invitation to attend the G7 summit after a phone call from Canada's new Prime Minister, Mark Carney. Details in just a bit. And you can also catch all CNBC TV18's news and updates on YouTube, Facebook, Instagram, X, and Jio Hotstar. Well, staying with Elon Musk, here's a big break for him coming in for his company, Starlink. India's telecom ministry has granted a license for providing satellite communication services. The license was granted after Starlink complied with various security protocols. After OneWeb and Jio, Starlink is the third entity to have secured a SATCOM license. After the license, Starlink also needs to secure an approval from space regulator in space. Meanwhile, the TRAI has recommended administrative allocation of spectrum instead of auctions for satellite communications. TRAI has also recommended a spectrum user charge of 4% of AGR. TRAI has also proposed grant of government subsidy for use of SATCOM services in rural and remote areas. The DOT, the Telecom Ministry, is yet to approve the TRAI recommendations. Starlink recently launched services in neighboring country of Bangladesh with a monthly charge of approximately rupees 3,000 and a one-time fee of approximately 33,000 rupees for the terminal. Well, more action from the insurance space now. The government is considering hiking the motor third-party insurance premium for FY26. Sources have told CNBC TV18 that the government has likely received recommendations from IRDAI to hike the premium and may take a call in 2 to 3 weeks. 2% equity of Bajaj Finserv worth 5,500 crore rupees exchanged hands in a large block deal today. The transaction took place at a little over 1,900 rupees per share. Sources tell CNBC-TV18 that promoters Bajaj Holdings and Jamna Lal Sons are the likely sellers. The sale comes after Bajaj Finserv signed share purchase agreements with Allianz to acquire a 26% stake in Bajaj Allianz. Well, a sign of thaw in strained relationships between India and Canada, Prime Minister Modi accepts an invitation to attend the G7 summit after a phone call from Canada's new Prime Minister Mark Carney. Prime Minister Modi said that both nations will work together with renewed vigour. And in a bid to bolster trade ties between India and the US, sources have told CNBC-TV18 that Assistant US Trade Representative Brendan Lynch is visiting New Delhi for discussions. The US delegation is in India from the 4th to the 10th of June with the Indian negotiating team. Both sides will engage in discussions pertaining to greater market access, reduction in tariff and non-tariff barriers, and enhancing supply chain resilience. Well, there is huge interest in the free trade agreement between India and European Union among our leaders and the business community. That's the word coming in from Commerce Minister Piyush Goyal, who is on a 5-day trip to Europe. Goyal added that there is near complete unanimity among both business and government leaders in Europe to see a fair and equitable deal concluded soon.
All my engagements with different European leaders and business community has clearly demonstrated a huge interest in the free trade agreement with India. This is an agreement whose time has come, and there is almost complete unanimity amongst businesses and governments that they would like to see a fair, balanced and equitable FTA being finalized and executed soon. We are working towards that, and I hope we make good progress very soon.
Now, China's grip on rare earth magnets has left the Indian auto industry in a bind. Sources have told CNBC-TV18 that the government is considering a scheme similar to a PLI to boost local manufacturing. Talks between the industry and the government are currently at a nascent stage, and no formal policy draft is under consideration. And speaking of export restrictions on rare earth magnets, Suzuki has suspended the production of its flagship model Swift. Reports have said that Suzuki is the first Japanese car maker to do so. The automaker paused production of the car since May 26th. Prime Minister Narendra Modi today inaugurated the world's highest railway bridge over the Chenab River in Jammu and Kashmir. The bridge offers all-weather railway connectivity between Kashmir and the rest of India. This visit also marks his first trip to Jammu and Kashmir following Operation Sindoor. Israel has carried out airstrikes in Lebanon's capital of Beirut. The Israel military has said that it was targeting Hezbollah drone units in the southern suburb of the city. Israel's defense minister has said that these strikes were needed to enforce the ceasefire rules between the two countries. Meanwhile, the Gaza Humanitarian Foundation has shut all of its aid distribution points in the Strip again. Palestinians have been told to stay away for their own safety. This comes as the UN reported nearly 3,000 children in Gaza under the age of 5 are suffering from acute malnutrition. And from one war-torn region to another, Ukrainian President Zelensky has said that Russia has targeted almost all of Ukraine in a massive drone and missile strike overnight. Zelensky added that 3 people have been killed in Kyiv. Meanwhile, Russia's defense ministry has said that its air defenses shot down 174 Ukrainian drones. And with that, it's a wrap on this edition of India Business Hour. Thanks so much for watching. News and updates will continue right here on CNBC-TV18.
The Reserve Bank of India's big growth bazooka lifted the Nifty back above the 25,000 mark, while the Nifty Bank soared to a record high. Friday's rally helped Dalal Street end the week in the green on a positive note. On this week's edition of Editors Roundtable, we decode the RBI's monetary policy, put the spotlight on railway stocks, and also take you through the bitter feud playing out between Donald Trump and Elon Musk. I'm Surabhi Upadhyay. With me, as always, Prashant as well as Nimesh. Guys, what a week,
right? Oh.
Thank God it's Friday.
I know. This week looked like let the Friday come. It was really a hectic week.
Conferences,
Conferences,
RBI.
so many blogs, Trump fighting with.
You know what I'm going to do is I'm going to go back to all our episodes and every Friday.
We see the same.
I mean, I think
No, but this time we really felt it. Like this Friday couldn't come soon enough. And when it did, the Friday itself was a bang.
This week also looked big.
Yeah,
because of conferences, blogs, so much happening.
Hectic.
But I think the week itself, I was just doing a wrap for the evening, and there's no point really doing Friday to Friday because I think, the day itself defined the week.
Yeah.
And I think when you think about it, when you come back on Monday, you're not going to look at the whole week, what markets did. You're going to pick off in terms of just where sentiment is, where markets are. And all of that has been defined by the RBI. And maybe over the weekend, if something comes from the US with that phone call, etc. But I think the defining moment, the defining day was really the RBI. And Surabhi, you put that interestingly. It lifted growth. I think it's lifted the Nifty.
Yeah.
Now it needs to lift growth
the actual growth as well.
Growth also.
That's true. So very quickly, just to sort of wrap this up and why Friday became the defining day of the week. It's the RBI bazooka, right? And the central bank decided to fire way beyond the market's expectations. We went into the event with the expectation of a 25 basis points rate cut. What we got, 50 basis points repo rate cut and a CRR cut and a whole host of other measures as well. For instance, for gold financiers, which makes lending easier when it comes to small ticket gold loans. And we'll talk about some of these issues as we go forward. For the market, this has meant that we are right at the top of the recent trading range. 15 trading sessions, the market has been in a band of about 550 points. The lower end has been about, 24,450. The upper end has been 25,116 to be precise, and we are right there. The Nifty is just about 100 points away from that peak that we hit on the 15th of May. The RBI governor, while discussing the policy and why they have done what they've done, he said that the RBI believes that we've won the war on inflation. It's time to put the focus on growth. And we'll get in Lata to sort of explain some of these steps and what the implications could be. Let's talk about the numbers now. For the week, because of Friday, and thank God it was that Friday, we're up 1% on the Nifty as well. But the mid-cap and the small-cap story anyway was firing earlier in the week. And the final tally is looking so good. 3% almost on mid-caps, 4% almost on the small-cap index. And look at the individual pockets. Real estate stocks, of course, a lot of that was Friday because of the policy action. 9% up on the real estate index. Capital market index up almost 8.5%. So you had specific pockets. Defense was patchy, one day on, one day off. But on an individual stock level, there's a lot of action. And finally, the Nifty is now firing up. The bank Nifty, in contrast, is up 1.5%, finally also hitting those all-time high levels. Now, while we're celebrating the RBI move here in India, let's also keep in context that in general, global markets have been completely looking through all the tariff noise, all the headlines, all the skirmishes and the drones in Russia and in Ukraine and the Twitter and the social media barrage. Markets have been going higher, 1 to 1.5% higher on the US. The Kospi is up, 4.5% this week. The Hang Seng is up 3.5% this week. In general, the sentiment in equities seems to be up. And we'll only hope, equity bulls will hope that the non-farm payrolls data that we get later this evening, that Prashant will watch very closely, that just keeps the good sentiment on and it doesn't kind of spoil the equity party.
Yeah, absolutely.
No, absolutely. I think let's bring in Aman Chauhan into the conversation. He's fund manager at Abacus Asset Management. Aman, great to have you with us here. Thank you for your time. Hi. Where will this RBI boost show up most from a stock market perspective? Which today, for example, it was banks, NBFCs, your capital market companies, the Nippon Mutual Fund and HDFC AMC. SBI card was up sharply. So it was all, financials, holding companies for some reason were jumping. But where will the real estate was another? Where will this show up in a big way, in actual way, in a sustained way, durable way? Aman.
I think at least for the next few weeks, it has to be financials, but more so NBFCs than banks. It can also happen in say now mid-sized PSU banks, because you have seen large private banks already moved up, you have seen large PSU banks also moved up. So mid-sized PSU banks, mid-sized bank, NBFCs, that's where I think where the buzz is going to be. Ultimately, what will happen is whatever is not moved up will move up once. Then people will try and realize to which is better way on price to book, ROA, ROE. That will all come subsequently. But for now, once whatever is not moved has to move up once. So today was the first day. I expect something similar to continue next week also.
You know, Digant Haria Aman was with us, and he was saying that banks, institutions with weaker liability franchises, and he named a few names also, RBL and Indocent and Yes, etc. These may benefit disproportionately, and these are also, I think they also kind of fit what the criteria you mentioned, things which have not done very well in that sense. You talked about PSU banks. Would you agree?
These are more of catch-up trades because for a genuine and justified reason, they are all trading below book, right? But now, when everything else is now moved beyond book, you want to have a relative trade. So in that relative trade, all this fits in. So the mid-tier PSU banks, RBLs, and independent banks of the world, they also see and you can say push up. So it's like tide lifting all boats. So the bigger boats are already there. The smaller boats are now going to follow.
Okay, big boats and smaller boats, but they're all going to go flying, as Aman put it. Aman, coming back to you, but let's go across to Lata now, who in the morning was telling us this is a preview that maybe we should expect fireworks, and I think fireworks is what we've got. Lata, over to you.
Well, since this is RCB week, let me start with some cricket analogies. The governor actually came out and batted like Josh Inglis, didn't he? I mean, who expected so many sixers? A double rate cut, 50 bips, and a 100 bip CRR cut. I can't remember when we last got a 100 bip CRR cut. Was it during the Lehman crisis or something? Even last November, Shaktikanta gave us only a 50 bips. So that was like really mind-boggling innings. But then he just got converted himself into, what do you call it, Rahul Dravid? I know that's my times. So, but just went back to the crease, as it were, and changed the stance from accommodative to neutral. So what does this mean? It doesn't mean more cuts. It means the August cut has been advanced to June. That's the only way you can read the word neutral. And also, neutral should more likely mean that there are no more rate cuts. You know, there is the chances of a further rate cut and taking the repo to 5.25 now drops very steeply, because I specifically asked the governor that, and he said, you know, you may have a 3.7% inflation cut now, but next year it is 4.5%. So that is exactly what the market wanted to hear. If your inflation, if you are looking at the inflation at 4.5%, then you have to add that 1.5 positive real return. Then you are at already at 5.5. There is no further scope to cut rates. So chances are the market will get used to that idea. That's about bonds. So the bond rally kind of peters out. Because of that, it kind of, has to stop over there. The other important point that he made is the impact on banks. That's the CRR cut. Immediately, the repo cut is what comes into effect. CRR comes into effect from September. The repo cut of 0.5% not expected, which means about 30% of the loans of every bank suddenly gives you 0.5% less. So it's going to be a bad first quarter for banks as far as their margins are concerned. But it starts improving. Because once the CRR cut starts factoring in, then, your cost also becomes cheaper. And as the year goes by, all your deposits start getting repriced. And therefore, banks are likely to exit the year with a very good margin. What the SBI chairman very beautifully put up as a U-shaped curve as far as the margins are concerned, fall and then rise just as dramatically. That's the story on banks. Exit FY26, very good. And for the rest of the market, the interest rate sensitives, NBFCs, real estate, those depending on consumer loans, even autos for that matter, I think it's a very, very good deal indeed, because we are going to see retail loans actually, getting cheaper and cheaper as the year goes by.
No, absolutely. Lata, thank you very much for that. And I think, important to set the context as Lata did. more money in the hands of the consumer, hopefully, which will come back into the economy. Let's just talk about the other thing, right? Which is sectors which have been zooming higher with regards to what we've seen in the market. Defense is one, and we've spoken about this quite a bit. But the other is railways. And Nimish, you've looked at this in some detail. What have you found?
Last 1 month, all the railway stocks have been buzzing. Even if you look at the valuation, they look very punchy. But the bigger thing is, if you look at the last 2 years of growth, that is what will surprise the market in a negative way. I'll just go to the wall and explain why I'm saying this. So let me put the data on the wall. If you look at the railway stocks in the last 1 month itself and the kind of rally the railway stocks have done, the chart will come up for you. In the last 1 month, all the stocks have been buzzing in the last 1 month or so. IRFC, Ircon, Railtel, RITES, RVNL. Look at the kind of move in the last 1 month, all in double digits, between 25% to 45-50% as well in terms of the 1 month move. But having said that, they're still down from the peak between 30 to 40%. So they've not hit the peak yet, what we saw earlier this year. But the rally has been pretty sharp in the last 1 month. But the question is the valuation. Now, if you look at the valuation chart for all these names, look at the valuation of all these companies. Ircon is sitting at 28 times 1 year forward versus the 5-year average of 15 times. Railtel is at 47 times now on 1 year forward. RITES is at 34 times versus the 5-year average of 21 times. And RVNL, which is the new entrant in the F&O, that is now trading at 60 times on 1 year versus that 5-year average of just 12 times PE. So that's the valuation picture. Next, the table which is going to come, that's going to surprise and shock a lot of investors. Look at the kind of growth these companies are reporting. On a sales, this is a 2-year sales, profit and EBITDA CAGR. Ircon, just 2% sales growth, negative profit, as well as just 9% or 10% EBITDA growth. Same is the case with IRFC as well. Look at the numbers, 3% sales growth to almost 3% profit CAGR and nothing for EBITDA. RVNL, the stock has been a big mover in the last few months. It's been a negative growth over the last 2 years, and the stock is quoting at 60 times. So that's what I wanted to explain, that earnings have not been supportive in many of these companies. The only stock or only company which has done relatively well is Railtel. That has consistently outperformed in the last 2 years in terms of sales CAGR of 33%, profit CAGR of almost 30-odd%, and EBITDA CAGR of 17%. Even RITES, for that matter, in the last 2 years, it's been a negative. In fact, there has been a degrowth, and the stocks have been buzzing. So, just to put into context, while we've seen a big rally, the valuations are quite punchy, the earnings are not very supportive, and that is what investors should watch out for. There is a bit of exuberance in the PSU basket, even in the rail basket, but when you look at the numbers, it shows you that it's not all good as far as the numbers are concerned. The last 2 year CAGR for someone like RVNL has been negative. Stock is at 60 times and quoting at almost 90,000 crores of market cap. So again, it's for viewers to just take a bit of an informed call that not everything in railway or not everything in PSU is going to do well. And just look at the numbers, and that's a bit of a shocking number that many of them have not grown for the last 2 years.
I'm glad you picked this up, Nimesh, because indeed, the fact that the railway rally started is really perplexing, because it's not like we've seen some mega bids or any order announcements or order wins this week. Let me throw this to Aman.
In fact, just to add to this, even the railway budget, or in the budget, the capex for railway is pretty much been flat for the last 2 years. There has been not incremental new capex that the government has announced.
Yeah.
And look at the kind of valuation these companies are quoting at. I was surprised with RVNL's entry into the F&O market. The stock is in the F&O from this series, 60 times flat growth or a negative growth, and 88, 90,000 crore market cap. I mean, it's really surprising that people are still looking to buy into this. And I missed out the last part on the retail participation in all these companies in last 2 years. The only segment which has seen an increase in the shareholding is all the retail investors.
Yeah,
so from that perspective, one needs to be a bit careful.
Nimesh, you mentioned that Kotak, there's a Kotak note as well.
There's a Kotak note as well. I've picked up.
Is there anything on defense in there? Because
not really. This was on railway. But Prashant, that's what maybe I'll work on that as well. So again, initially what I wanted to do was look at all the PSUs and classify into 3 different buckets. Something which has done well but supported by earnings. I think defense to some extent will be backed by earnings as well. Okay, but there are some pockets which are just buzzing, just going up because of the euphoria, without backed by real solid earnings growth.
So actually, let's throw this to Aman. Aman, both the sectors, one by one, if you can. Let's start with railways. Defense, like, Nimesh is also pointing out, some numbers are very good, some like Mazgaon were disappointing. But let's get back to railways. I mean, did you make any head or tail out of the sudden interest in railway stocks? What's your own, take and positioning on them?
As you rightly said, it's more of retail frenzy in this segment than any institutional frenzy. And I guess what could be the reason was that 1 year back, the segment that was doing well was defense and railways before the market started to correct. Right now, the defense has come back. For the retail guy, he is now feeling that defense has already performed, that has bounced back. Now it is time for the railways to come in. I believe that could be the only reason. Because first, rightly so, it's as Nimesh mentioned, valuations are stretched. There is nothing much exciting happening there. There is no news, there is no event. Besides the only fact that maybe it's a catch-up rally after defense.
No, absolutely. And I think that's the only rationale that I could think or come up with as well. I mean, nothing else in terms of news flow. On defense, because there's a big debate now, on defense. I mean, brokers like Kotak, for instance, are raising the red flag on, for instance, some of the shipbuilding stocks, saying that, what really is going to be the EPS CAGR. What's your thought? What do you still like here, and what would you completely avoid?
The EPS CAGR or near-term earnings is still next 2 to 3 years what you're factoring in. When somebody's defense stock is back, factoring the macro story that India wants to reduce import dependence, now with a very hostile equation with the neighbors, the defense spending will go up. Even if the spending doesn't go up, the urgency goes up. So what we wanted to do in 3 years, now we want to do it in 2 years. So near term, the base effect of the earnings growth comes in. That the people are buying for these reasons. They're not buying for immediate EPS growth, because anyway, whether they're shipbuilders or it is a large BL or a HAL kind of thing, when you deliver is when you make the maximum margin, and the delivery is 2, 3, 4 year cycle, right? So nobody is looking at the near-term earnings that way. So defense is more of a top-down macro approach, that this is the government focus. We are forced to spend more, forced to spend fast, and just import substitution means that these companies can still be 2 to 3x of what the current size they are. And that's what the opportunity is, that's what the excitement for defense is. I don't think anybody is buying for the next quarter or for the next year.
No, fair enough. But I mean, do valuations still offer some support? Even if you take a three-year view, got it? I mean, these are lumpy businesses. These are very large orders that take time to execute. But do the valuations still leave something on the table?
Not much. We don't own most of the defense names that got discussed. So that will give you an answer.
Defensive on defense. That makes sense. Aman, we're going to take a quick commercial break here. We're going to come back and continue this conversation on the other side. Stay tuned.